Yes, everyone. So, hello, hi, namaskaram, and good morning, students. I hope you guys are having a crazy, amazing day. If not, let us make this a crazy, amazing day, my dear warriors. The chapter which you've been waiting for from a really long time is finally here. I've heard so many students tell that derivatives and IRRM chapters are very difficult for the examination. Sir, we are going to skip this in option. Wait, do watch this revision video at least for the first 2 hours. We will ensure that you guys understand derivatives, we understand the concepts, we understand the logic, we solve master example questions so that we prepare you for your examination in the shortest possible time. So, two chapters we will be covering here is the chapter of derivatives as well as interest rate risk management. Okay, now before at the very outset, couple of things which I want to give you guys as a intro. Based on that, we will go ahead. First, this is going to be applicable for CA Final AFM as well as for CMA Final SFM students. All the topics are going to be applicable for both the students. Point number one. Point number two, this is going to be rocket revision. Now, understand, students, this is going to be a quick rocket revision of the chapter derivatives and IRRM on the assumption that you guys already have a small basic idea. You guys have already listened to the chapter once. If you are a student who is listening to the chapter for the very first time and absolutely doesn't know anything about derivatives or IRRM, you may feel the pace is too fast. Accordingly, you can adjust the pace. Is this clear, everyone? Point number one. Point number two, the intention is rocket revision. Now understand, derivatives plus IRRM. The regular batch approximately will take 50 hours. Exam oriented batch will be coming to approximately 40 hours. If I'm taking a fast track batch, that will also come to 30 hours. That much content is there. If I want to put a detailed revision wherein all the concepts properly in a detailed way will explain everything, that will also come to approximately 15 to 18 hours. Now, here the intention was approximately in 7 to 8 hours, we wanted to cover both the chapters by trying to explain maximum concepts in a quick rocket revision way so that you can revise it once, you can revise it multiple times, you can refer to it any point in time you want, you can refer to it even one day before examination. That is going to be the intention. So with that pace we have explained, it is not going to be that I'll be explaining things very slowly. Boss, this is not going to be regular batch. Is this clear? So if any student is watching this video, if he is a first time learner, will he understand things? Yes. But boss, the pace is going to be very fast. You might have to repeat and listen to it again. Is this clear, everyone? Okay. Now, yes, so many amazing, crazy files. Yes, revision files, audio revision files, quizzes. Yes, for CA Final AFM, similarly for CMA Final SFM, SCM. Yes, are available on our Telegram group, Think with Tabish. So before proceeding further, I want you guys quickly pause and go to our Telegram group, Think with Tabish. So many amazing resources you will be finding it there. Yes, AFM theory notes will be finding, summary charts will be finding, so many multiple resources you'll be finding. So quickly pause, go there, join the group, and then come back and proceed further, my dear students. Okay. Next, one very important thing. We have seen that so many students are watching, taking a benefit. These two were the chapters which were most demanded, most requested by students. Based on your request, we are coming up with a detailed revision series for these two chapters. Now, one thing I want you guys to do in return, boss, till now you have come, you guys know the quality we are giving, still you have not subscribed. Shantam Papam, very, very bad. If you do like that, you will not be getting marks. Sir, what is this, sir? Subscribe to the channel. Please do like the video. And only if you get information, you clear your examination, you become CA, you don't help your friends only. What is the point now? So do share it to all your friends. Tell them crazy Maja classes come for derivatives and IRRM. So please do share it to all your friends as well. Now, one simple request which I generally place before our students. We have voluntarily turned off monetization for all our education related videos on YouTube. Why? We had a very simple intention. All these marathons that we are uploading on YouTube, it is to help you guys in the examination. Monetization is on. Every 20 minutes, an ad keeps coming. It will keep disturbing your learning. And again, once that ad comes, you will try looking at something else. You will get distracted. That is why we have kept monetization off as a policy, because we really genuinely want to help you guys prepare well for your examination. But boss, there is a flip side, a disadvantage of turning off the monetization. Sir, what is it, sir? You will not be getting the money. That's not going to be a big deal here. Yes, the big issue is if the monetization is off, YouTube will not be promoting such a video. Sir, why, sir? Because if monetization is on, Now, what is YouTube? Is whether YouTube is a video sharing platform? No, YouTube is a ad generating business company. So what YouTube wants to do, YouTube wants you to put a video so that it can run ads on that video. Accordingly, it will make money, it will give you a share. If I have turned off the ads, if I have disabled the ads, it cannot be playing ads, it cannot be getting money, so it will not be sharing the video much. So what I want, we are at a disadvantage because we have turned off the monetization. So what I want our students to do, yes, please do watch the classes. Yes, if you enjoy the classes, if you love the classes, yes, for you guys itself, you've turned off the monetization. So what I want you guys to do is, please do share it to your friends as well. Yes, please do put in your valuable comments. Tell that crazy maja lecture it is, so that when new students get to know, they get to know the quality of the classes that we are providing. Yes, please do like, please do share it to all your friends and tell crazy maja lecture is there. Please do watch macha. Yes or no, everyone? Okay. Now, if you want to purchase the best quality classes for CA Final AFM or for CMA Final SFM or SCM, yes, I'm handling these subjects. You guys know exactly where to go. You can visit our website www.thinkwithtabish.com. The best class, the entire subject of AFM, SFM, SCM in case of CMA. We will be understanding conceptually, logically, without having the need to by heart even a single formula. Trust me, students, the entire subject of AFM, SFM, we will be understanding without even touching a single formula. Logically, in a structured way, using simple, relatable stories, we will go on understanding. So if you want to purchase, it is available at the best possible rate. Okay, you guys can visit our website thinkwithtabish.com. Now, again for CA final students, group wise combos are available from the best faculties in India. Additional discounts are also available for the entire group combo. Additional discounts are available. Mentorship support is available. So, if you want to study or your juniors are looking for guidance, please do suggest about our website as well as classes. Is this clear, everyone? Now, one final thing. Now, some students from North India were suggesting that I start up taking classes for AFM in Hindi as well. I am reasonably fluent in Hindi and I want to take classes in Hindi as well. I want to know if we have students who want to listen to the classes in Hindi. So if you are a student from North India, plus you want me to come up with revision series in Hindi, AFM revision series in Hindi or regular classes in Hindi, please do put a comment AFM classes in Hindi or SFM classes in Hindi so that I get to know we have students from the north as well who are eagerly waiting for our classes in Hindi so that accordingly I will plan my things. Is this clear, everyone? So this is going to be a quick introduction that I've given. From here onwards, we have recorded beautiful classes for derivatives as well as IRRM, where all concepts as well as master example questions as well as super 100 questions we have covered, my dear students. So from here onwards, we will start playing that. So please do have a look at the same. Do share, like, enjoy, have a great learning experience. Take care. Bye. So with this quick short introduction, shall we start with the discussion, everyone? Yes, everyone. So in three, two, one, let the maja begin. Yes, everyone. So we are going to start with the chapter derivatives. So quickly, directly, let us start. So what exactly is derivatives? There is meaning, definition, all those things are not important. In very simple terms, this is our understanding. It is an agreement between two parties. Two parties to buy or sell a specified asset. What is happening? To buy or sell a specified asset at a specific future date. When are we buying or selling? At a specific future date at a pre-decided specific price. Basically, there is a transaction which is happening in the future, but you're having a fear price may go up or price may fall down. So you're locking the price today. This is a derivative contract in the simplest of the terms. I'll give you guys a very simple story. Let us take the main character of this chapter, which is the legend from Ongole. Yes, Shri Koti Reddy. Now, Koti Reddy is one of the students of our CA final AFM face-to-face batch. Now, imagine, students. Koti Reddy fell in love. His parents, her parents agreed. So, in 1 year, they are getting married. So, in 1 year, he is getting married. So, for that purpose, he wants to purchase gold as a part of wedding ritual. Now, Koti is analyzing the gold prices. 2 years back, the gold price was 9,000 per gram. 1 year back, it was 10,000 per gram. 6 months back, it was 11,000 per gram. Today, the gold price is 12,000 per gram. Now, Koti is getting married after 1 year. So, he wants to buy gold after 1 year. Because he is having a fear. Boss, see the way gold price is going up. He's having a fear. In 1 year, gold price will go up and reach 15,000, boss. So tell me, if today only he is buying gold, imagine he wants to purchase 100 gram gold. Total, how much amount he has to pay? 12,000 for 1 gram into 100 gram, 12 lakh. But imagine, does he want gold today? No. Does he have cash today? No. He wants to buy gold after 1 year. After 1 year, as per Koti's expectation, if he is buying gold after 1 year, it will be 15,000 per gram. So as per that, for 100 gram, how much it will be? 15 lakh he has to pay. Today, if he is buying 12 lakh, after 1 year, he is buying 15 lakh. Because he is having a fear that price will increase. Now, what he can be doing, that is what we'll try understanding here. Is this clear, everyone? So he is having a fear that after 1 year, the gold price will go up. He wants to purchase gold after 1 year only. But boss, he wants to lock the price today. For that, he will be entering into a derivative transaction. Is this clear, everyone? So understand what is a derivative. It is an agreement between two parties. Okay, two parties are there, buyer and seller. Buy or sell a specified asset. In this example, the specified asset is gold. At a specified future date, we are locking after 1 year, we want to buy gold. At a specified pre-decided price, which is locked today. Today itself, we are locking the price. Let me introduce one more character here. Okay, Koti wants to buy 100 gram. Yes, if he is buying today, means it is going to be 12 lakh. If he is buying after 1 year, means it is going to be 15 lakh as per his expectation. Yes or no, everyone? Perfect. So, investor Koti wants to lock the price today for a transaction which will happen in the future date. How can he do that? He can use a derivative instrument. Now, one more character, let me introduce. Sir, who is this character, sir? This is me. Imagine. I decided once and for all that we are going to quit teaching. Sir, why, sir? What happened, sir? No maja only in life. Da. Okay. With so much difficulty, we are taking revisions on YouTube. Trust me, I'm having cold, cough, a heavy head, all those things. Despite that, we are taking revisions. Students are watching, students are enjoying, they are taking benefit also, but they're not recommending to friends. Till now, they have not even liked the video. They have not put their valuable comments. What is this? The very bad Shantam Papam. I can see till now you have not even subscribed to the channel. Subscribe quickly. So I decided once and for all we are going to quit teaching. So then what is it you're planning to do? I decided we are going to start Maja Gold and Diamonds, a gold shop. Is this clear, everyone? Okay, perfect. This is me. We have started with the business. Now try understanding. Koti comes to me. Koti is my student. He is coming to me. He is telling, boss, I want to purchase gold. Right? Today, the spot price of gold is 12,000 per gram. Yes. How much grams you want to buy? 100 gram. That means 12 lakh. He is telling, no, boss, I want to buy after 1 year. I will tell, come after 1 year. He is telling, no, boss. I want to purchase gold after 1 year, but rate I want to lock today itself. Oh. In that case, we will be using a derivative instrument. Is this clear, everyone? So when do we use a derivative contract? We want to purchase or sell an asset at a future date. The price we want to lock today itself. Is this clear, everyone? Yes, sir. So now understand. So I will tell Koti, okay, boss, understand that there are altogether two different markets. One is the spot market or the cash market. He's asking, sir, what is spot market or cash market? I'm explaining. Yes, it is a market where transaction is happening at spot. Imagine today you want to buy gold. Today only you will be making payment. He is telling, yes, sir. Today's rate only will be using. He is telling, yes, sir. It is called a transaction in the spot market. Is this clear? I'm telling simple. Today's price I will be using 12,000 per gram. You want 100 grams, 12,000 into 100 grams, 12 lakh. Yes, you pay 12 lakh. I will give you 100 gram gold. Story over. I am happy. You are happy. Story over. Is this clear? It is called spot market. Spot market means transaction is happening today. I am using today's rate. Settlement is happening today. Every story got over. Is this clear, everyone? They want to buy gold today. I am using today's rate, full payment. It is called spot market or cash. I am telling, boss, there is one more market called the derivative market. Yes, where what is happening is, yes, you want to buy gold in future, that is after 1 year. He is telling, yes, sir. Yes, but you want to lock the rate today. He is telling, yes, sir. Yes, I will tell, it is possible. We will do that. Yes, I will give you that after 1 year, you can purchase gold at 12,500. So what is happening? I am telling Koti, okay, Koti, look at this. Today T is equal to 0. The spot price of gold is 12,000. Yes, we are entering into a transaction today. But after 1 year, Koti wants to purchase gold 100 grams of gold. Yes, I give him a promise that you can purchase 100 grams of gold after 1 year at 12,500 per gram. Now, after 1 year, irrespective of whatever is the price, whether 1 gram gold price is 100, 200, 1000, 10,000, 1 lakh, 10 lakh, 1 crore, 15,000, 10,000, 8,000, whatever it is, zero. After 1 year, I am promising him, I will sell him 100 gram gold at 12,500 per gram. Koti is promising that he will buy 100 gram gold at 12,500 per gram. Is this clear, everyone? This is a derivative contract. Tell me what is happening in a derivative contract. It is an agreement between two parties. I am there, Koti is there. To buy or sell a specified asset. Yes, the promise is to buy or sell a specified asset. In this example, it is gold. At a specified future date, we are promising after 1 year this transaction will happen. At a pre-decided price. Boss, we have pre-decided. Today itself we have decided that after 1 year, gold will be bought or sold at 12,500 per gram. Basically, we are locking the rate today for a transaction it will happen in the future. Yes or no? After 1 year, buying or selling of gold will happen, but today itself we have locked the price. So in future, irrespective of whatever is the price, the transaction will get settled at 12,500 only. Is this clear, everyone? Yes. I am telling Koti, okay, boss, we can do that, but you will have to be depositing some margin. He's asking, why, sir? I'm telling, after 1 year, imagine the gold price becomes 15,000. That means if you are buying directly, you have to pay 15,000 per gram. But you are having the contract with me, you will come to me and purchase it at 12,500. He's telling, yes, sir. But imagine after 1 year, the gold price is 10,000 only. That time you will run away. How will I track you? It is not possible. So do one thing. I am giving you the right. After 1 year, you can purchase gold at, you will purchase gold at 12,500 per gram. Deposit some margin money with me as an advance. Is this clear, everyone? I am just setting up a story. Through that, we'll understand all the concepts. Pay attention, everyone. So this market is called the derivatives market. In trading terms, it is called the F&O market, futures and options market. Is this clear, everyone? Perfect. So I give him a quote of 1 year forward rate of 12,500 per gram. Now tell me, for a buyer, for Koti, he is happy. Why? Because in his mind, after 1 year, the gold price will go to 15,000. So he's telling, after 1 year, if I'm buying, I have to pay 15,000. But this person is promising me that he will allow me to buy at 12,500. So he is happy. Yes or no, everyone? I am the seller. I am also happy. Why am I happy? Point number one. Firstly, I've locked the customer. After 1 year, he'll come to me and only buy. Second, yes, I think that after 1 year, gold price will not increase. I am thinking, yes, already in the last 2, 3 years, gold price has increased. So from here onwards, it will not increase. 12,000 it is. Either it will fall down or be in 12,000 range or maximum 12,300, 12,400 it will be there. That is my expectation. So I'm thinking, anyways, I have locked him at 12,500. Is this clear, everyone? Perfect. Now understand, for a derivative transaction to happen, the most important thing is two people with opposite mindset. 40 is thinking the price of gold will increase. I am thinking the price of gold will decrease. There should be two people with opposite mindset. Only then a derivative contract can be entered. Is this clear, everyone? Sir, how can it happen, sir? Two people are having different opposite mindset. Always it will happen in the world, boss. Simple. Imagine there is a share, Reliance share, it is trading. Suppose today Reliance share is trading at 3,000 rupees. Person wants to buy the Reliance share. Why is he buying? He wants to buy because he's thinking, boss, in future this share price will go up. Now it is at 3,000. In 6 months or 1 year, it may reach 5,000. So he's thinking the price will go up. There is a person who is selling the share. Why is he selling the share? Either he is in need of money or he's thinking, boss, Reliance share already has increased so much. It has reached 3,000 right now. From here, it will not increase. From here, it will fall. So one person is thinking price will fall. Other person is thinking price will increase. Only then transaction will happen. Any given day, you see transaction is happening because two people are having opposite intentions. Is this clear, everyone? Okay. Till here, things are clear. Any doubt, students, give me a confirmation. Yes, everyone. So we put some additional details so that we can lock the contract. Yes, we finalize on the 1 year forward price. That is, after 1 year, transaction will be settled at 12,500 per gram. Yes, I'm asking total how much grams you want to buy. He's telling total 100 grams you want to buy. Yes, I tell him the initial margin is going to be, initial margin means how much money he has to deposit. Koti has to deposit with me. Is going to be 10% of the contract value. It is a total value. Tell me, after 1 year, what is the promise? He will buy gold at 12,500 per gram. Yes, boss. Total how much grams he wants to buy? 100 gram. That means after 1 year, total how much he has to be paying? 12,500 per gram into 100 gram, 12,50,000. This is called the contract value, total value of the contract, total value of the transaction. Okay. I am telling him, give me an initial deposit. It is just a deposit. It is not cost, just a deposit. Is of 10 percentage. Tell me 12 lakh 50,000 is there, 10 percentage of that. 1 lakh 25,000 Koti has to deposit today. After 1 year, he will come. He has to pay the balance payment, irrespective of whatever is the gold price that day. I will give him 100-gram gold at 12,500 per gram. Is this clear, everyone? Okay. Now, one very important thing we should be knowing is, in case of derivatives, transaction will always happen in lots. Is this clear, everyone? Derivatives is not for small, yes, jujube people. Yes, it is always happening in lot. Simple example. Scotty is coming and telling after 1 year, I'm having a fear that gold price will increase. So I want to lock the price today. I told okay. Yes, I'm asking total how much gram gold you want to buy. He's telling 1 gram gold I want to buy. What will I tell? Get lost from here in the first place. Because we are entering into a derivative transaction to hedge your risk. Fine. Boss, in 1 gram, how big a difference will be there? Yes, for 1 gram, small GGB things, we are not going to enter into this transaction. If you are having a big transaction, only then we are going to do it. Is this clear, everyone? You would have seen. Yes, for big customers, they give premium services. So this is a premium service only for big customers. Is this clear, everyone? So there will transactions in derivatives will always happen in lots. Imagine I am telling, boss, you cannot be buying 1 or 2 grams. Minimum one lot you should be buying. One lot is equal to 10 grams. Okay, fine. So tell me, Koti wants to purchase after 1 year how many grams of gold? 100 gram of gold. That means tell me how many lots or how many contracts Koti should be entering into. Simple, boss. One lot is 10 gram. He wants to purchase 100 gram. That means he has to enter into 1 lots. Yes or no, everyone? Imagine Koti wants to purchase 105 gram. One lot is equal to 10 gram. 105 gram is how many lots? 10.5 lots. Tell me, is it possible to enter into 10.5 lots? No. Then Koti has to decide. Either he will enter into 11 lots or he will tell for 10 lots I will enter. Balance 5 gram that day, whatever is the price I will purchase. Yes or no, everyone? Okay. So now once this is over, both of us will write down a contract. Yes, I will write down. I promise to sell 100 grams of gold. That is 10 lots of gold, every lot being 10 gram each, after 1 year at 12,500 per gram to Koti. Koti will be entering into promise. I promise to purchase 10 lots of gold, every lot being 10 gram each, at 12,500 per gram after 1 year. Both will enter into a contract, sign. Okay, this deal is finalized. Is this clear, everyone? Till here, things are clear. Yes, boss. Now comes a settlement. Settlement also we will see. After that, the basics quickly in one single shot we will see. Now, settlement in case of derivatives will happen in one of the two ways. Either settlement will happen through delivery or we will be having cash settlement. Generally, in practical life, cash settlement will happen. But for understanding, let us see both the things. First one is settlement by delivery. Okay. We entered into a transaction after 1 year. Assume the actual price of gold is 15,000. Now you'll have to see from both people's lens. First, see from Koti's lens. Koti had promised to buy gold. Tell me, students, if he had not entered into the derivative contract, okay, how much he had to pay? On that day, he had to purchase gold in the spot. Today, the spot price is 15,000. So he had to pay 15,000 for 1 gram. So for 100 gram, he had to pay 15 lakh. Yes or no, everyone? If there was no future, he had to pay 15 lakh, which is basically 15,000 per gram. But because he is having a future, he can come to me and he can show the contract and tell, boss, you have promised that you will sell me gold at 12,500 only. Take this 12,500, give me the gold. So I have to sell him. Yes, because of future contract, because of a forward contract, because of a derivative contract, how much only he is paying? 12,500 only he is paying. So tell me, students, if there was no derivative, he had to pay 15,000. Because the derivative is there, he is paying 12,500 only. That means, is he happy or sad? Sir, he is extremely happy, sir. Why? He has saved 2,500. Yes or no? So he is having a profit of 2,500. Is this clear, everyone? Just a simple gist. Now tell me, for me, I am the seller. I promised him that I will sell him 100 gram gold at 12,500 per gram. Tell me, I have promised to sell him at 12,500. So now I will be selling him at 12,500. But if we assume there was no future contract, after 1 year he would have come to me. Yes, he would have purchased from me only. Tell me if he would have come without a future contract, at what price I would have sold it to him? I would have sold it to him at 15,000 per gram. Yes or no, everyone? Perfect. So tell me, if there was no future contract, for every 1 gram, I would have received 15,000. Boss, because future contract is there, I am receiving 12,500 only. Tell me, if there was no future, I would have received 15,000. But now I am receiving 12,500 only. Am I happy or sad? Sad. Profit or loss? Loss. I am having a loss of 2,500 for every month. Is this clear, everyone? Now, one more very important point that we should be knowing. Always, derivatives is ultimately a zero sum game. One person is making a profit, other person is going to make the exact same loss. Tell me, Koti made a profit of 2,500 rupees. I incurred a loss of 2,500 rupees. Yes or no, everyone? That is for 1 gram. Total it is for 100 grams. So 2,500 into 100 is going to be 2,50,000. Is this clear, everyone? Okay. Now imagine after 1 year, the gold price is 11,500 only. Tell me, yes, we have both promised that after 1 year we will be, yes, buying or selling gold at 12,500 per gram. So tell me, Koti now has to pay how much only? He has to pay 12,500 only, irrespective of whatever is the price. So because of future, for every 1 gram, how much he is paying? 12,500. But if there was no derivative, how much only he would have paid? That day he would have gone to spot market, asked the person, Macha, how much is the rate? He would have told 11,500. He would have paid 11,500 only. So tell me, if there was no derivative, he would have paid 11,500 only. Because there is a derivative, he is now paying 12,500. He is paying 1,000 rupee extra because of derivative. Is he happy or sad? Sad. Profit or loss? Loss. How much is the loss, students? How much extra he paid? 1,000. So the loss is going to be 1,000 per gram. Yes or no, everyone? Now tell me from my perspective, either I can tell the profit is 1,000 without doing the calculation, or tell me, students, if there was no derivative contract, Koti would have come, he would have purchased 1 gram gold from me. I am the seller. How much he would have paid? 11,000. But because we entered into derivative, now irrespective of whatever is the price, he has to pay how much? 12,500. So how much extra I am receiving? 1,000. So my profit is going to be 1,000. Look at this. His loss is 1,000. My profit is 1,000. Is this clear, everyone? So derivatives is a zero sum game. So profit of one party is equal to the loss of the other party. Is this clear, everyone? Now, what exactly is a settlement by delivery? Settlement by delivery means on the settlement date, that is on the expiry date, the party will come, take the physical settlement, physical delivery of the asset. Yes, Moti is actually by coming and he is buying, yes, 100 gram of gold. So he is making the payment. Yes, I am actually selling 100 gram of gold. I am receiving the payment. This is clear, everyone. There is one more way, which is going to be the cash settlement. What is cash settlement? Here, yes, there is no delivery happening. Just the cash differences are being settled. So what exactly is it, sir? In simple terms, I'm telling. Now, imagine. Multiple different interpretations can be there. I will just show one quick interpretation and then we'll proceed further. Now, pay attention. What is happening is, yes, this is Koti. This is me. Yes, we have entered into a derivative contract at 12,500 per gram. Yes or no? Imagine after 1 year, yes, the price is 15,000. So tell me, what is Koti telling? Whether Koti is happy or sad? Koti is happy. Why? If there was no derivative, Koti has agreed to buy gold at 12,500. Tell me, because of the derivative, he is now having the, yes, he is buying gold at 12,500. If there was no derivative contract, how much he had to pay? He had to pay 15,000. So tell me, how much money did he save? 2,500 he saved. So can I tell he has made a profit of 2,500? That means, tell me, I would have incurred a loss of 2,500. Yes or no? Perfect. Yes, I have promised to sell him at 12,500. Otherwise, I would have received 15,000. So for me, it is a loss of 2,500. Now, either one option we can do is, Koti actually wants to buy gold. So he is paying 12,500 and giving him 1 gram gold. Or second option is going to be cash settlement, wherein I'm telling this. This is a simple transaction. Yes, I have incurred a loss. Yes, I am paying Koti 2,500. You do whatever you want. Now, different things can be possible. Imagine Koti is a speculator. He did not have to buy gold only. Chumma, he was speculating on gold price. He was doing a betting on gold price. He won. So he received 2,500. He will go back home sleep. Or imagine he actually wanted to buy gold. Now what he will do? I paid him 2,500. Perfect. Now what Koti will do? Koti will go to the gold shop. Koti will tell, I want to buy 1 gram gold. How much will the gold shop owner quote? It is a completely separate party. He's telling you have come today. Today's price is 15,000. You pay me 15,000 for 1 gram. Koti will pay 15,000 for 1 gram. But tell me, he had entered into a derivative contract with me. In that contract, he made a profit of 2,500. So even though he is paying 15,000, yes, in the 2,500 is my money. That means effectively how much cost only he has incurred? 12,500 only cost he has incurred. So effectively he has locked his cost. Yes or no, everyone? This is going to be cash settlement, multiple different things I can be interpreting in the regular batch, 6, 8 different variants of interpretation I've told, but here we are not discussing any of those things. Is this clear, everyone? Okay. Now, long short, yes, when the time comes we will discuss. Now if this is clear, now we will have a look at the concept notes quickly, my dear students. Pay attention, pay attention, pay attention. The meaning, the basics is the most important, because 90% students don't know what is happening. Okay, what is derivatives? It is an agreement between two parties. Quote and me, agreement between two parties to buy or sell a specified asset. Yes, in our example it is gold, at a specified future date after 1 year at a pre-decided price. Boss, today itself we are deciding that we are going to buy or sell gold after 1 year at 12,500. Yes or no, everyone? So in simple terms, we are locking the price today for a transaction that will happen in the future. After 1 year, we are going to buy or sell gold. But today itself, we are locking the. It is a derivative contract. Is this clear, everyone? Okay. Now, difference between cash market and derivative market in regular batch, so much I've told. Cash market, today transaction is happening. So today's price will be used. Today itself, full payment I'm doing. Derivative transaction is happening in the future. Yes, today I'm just locking the price. So I will only be depositing the advance. Yes or no, margin money. Yes or no, everyone. All these things not needed. Settlement of derivative contract, I've told either settlement will happen by delivery or cash settlement. Settlement by delivery means we are actually receiving the delivery. What is going there? Yes, I'm actually giving him 10 gram gold. He's actually making payment. Cash settlement means he doesn't buy gold from me. Yes, I don't sell him gold. Whatever is the cash difference, only that we are going to settle. Is this clear, everyone? Okay. Fine. Now, generally, cash settlement only is done. Then comes participants in case of a derivative contract. There can be three different participants in case of derivative contract. First is a speculator. Second is hedger. Third is going to be arbitrager. Yes, who is a hedger? Hedger is a person who is already having an existing exposure, and he just wants to reduce the risk. For that, he is entering into derivative. Now, three people will be entering into derivative, either a hedger or a speculator or an arbitrager. Who is a hedger? Hedger is already having an exposure. Simple example. Koti, he is getting married after 1 year. So he has to buy gold after 1 year. Tell me, he is having an exposure already after 1 year. In any case, he has to be buying gold. Yes or no, everyone? So tell me, what is the fear he is having? He is having a fear that the gold price will increase, because of which he has to make more payment. In that case, he can be entering into a derivative contract and lock the price. He is a hedger. Hedger is already having an exposure. Tell me, after 1 year, he has to buy gold. He is having an exposure already. Yes or no, everyone? Perfect. Now, who is a speculator? He is not having any exposure. Imagine second situation, story number 40 is there. 40 is not getting married. Koti doesn't want to buy gold. Chumma he was sitting. Yes, at one end I was sitting, Koti was sitting. Imagine. This is me. Sorry, this is Koti, this is me. Chumma both were sitting on a table. We had absolutely nothing to do. We told boss, gold price is going up. Koti is saying gold price is going up, boss. In 1 year, gold price will go up. I'm telling no, no, gold price has already increased so much. Gold price will fall. He's telling bet. I'm telling bet. He's telling gold price will go up about 12,500. Yes, about 12,000. I'll tell no, no, gold price will not exceed 12,500. He tell okay, bet. Now imagine after 1 year. Yes, after 1 year, yes, the gold price actually reaches 15,000. Tell me whose prediction turned out to be true? Coti's prediction turned out to be true. So who is making a profit? Coti is making a profit. But imagine after a year, gold price is at 10,000 only. Tell me whether Coti's prediction turned true. No, he told it will cross about 12,500, but it is at 10,000 only. So Coti's prediction turned out to be false. So he will be incurring a loss. Is this clear, everyone? Who is a speculator? He doesn't have any exposure, but he's just predicting what will happen to the price. If his prediction turns out right, he will make profit. Otherwise, he will incur loss. Is this clear, everyone? Okay. They take a position to make a profit by predicting. Yes, they may end up earning profit or loss. Now, who is an arbitrager? Arbitrager also don't have any exposure, but was they exploit mispricing in such a way that they earn riskless profit. Who is an arbitrager? Understand, students. Imagine Koti is there. Koti wants to buy gold after 1 year. In any case, he wants to buy gold. Okay. Imagine in India today Koti wants to buy gold. Imagine. In India today, the gold price is 12,500 per gram. Imagine Koti's friend is there. He went to Dubai for a trip or for some office work. He was just returning from Dubai. Yes, he just went to Dubai Mall. There he saw that gold is available for 1 gram at 10,000. There is going to be a small difference in different markets. So he came up with an idea. Boss, Koti anyways was telling that today he wants to buy gold. In India, if he is buying gold means 12,500 for 1 gram it is. Yes, I have an idea. What I can do? I can buy from Dubai and sell it to Koti. Why for charity? No, I can make some profit here. So what he does, he will tell Koti, you want to buy gold today? He's telling yes. Yes, what is the price there in India? He's telling 12,500. He's telling, boss, I will do one thing. I will give you 1 gram gold at 12,000 rupees. He's telling, okay. Now what he will do, arbitrager will do, imagine Mr. X, he will buy gold from Dubai at 10,000 per gram. He will sell it to Koti at 12,000 per gram. So thereby he will be making a riskless profit of 2,000 per gram. Is this clear, everyone? Already he has entered into a buy position here, sell position here. He will be making riskless profit. Is this clear, everyone? Okay. They don't have any exposure. They were not having any need, chumma, but they saw mispricing is there. We could exploit and make profit. So that is why they end up making profit. Is this clear, everyone? Okay. Then comes the different types of derivative contract. We have forward, future, options, and swaps. In the next units, we will go on discussing each of them. Now, various categories of underlying asset. Now, derivative is not an independent contract. Its value is derived based on the value of an underlying asset. Tell me, we had a derivative contract on gold. Its value is dependent on gold. Yes or no, everyone? So, what all different underlying assets can be there? Based on that, we have different classification. Now, imagine if the underlying asset is equity, that is share or index. Suppose we are entering into a contract. After 1 year, I will buy one Reliance share at 3,000 per share. Tell me, it is a derivative contract. But on what we are entering into derivative? On Reliance share. Here my underlying base is going to be the share. Yes or no, everyone? It is called equity derivative. Suppose the underlying is commodity. Yes, commodity can be gold, silver, bronze, copper, iron, etc., etc. Yes or no, everyone? We have seen the example of gold. It is called as commodity derivatives. Now, equity as well as commodity in this chapter, derivatives we will be discussing. Now, my underlying can be interest rate also. That we will be discussing in the next chapter, interest rate risk management. My underlying asset can be currency also. It is called currency derivatives. That we will be discussing in the chapter Forex. My underlying can be others also. Yes, we have something called as credit derivatives, where my credit outstanding amount, that is going to be the underlying. We have weather derivatives, where weather is going to be the underlying. We have electricity derivatives, where electricity is going to be the underlying. In regular batch, this also beautifully we have understood, but for examination, not important. Is this clear, everyone? So with this, our unit 0 basics of derivatives is done up. Any doubt till here, students? No. In simple essence, whatever we have discussed till here, gist is important, but in very simple terms, what is a derivative? It is agreement between two people to buy or sell a specified asset. OT is buying, I am selling. Specified asset in our example is gold at a specified future date, in our example, after 1 year, at a pre-decided price, which is fixed today. Today itself, we are fixing after 1 year. Okay, boss, we are going to buy or sell gold at 12,500. Basically, we are locking the price today for a transaction which is happening in the future. Yes or no, everyone? Then we have understood that derivatives is a zero sum game. One person is making, suppose 100 rupee profit means other person will be making 100 rupee loss. Profit of one party is equal to loss of the third party. Then we have told settlement in case of derivative, either physical delivery or cash settlement will be happening. Is this clear, everyone? With this unit number 0, basics is giving you guys a minute to let this sink in. Then we'll go ahead to unit number 1, which is forwards and futures. Yes, everyone. Now let us go ahead to unit number 1, forwards and futures. Now this entire chapter of derivatives, now we have 4 different units. Unit number 1 is forwards and futures. Unit number 2 is options. Unit number 3 is real options. And unit number 4 is going to be swaps. For your examination, the most important units are unit 1 and 2. Unit 1 is forward future, unit 2 is going to be options. Unit 3 real option, just a small extension of options. Unit number 4 swaps. We will not be discussing in this chapter with interest rate risk management. Their swaps is important. With that only we'll be discussing. Is this clear, everyone? Okay. Unit number 1 is going to be forwards and futures. Now, what is a forward? What is a future? What is a similarity? What is a difference? Now, simple, we have understood what is a derivative. It is an agreement between two parties to buy or sell a specified asset at a specified future date at a pre-decided price, which is locked. Yes or no? I told you guys an example. Yes, Koti wants to buy gold after 1 year. So we entered into a contract. Koti is telling, I promise to buy gold at 12,500 per gram. I will tell, I promise to sell gold at 12,500 per gram. Yes or no, everyone? This is in essence a forward or a future contract. Now understand, throughout, forward and future can be used interchangeably. Now, what is the similarity in forward and future, and what is the difference in forward and future? Similarity is both these things create obligation for both the parties. Okay, yes, whether I use forward or future, in this chapter I will keep using it interchangeably. In interest rate it is different, in currency it is different, but in equity, forwards or futures both are same. Is this clear, everyone? Fine. Now, what is a forward or a future contract? Yes, it is a derivative contract, okay, which creates obligation for both the parties. That means Koti is the buyer. We entered into a contract. Koti is telling, after 1 year I will buy gold at 12,500. I am telling, after 1 year I will sell gold at 12,500. Yes, forward or a future. It creates obligation for both the parties. Compulsion. After 1 year, buyer has to buy. Koti has to buy. Yes, after 1 year, whether the actual gold price is 15,000, Koti has to buy at 12,500. Even if the actual price is 10,000 only, he cannot tell, no, Machar, in the market price is 10,000. Why will I pay 12,500? No, he entered into a forward or a future. It is creating obligation. He has to exercise. He has to fulfill the obligation. Yes or no, everyone? Seller has to sell. I am the seller. I promise after 1 year I will sell, yes, 100-gram gold at 12,500 per gram. Yes, after 1 year, whether the gold price is 15,000, I cannot be telling, no, Macha, the price is 15,000. Now you pay me 15,000. No, boss, you've entered into a forward future. It creates obligation. You have to fulfill. You cannot tell, I want to, I don't want to, it is beneficial, it is not beneficial. Yes, you have to exercise. Yes or no, everyone? You have to fulfill the contract because it creates obligation. After 1 year, you cannot be telling, no, Macha, it is loss making for me. How can I do this? No, it creates an obligation. Is this clear, everyone? So it creates obligation for both parties. That is, buyer has to buy, seller has to sell. Then, sir, what is the difference between a forward and a future? The only difference is forward is a customizable contract which is traded over the counter. Future is a standardized, which is through exchange. Forward means basically between two parties. Yes, it is a customizable contract which is happening over the counter. Simple example I'm telling. Yes, Koti came to me. Yes or no? To a gold shop. Based on whatever Koti is wanting, I'm telling, yes, after 6 months you want, okay, after 6 months. Yes. You want to buy 52 gram of gold, okay, 52 gram of gold. Yes, based on two people, yes, their discussion, their negotiation, it is a customizable contract. Yes, a future contract is through stock exchange. Through stock exchange, it is getting entered. It is a standardized. Here there are specific lot sizes. You cannot do it the way you want. Is this clear, everyone? Simple example I'm giving. Imagine IPL match is happening between RCB and CSK in South. A very big rivalry it is. Yes or no, everyone? Now you want to do a betting. If you are doing the betting with your friend, you can do it the way you want. Yes, if RCB scores above 200 means I will win 100 rupees, 50 rupees, 10 rupees, whatever. If it doesn't score means you will win. Yes, whatever price, whatever score, how much is the bet money, when it will happen, everything. When you will make the payment, much I will make payment after 2 years only. Everything you can customize it between two people. That is a forward. Between two people, however they want, they can customize. It is over the counter. But boss, future is through exchange. Imagine you are doing a betting through Dream 11 or some other betting platforms. Yes or no? There can you tell, no, no, Macha, yes, today we will do the betting. Payment I will do after 1 year. No, today itself we'll have to be making it. Yes or no, everyone? That is going to be the difference. Okay, everyone. Now, so many things are there. All these things are not at all important for us. Simple thing. Yes, what is the forward and the future? It is creating obligation for both the parties. Buyer has to buy, seller has to sell. Story is over. Is this clear, everyone? Okay, fine. Now comes a very important point. which is the different positions in forward or future. In this entire chapter, whether I use the term forward or future, both are one and the same only. Okay, different kind of positions in futures. Now understand one very important thing, students. Yes, be it life, be it a relationship, or be it a derivative contract, we will have to be taking certain positions. Mm-mm. Mm. Corrupted mind, where it is going? Let it come back. Let it come back. Was I'm talking about the positions to be taken in case of a derivative contract. Yes or no, everyone? Now, what all positions are there? Yes, don't tell all different random positions. Come back, boss. Yes or no, everyone? In futures, we are having altogether two positions. One is the long position, which is also called as the buy position. One is the short position, which is also called as the sell position. Simple example, I will give it to you. Now, tell me, spot 1 gram of gold is at 12,000 rupees. Now, 1 year forward contract we entered at 12,500 per gram. Tell me, see from Koti's perspective. Koti is one of the students of our CA Final AFM batch, the legend of Ongol. Now, he will be buying gold. Yes or no, everyone? He wants to buy gold. Tell me which position he will be taking. Buy means long position. So, he will be entering into a long position. Is this clear, everyone? So, Koti wants to buy gold at 12,500. So, he will be entering into a buy position, which is also called as a long position. Simple, it is a technical term. Now, I want to sell gold. It means I will be entering into which position? I will be entering into a short position. Is this clear, everyone? Okay, so simple terms, long means buy, short means sell. Now, one more important point that comes here is the expectation. Okay, yes. Long means buy, where, okay, here we have written. Yes, simple example, look at this. Okay. Yes. Today, 1 gram gold is at 12,000. We have entered, made a promise that after 1 year, yes, we are going to buy or sell gold at 12,500 per gram. Now, let us see from Koti's perspective. Koti has promised to buy gold at 12,500 per gram. Okay. Now, imagine after 1 year, the actual price of gold is 15,000 rupees. So, tell me what Koti was thinking. He was thinking gold price will increase. Yes, gold price has actually increased. So, if there was no forward, now he had to pay 15,000 for 1 gram. But because the forward is there, he is now paying 12,500 only for 1 gram. So tell me whether Koti is happy or sad. Think and tell me, students. Yes, if there was no forward, he had to pay 15,000 today. But because forward is there, now he is paying 12,500 only. Is he happy or sad? Happy. Profit or loss? A profit. So he is having a profit of 2,500 per gram. Yes or no, everyone? When the price is increasing. Simple. Buyer will always be thinking that the price will go up. That is why he is buying today. Simple example, you purchase a Reliance share today, 3,000 rupees. Why? Because you're expecting that the price will go up. Yes or no, everyone? Buyer is always expecting that the price will go up. That is why he wants to lock the price, buy it today. Seller is always expecting that the price will go down. That is why he wants to sell and exit. Simple, you have purchased the Reliance share. You purchased it at 500 rupees. Now it had reached 3,000 rupees. You are thinking, boss, from here onwards now the share price will fall. Too much it had rallied already. So what you will do? You will sell it. So a seller is always thinking that the price will fall. Yes or no, everyone? So that is going to be the expectation. Tell me, yes, two different positions we are having in case of a forward or a future. One is a long position, one is short position. Tell me, what does long mean? Long means buy position. Yes, when do we enter into a buy contract? When we are expecting that the price will go up. Yes or no, everyone? That is when we'll be entering into a yes long position. When do we enter into a short position? When we are expecting that the price will fall down. Yes or no, everyone? As a buyer, Koti was thinking after 1 year, boss, gold price will reach 15,000. He is giving me a 12,500 only. Let me enter into that. Yes, as a seller, I was thinking that, boss, after 1 year, gold has already rallied to 12,000. After 1 year, gold will fall to 11,000 something. Yes, he's telling me, okay, boss, I want to buy at 12,500, means I can sell at 12,500. That is why I will enter. Is this clear, everyone? The expectation is going to be very important here. Okay, all these things are clear, yes or no, everyone? Okay. Now comes whether we should buy or sell futures. This is from a speculator's point of view. Now, the entire derivatives, okay, derivatives, IRRM, all those things that we are going to do, we should see from different people's perspective. Three different people will be entering into derivative. One is a speculator, one is a hedger, one is an arbitrage. So, from a speculator's perspective, how will he enter into a transaction? Very simple, students. Speculator, what is his expectation? If he is expecting that the price will increase, Tell me students, if you are expecting that the price will increase, yes, which position we should be taking? Buy position, which is basically the long position. In that case, speculator will be going for a long position, which is buy position. Is this clear? If the speculator is expecting that boss, the price will decrease, then they will be going for a short position, which is basically a sell position. Is this clear, everyone? Perfect. Any doubts in this? Simple example, students. Now, imagine today. Okay, imagine you are there. Yes, you are entering into a betting. Pure betting. You don't have to buy gold, sell gold. Chumma betting you are doing. Yes or no, everyone? India Pakistan match is happening. You are telling India will win. Nothing is there. Chumma you are betting. Yes or no? Similarly, gold price. Today, gold price is 12,000. You are entering into a betting. Yes. You are expecting that boss, gold price in 1 year will reach 15,000. So your expectation is that gold price will go up. So what you will do, you will enter into a long position, buy position. You will tell, boss, I want to buy at 12,000. So what will happen? Tell me, students, you will buy at 12,000. Sorry, 12,000. Imagine after 1 year, the gold price reaches 15,000. Your expectation turns out to be true. Yes or no, everyone? So tell me, you want to, you purchase, you entered into an agreement to buy at 12,000. Now sell is happening at 15,000. Yes or no, everyone? So that means you will be making a profit of how much? 3,000. Is this clear, everyone? Yes. So when we are expecting that price will go up, we will enter into a buy position, long position. If you're expecting that price will go down, that time we'll be entering into a sell position. Yes or no? Basic things. Yes or no, everyone? So this is also done. Yes or no? Yes. With this concept zero, basics of forwards and futures is also done. Then we'll be going ahead to concept number one. Just giving you guys a minute to let this sink in. Then we'll take the discussion forwards. Yes, everyone. Now let us go ahead to concept number one. Here, concept 1A. Here we'll be discussing two things. First is the price of a future contract. Next is profit or loss calculation. Let us try understanding this. First, initially using a simple story. Imagine. Koti is there. He is preparing for his CA final exam. Okay. Yes. In the meantime, he has to take care of his expenses also. So imagine next to his house, there is a classmate factory where classmate books are being produced. Yes, he knows the manager there. Okay. Yes. He is telling that, Koti, I can give you one classmate book at 100 rupees. He sees the MRP of classmate book. MRP of classmate book is 150. And Koti knows so many students, so many of his friends who are preparing, they are using classmate notes only. So Koti comes up with a crazy idea. He is saying, okay, boss, I will buy one classmate book at 100 rupees. And I can sell it to student at 150 rupees. I will be making 50 rupees profit. Crazy. Yes or no? Suppose I sell 10 books. 50 into 10, 500 rupees profit I made. Yes or no? If you crazy business idea. So he tells, okay, boss, let me enter into this business. But the manager is telling, boss, here manufacturing is happening. I will not give you one single classmate book. You cannot come and ask for one classmate book. Yes. From here, we will be manufacturing and selling in bulk. Yes or no? So at least you will have to be buying one lot. He is asking one lot consists how many books? He is telling one lot consists of 50 books. Is this clear, everyone? Okay. Fine. So now understand. Purchase price of the book is 100. Yes, one lot is consisting of 50 books. Tell me what is the price of one contract? Yes, Koti is telling I want to purchase one lot of books. How much price Koti has to pay? Tell me for one book how much he has to pay? 100. In one lot, how many books are there? 50 books are there. That means total how much he has to be paying? 5,000 rupees he has to be paying. Yes or no, everyone? It is the price per unit into the lot size. In one lot, how many units are there? Yes or no? Same is the story with respect to futures. Yes, whenever you are buying or selling futures, you cannot just be buying a single unit. You have to be buying one lot. So what is the value of one lot or one contract? It is the actual future price. What is the price of one unit into the lot size? In one lot, how many units are? Is this clear, everyone? Okay. Then, yes, suppose Koti wants to purchase six lots, six contracts. What is the total value? Tell me, students, for one contract, for one lot, how much he is paying? 5,000. That means like that six lot he wants to purchase means how much he has to pay? 5,000 into 6, 30,000. Yes or no? How can we do? Either I can write price of one contract into six contracts, or how did I arrive at the price of one contract? Tell me. Yes, it is 100 for one book. Yes or no? For one book, it is 100. In one lot, how many books are there? 50. So into 50 gives me the price of one contract. That way, how many lot we are buying? Into six lot, we arrived at 30,000. Yes or no, everyone? So the total contract value, what is the total contract value? Either I can tell price of one contract into number of contracts, or I can be writing it this way. Tell me, how do I arrive at the price of one contract? It is the actual future price for one unit. How much is the price? Into lot size. In one lot, how many units are there? 50 books are there. That gives me the price of one contract into six contracts. That gives me the total contract value. Yes or no, everyone? Perfect. Now imagine, calculate the number of lot purchased if he has purchased 1000 books. OT wanted to purchase total 1000 books. Tell me, students, in one lot, how many books are available? One lot means 50 books are available. Means if he wants 1000 books, how many lot he should be buying? 20 lot he should be buying. Yes or no, everyone? Yes. Calculate the total profit if he sold every book at 150 and he sold total 1000 books. Tell me how all we can be doing the profit loss calculation. First, I will calculate profit or loss per unit. Tell me every book at what price Koti purchased? 100. To what price he is selling? 150. So what is the profit per unit? 50 rupees. Total how many books he sold? 1000. So it is 50 into 1000. It is going to be 50,000. Yes or no, everyone? That is one way of doing. Other way of doing. Tell me, students. Yes, profit for one book is going to be 50. Yes, suppose Koti sold one lot. One lot, how many books are there? 50 books are there. So what is the profit for one lot? It is 50 for one book. That way 50 books are there. It is 2500. Yes or no, everyone? Now tell me, yes, one lot means 50 books. Yes, Koti has done a transaction on total 1000 books. That means how many lots should be there? Yes, 1000 divided by 50. 20 lots he should have purchased. Yes or no, everyone? So the total profit I can tell was for one book, the profit is 50. For one book, the profit is 50. One lot consists of how many such books? 50 such books. So for one lot, the profit is 2500. This way we enter the transaction with 20 such lots. That gives me the total profit. Yes or no? This way we can tell the total profit as profit per unit into the lot size into the number of lots. Yes or no, everyone? Perfect. So in a very simple way, without making anything very technical, we've understood all the basic things. Yes, we've understood. Look at the students. Yes, price of one future contract. You are entering into one contract. Yes, how much you should be paying? We know I cannot just be buying a single future unit. I'll have to be buying a lot. So how much I have to be paying? It is the actual future price into the lot size. Is this clear, everyone? Okay, fine. Now lot size question can be giving different wordings. Yes, lot size means number of shares in one contract. It is also called as minimum trading lot, also called as contract multiplier. Is this clear, everyone? Okay. If actual future price is not given in the question, then we'll assume it is the same as theoretical future price. Next concept, we'll understand how to calculate theoretical future price. Then comes total contract value. Yes or no, everyone? Suppose, yes, Koti had purchased 6 contracts. What is the total value? It is the actual future price. Yes, for one classmate book 50 into lot size. Yes, into number of lots. Yes or no? Actual future price into lot size into number of lots. Is this clear, everyone? Okay, fine. Now, we'll do one thing. In our workbook, we are having a simple example. Let us quickly try seeing this students. 3-month Reliance Futures is currently trading at 2500 per share. Okay, first example we are doing just basic calculation. 3-month Reliance Futures. Reliance Futures we are talking about, future contract. Currently it is trading at what price? 2500. The lot size is specified by exchange is 250 shares per lot. I cannot just buy a single unit in future. Minimum 250 shares I should be buying in a lot. Okay. Calculate the price of one future contract. Simple, students. Tell me one Reliance future is available at what price? 2500 per share. In one lot, bare minimum how much I should buy? 250. So 2500 into 250, it is going to be 6,25,000. Yes, what is the total contract value? If investor is buying 5 such lots, tell me for one lot it is going to be 6,25,000 into 5 gives me the total contract value. Yes or no, everyone? Perfect. Now, calculate the number of contracts required for an exposure of 62,50,000 rupees. We are telling boss, investor wants to take a total exposure, total contract value of 62,50,000. Tell me how many contracts he should be buying. Tell me, students, what is the price of one contract? 6,25,000. So I can tell one contract is equal to 6,25,000. That means 62,50,000 means how many contracts? 62,50,000 divided by 6,25,000. It is going to be 10 contracts. Yes or no, everyone? If you want it in the form of a formula, trust me, formulas are simple, jujube halwa things. Tell me it is a total contract value 62,50,000 divided by price of one contract 6,25,000. Yes or no, everyone? That is what is given here. Total contract value divided by price of one contract. Is this clear, everyone? So with this one basic thing, that is calculation of price of one contract, calculation of total contract value, as well as calculation of number of contracts, we've understood. Is this clear, everyone? Now let us go ahead to the next point, which is going to be profit or loss calculation. Giving you guys a minute to let this sink in. Even students who are watching it on YouTube, pause. Let this sink in. Just pause. Then we will take the discussion forward, everyone. Yes, everyone. Now let us go ahead to the next point, which is profit or loss calculation on future contract. Now understand a very simple sentence, students. Students by heart so many things to calculate profit or loss. Trust me, simplest thing in the world. Third standard student will also tell how to calculate profit or loss. Unnecessarily, you are unnecessarily complicating things. Just remember a golden principle to calculate profit or loss on anything in the world. Yes, always take a reverse position on the date of settlement. Yes, whatever position you have taken, always take a reverse position of that. Simple example, I'm giving it to you guys. Look at this here, students. Yes, golden principle to calculate profit or loss, always take a reversal position. Tell me, imagine originally you have taken a buy position. That means on the settlement date, reversal should be sell. If you have taken a sell position, means you should be taking buy. Sir, what nonsense is this, sir? Through one example, I will try explaining. Imagine example number one. Pushpa, Pushparaj, Teggedele. Yes or no, everyone? What does Teggedele mean in Telugu? Yes, it means do not bend. Yes or no, everyone? Our students do not bend. Don't think in some other way. Okay, come back, come back. Okay, Pushpa purchases 10 kg tomato at 30 per kg. He has purchased the 10 kg tomato at 30 per kg. Now, after 3 months, he held the tomato for 3 months. After 3 months, he sold it at 40 per kg. Calculate the profit or loss. Can we do this? Yes, boss. Tell me, yes, Pushpa is purchasing 10 kg tomato at 30 per kg. So, total how much money he paid? 30 into 10, 300 he paid. After 3 months, he sold every kg tomato at what price? 40 per kg. So, how much he received? 40 into 10, 400 he received. 400 he received, 300 he paid. That means his profit is 100. Yes or no? This is the most logical way of doing things. Now, forget this. In a very simple way, I will do it for you guys. Tell me, students, what is the original position? Yes, Pushpa had taken. Yes, pay attention. Let me just show it to you guys. Okay. Original position. Tell me, Pushpa originally what he has done? He has purchased. So originally he has taken a buy position. Yes or no, everyone? Yes. How much kg tomato? 10 kg tomato at the rate 30 per kg, 300. Yes, I have told you in order to calculate profit or loss, always take a reverse position. Yes or no, everyone? So I will be taking a reverse position. Yes, buy means reverse is going to be sell. Tell me 10 kg tomato at what price is selling 40? So it is 400. Tell me, students, you ask a second standard student, boss, I have sold and received 400 rupees. Purchased, I paid 300 rupees. Did I make profit or loss? He will tell you made a profit. How much is a profit, students? 100 rupees is a profit. Is this clear, everyone? Simple. Now, throughout calculation of profit or loss is simple. You see the original position, you take a reversal position. If originally is buy means you take sell. Originally sell means you take buy. Now, second example. Yes. Suppose Pushpa is purchasing shares. Pushpa purchased 10 Reliance share at 30 per share. Tell me original position is what? Buy. How much? 10 Reliance share at 30. That means it is going to be 300. Now, after 3 months, Reliance share is now worth 40 rupees. Today, Reliance share is 40 rupees. Yes, either he can be selling or he need not be selling. Yes, calculate profit or loss. Tell me, students, yes, Pushpa has purchased the share at 30 rupees. Today, the value is how much? 40. Tell me, original position is buy. To calculate profit or loss, I will be taking a reverse position. Yes or no, which is going to be a sell position. Tell me 10 Reliance share at the rate of 40. That means what is the total value? 400 rupees. I'm telling boss, today if I sell now 400 I will receive. Whether you sell or not is a different story altogether. So tell me, yes, you purchased at 300, you can sell at 400. That means overall we are making a profit of 100. Yes or no, everyone? Yes, boss. So, is this clear, everyone? Now, other situation I'm giving it to you. Other situation I'm giving it to you. Directly I will come here. I will not be explaining much here. In regular, so much I've explained. But here directly just a calculation will come. Yes. Pushpa has short sold. Short sold means now I am selling. Afterwards, I will purchase back. Short sell means simple, boss. Right now I'm selling. Afterwards, I will be buying back. Okay. Short sold means basically now you are selling. Okay. 10 shares of Reliance at 50%. Okay. Tell me, so original position that you have taken is a sell position. Tell me 10 shares at the rate of 50. So total it is going to be how much? 500 rupees. Yes or no, everyone? 1 week later, the Reliance share is trading at 30. Tell me, students, after 1 week, the Reliance share is now trading at what price? 30. Yes, calculate profit or loss. Tell me, in order to calculate profit or loss, we should be taking a reverse position. Tell me original position that you have taken is sell. That means now what we should be doing? Buy. I sold, boss. I was not having share. Right now I should buy and do that. It's a detailed transaction, not getting into that. Simple calculation is going to be very simple. Original was sell. It is going to be 500. Reversal is going to be buy. Tell me, students, how many shares? 10 shares. Today, on the date of settlement, what is the price? 30. So it is going to be 300. Tell me, students, I sold at 500. I am buying back at 300. Happy or sad? Boss, I purchased at 300. I am selling at 500. Happy or sad? Happy. Profit or loss? Profit. How much is the profit? 200. Is this clear, everyone? Okay. Now comes profit or loss calculation in case of futures. Pay attention. Very simple it is going to be. First, I will give you a parallel example. Yes. Pushpa brought 5 lots of classmate notebook. Pushpa purchased 5 lots of classmate notebook. Every lot consists of 10 notebooks. Tell me, in every one lot, how many notebooks are there? 10 notebooks are there. Okay, crazy. Now, the purchase price of one notebook is 100 rupees. Okay. Yes, in 10 days, yes, Pushpa sold all the notebook at 150 per book. Calculate the profit or loss. How can we do? First, tell me what is the original position we have taken, purchase. Tell me, students, how much we have purchased. One classmate notebook is 100 rupees. Tell me, can I just buy one notebook? No, boss. At least one lot I have to buy. In one lot, how many notebooks are there? 10. That means to buy one lot, how much I should be paying? 100 into 10,000. Yes, tell me, how many lot did we buy? 5 lots. So total, how much we would have paid? 5,000. Is this clear? This is the original position, which is buy. Tell me, to calculate profit or loss, I should be taking a reverse position. If I purchase means what I should be doing? Sell I should be doing. Tell me at what price I am selling. Yes, one book I am selling at 150. Tell me, in one lot, how many books are there? 10 books are there. So how much I'll be receiving? For every book, 150, 150 into 10. 1,500 I would have received. Tell me, how many lots did I sell? 5 lots. So total, how much I would have received? 7,500. Yes or no, everyone? This is one way of doing the calculation. There is one more way of doing the calculation. Pay attention. Where is the space? Ah, let me just show it here. I just want to do it. It's the same calculation. Yes. One more way of doing the calculation is first calculate profit or loss per unit. Tell me, students, what is the original position? What we did first with respect to classmate book? Buy at 100 rupees. Reversal is sell. We sold it at 150. Tell me, students, you are buying a classmate book at 100. You are selling it at 150. Happy or sad? Profit or loss? Profit. How much is a profit per unit? 50. Now you want to calculate the total profit. Very simple. Tell me, I can tell it is 50 per book. Yes. Tell me, in one lot, how many books are there? 10 books are there. So into 10 books per lot. That gives me the profit of 50 for one book, 50. That way 10 books gives me a profit of 500 for one lot. In one lot, I made a profit of 500. Tell me, that way, how many lots did I sell? 5 lots I sold into 5 lots. So the total profit is 2,500. Yes or no, everyone? Perfect. The same thing I can write it this way. Look at this, 50 per unit. It is the profit or loss per unit into, yes, the lot size. In one lot, 10 books are there, into the number of lots. That gives me the total. This is the profit for one book into lot size. That gives me the profit for one lot into number of lots. That gives me the total profit. Yes or no, everyone? Perfect. Let's look at this example here, students. Pay attention quickly. Yes, Pushpa went long on 5 contracts of Nifty futures when Nifty futures is trading at 100. Okay. Every lot consists of 10 Nifty futures. Okay. In 10 days, he settled his position when Nifty futures turns out to be 150. Calculate profit or loss. This is how we'll be having question. Simple, boss. First, I should be knowing how to calculate profit or loss. Second, I should be knowing long means buy, short means sell. Just a minute. Let me just connect the charger. Yes, my iPad is low on charge. Yes, everyone. Very simple way to calculate the profit or loss. First, tell me, Pushpa went long. Yes. In the real world, we have buy sell. In futures, they're calling it as long short. Tell me, long means which position? My position. So first I will write original position that I have taken is long. In bracket, I will write long means what? My position. Tell me how many contracts I took a long position on 5 contracts. When Nifty future was trading at what price? 100 rupees. Yes, one lot consists of how many Nifty futures? 10 Nifty futures. Same example of classmate notebook. One classmate notebook is of 100 rupees. In one lot, 10 classmate notebook is there. So for one lot, 100 into 10,000. Similarly, I purchased 5 lot, 5,000. Same story. Yes or no, everyone? Tell me one Nifty future is for 100. Can I purchase a single Nifty? No, boss. At least one lot I should be buying. In one lot, 10 Nifty is there. So 100 into 10,000. That way, 5 lot is there. Yes, into 5, 5,000. This is the original position. Is this clear, everyone? Now, after 10 days, he settled his position. Yes, tell me originally I took a long position to settle. Yes, I took a buy position to settle. I will be entering into a sell position, a reversal position. Yes or no? When Nifty future is at 150, calculate profit or loss. Tell me original position was long, which is buy. That means today I will be taking a reversal position, which is going to be short position. Short means what? Sell position. Simple, boss. If you have purchased means you should sell to calculate profit or loss. If you have sold means you should be buying. If you have taken long position means you should take short position. If you have taken short position means you should be taking long position. Yes or no? Very important rule in life. Whatever position you have taken, you should be taking a reverse position also. Chumma, if you just take a single position, it is not sufficient in life. Because you should be willing to take a reverse position also. Sir, what you are telling, sir? Derivatives. Da. If your mind is going somewhere else, you're having a very corrupted mind. I am not responsible for that. Come back to the discussion. Yes or no, everyone? Okay. Okay. So tell me reversal position you are taking on that day. Nifty future is trading at what price? 150. So similar, let us take the example of book only. One classmate I am selling at 150. Yes, in one lot, how many Nifty futures are there? 10. How many lots did I sell? 5. So it is 150 into 10 into 5. It is 7,500. Tell me buy is at 5,000. I purchased at 5,000. Sell is at 7,500. I sold at 7,500. So my overall profit is how much? 2,500. Simplest thing in the world. Yes or no? Or else I can be doing it this way as well. Step 1, calculate profit or loss per unit. Yes, this way is what we will be doing throughout in this chapter. First, we will calculate profit or loss per unit. Tell me, students, what is the original position? Long, which means buy. At what price we entered into long? 100. Yes, in order to calculate profit or loss, I will be taking a reversal position, which is short, which is basically sell. At what price I am entering into a reversal position? 150. So tell me, I purchased at 100. I sold at 150. So my profit per unit is 50. Now let me try calculating the total profit. Yes, for one Nifty, the profit is 50. Yes, in one lot, 10 Nifty is there into 10. That way I entered into 5 lots. So it is profit per unit into lot size into number of lot. That gives me the total profit or loss. Yes or no, everyone? Perfect. Is this clear? Is this clear? Similarly, if you have taken a short position, yes, short position is there. First, you will write down the short position. Reversal is going to be long position, which is buy. This way, any number of questions we can be doing. Is this clear, everyone? Perfect. Yes, everyone. If you want, we can come to the workbook. Quickly, one question we can see. This is anyways on long position only. Doesn't make. Okay, let us quickly see. Yes. Answer each of the independent situation. Situation 1. Pushpa went long on 4 contracts of Nifty futures. He took a long position. Long means buy. When Nifty futures is trading at 25,000, the lot size is specified is 100 units. At expiry, Nifty closes at 25,300. Calculate the total contract value. What is the total contract value? Tell me, students, how many contract quote? Yes. Pushpa entered into 4 contracts. Yes. At what price he entered? 25,000. Yes. One lot is how much? 100 units. So I will tell, okay, boss. Yes, future is available at 25,000. Yes, one lot consists of 100. Tell me how many lot he entered into 4. That gives me the total contract value. Yes or no, everyone? Perfect. It is going to be 100 lakhs. Then comes profit or loss calculation on maturity. First, tell me I took a long position, which is buy position. At what price? 25,000. In order to calculate profit or loss, take a reversal position, which is going to be sell position. At what price? 25,300. So first, buy is at 25,000, sell is at 25,300. So I am making a profit of 300 per unit. So now tell me what is the total profit? It is 300 per unit into the lot size is 100 into we entered into 4 lot, that gives me a profit of 1,20,000. Is this clear, everyone? Yes, perfect. So with this point is done. So come to the concept book. Look at this profit or loss on futures. Calculate reverse position. First, calculate profit or loss per unit. See the original position, take reversal position. I will arrive at profit or loss per unit. Then comes the total profit or loss. It is profit or loss per unit into the lot size into the number of lots. Is this clear, everyone? With this concept 1A, profit or loss calculation is also done. Giving you guys a minute to let this sink in. Then we'll go ahead to concept 1B, which is a beautiful concept, which is theoretical future price. That is ideally how much should the future price be. Yes, everyone. So let us proceed further to concept 1B, which is calculation of theoretical future price. That is, I want to enter into a future contract. Ideally, how much should be the price of a future contract? Okay, simple. Before we enter into that, first we'll have to understand how do we calculate the future value, basics of time value. Yes, discounting, I am coming front, compounding, I am going forward. Yes or no? Future value calculation, simple. Yes, in case of simple interest, it is present value into 1 plus R into T, where R is the interest rate per annum, T is the time period in terms of years. Compound interest, yes, future value, it is present value into 1 plus R to the power T. Yes, wherein, yes, present value is today's value. Yes, R, it is the interest rate for the compounding period. Suppose you're doing monthly compounding means, yes, interest rate per month. If you're doing quarterly means interest rate per quarter. C is the number of compoundings that we are doing. Yes or no? In case of continuous compounding, yes, future value is equal to present value into e to the power RT. Yes, E is the exponential value. Yes or no, everyone? Yes, R is the interest rate per annum. T is going to be time in terms of years. Now, this is something from foundation days you've learned. Do not expect me to tell, sir, what is this, sir? Foundation you've learned, inter you learned, final regular again you've learned. Yes, or else you can see my video on YouTube wherein basics of AFM is there. This again, 1, 2, 3 hours we have discussed this. Is this clear? Still quickly in 2 minutes, I will tell you guys. Imagine. Yes, item. This is one of the characters. Yes, item from our class. Okay, item invested 1,000 rupees in a bank for 9 months. Yes, today he is investing 9,000 rupees in a bank. T is equal to 0. 1,000 he's investing. He wants to withdraw the money at 9th month. Yes or no, everyone? He's investing in a bank. Bank will give him interest. Yes or no, everyone? Okay. Now, calculate the total amount at the end of 9 months in each of the following situations. First situation is interest rate is 12% per annum simple interest. So tell me, how do I do? 1,000 rupees he is investing. Yes, bank is paying him 12% per annum, but he is investing only for 9 months. So 12 into 9 by 12, he will be getting 9%. So 1,000 plus 9%, it is going to be 1,090. Or we can tell, yes, present value into 1 plus R into T. Yes, 1,000 he is investing, 1 plus rate of interest is 12% per annum. He is investing only for 9 months into 9 by 12. It is also going to be 1,090. Yes or no, everyone? Imagine interest rate is 12% compounded quarterly. Tell me, bank is telling every quarter we will give interest. And then compounding will happen. Tell me what is the interest rate, students? 12% per annum. I want it for every quarter because bank is paying interest for every quarter. Tell me in 1 year how many quarters are there? 4 quarters are there. That means what is the interest rate per quarter? 12% per annum divided by 4. It is going to be 3% per quarter. Yes or no, everyone? So simple. Yes, 1,000 rupees he is investing today. Yes, in the first quarter he will get 3%. Second quarter again he will get 3%. Third quarter, again he will get 3%. Boss, he's investing only for 3 quarters, 9 months. Yes or no? So how we can write? We can write it as 1,000 into 1.03. 1, 2, 3. 3 times compounding is happening. Yes or no, everyone? Or else we can write it this way. Present value into 1 plus R to the power T. Present value is 1,000. 1 plus interest rate per quarter is 3%. 1.03. Yes, to the power T. How many times compounding is happening? 3 times it is happening. So you will get 1,092.73. Similarly, if you are doing monthly compounding, yes, 12% compounded monthly. Tell me interest rate is 12% per annum. Yes, for 1 month it is going to be 1%. So every month 1%, 1%, 9 times it is happening. So 1,000 into 1.01 to the power 9. Yes or no, everyone? It is 1,093.63. Yes, then in regular so many more things we have done. Yes or no, everyone? Yes, so if you are doing continuous compounding, yes, there is a Euler's value. Yes, value of E, it is 2.7183. Using that, e to the power x value will be given in the question. Yes, suppose question is telling interest rate is 12% continuously compound. Now understand, students, yes, same story for 9 months at 12%. If you are doing simple interest, now we got 1,090. If you are doing quarterly, na, yes, you are doing compounding more, you will get 1,092. If you are doing monthly, na, you are getting 1,093. Yes, you do daily, you will be getting 1,094.06. So tell me, more is the compounding period, more number of times, yes, interest is getting added, it is getting compounded, more should be the value. So if you are continuously compounding, means every second it is compounding, it reaches to infinity. That is how the value comes. Yes, the formula is going to be present value into e to the power rt. This is going to be my future value. Is this clear, everyone? Okay. So look at this, students. Yes, present value is 1000 rupees I'm investing into e to the power r. Rate of interest is 12% per annum. But boss, we are investing only for 9 months into 9 by 12. So e to the power 0.09. Now e power x value will be given in the question. It is 1.0942. Tell me 1000 into 1.0942. It is 1094. Is this clear, everyone? Look at this. Here I got 1094.06. It should be more than that. It is 1094.2. Now comes a question. Sir, whether e power x value will be given in the question. It will be given in the question. Sir, what if it is not given in the question? If it is not given in the question means simple thing. Remember, value of e is 2.7183. Tell me, students, what is the value of e? 2.7183. So if I have to calculate e to the power 0.09, it is 2.7183 to the power 0.09. In basics, we know dirty power trick. Yes or no, everyone? Yes. So as per that, we will be doing. Yes, we will first write down the base number 2.7183. Press the square root 12 times 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Yes, minus 1 into the power 0.09 plus 1 into equal 12 times. You will get the value that is going to be this value. Yes or no, everyone? Yes. So how to calculate e to the power rt? If it is given, great. If it is not given, value of e is 2.7183. As per that, use dirty power approach. Is this clear, everyone? Great. Yes, this is going to be the base. Calculation of future value as per simple interest, compound interest, continuous compound. Is this clear, everyone? Now, giving you guys a minute to let this sink in, then we'll go to the main thing. This is considered to be very difficult by students, but trust me, we've got one chart wherein everything gets covered in a single chart. Beautiful chart. Trust me, students. Once you see this, if you get to know the concepts properly, even though it is a rocket revision, then I want you guys to put in a comment in the YouTube. Crazy Maja lecture, and I want you guys to recommend to your friends as well. Is this clear, everyone? Okay. Yes, everyone, one more small point. Tell me, if I want to calculate present value, can I create the formula for that as well? Simple, boss. Present value in this case is going to be future value divided by 1 plus r into t. In case of simple interest, here it is going to be future value divided by 1 plus r to the power t. Here it is going to be, yes, future value divided by e to the power rt. Yes or no? Basics. You are discounting. From back, you are coming back. Divide you is what you will be doing. Yes or no? You are going front means we will include interest into. You're coming back means eliminate interest, divide. Basics, the way we have understood it logically. Yes or no, everyone? Okay. Now comes the most important thing. This is the concept. Theoretical future price. This is telling how much should be the future price. Yes, let us try understanding this quickly with the help of a story. Yes, imagine. Today, spot price of gold is 12,000 per gram. Okay. Koti is coming to me. He's telling, sir, I want to buy gold. I'm telling, today you purchase it at 12,000 per gram. He's telling, no, sir, I want to buy gold after 1 year. Yes, let us lock the price today. So there is a model, cost of carry model. It is telling how much should be the future price, theoretical future price. Yes, it gives you a golden equation. Theoretical future price, it is equal to spot price plus interest minus dividend. Logically, quickly, let us try understanding. Yes, how much is the rate? Now, simple, I'm telling, yes, I'm asking Koti, when do you want to buy? He's telling, sir, after 1 year, I want to buy. I will tell very simple example. Koti, yes, price of 1 gram of gold today is 12,000. Yes, if you don't buy, I can sell to a customer today at 12,000. Yes, imagine I'm having only 1 gram gold. Imagine this is 1 gram of gold. Yes, this is the only 1 gram gold I'm having. Tell me today's price is how much? 12,000. Yes, I can sell to a customer today and I can receive 12,000. But you are telling, no, sir, I want it. So I will do one thing. I will hold this. It was understand. I could have sold it at 12,000. So for you, I have sacrificed that 12,000. So this 12,000 anyways you should be giving. He's telling, sir, that I will pay you, sir. I will tell, wait, there is one more thing. 12,000 I am receiving today. You will be making payment after 1 year. This 12,000, if I would have received today means I could have gone to bank, deposited, earned the interest of, imagine, 10 percentage. So tell me after 1 year how much it would be worth. Sir, 12,000 plus 10%, 13,200. So you are making payment after 1 year. So you will have to be making a payment of 13,200. Is this clear, everyone? Simple. Yes. Investor wants to buy 1 gram of gold today. Means I can sell it off. I can receive 12,000 today. I can invest in a bank. After 1 year, I can be receiving 13,200. But investor is telling, I will buy after 1 year. You give me the price today. I will tell, boss, You will have to pay me after 1 year at least 13,200. Is this clear? Quickly, I have told it to you guys. Yes or no, everyone? So today itself, if you are paying, you pay the spot price. You are paying after 1 year, boss. You are not paying today. After 1 year, you are paying. Pay the interest also. So it comes to 13,200. Is this clear? So the theoretical future price, it is equal to spot price. Anyways, you should be paying. But boss, you are paying in the future. So interest also you should be paying. Is this clear, everyone? Okay. Now, yes, golden equation is theoretical future price. It is spot price plus interest minus the dividend. Yes, all these things, so much discussion is not needed. Okay, directly let us come in the case of shares. Simple example. Tabish is holding one share of Reliance, whose spot price is 1000. Okay. Koti wants to enter into a 1 year forward buy contract with Tabish. Calculate the theoretical future price after 1 year if the risk-free rate is 10%. Tell me, students, one share of Reliance is available. What is the price? 1000 rupees. What all option is available with me, Tabish? Yes. Either I can sell the share today itself in the spot market. In that case, how much I will receive? 1000. When I will receive that 1000? Today itself I will receive. What I can do with this 1000 that I've received? I can invest in the bank at risk-free rate. 10 percentage I can be getting. So at the end of first year, how much I will be receiving? 1100. What is selling? No, no, sir. I will buy from you, sir, after 1 year. Tell me, he is making payment after 1 year, yes or no? So that means how much he should be paying? 1100 he should be paying. Yes or no, everyone? So your theoretical future price, it is a spot plus interest. Here is this clear? Yes, sir. Now one more adjustment is there. Crazy discussion. This is in case of dividend adjustment. Now, if dividend income is given in the question, extension of the story, pay attention. Tabish holds one share of Reliance, whose spot price is 1000. Okay. Koti wants to enter into a 1 year forward buy contract with Tabish. Koti is saying, sir, after 1 year, I will purchase this share from you. I told, okay. Calculate the theoretical future price after 1 year. If risk-free rate is 10 percentage per annum and Reliance is expected to pay a dividend of 200 at the end of year. Okay. Yes, this is the extra line. So understand what all options are available with it. Option number one, I can sell the share today itself in the spot market. Tell me, if I sell today, how much I will be receiving? 1000 I will be receiving. Okay, boss. I can be investing at a risk-free rate 10 percentage. So at the end of first year, how much I will be receiving? 1000 plus 10%, 1100 I will be receiving. Yes or no, everyone? So I will tell Koti, boss, if I sell the share today means 1000 I will be receiving. 1 year, 10 percentage interest, 100 also I'll be receiving. So 1100 I'll be receiving. If I give it to you also, I want 1100. Okay. But understand here, I am having two options. Either option number one, I sell the share today, or option number two, I can hold the shares with me for 1 year and give it to Koti at the end of 1 year. Yes or no, everyone? Perfect. If I'm selling the share today I'm receiving 1000, 1 year interest 100, 1100 I'm receiving. So from the second option also, at least 1100 I want. Yes or no, everyone? Yes, sir. Now tell me, if I'm holding the share for 1 year, there is one advantage that I'm getting. Tell me, if I sell the share today, Reliance will be announcing a dividend at the end of first year. Will I receive it? But boss, if I hold the share for 1 year, second option, I hold the share for 1 year, I will only receive the dividend. Then I will sell it to Koti. Yes or no? In that case, I am receiving two cash flows. One dividend I am receiving. With that, I will be receiving the theoretical future price. That is the price that Koti is going to pay. Yes or no, everyone? Tell me how much dividend I will be receiving. Tell me, I am expecting to receive a dividend of 200 rupees at the end of first year. Okay. I will tell boss. Ultimately, theoretically, yes, whatever I am receiving in this option, at least same amount I should be receiving. That is what bare minimum I want. Yes or no? Tell me, if I sell the share today, 1000 I will receive. 1 year interest 100. 1100 I am receiving in first option. Second option also I want 1100 only. But tell me, in the second option, I am receiving a dividend of 200. That means from Koti, how much only if I get, it is sufficient. 900 only if he pay also, it is going to be sufficient. Yes or no, everyone? Perfect. So the theoretical future price is going to be 900. How do I arrive at that? Simple. Total cash flow in option 1 should be equal to total cash flow in option 2. First option, if I sell today, I will receive spot as well as interest. Second, if I'm selling after 1 year, boss, I will receive dividend for first year as well as at the end of first year, I will be receiving the future price, what is locked. So the theoretical future price, it is a spot plus interest minus the dividend. Yes or no, everyone? Or else this way also I can be telling one final explanation. Tell me, students, I could have sold the share today. I could have received 1,000 rupees. That I am not receiving. That I want. Yes. If I had sold today means 10 percentage interest, 100 rupees also I would have received. That also I'm not receiving. That also I want. But boss, if I would have sold the share today means the dividend you received, you would not be receiving. Yes or no? But you received that benefit, so reduce that. Yes, these two are costs, so we added them. This was a benefit, so I reduced them. Is this clear? This is a logical explanation, or else in simple, you can just remember theoretical future price. It is going to be spot plus interest minus the dividend. Is this clear, everyone? Perfect. Okay. Now we are going ahead to one chart for all calculations. What we want to calculate? We want to calculate the theoretical future price. In the story, this entire chapter will keep the same story. I am there. I am having Maja Gold and Diamonds. Koti is there. He wants to buy gold after 1 year. Okay. Yes. Today's spot price is 12,000. After 1 year, he wants to purchase. What is the price I should be quoting? Theoretical future price. Ideal. In reality, price could be different also. Is this clear, everyone? Now we are telling how do we calculate the future price. Interest I should be adding. Interest either can be simple interest or compound interest or continuous compounding. So tell me, as per simple interest, the future price, it is the spot price into 1 plus R into T. Basically, present value is today's spot price into 1 plus R into T. Yes, compound interest, it is present value into 1 plus R to the power T. Spot price into 1 plus R to the power T should be the future price. Continuous compounding, it is present value into e to the power RT, which is basically today's spot price into e to the power RT. Yes or no, everyone? This is the basic discussion. Till here, is this clear, everyone? Give me a confirmation. Okay. Future price I want to calculate. Yes. Spot price I know. I will add interest. I will arrive at the future price. Simple interest means spot into 1 plus R into T. Yes. Compounding. Yes. Compound interest means spot into 1 plus R to the power T. Yes. Continuous compounding means spot into e to the power R. Till here, things are clear. Okay. Giving you guys a minute to let this sink in, then we'll take the discussion forward. Yes, everyone, look at this calculation of theoretical future price without dividend adjustment. Simple. Spot price of Reliance share is 500. Today, Reliance share price is available at 500. Interest rate is 12% per annum. Calculate theoretical future price with 3-month Reliance future in the following situation: simple interest, monthly compounding, continuous compounding. First one is simple interest. What is this trying to tell? Simple, boss. Today, Reliance share is available at what price? 0. 500 rupees. Yes, I want to calculate the value of a 3-month future at the end of 3 months, how much it is going to be. I want to go front, include the interest, yes or no. Imagine it is simple interest, very simple. Tell me 500 it is into 1 plus, what is the rate of interest? 12% per annum. But boss, I want it only for 3 months. So 12%, 1 plus 0.12 into 3 by 12, I will arrive at 515, yes or no. Second, imagine monthly compounding. Tell me what is the interest rate? 12% per annum. I want per month. So divided by 12, it is going to be 1% per month. Yes or no, everyone? Tell me, I want to do monthly compounding. Total 3 months are there. So today the price is 500. Yes. First month, one time. Second month, third month. Total 3 times we are compounding. Yes or no, everyone? So, yes, monthly compounding, how it will happen? It is 500 today into 1.01. How many times I'm compounding? 3. So it is going to be 515.15. Formula simple. It is a spot into 1 plus R to the power T. Yes or no, everyone? Then comes continuous compounding. Here I will be using e to the power x. So tell me what is the spot price? 500. Continuously it is compounded for 3 months. How much it will be? Tell me, students, spot price is 500 into e to the power RT. 500 into e to the power. Rate of interest is 12%, but it is per annum. Yes, the contract is for 3 months only. Into 3 by 12, it becomes 500 into e to the power 0.03. E to the power 0.03 will be given in the question. Yes, it is 1.03045. So 500 into this will be 515.225. Is this clear, everyone? This is the basic calculation of future price without any adjustment. So, yes, if in the question, 3 different types of questions can come. Okay. Type 1 question wherein there is absolutely no dividend adjustment. Okay. If there is absolutely no dividend adjustment, I can directly apply this formula and calculate the future value. Is this clear, everyone? Yes. Oh, sorry. Yes, everyone. Now let us try understanding different types in which questions can come. Three different types of questions can be there. Is type 1, there is no dividend adjustment. Type 2, if dividend is given in the form of rupees or dividend rate is given. Type 3 is if dividend yield percentage is given. Now quickly we will come to the workbook, and through the workbook there is one example, master example, in which every different adjustment is covered. Through that, let us quickly try doing it, students. Yes, theoretical future price. Crazy example it is. Spot price of Maja Limited share is 1000 rupees. There is a company called Maja Limited. Its share price today is 1000. Okay. Face value of the share is 100 rupees. Okay. Interest rate is 12% per annum. Okay. You are required to calculate the theoretical future price. Future price of the 6-month future contract. I want it for 6 months in each of the following independent situation. Okay. Situation number 1, there is no dividend. Okay, question is telling solve each situation as per simple interest, as per monthly compounding, as per continuous compounding. For continuous compounding, e to the power x values are given. Okay, fine. Now, first, if there is no dividend expected, tell me, students, today what is the share price? 1000. Today's share price is 1000. I want the share price after 6 months, means I will include interest. Tell me what is the interest rate? 12% per annum. If I am doing as per simple interest, means I will tell 12% per annum for 6 months, means it is 6%. 1000 into 1 plus 0.12 into 6 by 12, 1.06, it is 1060. If you are doing monthly compounding, I will tell boss 12% is the interest for 12 months. That means for 1 month, how much it is? 1%. Tell me from here, I want to go 6 months. First, second, third, fourth, fifth, sixth, 6 times I will be compounding. So it is 1000 into 1.01 to the power 6. Yes or no? You will receive it as 1061.52 something. Then if you are doing continuous compounding, yes, 1000 is today. I want at the end of 6 months. It is 1000 into e to the power RT. Yes, rate of interest is 12% per annum into 6 by 12 is e to the power 0.06. That value is given. Accordingly, the value is going to be 1061.8. Is this clear, everyone? This was a very simple thing. Now we will go ahead to the second type of question. Type 2 question, where a dividend is given in the form of rupees or dividend is given as a percentage on face value. Look at the second situation, students. Yes. Spot price of Maja Limited share is 1000 rupees. Face value is 100. Interest is 12%. I want to calculate 6-month future price. Okay. When, yes, Maja Limited is expected to pay a dividend at the rate of 20%. Tell me, students, one very simple thing. If dividend rate is given, means the rate is on face value. Yes, what is the face value of the share? 100. On 120 percentage means it is going to be 20 rupees. Dividend, yes or no? Everyone, perfect. Just a minute, what is happening? Where is it? Okay, it is here. Okay. 20 rupees is going to be on the face value. When am I receiving the dividend? At the end of 3 months. So now understand, students. Simple pictorial representation. T is equal to 0. T is equal to 3. T is equal to 6. Okay. Now imagine I am telling. If I sold the share today. Okay. If I sold the share today. Today itself I will be receiving the spot price, which is how much? 1000. But boss, if I sell the share today, I will not be receiving the dividend which I would have otherwise received. Yes or no, everyone? Yes, both these are opposite in nature. If I don't sell the share today, it means today I don't sell. That means I will not be receiving 1000 that I should have received. I will not be receiving. But boss, advantage is there. At the end of third month, I will be receiving a dividend of 20. Yes or no, everyone? These two are always opposite. Yes or no? I want to calculate the price at the end of 6th month. Now, in a regular batch, I've told you multiple different ways in which I can be doing, but ultimately we came to a simple conclusion. What we will do? Tell me, can I tell my net cost instead of selling the share today? I held it. What is my net cost? Was 1000 I would have received that I did not get. But boss, 20 rupees dividend I got now. That means what is the net cost that I've incurred? 1000 minus 20, 980. Yes or no? Yes or no? Yes or no? No, sir. Why is it a no? Because 1000 is at t is equal to 0. 20 is at t is equal to 3. So I cannot be compared. So what I will do first, I will bring this dividend into the present value. Is this clear, everyone? Step number 1, I will calculate present value of dividend. I am telling boss, yes, I will be receiving a dividend of 20. But that 20 I will receive at the end of third month. I want it at 0th period. How much it is? Tell me, students. First, let me do simple interest. Tell me what is the rate of interest? 12%. Yes, I want to come back how many months from third month, second month, first month, 0th month, 3 month, yes or no, everyone? Into 3 by 12, it is going to be 20 divided by 1.03. I will get some value. I guess here I've calculated. So many multiple different ways I'd calculated here. I guess I'll have to be showing it here only. Fine. Approach number 3. Look at this. Yes, I am coming back. Yes, it comes to 19.42. So can you guys tell me what is the net cost? Was spot price is 1000. Yes, present value of dividend is 19.42. That means what is the net spot price? 980.58. Yes or no, everyone? So step number 1, we calculated present value of dividend. Step number 2, we calculated the net spot price, which is basically spot price minus present value of dividend. Yes or no, everyone? Okay. Now again, I am repeating, pay attention, students, pay attention. I am having two options. Yes, either I can sell the share today or I can enter into a future contract, sell after 6 months. If I enter into a future contract, one loss I am having. What is the loss? Spot price I am not getting. But boss, one gain also I am having, third month dividend I am receiving. So what is the net loss I'm having? What is the net cost I'm having? Yes, it is 1000 minus 20, but I cannot compare because 20 is in the third month. Bring it to 0 to pay. So step 1, present value of dividend. Step number 2, calculate the net spot price. It is a spot minus present value of dividend. Now that I've calculated, I know, boss, my net loss is going to be 980.58 at the 0th period. But I want to know I am receiving money at the end of 6th period. So I will take it to the future. Yes or no, everyone? So step number 3, calculate future value. From here onwards, calculation of future value is going to be very simple. Why, sir? Yes, I know how to calculate future value. Yes, on the present value, add interest. Spot price, I know. Yes or no? If you are doing simple interest means spot into 1 plus R into T. If you are doing, yes, monthly compounding means spot into 1 plus R to the power T. If you are doing continuous compounding means spot into E to the power R. Yes or no, everyone? Simple. So based on that, I will be calculating. So 980.58. Yes, it is today. I will go front for 6 months. It is going to be 980.58 into 1.06. I will get some value. It is going to be the theoretical future price. Is this clear, everyone? So look at this present value of dividend, step number 1. Step number 2, calculate net spot price. Yes, step number 3, calculate theoretical future price. This I will do as per simple interest also. This is as per simple interest. Yes, if you are doing as per monthly compounding. Yes, look at this, students. In third month, you are receiving a dividend of 20. Yes, you want to bring it to 0th period. Monthly compounding. Interest rate is 1% per month. How many months you want to come back? From third month to second to first to 0. 3 months you want to come back. So it is 20 divided by 1.01 to the power 3. Yes or no, everyone? 19.41. So step 2, I will calculate the net spot price. 1000 minus 19.41, 980.59. Third, I want to calculate the future price. Tell me at 0th period, I know. I want to go 1, 2, 3, 4, 5, 6. Yes, into 1.01 to the power 6, I will arrive at the future price. Is this clear, everyone? Oh. Then in case of continuous compounding, same step, 3-step framework. Look at this, students. Here we have written it down. If dividend is given in rupees or dividend rate is given. Step 1, calculate present value of dividend. Dividend I will be receiving in future, bring present value. Step 2, calculate the net spot price. It is spot price minus present value of dividend. Step number 3, once you get to know the net spot price, calculate the future price using the formula given. Yes or no, everyone? Perfect. Yes. Now, in case of continuous compounding also, yes, 20 rupees dividend I am receiving in third period. Let me bring it to present value terms. Yes, 20 divided by e to the power RT. Yes or no? I am bringing back 3 months. So 20 divided by e to the power, rate of interest is 12% into 3 by 12. Yes or no? So similarly, you simplify, you will get 20 divided by e to the power 0.03. It is 19.41. Accordingly, you do all the calculations. Is this clear, everyone? Okay, sir. So type 1 question we have done. If there is no dividend adjustment, life is jingala. Type 2, if dividend is given in the form of rupees or dividend rate is given. Basically, here I am having a t is equal to 0 spot price. Here somewhere between dividend is there. What I should do? Step 1, calculate present value of dividend. Step 2, calculate the net spot price, which is spot minus present value of dividend. Step number 3, calculate future price, which is basically your spot price, net spot price into, yes, whatever the formula which you are using, either based on simple interest, yes, monthly compounding or continuous. Is this clear, everyone? Then comes a type 3 question. Type 3 question. Now, all these things quickly I'm explaining on the assumption that you have studied the chapter once already. Again, I'm reminding you guys, this is a quick rocket revision. This is not a regular batch. This is not an exam oriented batch. This is not a fast track course. This is not a detailed revision batch. This is a rocket revision on the assumption that you've studied already. You just want a quick brush up. Still, everything logically only I'm trying to explain at every point in time. Is this clear? But boss, we're having a necessity. We'll have to do it fast so that you guys can revise it one day before examination. Okay. Then comes a type 3 question. If dividend yield is given. Now, what is the dividend yield? Let us have a look at the third situation here, students. Look at this. Are we having third situation screenshot here? I don't have the screenshot here. Okay, fine. Tell me if dividend yield is given. Dividend yield means it is a yield on the market price. Simple, boss. Look at this. Spot price of Maja Limited share is 1000. Okay. Face value is 100. Okay. Interest rate is 12%. Okay. Calculate the theoretical future price in situation 3 where it is telling dividend yield on Maja Limited share is 5%. Simple, boss. Maja Limited share is there. This is the share. I was thinking of selling it today. I would have received 1000 rupees. What I could have done, I could have put this money in the bank. Yes, it would have given me risk-free rate of 12%. Yes or no, everyone? But boss, if you sell today, yes, advantage is spot price you are getting, interest also you are getting 12%. But boss, there is one loss. If you had waited for forward, you would have received the dividend of 5% per annum. But because you are selling, you are not receiving the dividend. Yes or no? So tell me in spot, I will tell yes, because I select spot, what all advantage I will get? 1000 rupees I will be getting. Interest also I will be getting. But tell me how much interest only will be my benefit? Boss, 12% interest I am getting. Even if I had held 5% I would have got in the form of dividend only. That means tell me net benefit is how much only? 12 minus 5, it is going to be 7%. Yes or no, everyone? So what we will do, we will calculate the net interest percent. It is basically interest minus a dividend yield. Here dividend is given in the form of a yield percentage on the market price. So I will calculate the net interest percent. Is this clear, everyone? So look at the steps. Step number 1, calculate the net interest percent, which is basically my R. It is interest percent minus the dividend yield percentage. Once we have calculated this, now I will apply it in the above formula and I will arrive at the theoretical future price. Is this clear, everyone? So look at the third situation. Yes, so if dividend yield is 5%, then how I will be doing my calculation? Quickly, I will show it to you guys. Monthly 20, yes. Dividend yield is 5% per annum. Tell me interest rate is 12% per annum, dividend yield is 5%. That means the net interest rate is how much? 7%. So simple interest means I will do it. Yes, spot 1000 rupees. Yes, interest I will be taking 7%. Yes, or no, I will take 1000 rupees. Interest I will be adding 7% only because I'm telling boss, I am earning 12%. Even if that was not there, 5% I would have still earned. That means net 7% only I'm earning. Is this clear, everyone? It's monthly compounding. Yes, I will first calculate the net interest cost. 12 minus 5, it is going to be 7% per annum. Yes or no, everyone? Now I will do the compounding. Tell me, yes, I want to go 6 months, friend, but I want to do it month on month. Tell me what is the net interest rate? 7%. It is per annum. That means per month, how much? 7 divided by 12. 0.5833 percentage. So how many times I should be compounding? 6 times. Accordingly, I will arrive at the future value. Yes or no? In case of continuous compounding, step 1, calculate net interest cost 7%. Then accordingly, you do the continuous compounding, you will arrive at the values. Is this clear, everyone? Perfect. Now look at the concept book. Yes, this formula is used to calculate the theoretical future price. Ideally, how much should be the future price is what this concept is telling. The actual price of future could be different. It depends on demand and supply and multiple other factors. Is this clear, everyone? Okay. That is one very important thing that we have done. Next thing that we are going to do is calculation of present value of dividend, because here in type 2 question, our first step was to calculate present value of dividend. Sir, how do we calculate present value? We know in case of simple interest, directly bring it back. In case of, yes, monthly compounding, based on the compound interest, you bring it back. Already I had discussed it here. Yes or no, everyone? Simple. Look at this. Dividend of 20 I am receiving in third month. I want to bring it to 0th period. How do I do it? In case of simple interest, directly bring it back. Dividend divided by 1 plus r into t. In case of compound interest, it is going to be dividend divided by 1 plus r to the power t. In case of continuous compounding, it is going to be dividend divided by e to the power r. One very important point that we should be remembering here, t. throughout, what is going to be the time period? Tell me how much months I want to bring it back. It is from the date of dividend to the date of contract. Yes or no, everyone? Perfect. So it is going to be T is the period from the date of contract till the date of dividend. Yes, my future is for 6 months, but was dividend I am receiving in third month only, na? From third month to zeroth month, I am doing it. Is this clear, everyone? Yes or no? Trust me, this is a very simple concept. If you try sitting and by hearting formulas, I can give you some 9, 10, 12. How many formulas I can give you? 3, yes, 6, 9, plus again there are multiple variants. Some 12, 13 formulas I can give you. None of those things are needed. First, I should be knowing how to calculate future value. Simple. I am including interest. I am going front. Yes or no, everyone? Yes. So, as per simple interest, as per compound interest, as per continuous compound. Now, what all types of questions can be there? Either there are no dividend adjustment. Simple life is jingalala. Or dividend is given in the form of rupees. Or dividend rate is given. Basically, I'll be getting in the form of rupees. In that case, what I will do? Spot price is given at 0th period. Dividend will be available somewhere at mid period. What we will do first is calculate present value of dividend. Then calculate the net spot price, which is spot price minus present value of dividends. Then step number 3, now calculate the theoretical future price using the formula. Is this clear? If dividend yield is given, percentage is given, then directly it is a percentage on market price. Yes, interest rate is anyways available. I will calculate the net interest, which is interest minus the dividend yield. Based on that, I will calculate the formula. Is this clear, everyone? Okay. Now comes a very important question. Okay, sir, there was a question on calculation of theoretical future price. Which interest rate we should be doing? Should we do it as per simple interest or monthly compounding or continuous compounding? It depends on the way question is asking us. Now look at this, students. If question is specifically telling do as per continuous compounding, we will do. Yes, but if question is giving us hint, sometime question will be giving us hint. Say for example, if the value of e to the power rt is given. Suppose question is telling in the question, it is asking calculate theoretical future price below e to the power 0.04 is 1.0405. This is itself is giving an indication that I should be using e to the power x, that is continuous compounding. I will do continuous compounding. Or question is telling the continuously compounded interest rate is 8%. So question itself is telling I should be using continuous compounding. Is this clear, everyone? In this case, I will go for continuous compounding. Or if question is telling the interest rate month is 2%. Question is giving an indication monthly compounding you do. Or question is telling interest rate on monthly rest. Monthly compounding is this. So question is giving an indication that I should be going for monthly compounding. If nothing is specified, very simple, go for simple interest. Is this clear, everyone? Okay. So we have understood how do we calculate the theoretical future price. Now we have one more small point, not very important for examination, which is contango backwardation and convergence. What is this trying to tell? Imagine the theoretical, the spot price is 1000. Future price is going to be 1100. Tell me the future price is greater than the spot price, yes or no? So what we are telling, boss, today the value of asset is 1000. In 3 months, the value of asset will become 1100. The value of asset will increase. That is called as contango, where the future price is greater than spot price. Is this clear, everyone? Yes. What is the backwardation? Backwardation means the future price is less than spot price. Today's spot is 1000 rupees. But 3 months later, I am asking what is the future price of Reliance share? After 3 months, they are telling it is 900. So tell me future is less than spot. So what is expectation that market will fall? It is called as a backwardation market. Is this clear, everyone? And then we have convergence. What is convergence? It is when my future and spot become one. They converge into one. It happens on the date of expiry. On the date of expiry, what will happen? My future and spot price will become the same. It is called as convergence when both the prices. Is this clear, everyone? With this concept number 1C or 1B, calculation of theoretical future price is done. I hope you guys have understood to a reasonable level. Yes, trust me, students, this is a rocket revision. Yes, there are so many things I can tell, but I am bound by the pace and the time restriction. So I'll have to explain things in a very fast way on the assumption that you've learned the subject already. If you have not learned the subject, I would recommend you guys to go and watch the detailed marathon, which is there on YouTube. There slowly we'll try explaining everything. Is this clear, everyone? Yes, giving you guys a minute to let this sink in, then we'll take the discussion forward, students. Yes, everyone. So questions Right now, we are taking more time to explain the concepts itself more than what we expected. So questions right now we are not doing. In the end, if we have time, we will do it accordingly. Now, going ahead to concept number 2, which is margins in case of future. Now, understand one very simple thing, students. There are three different types of margin: initial margin, maintenance margin, mark to market margin. Now, questions have been coming for 6 marks, 7 marks, 8 marks. Trust me, very simple halwa questions. Still, students find it very difficult. Yes, give me 10 minutes, we will understand. Now, understand, future contract is entered. Future contract is always entered through the exchange, wherein there are two parties. Imagine, yes, Koti is there. Koti wants to buy gold after 1 year. I am there. I want to sell gold after 1 year. Okay, this is happening after 1 year at 12,500 per gram. Imagine it is routed through the stock exchange. Yes or no, everyone? Now tell me, forwards and futures. It is creating an obligation, that is buyer has to buy whether it is profit or loss. Seller has to sell. So tell me, can there be a risk of default? Yes or no, everyone? Simple example I'm giving. Koti is there. Koti had promised that after 1 year he will purchase gold at 12,500. Assume after 1 year the gold price reaches 15,000. He will directly come and tell, Macha, we promise that yes, I will be buying at 12,500. Take 12,500, give me 1 gram. Imagine the gold price becomes 5,000. So tell me what Koti is thinking. Boss, if he goes to market and buys directly, it is 5,000 only. Yes, who will come there and pay 12,500? Yes, it is a loss making contract. Yes or no, everyone? But boss, in case of future, forward and future, you have to fulfill whether it is profit or loss. In option, you are having an option. So, can there be a risk that the counterparty will default? Yes, Koti will not come only. Can there be a risk for that? Yes, boss. For that, in case of futures, what stock exchange is doing is stock exchange is collecting margin from both the people. Yes, he's telling you also pay me some money, you also pay me some money. Why? Because you guys can escape, you guys can run away. We don't want that to happen. That is why we are collecting some money, so that even if you try running away, your money is with us. So from that, we can take care of it. Is this clear, everyone? Now understand one more additional point. Yes, margins is there only in case of futures. Forward is happening between two parties. Yes, over the contract. Yes, it is based on a trust. So here there is no margin. Yes, when future contract is there, it is routed through a stock exchange. There is a stock exchange, a mediator, an intermediary. So what stock exchange will do? Stock exchange will collect margin from both the people. Is this clear, everyone? First, concept of margin. Why do we have margin? Forwards and futures create obligation for both the parties. If it is unprofitable, they may try running away. That is why margin is being collected. Who collects margin? In case of future contract, stock exchange collects the margin from both the people. Is this clear, everyone? Okay, fine. So we have tried understanding the margin. Look at the students. Yes, this is Koti. Yes, he is taking a long position because he wants to buy gold after 1 year. He has agreed for, yes, 3 month future buy at 12,500 per gram for 100 gram gold. Yes, this is me, owner of Maja Gold and Diamonds. I entered into a short position. That is, I want to sell gold after 3 months. So I entered into 3 month future sell at 12,500 per gram. Yes, in between there is a stock exchange who is the intermediary. Tell me, is there a risk that I can default? Yes. Is there a risk that I can also default? Yes, boss. So that is why what stock exchange does. Stock exchange is telling I will collect margin from these people. Okay. Suppose the stock exchange is telling in order to enter into a future contract, initial margin is a 10% of contract value. Whatever is a total contract value, 10 percentage of that you will have to pay initial margin. Tell me, students, yes, what is the contract? Yes, we are entering into a 3 month future contract for gold at 12,500 per gram. And tell me what is the total value of gold 100 grams. So can you tell me the total contract value? 1 gram is 12,500. That means 100 gram is going to be how much? 12 lakh 50,000. Yes or no, everyone? Perfect. Yes, that is a contract value. Initial margin is how much? 10 percentage of that question will specify. It is going to be 1 lakh 25,000. What does initial margin mean? It is the margin money, deposit money that a party has to deposit with the stock exchange to enter into a future contract. Yes. So if a future contract has to start, what has to happen? Yes. Koti will deposit 1,25,000. Yes. I will also deposit 1,25,000 with the stock exchange. Whether margin, yes, whether margin money is cost? No, boss, it is not cost. It is just a deposit. Say, for example, you are taking a house on rent. Initially, you will have to be paying a deposit. Yes or no, everyone? Is it a cost? No, boss. It is just advance that you have paid. Is this clear, everyone? Initial margin is 10% of contract value. Yes. Daily profit or loss will be adjusted. So what stock exchange is telling, boss? Initial margin I've taken, but it could be possible that daily you are earning loss, 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 loss. So whatever margin money you've kept from you, it is exhausted. So what we will do, daily profit or loss adjustment also will do. And if your value falls below a certain level, you will have to refill the. Is this clear, everyone? This is the concept of margin. Yes, in the regular batch, so much through a complete story, will understand everything. But here, right now, I hope you guys are having an idea at least. Initial margin means it is the initial deposit that I'm paying to enter into a future contract. Okay, boss. In our example, it was 1,25,000. Suppose question is telling the maintenance margin is 80% of initial margin. Maintenance margin will generally be given as a percentage of initial margin. Yes, it is how much? Yes, 80 percentage of initial margin 1,25,000. It is 1 lakh. Now, what exactly is maintenance margin? Yes, maintenance margin is trying to tell you that if your balance falls below maintenance margin, now you have to refill. Simple example. Imagine this is Koti's ledger. Yes, in order to enter into a future contract, how much he has to deposit? 1,25,000. Tell me this 1,25,000. Is this a cost to Koti? No, this is just a deposit. Yes or no? At the end, he will be receiving back the money. Imagine first day he had a profit of 10,000. So what Koti will tell to the stock exchange? Koti will tell stock exchange, you have my 1,25,000 deposit. Stock exchange is telling yes, yes. With that first day I made a profit of 10,000. That also you have. Stock exchange is telling yes, yes. So that means total you should be paying me 1,35,000. Stock exchange is telling yes, yes. Perfect. So first day he had a profit. Assume it reached 1,35,000. 10,000 profit he had. Is this clear, everyone? Second day he had a loss. So assume it came to 1,10,000. Yes. Third day again he had a loss. Suppose it came to 1,05,000. Fourth day again he had a loss. Assume it came to, yes, 98,000. So now what stock exchange is telling is, stock exchange has set a maintenance margin of 1 lakh. What is maintenance margin? Yes, your value should not fall below this. Yes, 1 lakh at least should be there in your margin. Stock exchange will take initial margin from you. Daily profit or loss, it will adjust. At least 1 lakh should be there. Now tell me your value has fallen below 1 lakh rupees. Yes or no? What was the intention of receiving the margin money, deposit money, initial margin? To ensure that the party doesn't default. Now stock exchange is again having a fear. Balance is very less. Tomorrow if adverse situation happens, yes, if he incurs loss further, yes, if the balance becomes negative, if he runs away, what we can do as a stock exchange? Yes or no, everyone? So for that, what stock exchange is telling? Stock exchange is telling, if your balance falls below maintenance margin, you have to refill your account, redeposit so much money so that it goes back to the initial margin. Tell me right now what is the balance? 98,000. In this case, yes, in order to continue, yes, if Koti wants to continue, what he has to do? He has to deposit so much money so that it comes back to the initial margin, which is 1,25,000. Tell me, students, that means how much money he has to deposit? 98 minus 125. He has to be depositing 27,000. Yes or no? So the day it reaches 98,000, Koti will be getting a notification. Yes, your balance has fallen below the maintenance margin. Please deposit 27,000. Koti deposits it. Wait. Koti doesn't deposit. He'll tell I will not. The very next day, the contract gets cancelled. Is this clear, everyone? Okay, fine. So we've understood what is maintenance margin also. Then daily profit or loss calculation also, let us try seeing. Simple, boss. Yes, it depends. Look at this, everyone. Let us directly see the chart here. In chart, yes, simple we have done. Three different margins I'm having. First is initial margin. It is the upfront security deposit. Okay, everyone. Now, how do we calculate initial margin? Yes, sometimes initial margin will be given as a percentage in the question. Question is telling initial margin is a 10% of contract value. So I will calculate contract value into 10 percentage, contract value into the initial margin percentage. Sometimes initial margin percentage will not be given. Yes, how to calculate also will not be given. In that case, how do we calculate initial margin? Yes, in that case, my initial margin is mu plus 3 sigma. What is mu? It is average. Yes or no? Yes, average value plus 3 times of standard deviation. Simple, boss. Imagine, yes, we are entering into a future contract on gold. Yes, daily price change will be there. Yes, mu is referring to the average price change. That is, on an average, daily, the price change can be, say, for example, 500 rupees. Is this clear, everyone? On the contract, imagine. Okay, yes, we want to be on a safer side. Mu is just telling the average. Simple, boss. Look at this. So much I'd explained in the regular batch here. I don't want to complicate things. Where is it? Okay, simple. Imagine. Yes, you are entering into a transaction. Yes, Koti enters into a gold buy. I enter into gold sell. Okay, yes, for 100-gram gold at 12,500 per gram, the total value is 12 lakh 50,000. Yes, tell me every day gold price will change. Yes or no, everyone? Yes, imagine first day gold price change by 5%, second day change by 8%, third day change by 2%. Yes or no? Can I calculate the average change? Imagine the average change is 10,000. So, yes, stock exchange is telling on an average, the change could be 10,000. So, on one day, loss can be how much? 10,000. You deposit that as initial margin. Yes or no? So, court is telling, okay, boss, let me deposit 10,000. But stock exchange is telling, wait, this is just the average change. Some days there could be more loss, some days there could be less loss. We don't want any risk. So, what we are doing, we are collecting average. In addition to that, three times of standard deviation also we are collecting. Yes or no? If you guys remember, standard normal distribution table, if you cover up to 3 sigma, yes, 3 sigma to the right, 3 sigma to the left, 99% of all cases would be covered. Yes or no? That is why, that is where this formula is coming from. Yes, it is initial margin is mu plus 3 sigma. Is this clear? Where mu is the average daily change in the contract value, 3 sigma. Sigma is the standard deviation of change. Is this clear, everyone? Okay. Now we are going ahead to the maintenance margin. What is maintenance margin? It is the minimum balance that should be maintained. At least this much should be there. Sir, what if the balance falls below maintenance margin? In that case, I should deposit money in such a way that it comes back to my initial margin. If it falls below maintenance margin, deposit money in such a way that I restore it to my initial margin. Is this clear, everyone? Then comes mark to market margin. Yes, this is the daily profit or loss. Yes, everyone. So let us look at this. Okay. Let us see from Koti's perspective. Yes, Koti had entered into a 3-month future buy on gold at 12,500 per gram. So he's telling us after 3 months, he will be buying gold at 12,500 per gram. Now imagine he has taken a long position. He has taken a buy position. Buy basically means a long position. Yes or no, everyone? Imagine first day, the gold price reached 12,800. Is it profit or loss? Now one way of doing it is tell me original position was long, which is basically buy at 12,500. Yes. Calculate profit. Take a reversal position short, which is at 12,800. So tell me you purchased at 12,500, you are selling at 12,800 means you are having a profit of 300 per gram. So for 100 grams, the profit is 30,000. That is one way. Or else tell me, yes, when you are entering into a long position, buy position, what is your expectation? Your expectation is that price will go. So in reality, if the price goes, you will make a profit. If the price goes down, you will incur a loss. Simple, boss. You are entering into a betting. You are telling that, okay, Kohli will make 100. If Kohli makes 100, you win. You make profit. If Kohli doesn't make a profit, yes, if Kohli doesn't make 100, you lose. You give money. Simple. Yes, when you're entering into a long position, your expectation is that price will go up. If in reality price goes up, means your expectation turns out to be true. You make a profit. If it falls, your expectation is false, you will incur a loss. As simple as that. Yes or no? So 12,500 was there. Suppose it became 12,800. Price went up. You make a profit of 30,000. Suppose it reached 13,000. From 12,800 to 13,000. Again 200 rupees went up. Again you make a profit. 200 per gram into 100 gram, 20,000. Yes or no? Suppose it falls to 12,400. Your expectation was it will go up, but boss, it fell down. So today it fell down by 600 per gram into 100 grams. 60,000 is a loss. Accordingly, your margin account will keep adjusting. Tell me your initial margin was 1,25,000. Yes, first day profit was 30,000 means right now your balance is 1,55,000. Second day profit is 20 means right now your balance is 1,75,000. Third day your loss was 60,000 means right now your balance is 1,15,000. Fourth day your loss is 40,000 means right now your balance comes to 75,000. Tell me your maintenance margin was 1 lakh. So if the balance fell below 1 lakh means I should redeposit, refill how much so that my balance goes back to 1,25,000 again. So from 75, my balance has to go back to 1,25,000. That means I need to refill 50,000. Is this clear, everyone? This is how this calculation is being done. Okay, everyone. Now look at this. Initial margin, this is upfront deposit that I'm paying. Yes, if percentage is given, great, or else I will calculate it as mu plus 3 sigma. Maintenance margin, at least this much balance should be there. If my value falls below this, I will redeposit, refill so much money so that it goes back to my initial margin. Yes, mark to market margin. It is a daily profit or loss. Okay. How do I calculate daily profit or loss? Some 4 or 5 different formulas are there. None of those things are needed. Simple, just know the expectation. Yes, if we are having a long position, I am having the long position means what is my expectation? Expectation is that price should go. If on that day price went, means I will be making a profit. But boss, if the price fell down, means I will be incurring a loss. Is this clear, everyone? I am having a short position, sell position. If you are having a short position, we have seen what is expectation. Expectation is that price will fall down. If in reality price fell down, I will be making a profit. Yes, if opposite happens, I will be incurring a loss. That is my daily profit or loss. Yes or no, everyone? Now, how do we solve the question? Okay, we've understood concepts. How do we solve the question? Now, if you see Institute's presentation, in a single table, they've created a mess. We will split it into 3 different steps. Step number 1, whenever a question comes, we will calculate initial margin and maintenance margin. Calculate initial margin and maintenance margin. Step number 2, we will calculate the daily profit or loss. For that, what all we will write? We will write down the date. We will write down the closing rate. Based on that, we will calculate the daily profit. Okay. Once I've calculated the daily profit or loss, based on that, step number 3, I will now prepare a margin account. In that, what all I will write? First, I will write down the date. I will write down the opening balance in the margin account. I will write down the daily profit or loss. I will arrive at the revised balance. Yes, opening balance anyways was there. If it is profit, means it is increasing the balance. If it is loss, means it is decreasing the balance. I will accordingly arrive at the revised balance. Yes or no, everyone? Tell me, if my revised balance in the margin account value is falling less than maintenance margin, means I should be calling some money, extra deposit I should be doing. Column number 5, call money. Based on that, I will arrive at the closing margin. Is this clear, everyone? Yes, one comprehensive question we will do. Through that, everything will be fine with that. This concept, we will close it, my dear students. Look at this. Yes, example number 4. Simple example. On 1st September, Amarendra Bahubali has taken a long position on 10 lots of Nifty futures. What Amarendra Bahubali has done? He has taken a long position, buy position on 10 lot of Nifty futures when they were trading at 25,000. Okay, one lot is equal to 50 units. Crazy. Initial margin is 10% of contract value. Maintenance margin is 80%. Closing price for the next 4 days are given here. Crazy. Prepare a statement showing the daily margin is in the margin account and payment of margin qualified. Margin account have to be prepared. Tell me, we will prepare in 3 steps. Step number 1, we will calculate initial margin and maintenance margin. Tell me, students, what is initial margin? 10% of contract value. So first let me try calculating the contract value. Tell me, Nifty future is trading at 25,000. One Nifty future is trading at 25,000. Can I buy or sell one unit? No, boss. At least one lot I want. In one lot, how many units are there? 50 units into 50. That gives me the price of one lot. That way, how many lots we have purchased into 10? That gives me the contract value. Yes or no? 25,000 into 50 into 10 gives me the contract value. It is going to be 1.25. Now tell me, initial margin is how much percent? It is a 10% of contract value. So 1 crore 25 lakh into 10%, it is going to be 12 lakh 50,000. Maintenance margin is how much? 80% of initial margin. So 12 lakh 50,000 into 80%, it is going to be 10. Is this clear? Step 1 is over. Now comes step 2. We will calculate the daily profit or loss. Tell me, Amarendra Bahubali has taken which position? Long position. So what was his expectation? That price will go. In reality, if price goes up, means he will make profit. If price goes down, he will incur loss. Yes or no, everyone? Okay. Tell me, 1st September, the price was 25,000. 2nd September, the price became 25,250. Tell me whether the price increased. Yes, boss. So he will be making profit. How much is a profit? 250 per unit. Yes, into, yes, one lot consists of 50 into 10 lot. The profit is 1,25,000. 3rd September, what happened? The price came to 24,750. Tell me, yesterday's closing price was 25,250. Today it became 24,750. So the price fell by how much? Yes, I guess the price fell by 500. Yes or no? So I made a loss of 500 per unit. Tell me, in one lot there are 50 units into 10 lots. So the total loss is 2,50,000. Similarly, next day again the price fell. Loss. It is going to be 500 per unit into 50 into 10. Yes, next day again the price reached to 24,000. So 24,250 to 24,000. Again it fell by 250. It is a loss of 250 into 50 into 10, 1,25,000. So step 2, I will calculate profit or loss. Step 3, now I will prepare the margin account. Look at this, students. How do we prepare the margin account? Yes. Date 1st September. What is the opening balance? We have deposited initial margin of 12 lakh 50. Yes, cost is there. 2nd September, 12 lakh 50,000 was there. What happened there? I made a profit of 1 lakh 25,000. So the closing balance is going to be 13 lakh 75,000. 3rd September, 13 lakh 75,000 was there. But boss, I incurred a loss of 2 lakh 50. So now the value is 11 lakh 25,000. Yes or no, everyone? Okay. 4th September, 11 lakh 25,000 was there. I incurred a loss of 2 lakh 50,000. So the revised value is 8 lakh 75,000. Oh. Tell me, I am having a maintenance margin. Yes, which is a 10 lakh. So at least 10 lakh should be there. If my value falls below 10 lakh, I should redeposit. How much I should redeposit? In such a way that my balance goes to the initial margin, which is 12 lakh 50. Now I am having 875. But I want to make the balance reach 1250. That means how much I should deposit, students? 875 minus 1270. Sorry, 1250. 3,75,000 I should be depositing. Yes or no, everyone? Perfect. This is the margin money I should redeposit with the stock exchange. So now the balance is 1250. Yes, 5th September, again I incurred a loss of 1,25,000. So the value is going to be 11,25,000. Now in reality, on 5th of September, if I cancel my contract, what stock exchange will do? Yes, 11,25,000, my money is lying there, they will repay. Is this clear, everyone? Okay. Now, with this, generally, whenever a question comes on margin, one question will be prepare margin account. We have prepared. Question will also ask, yes, also calculate profit or loss on the future. Now, how can we calculate profit or loss? Two different approaches are there. Approach number one, the general approach. What is original position, reversal position? Through that we can do. Tell me, students, what is the original position Amarendra Bahubali had entered? He entered into a long position, buy position at what price? 25,000. Yes. Today he will be taking a reversal position, sell position at 24,000. So that means he is incurring a loss. Yes or no, everyone? Tell me. Yes, 25,000 he purchased, 24,000 he is selling. That means his loss is 1,000 per unit. Total loss is 1,000 per unit into lot size is 50 into 10 lots. It is going to be 5 lakh. That is one approach. Or there is one more approach. Sir, what is one more approach? Inflow outflow approach. Tell me, students, on the very first day, to stack the contract. Yes, Amarendra Bahubali is paying stock exchange. How much he is paying? 12 lakh 50. Midway through, stock exchange told balance is not sufficient. So he paid extra. How much extra he paid? 375. So 1250 also he paid. 375 also he paid. Yes or no? At the end of the contract, how much he received back? 11 lakh 25,000. So look at the students. Yes, 12 lakh 50 also he paid. 375 also he paid. So total 16 lakh 25,000 he paid, but he received 11 lakh 25,000 only. So the loss he has incurred is going to be of 5 lakh rupees. Is this clear, everyone? This we also we can be doing. Perfect, everyone. Yes. Now, one very important thing we should be remembering here is that whenever we are calculating the daily profit or loss, this daily profit or loss calculation, it is based on the closing price. Sometimes institute in the question, they will twist the question this way. Yes, and they will give you all the three prices. Look at this margin question in case of futures. Yes, question 567 is there, I guess. Where is it? Okay. Yes, everyone. Look at this. Question number 6. It had come in the study material as well as MTP. Yes, daily question is giving high, low as well as closing. Yes, to calculate profit or loss, we will consider closing. High is also not needed, low is also not needed. Is this clear? This is one adjustment. Another adjustment which will be there in the question will first tell, I am having a long position. Ask the story. It will ask to calculate, yes, margin account, profit or loss, everything. Then they will tell what will be the gain or loss if he had taken a short position. Tell me, students, very simple. Yes. Daily, in case of long position, I've calculated profit or loss. In case of short position, it is just going to be reverse. I need not do the calculations again. Suppose on day one, long position, I had a profit of 10,000. In case of short position, my loss will be 10,000. Day two, long position, loss is 5,000. That means short position, profit is 5,000. So I just need to reverse that. Using that quickly, I can be doing. Is this clear, everyone? This way questions are coming in the examination for 8 points. So with this, yes, concept number 2, margins in case of future is also over, my dear students. Multiple times it has been tested in the examination. Simple, three different types of margin. Initial margin, upfront deposit. Maintenance margin, below this if it falls, I need to refill to initial margin. Mark to market, it is a daily profit or loss. How do we solve a question? Step 1, we will calculate initial margin and maintenance margin. Yes, step 2, we will calculate the daily profit or loss. See the position. Long means, yes, expectation price will go up. If it goes up, profit. If it falls, loss. Short means expectation price will fall. If it falls, profit. If it increases, loss. Based on that, step 3, prepare a margin. Is this clear, everyone? Yes, daily profit or loss is based on the closing price. Giving you guys a minute to let this sink in. Then we'll go ahead to the next concept, one of the biggest concept, which is going to be arbitrage using futures. Yes, everyone. Now let us proceed further to concept number 3, which is hedging using futures. One of the most important concepts, beautiful, simple concepts. Now, the maximum questions in forwards and futures will be coming from this concept. And 8 out of 10 times, if a question comes in the exam, question will also be coming on this concept. So we'll have to understand this in the beautiful way, props. Is this clear? Are we ready to do that? Yes, boss, we are ready to do that. So first, let us try understanding the golden principle for hedging. Yes, very simple principle, students. Always take reverse position. That is originally, yes, if you want to reduce the risk, na, take opposite position. If you want to increase the risk, take the same position in futures. Simple. Let me try explaining using a simple story. Okay. Yes. Golden principle for hedging. Yes. If you want to reduce the risk, take opposite position. If you want to increase the risk, take same position. Sir, what nonsense is this, sir? Simple example I'm giving. Imagine India-Pakistan match is happening. Okay. This is me. This is Koti. I am telling India will win 1 lakh rupees bet. Koti is telling Pakistan will win 1 lakh rupees bet. Is this clear, everyone? Okay. Yes. I have now taken up a position. Yes. I have already taken a position that India will win. Now tell me, students, have already taken up a position. Now what all can happen? Either a profit or a loss. If India wins, I will lose 1 lakh. If India loses, I will be losing 1 lakh. Yes or no, everyone? Perfect. Same is the Koti story. Perfect. Now, midway through, yes, India's batting, yes. Pakistan's batting got over. They scored really well. Imagine they scored 370 runs. India started batting. India's batting is very bad, very terrible. Imagine for 200, India has lost 8 wickets. Now understand what will happen. I have originally taken a bet. What is the original bet that I've taken? India will win. Now I am having a fear. Boss, looking at the scorecard right now, I think India cannot win at all. Yes. Am I having a risk? I am having a risk. So what I want to do, I want to hedge my risk. Now, how do I hedge my risk? In order to hedge your risk, take opposite position. Very simple. Tell me what is the position I had taken. I took up a position that India will win. If you want to hedge your risk, very simple. Take up opposite position. Take up a position that Pakistan will win. Your risk will automatically get hedged. Sir, how is it, sir? Simple example, I will give it to you. Imagine here I took up a bet that India will win. Imagine here there was another person who was still supporting for India. Now I realize, boss, India winning is going to be difficult from here. I'm having a fear that I will be losing 1 lakh. In order to prevent that, what I did, I took up opposite bet here. Yes, there was this person who was sitting here as well. He was still cheering India, India, you can win India, you can win India. I told India will not win. He's telling, no, no, India will win. I tell Pakistan will win. He's telling 1 lakh rupees. Yes, I'm telling 1 lakh rupees bet. He's telling 1 lakh rupees bet. So I took up two bets. Here I had already taken up a bet that India will win. Yes or no, everyone? Now I'm having a fear. I'm having a risk. To hedge my risk, what I do, I take up a reverse position that Pakistan will win. Now understand my risk is completely hedged. Look at the beauty, students. Yes, I took first position that India will win. I took up the second position that Pakistan will win. Now, irrespective of whatever is outcome, I can easily sleep. Sir, why, sir? Imagine in reality, if India will win. With Koti, I told that India will win. Yes, I win 1 lakh. But boss, there was the other person with whom I told that Pakistan will win. Tell me, did Pakistan win? No. So I'll have to pay him 1 lakh. I will lose 1 lakh. Yes or no? So the net profit or loss is going to be zero. Imagine Pakistan wins. So tell me, Koti, yes, with him I put a bet that India will win. Did I win the bet? No, I lost the bet. I'll have to pay 1 lakh. But boss, the other place, I have won the bet. I will win 1 lakh rupees. So overall, my profit or loss is zero. Yes or no, everyone? Hedging means I already have an existing exposure. But boss, right now I'm having a fear. To eliminate the risk, what you will do? Take opposite position. Is this clear, everyone? So if you want to reduce your risk means you will be taking opposite position. Okay, boss. But you will be having a doubt, sir. What is the point, sir? You could have won 1 lakh na. If you had just put up a bet that India will win. If India would have won, you could have won 1 lakh na. In this case, you are making neither a profit nor a loss. Understand the mindset of a hedger, my dear students. Hedger is right now not in a mood to make profit. He doesn't want loss. That's all. Simple. Match started. I put a bet that India will win. Why? Because I was expecting India to win. Thereby, I was expecting I will make some money of 1 lakh rupees. But boss, match reached midway. Now, Pakistan has scored 350. India is 200 for 8. I know India will lose for sure. Right now, I'm not thinking of making money. My only hope, prayer is that somehow, boss, I think that I am going to lose 1 lakh. Somehow, if I can come up with something that will ensure that I don't lose 1 lakh, that will be the best thing I can do. That is the mindset of a hedger. Hedger is not thinking to make profit. He is just thinking, somehow I don't want to make loss. How can I do that? That is going to be the mindset of a hedger. Is this clear, everyone? Okay. So hedger is not thinking about profit. He is only thinking about eliminating the loss. Now there is one more possibility. If you want to increase the risk, in reality, in practical situation, it will not happen. But institute, in some examples, they have put this. So for that purpose, we are seeing this. Look at this, students. Yes, original position I have put that India will win 1 lakh rupees. Now here I want to increase the risk. With the other person also I will tell India will win 1 lakh rupees. Now what will be the outcome? Tell me, students. Yes, bet 1, position 1 I have taken, India will win. Position 2 also I am telling India will win. Now imagine in reality India wins. Tell me, from the first bet I will win 1 lakh. From the second bet also I will win 1 lakh. So total 2 lakh I will win. But if in case India loses, first bet also I will lose 1 lakh, second bet also I will lose 1 lakh. So total 2 lakh I will. Yes or no, everyone? So overall my risk has rate increased. Is this clear, everyone? Perfect. Yes. So look at this golden principle for hedging. Yes. If we want to reduce the risk is always measured in the form of beta. I will be taking opposite position. But if I want to increase the risk, I will be taking the same position. Is this clear, everyone? Okay. Now let us come to future market. What all positions are there in future market? Either long position or short position. Imagine originally I am having a long position in the cash market. Two markets are there: cash market, future market. In cash market, I have invested, so I'm having a risk. That is why to hedge, I am going for future market. Simple example: I have purchased the shares of Reliance. I have already purchased. Yes, it is in the cash market. Which position I have taken? I have purchased. Purchase means buy. That means long position. I am having a long position in the cash market. Yes or no? Now I'm having the risk. To hedge my risk, what I will do? If I want to reduce the risk means I will take opposite position in the future market. Here I'm having long. I will take a short position in future. But if I'm telling no, no, boss, I want to increase the risk, take the same position. Here you're having long. Take a long position in futures. Is this clear, everyone? Okay. Yes. Situation two. Imagine you are having a short position in cash market. Okay. Yes. You want to reduce your risk. Take opposite position. Take a long position in future market. You want to increase the risk. Take the same position. Take short only in futures. Is this clear, everyone? Okay, fine. Now, what all can be possible? Yes, either hedging can be done using the respective share futures, or hedging can be done using index futures. Yes, hedging using the respective share futures. This is not important. This is not even going to come in the examination. For us in the exam, what we will be having is hedging using index futures. Now, to take the discussion forward, whether risk is hedged or not, all these things, profit or loss calculation. Okay, fine. Yes, from here onwards, what we will do, students, just 2 3 months back, I have recorded a video on YouTube. Yes, wherein derivatives we have in detail covered. Yes, hedging using futures. That concept in detail we have done. So what I will do, I will not be taking it again from here. Yes, in the video, I will crop it in such a way that that discussion will come here, because this is a very important discussion. Approximately 2 2.5 hours. We have understood the entire concept of hedging. Yes, we have given examples. We have solved all different variants of questions, master questions also. So what I will do is, from here onwards, that portion I will add. Yes, the next concept we will continue our discussion. Is this clear? Because right now the time is a bit short. Is that video is anyways there on YouTube? I will crop and upload it on YouTube. Is this clear, everyone? For YouTube students, yes, you will see a different color shirt. Don't worry, boss, it is me only. Yes, concept is going to be same only. Beautifully, in a very detailed way, we'll be understanding that as well. Okay, everyone.
Now, what is it we were discussing? Let me quickly summarize whatever we were discussing. First, I told hedging. Yes, what I will be doing for hedging. If I want to reduce my risk means opposite position. If I want to increase my risk means same position. Okay. Point number 2, I told how can we hedge. Either you can use the respective share futures or you can use index futures. Respective share futures, we told it is very simple. Yes, I told Tata Motors share I had purchased long position. I want to hedge my risk. That means I will be taking a short position. Now we wanted to see if I take a short position whether my risk is fully hedged or not. For that I wanted to know how to calculate profit or loss. That is why we came here. Now let me go back to the story. Look at the students. Yes, what happened? I had purchased one Tata Motors share of 500 rupees. That is basically long position I had taken. I wanted to hedge my risk, reduce my risk. So I went for short futures. How much amount? 500 rupees. How much did I go for long? 500. Short also I will be doing 500 only. India will win 1 lakh rupees. That means opposite bet. Pakistan will win. That also I will be putting 1 lakh bet only. Only then it will be nullified. Is this clear, everyone? Now let me try seeing what will happen. Pay attention. Yes, here we are calculating profit or loss now. Look at the students. Yes. Let us check whether my risk is perfectly hedged or not. Tell me, students, two different markets, two different bets I have taken. Spot market, cash market. First bet, what I told, I had purchased the Tata Motor share. That is, I had taken a long position in Tata Motor share at 500 rupees. That day only, yes, I took a opposite bet because I wanted to reduce my risk. Yes, 3 months Tata Motors futures, I had taken a short position. Yes, at same 500 rupees price. Is this clear, everyone? Okay. Now imagine. After 3 months, the actual price of Tata Motor share became 300 rupees. Okay. Yes, this is the expiry of futures contract. Now there is a thing that okay, on the date of expiry, your spot price and future price, yes, will intersect and they will become one. It's a point of convergence. Right now not needed. Yes, I am assuming that okay, spot price and future price is same only. Is this clear, everyone? So 3 months later, Tata Motors price became 300 rupees. Now how do I calculate profit or loss? Pay attention. Aram se simple jujube. Trust me, this is what students consider to be one of the most difficult things. Jujube it is. What is it? Jujube. Halwa. Okay, everyone. Tell me, first, two different markets separately only will do my calculation. Okay, first coming to my spot market, cash market, that is basically share market. Tell me what is the original position I had taken. Originally, I took a long position. That is, I had purchased. At what price I had purchased? 500 rupees. Tell me when I am buying means I am paying or receiving. A paying, that means money has gone. Yes, in order to calculate profit or loss, what I'll have to do? I'll have to take a reverse position. Long means short, that basically means sell. Tell me today what is the price? 300 rupees. So today if I am selling 300 only I will get, but when I purchase I paid 500. Happy or sad? A profit or loss? Loss. I am having a loss of 200 rupees. Is this clear, everyone? Okay, this is in my spot market, cash market. But boss, one more bet I am having in the future market. Tell me, future market, what position I had taken? I had taken a short position, which basically meant I am selling at what price I sold? 500 rupees. That technically is my inflow. Yes, in order to calculate profit or loss, I'll have to take a reverse position. This was short, means I'll go for a long position. That is basically buy. Yes, today what price it is prevailing? 300 rupees. That means at 300 I will buy 300. Yes, I'm buying, I'm paying. That means tell me what is the profit or loss? 500 I sold, I received. 300 I purchased, I paid. That means a net 200 is going to be my profit. Yes or no, everyone? So tell me, at one place I lose 200, at one place I gain 200. Net 0. Yes or no, everyone? One more situation let me take. Imagine after 3 months Tata Motors share price increased, it became 750 rupees. Now tell me, spot market. What I did, I took a long position at 500. So I will tell, okay boss, I took a long position, that is buy at 500. So I am paying money. 3 months later, I have to calculate profit or loss. I'll take a reverse position. Long means short, that basically means sell. What is the price today? 750 I received. So 500 I paid, 750 I received, 250 is my profit. Yes or no? Now coming to futures market. Futures market, what was the position I took? Short. I took short. That basically means sell. At what price? 500 I sold. So money I am getting. 3 months later, to calculate profit, I'll take a reverse position. Short means here I'll do a long. That is basically buy. Today I am buying. What is the price in the market? 750 is the price. That means I'll have to pay 750. Yes, 500 I received, 750 I am paying. Profit or loss? Loss. 250 is my loss. Yes or no, everyone? Perfect. So tell me. 1 place 250 profit I made, 1 place 250 loss I incurred. Overall 0. Yes or no, everyone? Perfect. Hedging using the respective share futures is over. Very simple this is. And you know what? A question will not come on this. So then, sir, why did you spend so much time on this? Because once you have understood this, only then we can go to hedging using Nifty futures. Okay? Perfect. Now look at this. How do we hedge? Hedging using the respective share futures. Suppose I am having a long position in the cash market. Yes, that is I have purchased shares. Tell me, if I want to hedge my risk, if I want to reduce my risk, means what I'll have to do? I'll have to take an opposite position. Here, if I'm having a long position, means here I'll be going for a short position on future market. Is this clear, everyone? Suppose I'm having a short position in cash market. That means in order to hedge my risk, eliminate my risk, I'll have to take opposite position. This is short, means I'll go for a long futures. Is this clear, everyone? Okay. Sir, how much amount of futures I should be going for, sir? Yes, whatever is the value of my share, now on that much value only I'll be going for a futures. Yes, sir. In my first example, I told 1 lakh rupees India will win. In order to fully hedge, yes, I told next bet, opposite bet, 1 lakh rupees Pakistan will win. Only then my risk was fully hedged. Here, Tata Motors, yes, 500 long I went. That means in order to fully hedge, Tata Motors futures, 500 short I went. Is this clear, everyone? So how much value of future I have to go in? How much is the value of my share portfolio? That much value only future I'll have to be going for. Till here, everything is clear. Any doubt? Maja is coming up. Absolutely no complication. Yes, from here the real maja will start. Yes, which is going to be hedging using index futures. Beautiful, beautiful, beautiful. But for us to understand this, whatever we have discussed till now was important. Let me just have a sip of water, then we'll continue our discussion. Okay, and one very important thing, till here if you have understood properly, maja has come, means trust me, going further, more maja is about to come. Crazy it is going to be. So if you have loved, means chumma you are watching and going, very bad. Like, share it all your friends and put in your valuable comments also. Yes, everyone, so let us continue our discussion. Now I have taken a small break for the prayers. Okay, so we have finished 2 points. Golden principle for hedging. I want to reduce risk, take opposite position. I want to increase risk, take same position. Then we have understood how do we hedge using the respective share futures. That is, if you are having a long position, yes, to reduce risk, take a short position. If you are having a short position, take a long position. Yes, same amount as your share portfolio, you will be investing in futures. Okay, fine. But till now, whatever we have discussed will not be coming in exams. Sir, you wasted 1 hour, sir. The principles are going to remain same. Okay, but for us, what comes in the examination is we'll be hedging using index futures. Now, index futures means Nifty or yes, Sensex. Yes, it is also called as 4 different names. One person with 4 names. It is called as market, index, Nifty, Sensex. All 4 means the same. Okay. Now comes the question, sir. Why are we using the index futures, sir? Yes. Why are we using index futures when we are having the respective share futures? Okay. Yes. A share is there. Suppose Reliance share is there. We can directly use Reliance futures. Now why are we going for index futures? Now only in 2 situations we will be going for index futures. When? Yes. Situation number 1. Yes. The share future for the respective share is not available. Say for example, I have invested in a random small company which has just come up with IPO. Random Jujube. Okay, small baby company it is. Yes. Now, if futures should be available, futures will be available only for big companies. Say for example, simple, betting is happening. Okay. Suppose India-Pakistan match is there. So many people are watching. So many people will be doing their betting also. Suppose a random match is happening. Pakistan-Zimbabwe or Ireland-Netherlands. Will there be anyone to do the betting? No. So, will there be bookies who are so concerned about that? Same thing. Reliance, a big company. So many people are speculating. The price will go up. The price will come down. Yes, futures will be there. Suppose a random small company. Yes, which has just come in the stock market. Okay. Yes. There will not be futures available. But I have purchased. I am having a long position. Yes. In the share market, I have purchased that share. How do I hedge my risk? Yes. In that case, you can go for index futures. Or situation number 2 is I want to hedge my portfolio of many shares. I am having a portfolio wherein I am having 10 different shares. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Now, either for every share I can take a respective future, or instead of taking 10 different futures, yes, I'll take, for the entire portfolio, I'll be taking the index futures. Okay. Now, why am I taking that is not going to be a big deal. Okay, fine. But still I have explained, yes, only in one of the 2 situations. Either respective share future is not available or I am having a big portfolio. So, instead of individually hedging, I'll go for a index future. Okay. Now comes, sir, our share is there, index is there, market is there. I am presuming you guys have a small knowledge of portfolio management. Or if you are not having, yes, I have uploaded a detailed, beautiful marathon of portfolio. Trust me, you think portfolio management chapter has so many formulas? Simple logics, simple stories. We will keep deriving everything. Trust me, one of the most beautiful marathons on portfolio you will ever see. If you are having even the smallest hint of doubt, please do refer that. Because one concept of portfolio will be using it here. That is the concept of beta. Okay. So what is the connecting link between our portfolio and index? Now, in the previous cases, we knew that, say for example, yes, whatever bet we took, it was 1:1 basis. Say for example, yes, I took first bet I took is India will win 1 lakh, Pakistan will win 1 lakh. So if India wins, Pakistan loses. Exactly this happens. If Pakistan wins, India loses. Exactly this happens. Yes or no? Or Reliance share, Reliance futures. Exactly same percentage movement is happening. But my portfolio, my share portfolio as well as index will not move in the same direction or not changing by the same percentage. So there is a connecting link between my share portfolio as well as the index or the market. That connecting link is called beta. In portfolio management, you would have heard that. I'll just give you a small idea of what is beta formula because we'll be using it subsequently, but not going into detail. 1.5 2 hours of detailed discussion, beautiful derivations of those things are there. You can refer that marathon. Okay, now what exactly beta is telling? Beta is a connecting link between our portfolio and index. Beta measures the systematic risk, that is a market risk, discussed in detail in the chapter portfolio management. Okay, yes, what exactly beta is telling? Beta is telling that, boss, if my market changes by 1%, by how much percent my share is changing? That is what beta is telling. Yes, look at this. Beta, it is a percentage change in my portfolio for 1% change in market. Okay, simple. Now look at this, look at this, look at this. If beta of a portfolio is 1.5, what does it mean? It means that, yes, my portfolio will change 1.5 times of the market. That means if market will increase by 1%, my portfolio will increase by 1.5%. If market will decrease by 1%, my portfolio will decrease by 1.5%. Is this clear? Yes, beta is equal to 2. What does it mean? If market is increased by 1%, my portfolio increased by 2%. Market decreased by 1%, my portfolio decreased by 2%. Is this clear, everyone? Okay, perfect. Now, how do we calculate? Here, for this specific chapter, we only want the simple formula of beta that we will discuss. Yes, there are many more formulas, portfolio. Okay, yes, now. In one day, yes, imagine my market increased by 3% and on the same date, my shared portfolio increased by 6%. Calculate the beta. Tell me students. Yes, when market increased by 3%, share portfolio increased by how much? 6%. That is 2 times of market, yes or no? So I will tell boss, one day when market increased by 3%, my portfolio went up by 6%. I want to calculate beta. What does beta tell? Beta is telling, boss, if market changes by 1%, by how much percent my portfolio will change? Cross multiplication, yes, it is 6 divided by 3, beta is 2. Yes or no? My portfolio is changing 2 times that of market. If you want to write it in the form of a formula, what is 6? Yes, it is a change in share portfolio, change in portfolio percentage. Yes, what is 3? It is change in market percentage. Simple formula, this is what we want here. Is this clear, everyone? So I have written down the formula here. Again I am telling, yes, more discussion on beta portfolio here. Yes, not even needed. This is again a marathon. Okay, still I am telling. It is percentage change in our portfolio divided by percentage change in market or index. Is this clear, everyone? Now, 5 steps we want to solve a question wherein we are having index futures. Students consider it to be one of the most difficult. So many questions are there. I have told 8 out of 10 times. If a question comes on futures, forwards and futures, that question is going to be on this. Apart from this, some small GGB topics only are there in forwards and futures. You are having theoretical pricing of a future, again GGB. Arbitrage is there, beautiful concept, but institute is not testing much. Then you are having a question on margins, initial margin, maintenance margin. Profit or loss I have already explained. Is this clear? This is going to be the thing. 8 out of 10 times question is coming on this. And yes, there are so many formulas, students by heart the formula, they tell, okay, they commit a lot of mistakes. So many complications are there. Trust me, I am giving you guys a promise. You will tell this is the most GGB thing ever. I have told you, I am not going to explain. You will explain. Sir, 5 steps are there. So much is there, sir. Yes, look at the steps. Step 1 will calculate desired change in beta and action to be taken. Step 2 will calculate total value of share contract. Yes. Step 3, price of a contract. Yes, number of index futures to be bought or sold. Step 5 is going to be profit or loss. Sir, so much is there, sir. Should you buy it, sir? I am there now. I will tell you a story. You will only tell me logic. You will only derive now. Simple. Keep it simple. Okay. So, are we ready for the magic, everyone? Yes, sir. We are ready. So let us go ahead. Just a minute. Okay. Let us go ahead. Okay, hedging using index futures. Okay, fine. Yes, all I want is the basic principles that we have already learned. Two simple principles we had learned. Principle number one we had learned was, is if I want to reduce risk means opposite position, increase risk with same position. Okay. Principle number two is, yes, how much amount I will be investing. Yes, first bet I took India will win 1 lakh. Opposite bet I took Pakistan will win 1 lakh. Yes, same amount bet I took. But here I'll have to change. I'll explain. Don't worry. Okay. Now assume you have invested 10 rupees in a portfolio of stocks having a beta of 2. Imagine you guys are all rich people going for articleship, getting crores and crores of stipend. Yes, sir. There's a beautiful video, I guess. Yes. How much do you earn? Yes, I earn pretty well. I earn in lakhs. So they ask how much lakhs? 0.1 lakh. That way you can tell. Yes, I earn 1 lakh minus 99,000. Yeah. Okay. So imagine from your articleship money, you thought, okay, you will invest in stock market. So you had 10 rupees with you. Sir, what, sir? You're also making fun of us. That time will come. You will play in cross. Okay. So today, focus, work. Okay. Simple example we are keeping. Imagine you invested 10 rupees in a portfolio of shares. They are having a beta of 2. Yes, what does beta of 2 mean? Beta of 2 means that, yes, my portfolio is changing 2 times that of market. Market increases by 1%, my portfolio increases by 2%. Market decreases by 1%, my portfolio decreases by 2%. Okay. You have a fear of falling the portfolio value. For you, 10 rupees is a very big amount. Oh my God, if this 10 value reduces, what will happen to me? So what you want to do? You want to hedge your risk by using index future. You want to hedge your risk. Now are you thinking of profit? Not thinking somehow. I just want to eliminate my risk. So to hedge your risk, what you are using? You are using index future. Either respective share future is not available or you are having a portfolio. So instead of individual doing, you thought, let me use index future. Okay. Calculate the value of futures and action to be taken. Now, in order for us to calculate this, yes, a simple point we should be knowing. Yes, let me just write and keep here. Yes, beta of index is 1. Yes, this is one basic point in portfolio. Beta of market index, Nifty, Sensex, all of that is 1. Because you are calculating the change with respect to the market. So, market is always going to be 1 loss. Not explaining much again, but a simple thing. I am seeing beta is how much percentage my portfolio will change. For 1% change in market, tell me if 1% market is changing, by how much percent market will change? 1% only, na? So beta of market is always going to be 1. Simple point I just wanted to tell. Now, calculate the total value of futures and action to be taken. Simple. Aram se. I am not going to do anything. You will only tell. Okay. First step. Yes. Tell me what position you are currently having. Sir, currently in the cash market or the spot market, which is basically the share market, you have invested money. That means you have purchased the share. That means you are having a long position. So you are having a long position of 10 rupees. If she is having a beta of 2 rupees. Yes or no, everyone? Perfect. What do you want to do? You want to hedge your risk. You want to reduce your risk. Tell me. Yes, currently you are having a long position. You want to reduce your risk. That means what you will be taking? Opposite position. That means you will go for a short position. Yes or no, everyone? Yes, I want to bring my risk to 0. That means I want to reduce my risk. That means what I will be taking? I will be taking an opposite position in futures market. Yes, here I had a long position. That means I will go for short position. That is sell index futures. Till here any doubt? Sir, no doubt, sir. GGP, sir, you tell further, sir. Okay. Position is not a doubt. But how much money should I invest is a doubt. Okay. Yes, tell me. Yes, how much money you had taken a long position? 10 rupees. That means tell me how much amount you should be taking a short position. Simple, sir, 10 rupees. Yes or no, everyone? No. This is where the catch comes. Are we ready for the magic, everyone? Yes, excitement. What's in the feelings? Excitement. Okay. Yes. Understand, beautiful Maja concept is going to come for you guys. Okay. So the question is how much total value of index futures I should be selling? How much total value of short position I should be taking? You will be telling, sir, simple, sir. Long position was for 10 rupees, sir. That means short should also be for 10 rupees. No. Till now we had seen that. India will win 1 lakh, I told. That means if I am taking the reverse bit, I also told Pakistan will win 1 lakh. But there the percentage change was exactly same. Here beta will come into picture. Tell me if my market increases by 1%, I am using market index. Yes, whether my share portfolio will increase by 1%, no, 2% it will increase. That means some adjustment has to be done. That is what we will be understanding here. Pay attention. Imagine for the time being, let me assume I take a short position of 10 rupees only. Okay, if we short 10 rupees only, what will happen? So understand what all positions I am having currently. In the cash market, I am having a long position of 10 rupees. Yes, in the futures market, I am having a short position of 10 rupees. Okay, fine. Now suppose at the end of first day, what happened? My index fell by 10%. Index fell by 10%. Yes, that means tell me my share portfolio will decrease by how many times? Tell me what is beta of the portfolio? 2. That means my share will change 2 times that of market. Yes, market fell 10%. That means my portfolio will change by 20%. Yes or no, everyone? Perfect. So I want to calculate profit or loss. Let me aram calculate profit or loss. First, in cash market, what you had done? You had invested. That means you had taken a long position for 10 rupees. Yes or no, everyone? So I'll tell you, we have a long position of 10 rupees. That is basically by, okay, you've paid money. To calculate profit or loss, you will take a reverse position. Yes, that means long means here you will go for a short position. That means sell. That means basically end of the day you are trying to sell your share portfolio. Tell me your share portfolio has reduced by how much percent? 20% it has reduced. Tell me how much was the original value? 10 rupees. 20% it has reduced means now how much is the value? 8. Short means sell. When you are selling you are receiving money plus. Yes or no, everyone? So that means what is your overall profit or loss? Yes, 10 rupee you paid, 8 rupee you received back, 2 rupee loss. Yes or no, everyone? Till here any doubt? No doubt, sir. Yes. Students by heart so many formulas to do this calculation. Original value plus this, so much nonsense they are doing. Keep it simple, no formula, absolutely. Okay. Now coming to futures market. Futures. Tell me in futures market what was the original position you took? You went short for 10 rupees. Yes or no, everyone? So original I took a short position, that is basically sell. How much? 10 rupees money I am getting. Now end of the day you want to calculate profit or loss. That means you will be taking a reverse position. Short means here you will go for a long. That means buy. Tell me end of the day where you have taken a short position in index. Tell me how much percentage did my index fall? Index fell by 10%. Originally it was 10. Now it fell by 10%. That means it became 9. So at 9 I am going for a long position. Long means buy. I am paying money. Yes or no? That means what is my profit or loss? I sold at 10. I am buying at 9. That means 1 rupee profit. Yes or no, everyone? Yes, that means tell me. I am having a 2 rupee loss. 1 rupee gain. That means what is my net loss? Net loss is still 1 rupee. Yes or no, everyone? Tell me whether my risk is fully hedged. No. If my risk was fully hedged, my net profit or loss should have been 0. Yes or no, everyone? Perfect. So I understood that. Okay, moral of the story, I understood that I am having a long position in cash market. That means I should be taking a short position only. But I understood that if I am having a 10 rupee long position, 10 rupee short is not sufficient. Now we'll understand why. Okay, pay attention. So comes the question, why is my risk not fully hedged? Yes, when we are taking a long position of 10 rupees, yes, my share is having a beta of 2. That means its risk is 2 times that of market. That means it will change 2 times that of market. That means if I have to fully hedge my risk, I'll have to invest, yes, take a short position for 2 times the value of my portfolio. Let me explain. Aram se will go. Okay. Going beyond that. Chill. I am there, don't worry. Okay. So it is 2 times more volatile than the market. So that means in order to hedge, I have taken short futures. Yes or no? Look at this. Okay. Yes. I am having, yes, what was my original position? Yes, original position in cash market was long for 10 rupees. But it had a beta of 2. Yes, beta of 2 was there. Now I want to fully hedge. That means I want to bring my risk beta to 0. Yes, that means I'll take a reverse position, short position. Okay. But what is the beta of index? I am using index, yes or no? What is the beta of index? Beta of index is 1. That means my index will reduce the risk only by 1 time. Yes or no, everyone? Perfect. So look at this. So when we short futures, yes, I am reducing the risk. But my Nifty will reduce the risk only 1 time because beta of Nifty is going to be equal to 1. That means if I take a short position of 10 rupees, what will happen? Tell me I have taken a long position of 10 rupees. Okay, aram se. Yes, this is where most students make it complicated. Simple. Cash market. Originally 10 rupees share you purchased. How much was the beta? 2 times was the beta. 2 was the beta. Okay, this is what you had done. Now you want to reduce the risk. That means what you should be doing in the futures market? Short you will be doing. Yes, imagine you take a short position. Okay, short means your risk is coming back. But you are taking a short position using the same future. You are using the same share or using Nifty. I am using Nifty, that is index. Index will reduce the risk. How many times only? 1 time only. That means if I take a short position for 10 rupee, By one time my beta will be reduced. I want to bring my beta to what? I want to bring my beta to 0. That means 10 rupee if I take short, my risk becomes 1. I want to bring my risk to 0. Again a 10 rupee short I should be doing. Yes or no? That means total how much rupee short I should be doing? 20 rupee short I should be doing. Is this clear everyone? Yes or no? So I am telling, if I short by 10 rupee na, I will reduce the risk one time. I want to reduce the risk 2 times. That means total 20 rupees short I should be doing. Is this clear? So the total value of future is 10 into 2. It is going to be 20. Simple formula. It is nothing but your total portfolio amount into beta. Yes or no everyone? In our case, my share portfolio was of 10 rupees. It was having a risk of 2 times. I wanted to bring it to 0. That means into 2 times 20, I will be taking a short position. Is this clear everyone? At least reasonably fine. Got an idea? Yes or no everyone? Don't worry, we'll make it pakka clear. Okay? Yes. Now, till here things are clear. Let me repeat one more time. Very simple thing, students. Yes, trust me. Yes, just line will draw, with line everything will be clear. Now look at this. Sometimes if your life is not working out, all you'll have to do is a proper line. Sir, what you are telling, sir? To solve questions, I am telling the what all you are thinking. Okay, imagine I am having absolutely no position. What is my risk? My risk is 0. You took the first position. What you did? You took a long position of 10 rupees. Yes or no? In the cash market. Long position of 10 rupees in the cash market you took. Okay. Now, how much is the beta of your portfolio 2? That means you are having a risk of 2 times. Yes or no? You are having a fear. You want to reduce your risk. Using which one you are reducing your risk? Sir, I am using Nifty futures to reduce my risk. Okay. Tell me what is the beta of Nifty? Beta of Nifty is 1. That means if you invested 10 rupees now, if you take a position of 10 rupees, your Nifty will change the risk by 1 time. To reduce your risk, you are taking a short position. Okay. Position you are going to take is short only. But if you take a bet of 10 rupees now, what Nifty will do is, Nifty can reduce the risk 1 time only. It can bring to, yes, your beta to 1. Where you want your beta to be? You want it to be 0. That means again a 10 rupee position you will be taking. That means total how much rupee position you will be taking? 20, which is basically 10 into 2, which is a value of portfolio into the beta. Till here, is this clear everyone? Give me a confirmation. Okay. Now, if this also is not clear, I have a very simple jujube story for you guys. Pakka you will understand. Ready? Okay. Imagine. You have qualified, you have become a CA or a CMA. Imagine you're having your boyfriend or your girlfriend. You guys decide to go on a big trek. Only 2 of you. Sir, Himalayas, trekking up the mountain. Don't imagine anything else. Okay. Both of you guys are going. Maja is coming. Both of you guys are holding the hands. Sir, crazy, sir. Sir, become CEO also, got a girlfriend also, sir. Dream become true, sir. Focus. You have to study first. Okay. Now, what you did is, you are climbing the Himalayas. La, Maja is coming. Okay. Now, imagine both of you guys are there. Yes, you did a trek for 10 hours. For 10 hours, continuously non-stop, you went up the Himalayas. Yes, your speed was at the rate of 2 km per hour. Slowly, you are holding hands, you are speaking. Slowly, you are doing most softest hands ever. All those, I also know all those things that you guys do. Okay. So, can you guys tell me total how much distance you guys have traveled? 10 hours, every hour you have traveled 2 kilometer. Yes or no? That means total 20 kilometer distance you have traveled. Yes or no, everyone? Perfect. 20 kilometer you have traveled. Simple. Now let me show this to you guys. Yes, look at this. You were standing here at point 0. Yes, every hour 2 kilometer you traveled. 2. This way 10 hours you traveled. Yes, here now you are at 20 kilometers. Is this clear, everyone? Okay. Now, by the time you reached here, you are having a risk, you are having a fear. You reach almost the top of the mountain. You feel, yes, you cannot take breathlessness. You are having a fear. What if earthquake comes? What if something happens? Risk is there. So now you guys want to come back. You want to hedge your risk. That means you want to nullify, you want to come back to 0 again. Is this clear, everyone? Okay. Now, imagine, by the time you reach this place now, yes, your girlfriend or boyfriend, whatever it is, yes, they got a pain in their legs. So now they are not in a position to walk in their normal speed. Okay, so you guys are walking slowly. Yes, you want to hedge your risk. That means you want to come back. Okay, but when you guys are coming back now, you cannot walk in your normal speed. Yes, while you are coming back, you cannot walk in your normal speed. You can only walk at 1 kilometer per hour. Yes, your speed is only going to be 1 kilometer per hour. Tell me, yes, when you were going, at what speed you were going? 2 kilometer per hour, 2 kilometer, 2 kilometer, this way 10 hours you went, 20 kilometer you reach. Now you are coming back. Yes, at what speed you guys are coming back? 1 kilometer, 1 kilometer, 1 kilometer, 1 kilometer. Tell me, to bring your risk to zero, that is to come back to this point, total how much hours you should travel? Yes, tell me at what speed you guys are coming? Only 1 kilometer speed you are coming. That means total how much hours you should travel? 20 hours you should travel to completely nullify your risk, come back to zero. Yes or no, everyone? Same thing is happening here, students. Exactly same thing. Look at this. Same thing pictorially I have shown here. Zero you had, you guys went 2 kilometer, 2 kilometer. Yes, 10 times you went, 20 kilometer you reached. Yes, now you are coming back. But when you are coming back, yes, is only at 1 kilometer per hour speed. So you will be taking total 20 hours to come back to your original position. Yes or no, everyone? Exactly same analogy. You had a long position, yes, of 10 rupees, but it had a beta of 2 times. Yes or no? That means your total risk weighted beta, your total beta was 10 into 2, 20. Yes or no, everyone? So zero you were. Yes, every rupee that you had invested had a beta of 2 times. 2 times it was riskier than the market. 2 times. So it reached 20. Now you feel, okay, boss, it is very risky. So I want to nullify my risk, fully hedge my risk, bring it to zero. That means I'll be taking an opposite position. Here I had long, I'll be taking short. Which one I am using to hedge? I am using Nifty to hedge. Tell me, Nifty will reduce the risk by how many times only? 1 times only. That means every time one time it will reduce. That means from 20, if you want to come back to zero, total how much times you'll have to be coming back? 20 times you'll have to be coming back. Yes or no, everyone? So the total index to be short to fully hedge is going to be 20. Same story. Is this clear, everyone? Simple jujube logics da. So unnecessarily we are complicating things. Till here whether things are clear. Absolutely no doubt. Perfect. Trust me, this was a very important landmark for us. From here subsequent things are going to be very simple only. Okay, now sir, how do we know, sir? Chumma, because you told 20 rupees if we take a short position means our risk is fully hedged. How do we believe you? Don't believe me, I'll show it to you guys. Okay, let us see the proof whether my risk is fully hedged or not. Tell me, cash position I had a long of 10 rupees. Yes, futures position I took a short position of 20 rupees. Now imagine end of the day, index fell by 10%. That means my share portfolio, what is the beta of it? 2 times. It is 2 times risky, 2 times volatile. That means if index changes, falls by 10%, my portfolio will fall by 20%. Yes or no? I know how to calculate profit or loss. Simple jujube thing. Take a reverse position. Tell me, originally I had a long position, long. That is basically by how much? 10 rupees. That means to calculate profit, I will take a reverse position, which is short. That is sell. Tell me, cash market, that is my share portfolio, end of the day, how much percentage it fell? 20% it fell. So it was a 10 rupees, it fell by 20%, it became 8 rupees. Yes or no, everyone? Yes, short means sell. When you are selling, you are receiving money plus. So you sold at 8 rupees, you received, you purchased at 10 rupees. Happy or sad? Sad. Profit or loss? Or loss. How much is your loss? The 2 rupees is a loss. Is this clear, everyone? Now come to futures market. Tell me, futures market, what was the position you took? You took a short position. For how much amount? 20 rupees you had taken a short position. So originally you had taken a short position. Short basically means sell how much amount? 20 rupees. When you are selling, you are receiving money. Now to calculate profit or loss, you will take a reverse position. Short means you will go for a long. That is basically buy. Tell me, futures market, you had taken a position in index. How much percentage did index fall? Index fell by 10%. So 20 rupee it was, it fell by 10%. 20 minus 10% became 18. On 18 you are taking a long position, means you are buying at 18 minus. Yes, this we also aram, so you can see you sold at 20, you purchased at 18. That means your profit is going to be 2 rupees. Arthamainda Raja. So tell me, in your cash market your loss is 2 rupees. In your future market your profit is 2 rupees. Overall your profit or loss is 0. Your risk is fully hedged. అర్థమైందా రాజా? టెల్ మీ పురింజడ్చా మనసిలాయో మాలూమ్ కా? Yes, for the people of north also, if you guys want me to make videos in Hindi, just put your request, I will do it. Okay, I know Hindi properly. Okay, but if you guys want me to make a video in Hindi, I'll do it. I know Malayalam, Hindi, Tamil konja konja Telugu konja konja కొంచెం డైలాగ్ మాత్రం. ఓకే, ఇంకేం కావాలి, ఫోకస్ ఆన్ యువర్ స్టడీస్. ఓకే ఫైన్. ఎస్, సో వాట్ ఈస్ ద మోరల్ ఆఫ్ ద స్టోరీ? వాట్ ఈస్ ద మోరల్ ఆఫ్ ద స్టోరీ? ఎస్, ద మెయిన్ లెసన్ ఫ్రమ్ దిస్ ఈస్, if I want to change the risk of my portfolio by 1 unit, okay, pay attention everyone, deep breath, control. If I want to change the risk of the portfolio by 1 unit, how much amount I should be investing in the futures? I will be investing an amount which is equal to the value of my portfolio. Yes or no everyone? In my, yes, this example, I had a long position of 10 rupees. It had a beta of 2. Yes, if I invest 10 rupees, if I take a position of 10 rupees in futures, yes, index futures, yes, my risk will change by 1 unit. Yes, which side it will change? It depends on the position you are taking. You take opposite position means your risk will reduce. You take the same position means your risk will increase. As simple as that. Is this clear everyone? Now using that, some simple examples are there. Yes, shall we play a kutti game? Are you guys ready? With this, our explanation thing is over. Then it is just taka solving. Every variant of question will do it. Okay, trust me, your confidence is going to reach a completely different level altogether. Let me just have a sip of water, then we'll solve questions. Yes everyone, look at this. Same example, but this case, now I want my beta to be different. Now look at this. Assume you have invested 10 rupees in a portfolio of shares having a beta of 2. Tell me right now, what is your beta of 2? You want to hedge your risk by using index future. Which future you are using? Index future. Tell me, index future will change the risk by how many units at a time? Only 1 unit at a time. Calculate the total value of futures. An action to be taken in the following situation. Situation number 1, I want my beta of portfolio to be 0. I'll show you guys a very simple trick. Tell me students. Currently, what position I have taken? I have purchased, that means I have taken a long position. Yes or no everyone? I have taken a long position in cash market. Okay, cash market, I have taken a long position. Right now, what is my risk? 2. Where do I want to bring the risk? Yes, I want to bring the risk back to 0. Yes or no everyone? That means I want to reduce the risk. That means tell me the action to be taken. Currently I am having a long position. That means I will be taking a short position. Yes or no? Till here, is this clear? Okay, fine. Which product I am using to reduce my risk? Am I using the respective share or index? Index at a time, how much risk only it will reduce? 1 unit risk only it will reduce. Tell me, yes, I want to reduce the risk from 2 to 1 and again from 1 to 0. That means 2 times of my portfolio I should be investing. Yes or no everyone? Yes, how much I have invested in portfolio? 10. So 2 times of that. So value of futures 10, 2 times of that 20. What position I will be taking in the futures market? I will be going for a short futures. Yes or no everyone? Any doubt? No sir. Now situation number 2, I want to bring the beta of portfolio to 1. So look at this. Same example, main example is same. Originally in the cash market, I took a long position of 10 rupees. Right now, what is my risk? What is my beta? My beta is 2. Yes, I want to bring the risk to what? To where I want to bring the risk? To 1 I want to bring the risk. That means tell me, I want to increase the risk or decrease the risk? I want to reduce the risk. That means what position I will be taking? Opposite position. I have long means here I will be going for short. Tell me how many units risk I want to reduce. From 2 I want to bring it to 1. That means 1 unit I want to reduce. That means how much amount I should be putting in futures? Yes, my long is 10. So 1 unit of risk I want to reduce. That means I will be putting 10. So I will tell 10 rupees short position I will be taking in futures market. Is this clear? Okay. Third situation, I want to bring down my, yes, beta of the portfolio to 0.5. Yes, tell me. Originally I took a long position. Yes or no everyone? Yes, how much amount? 10 rupees. Tell me what is my risk right now? My risk right now is 2. Yes, where I want my risk to be? I want my risk to be here 0.5. Yes or no everyone? Perfect. That means tell me, yes, I want the risk to reduce by how much units? 1.5 units of risk I want to reduce. Yes or no everyone? Perfect. Tell me, I want to reduce the risk. That means I will be taking a opposite position, short position. Tell me, yes, my index will reduce the risk one time by how many units? Only by 1 unit. Yes, that means long position was of 10 rupees. So if I take a short position of 10 rupees now, only one time risk will be reduced. That is from 2 it will come to 1. I want to bring it to 0.5. That means how many units of risk I want to reduce? 1.5 units of risk I want to reduce. That means total how much amount I should be putting? 15 rupees short position I should be taking. Yes or no? Simple. Jujjibi. Simplest thing in the world. From here, see how it is going to happen. Yes, I want to bring the beta of portfolio to 1.4. So tell me. Yes, right now long position I have taken. Right now my risk is to where I want to bring it to 1.4. That means tell me how much risk I want to reduce. 0.6 units of risk I want to reduce. Yes or no? I want to reduce. That means I'll go for a short position. Tell me what is the value of portfolio. 10 rupees is the value of portfolio. So if I take a position of 10 rupees, my risk will change by 1 unit. I want it to change by 0.6 only. That means I'll be taking a short position of 6 rupees. As simple as that. Now, final situation. I want the beta of portfolio to be 3. Tell me originally what I have done? I have taken a long position. Yes or no? That is I have purchased. Yes. How much amount? 10 rupees. What is my risk right now? What is the beta right now? 2 times. Now what I want to do? I want to reduce the risk. I want to increase the risk. Just a minute, students. Let me. Okay. Tell me right now what is my risk? 2 units. I want to reduce the risk. I want to increase the risk from 2. I want to take it to 3. That is basically I want to increase the risk by 1 unit. Yes or no, everyone? Tell me. I want to increase the risk. Will I be taking same position, opposite position? Same position. Original in my cash market is long. Here also I'll go for long. Tell me how many unit I want to increase the risk? 1 unit. My portfolio value is 10. That means 10 rupee long position I will be taking. As simple as that. Simplest thing in the world, my dear students. Is this clear, everyone? This much if you have understood, trust me, the entire concept is over. Just a small adjustments here and there will be doing. But trust me, yes, the thing that you were telling, hedging, very difficult, sir. Jujube. Something which you know already. Yes or no, everyone? Perfect. Now if this much is clear, so look at this, everyone. The final lesson is total how much money we should be putting in futures. So what is the total value of futures? It is the value of my portfolio and into the change in beta. Yes or no? Yes. In this case, look at this. My beta was at 2. I want to bring it to 1.4. That means I want my beta to reduce by 0.6. Yes or no? That means the total value of futures is going to be, yes, 10 rupee long I have, 0.6 units I want to reduce. That means 10 into 0.66 it is going to. Is this clear, everyone? Yes or no? Formulas chumma for namesake I am writing. Absolutely no need for that. And these formulas just I have created. You see the institute, you will find some other formula only. You will find some VP into BE minus BR, some divided by some 2-3 terms, something and all is there. If this is negative, this we should do positive. So much nonsense is there. Okay, absolutely no need. Let's see. Yes, declutter all the nonsense that's happening around. Is this clear, everyone? Give me a confirmation, students. If this much is clear, I will go for an example. We'll do 1, 2, 3 steps. Then I will show you the first 3 steps. Are you guys ready? Yes, sir. Let us come to the workbook. In workbook, I am having altogether 5 examples. We'll solve all 5. Once you solve all 5, any question in the world on your hedging using futures, you can do it. Trust me. Every model we have done. So are we ready, everyone? Yes, sir. So hedging using futures, type 1 is going to be basic questions. First, Rajnikant. There is nothing a Rajni can't do. Rajnikant has invested 50 lakhs in a portfolio of shares having a beta of 2. Okay, tell me, Rajnikant has invested. That means he has purchased. That means he has taken which position? The long position he has taken. Okay, fine, sir. He is worried about the falling value of his 3-month portfolio. He is fearing that his value will reduce. And he wants to hedge himself using Nifty futures. What he is planning to use? Index he is planning to use. 3-month Nifty futures is currently trading at 10,000. Right now, at what price? Nifty is available 10,000 and the lot size is 50. Okay. Answer each of the 3 independent situations. Yes. Each of the 3-4 independent situations are there. We are going to answer. Now, just a minute. Calculator is not there. Let me quickly get my calculator. Yes, everyone. So, the calculator is also ready. Are we ready for the Maja? Yes, I want all of you guys to comment. Maja is coming. And if you have loved the content till here means, trust me, you only take benefit, you don't share it to friends. That is now bad rule of friendship. Share it to all your friends. Tell your friends, Maja. Derivatives is a jujube. Tell jujube. Okay, let us. Situation 1, he wants a perfect hedge. So calculate the total value of futures, also the number of contracts if he wants a perfect hedge. Also calculate the overall profit or loss on the date of maturity. From the date of maturity, Nifty falls by 10% and share portfolio falls by 20%. Sir, nothing we understood, sir. You know everything. Aram se will do. Okay, first, Rajnikant is there. What he did? he has invested 50 lakhs in a portfolio of shares having a beta of 2. So tell me, yes, original what he has taken. He has taken a long position in cash market. Tell me right now what is his risk, what is his beta? His beta is 2. So I will tell, okay boss, yes, he has taken a long position in cash market. He is having a beta of 2. Yes, what he wants to do situation, he wants a perfect hedge. That means he wants to bring his risk to 0, 0, 0. That means tell me how many times he want to reduce the risk. He want to reduce his risk by 2 units. Yes or no, everyone? Tell me, yes, I want to reduce my risk means which position I will be taking. I will be taking opposite position. Original position was long. Yes, that means which position I will be taking. I will go for short futures. Yes or no, everyone? Perfect. How much is the value or change in beta? Let me just show change in beta. We are doing it stepwise. Yes, from 2 unit I want to bring my beta to 0. That means I want to reduce my beta by how many units? 2 units. Yes or no? So 2 minus 0 is equal to 2 units. I want to reduce my beta. Till here is this clear, everyone? Okay, so I've understood. Okay, which position I want to take short, how many units I want to change my beta? 2 units I want to change my beta. So step 1, I've seen the desired change in beta, how much change in beta I want, and what is the action to be taken. Step 2 is going to be the total value of futures contract. We know already. Yes or no, everyone? Tell me, Rajnikant is having a current long position of how much? 50 lakhs. So 50 lakh long position is having, his risk is how much? 2 units. I want to bring back the risk to 0. That means how many units I want to reduce the risk? 2 times. That means how much value of futures I should be investing? Yes, 50 lakh portfolio is there. 2 units I want to reduce the risk. That means total 100 lakh position I should be taking. Yes or no? Simple. Jujube. Tell me, everyone. Jujube. Yes or no, everyone? Perfect. Same thing in a single, yes, diagram only I am getting. I have just bifurcated into 2 simple steps. Step 1, I will see the change in beta and the action to be taken. Yes, existing beta is 2. I want to bring it to 0. That means change in beta is 2 units. And what is action to be taken? I want to reduce the risk. That means I will go for a short position. Step 2 is going to be total value of futures. Total how much value of futures I should be entering into. Yes, it is nothing but a value of portfolio into the change in beta. Tell me what is the value of portfolio? 50 lakh is the value of portfolio. Yes, I want to change the beta by 2 units. That means how much value of futures I should be entering into? 50 into 200 lakh. Till here is this clear? Okay. This is the total value of futures contract. Okay. Yes. Now step 3 is calculating the price of one future contract. I have told you guys, futures will be trading in lots. It is not possible you go and yes purchase a single future. You will have to buy minimum one lot of future, one contract of future. Tell me, if you see the question is telling, look at this, everyone, the second line. Yes, 3-month Nifty future is currently trading at 10,000. So today I go to stock market. I ask stock market. 3-month future I want. How much is the price? What will stock market tell? The Mandu say 10,000 is the price. Yes, what does Mandus mean? Mandus is a Malayalam term which means intelligent. So every time you go, you meet a person who is intelligent, you tell, Ada Mandu say. Okay? Okay. So they tell 10,000. So I tell 10,000, I want to take a position. What will stock market tell? Ada Mandu say. You cannot buy a single future. You'll have to buy minimum a lot. And tell me one lot has how many futures? 50 futures. That means tell me to buy or sell one lot. Total how much price is needed? 10,000 for one future into 50. That means it is going to be 10,000 into 50. How much is it going to be? 5 lakh. Yes or no, everyone? Perfect. So I will tell it is nothing but my actual future price 10,000 into lot size 50. It is going to be 5 lakh. Yes or no, everyone? Till here, is there any doubt? No. Am I touching upon any formula? Chumma for namesake I have written. Yes or no? What is the price of one contract? How much is the actual future price? For one future it is 10,000. Can I buy or sell one future? No, minimum one lot I want. In one lot I am having 50, so it is 5 lakh. Yes or no? Perfect. Now comes the number of contracts. Pay attention. Till now what all we have done? First I understood how much change in beta I want. Beta was 2, I want to bring it to 0. That means I want a change in 2 units of beta. What action I should be taking? Long was there, that means I will be taking a short. Step 1 over. Step 2, total how much value of futures. I told boss, portfolio value is 50 lakh. I want my beta to change by 2 units, 2 times. That means 50 into 2. Total 100 lakh position I should be taking in index futures. Is this clear? Tell me total how much position I should be taking? 100 lakh. I went to stock market. I asked boss, for one contract, for one lot how much? They are telling 5 lakh. So tell me how much contracts I should be buying or selling. How much contracts I should be buying or selling? Boss, for one contract, stock market is telling 5 lakh. I want to take a total contract of 100 lakh. That means total how much contract I want? Total 100 lakh contract I want. For one contract it is 5 lakh. That means it is going to be 20 contracts or 20 lots. Yes or no, everyone? You want a formula for this, Sada? What is the formula? Yes, total value of futures divided by price of one contract. Number of units. Yes or no? Same formula it is. Total value of future divided by price of one contract gives you the number of contracts. As simple as that. Till here, is this clear, everyone? 4 steps I have done. I will show you guys the 4 steps also here. Look at this, everyone. Yes, where is it? Okay, step number 1. Calculate the desired change in beta and action to be taken. Desired change in beta is nothing but the change in beta. That is, what is my existing beta minus what is my required beta. Okay. What is the action to be taken? I want to reduce my risk means take opposite position. I want to increase the risk means take same position. Step 1 is over. Step 2 is calculate the total value of futures. Total how much I should be investing in futures. It is nothing but value of your portfolio into change in beta. Yes or no? Rajnikant's value of portfolio is 50 lakh. He wants the risk to change by 2 units. So into 200 lakh position he will be taking. Third is what is the value of price of one contract. Okay, Nifty is actually trading at 10,000. Yes, one lot I want at least 50. So it is actual future price into lot size. Okay. That means how many contracts I want? It is step 2 divided by step 3. That is the total value divided by price of one contract. Yes or no, everyone? Till here clear? Absolutely no tension. Okay. Then comes step number 5, which is calculation of profit or loss. That is also simple. We have learned the basics, principles already. We are just implementing it here. So total, tell me. So what is the decision? Yes. So we are going to take a short position. Yes or no, everyone? For how many contracts? 20 contracts. So we'll take a short position in 20 contracts. Is this clear, everyone? Now comes step number 5, which is going to be calculation of profit or loss on the date of settlement. Okay, now 2 different places positions we have taken. Okay, where all positions we have taken? Look at the students. Firstly, in the spot market I am having a position. Yes, here what was my original position? Yes, Rajnikant has invested, he has purchased, he went for a long position, that is buy. How much amount it was? 50 lakh it was. I am buying, I am paying. To calculate profit or loss, I will be taking a reversal position. Long reversal is short, buy reversal is sell. Yes or no? Question is telling on the date of settlement what happened to the share price. Yes, let us see the situation. What is question telling? Calculate second situation. Calculate the overall profit or loss on the date of maturity. If on the date of maturity Nifty falls by 10% and my share portfolio falls by 20%. Tell me, share portfolio fell by how much percentage? 20% it fell. 50 lakh minus 20%. I guess it is going to be 40 lakh. Yes or no, everyone? Perfect. Yes, I am taking a short position. I am selling at 40 lakh. I am getting money. That means, can you guys calculate the overall profit or loss? Simple. Yes, I purchased at 50 lakh. I am selling at 40 lakh. Happy or sad? Profit or loss? Loss. How much is the loss? 50 minus 40. 10 lakh is my loss. Yes or no, everyone? Yes, this is happening in one market. Which market? Spot market, share market, cash market, all same names. One more market I have taken a position, sir. Which position da? Which market da? Sir, futures market is also there, na, sir? Okay, let me go there. Futures market. Okay, here, what was my original position that I had taken? Original what position I had taken, students? Yes, here I went for a short position. Yes or no, everyone? Yes, original I went for a short position. That basically means sell. Yes, at what price I sold Nifty? On the date of entering contract, it was at 10,000. So I entered into a short position at 10,000. This money I am getting. To calculate profit or loss, I'll take a reverse position. Yes or no, everyone? Yes, that means I'll go for a long. Sell means basically buy. Tell me, on the date of settlement, I want to square off. I'll take a reverse position. Yes, what happened to Nifty? Index fell by 10%. Yes or no? Originally it was at 10,000. It fell by 10%. That means it became 9,000. Yes or no, everyone? Yes, 9,000. I'll go for a long position. Now tell me. Happy or sad? Yes, I sold at 10,000. I purchased at 9,000. At 9,000 I purchased and at 10,000 I am selling. Happy or sad? Happy, sir. Profit or loss? Profit, sir. How much is my profit per unit? It is 1,000. Wait, the story is not over. I will tell total profit. It is profit or loss per unit into my lot size into my Number of lots or number of contracts. What is this basically? This is nothing but total number of units. Yes or no? I'll tell. Boss, in one nifty, na 1000 rupees profit I got. But tell me, can I trade in one single nifty? No. Minimum one lot I should take. And tell me in one lot how much nifty I'm having. 50 nifty if I'm not wrong. Yes or no, everyone? Yes. Lot size is 50. Yes. That means if I enter into a contract for one lot, how much would be my profit? 1000 into 50 would be my profit. But tell me, how much contracts I took a position? Sir, I took a position in 20 such contracts. So into 20, yes. So my profit is going to be 1000 into 50 into 20. It is going to be 10 lakh. Yes or no, everyone? Perfect. So look at this. In my spot market, I had a loss of 10 lakh. In my futures market, I had a profit of 10 lakh. Overall profit or loss is 0. Yes or no? Story over. Did we hedge? Hedge. Question is over. Over. This is what we get in exam. Yes. Sir, this much only, sir. Jo B. As simple as that. Yes or no, everyone? So how we are going to write the same thing? Here I showed it in the form of a chart. You can show it in the form of a chart or a table. If you are doing in the form of a table, this is how you are going to show it. Profit or loss on shared portfolio. Original in shared portfolio, you had a long position 50 lakhs. Yes. For reversal, you go for a short position 20% it reduced. That means 40 lakh. I've shown the calculation already. So yes, you sold at 40 lakh. You're buying at 50 lakh. You just pause and think. In long and short, you write buy sell. Yes, 10 lakh loss you're having. Yes, futures. Originally you went for a short position. That is you sold at 10,000. Yes, for reversing you will be going for a long position. On that day, yes, index fell by 10%, 10,000 became 9,000. So that means you're having a profit per unit of 1000. Total profit, yes, 1000 per unit. Like that, in one lot 50, like that 20 lots. So total 10 lakh. That means your overall profit or loss is 0. Story over. Is this clear, everyone? Jujube, simple. Sir, this much only was there, sir. Sir, everyone told very difficult, deadly, that, plus, minus, all those things. Jujube. Now let us see the steps properly, and what we'll do is whatever extra adjustments are there, everything we'll discuss. Okay, let me just have a sip of water, then we'll continue. You guys, if you want, continue. Anyways, it's a video. Yes, everyone. So now let us come back to our steps. Okay, here everything that is required, everything end to end we have written. Now look at this. What are the steps to solve? Yes, step 1, I will calculate the desired change in beta and action to be taken. By how much unit I want my risk to change in beta. What is change in beta? It is nothing but my existing beta minus my required beta. What is the action I will be taking? If I want to reduce the risk means I will take opposite position. If I want to increase the risk means I will be taking the same position. Simple jujube. Step 1 is over. Now additional notes here. Yes, if a required beta of the portfolio is not given in the question, assume it as 0. Yes, question has told me that, yes, right now beta of my portfolio is 2. Question told, yes, hedge. Question did not tell how much you want your beta of the portfolio to be. I will assume I want my beta to be 0. Yes or no? Because when I am having absolutely no risk, when my beta is 0. Is this clear, everyone? So if question doesn't tell anything, I will assume that, yes, the required beta of portfolio is 0. Second, action to be taken. Yes, what is opposite position, same position? Point number 1, golden principle, I have already discussed. Is this clear, everyone? Okay. Second, total value of futures. Total how much? Yes, value of futures I should be buying or selling. How, what is it? Simple. It is the value of portfolio into change in beta. Yes, portfolio how much is the value into how many units you want to change the beta. That is going to be the total value of futures. Is this clear? Yes. Then you will see for one future contract how much you should be buying. That is the total value. For one future contract how much you should be buying. It is nothing but your actual future price into your lot size. Yes or no, everyone? Perfect. Now, yes, if actual future price is not given, then we will assume it to be the same as the theoretical future price. Now, students who have already studied derivatives, futures, you will be knowing something called as theoretical future price, cost to carry model. There will be calculating the theoretical future price. Sometimes question will not give actual future price. Actual future price is given, we'll use that. If that is not given, theoretical future price we can be calculating. We'll assume it is same. If you have understood, great. Or else subsequently when we are discussing calculation of theoretical future price, it will be clear for you. Is this clear, everyone? Okay. Then comes calculation of number of index contracts, number of contracts. It is basically step 2, total value divided by value of one contract. Yes or no? Total value divided by price of one contract. Chumma for namesake I have written. Nothing is there in this. Is this clear, everyone? Okay. Now comes a very important thing. If the number of contract is in decimal, say for example, question is telling in order to fully hedge, I should go for 3.47 contracts. Tell me, is it possible to enter into 3.47 contracts? No. Either you will enter into 3 contracts or you will have to enter into 4 contracts. Now tell me, if you enter into 3 contracts only, whether your risk is fully hedged? No. That means in order to fully hedge your risk, what you will have to do? You will go for one round higher. That means you will always round it up. Yes or no, everyone? If the number of contract is in decimal, always we will be rounding it up. That is, if I am having 3.42, I will make it as 4 contract. But sometimes, yes, when the value after decimal is very small, say for example, I am having something called as a 3.08 contract. Yes, technically to fully hedge I want to make it 4 contract, but institute is selling chumma 0.0, small decimal value it is there. For that purpose, why you want to again take one more contract? So in that case, what institute is doing? In that case, institute is writing it as 3 or 4 contracts. I am telling you exactly what institute is doing. Okay, so if the number of contract is in decimals, normally institute will round it upwards. But if the value is very small, jujube, 3.05, 3.02, 3.12, institute is saying chumma, for that why you are taking one more contract, keep it as it is. So in those cases, institute is writing it as 3 contract or sometimes 3 or 4 contracts. Is this clear, everyone? Okay, fine. Now fifth step, final step is calculation of total profit or loss on the date of settlement or on the date of maturity. Two different markets are there. First is cash market, spot market, which is my share market. Second is my futures market. How do I do? Simple. Profit or loss in share portfolio. What is my original position? What is my reversal position? I will get my profit or loss. Profit or loss in future. What is my original position? What is my reversal position? It gives me my profit or loss per unit. I want the total profit or loss. It is profit or loss per unit into number of units. Number of unit is nothing but lot size into number of lots. As simple as that. Is this clear, everyone? Perfect. Till here is it clear? Okay, fine. Now here, calculation of profit or loss in futures is already discussed in concept 1. That I have not told here. Okay, yes, I have directly come to concept number 4. Now a very important point here. Yes, here students make a lot of complications. Okay, when I am calculating the profit or loss on the date of settlement. Now originally there is a date on which I have entered into a contract. Then there is a date of settlement. Rajnikant case. First today I had 50 lakh portfolio, I entered into short future of 100 lakh. After 3 months, when I am calculating profit or loss, yes, how do I get the profit or loss? Yes, here I was there. Yes, here I was at t is equal to 0, t is equal to 3. In order to calculate profit or loss, either question will have to tell me on that day what is the price. If it is given, simple. Or question will tell by how much percentage change has happened. My share portfolio, how much percentage it changed. My future portfolio, by how much percentage change. If percentage change is also directly given, again it is simple. I'll do either plus or minus percentage. But sometimes only 1% change will be given. In that case, other percentage change I'll be calculating. Chumma, so many people will by heart again so many formulas for that. Simplest thing in the world. Now look at this, everyone. Yes, in this question that we solved, I calculated profit or loss. So on the date of maturity, yes, question had specifically told was on the date of maturity, Nifty is falling by 10%, share portfolio is falling by 20%. For both the things, for future also how much percent change is there, it is given. For share also how much percentage change is there, it is given. If it is given, I will use it. As simple as that. Yes or no, everyone? So look at this. If percentage change in both index and portfolio is specifically given in the question, then use the data given in the question. But sometimes what will happen is, if percentage change in only one is given, sometimes what will happen is, instead of this, question will just tell this much. Question will just tell, yes, calculate overall profit or loss on the date of maturity. If on the date of maturity, Nifty falls by 10%. Sir, percentage change in share portfolio is not given, sir. How do we calculate? Simple da, jujib. For that purpose, sometimes when data is not given, it is not that data is not given. You have to just open your eyes. How da? Open your eyes. What will have to do? Simple. Question has told you the beta. Yes, my beta is 2. Beta is 2. What does it mean? Beta is 2. It means that if my index will change by 1%, my share portfolio will change by 2%. Yes or no? That means tell me, if my index fell by 10%, my share portfolio will change by how much percent? 2 times of that 20% it will change. As simple as that. Yes, so simple. Unnecessarily we are complicating things. Yes or no, everyone? So if percentage change in only one is given in the question, we will calculate the percentage change in other using the concept of beta. Look at this. Here I guess I am having 1 or 2 examples also for that. Look at it. Simple. Beta of portfolio is 1.5. Index fell by 2%. Calculate the percentage change in our portfolio. Tell me beta is how much? 1.5. That means my portfolio is changing 1.5 times of market. So if index changes 1%, my portfolio will change 1.5%. Tell me index fell by how much percent? 2%. That means tell me my portfolio will change by how much percent? It is going to be 2 into 1.5. It will be changing by 3%. Yes or no, everyone? Perfect. Second situation. Beta of portfolio is 1.5. Our portfolio fell by 3%. Calculate by how much percent Nifty would have fallen. Simple. Cross multiplication. Yes or no, everyone? Tell me. My beta is 1.5. That means if index changes by 1%, my portfolio changes by 1.5%. Tell me my portfolio changed by how much percent? 3%. That means index would have changed by how much percent? Cross multiplication. Yes, it is 3 divided by 1.5. It is going to be 2 times. Yes or no? So many different marathon videos I have told you how to use cross multiplication. Same thing I am not repeating. Is this clear? So what is the percentage change in index? Yes, it fell by 3%. That means index would have fallen by 2%. Is this clear, everyone? Okay, wow. Okay, perfect. So 2 or 3 more situations are there. Quickly, taka, we will solve it. Is this clear? Are we ready, everyone? Yes, sir. Now situation number 2. Story is same. Rajnikant had taken a long position, invested 50 lakhs. Beta was 2. He wants to hedge his portfolio. Sorry. Now let us see the different situations. Okay, situation number 2. Now look at this. He wants to reduce the beta of his portfolio to 0.5. Rajnikant is telling me, I am Rajnikant. I will not bring down the risk to 0. I want to keep the risk to 0.5. Yes, in that case, calculate the number of contracts. Also calculate overall profit or loss. Now simple. Tell me, right now what is the original position Rajnikant has taken? Long. What is the risk he is having? 2 units. Tell me how much he wants his risk to be. He wants his risk to be 0.5. That means by how much he wants to reduce his beta, how much he wants to reduce his risk? 1.5 times. Yes or no, everyone? So change in beta is 1.5 units. Tell me he wants to increase his risk or reduce his risk? Reduce. That means opposite position. That means what is the position I will be taking? Tell me originally I had a long position. That means I'll take a reverse position, which is short position. Total how much value I should be investing? Tell me how much I had originally invested in his portfolio? 50 lakh. Yes, now I want to change the risk by how many units? 1.5 times. That means how much I should be investing into 1.5, which is going to be 75 lakhs. Yes or no? So total 75 lakhs short I should be taking. Yes or no, everyone? Perfect. Yes, what is the price of one contract? Step number 3, price of one contract. One future is available at 10,000. Yes, lot size is 50. That means it is going to be 5 lakhs. Yes or no? Step number 4, total how many contracts I should buy or sell? Total 75 lakhs I want. One contract is of 5 lakhs. So that means is it 15 contracts if I am not wrong? Yes or no? 75 divided by 5. 15 contracts I will be going for a short position. Yes or no, everyone? Perfect. Step 5 is calculation of profit or loss. Yes or no, everyone? Step 4, I'm just writing 15 contracts. Okay. Step 5 is calculation of profit or loss. Question has asked me, look at this, everyone. Calculate the overall profit or loss if on the date of settlement the value of his share portfolio increased by 15%. What has happened? His share portfolio value increased by 15%. Tell me. Yes. What happened? Okay, fine. Percentage change in share portfolio. 15% increase. Yes or no? Or percentage increase, let me put. Okay, my share portfolio has increased by 15%. Now tell me, for me to calculate profit or loss, I want a change in share also, change in index also. Whether change in index is given? No, sir. Can we calculate? Simple, sir. How? Beta is there now. So percentage change in index. Tell me, students, what is the beta of my portfolio? What is the beta of my share portfolio? 2. So I will tell index portfolio. If my index changes by 1%, my share portfolio will be changing by 2%. Tell me, in my case, my share portfolio has increased by how much percent? 15%. That means index would have increased how much percentage? Yes, 15 divided by 2, 7.5% increase. Yes or no, everyone? Perfect, sir. So can we calculate the profit or loss? Yes, sir. Simple. We know how to do it already. Yes. First, I will calculate profit or loss in share portfolio. Tell me, students, what was the original position? I took a long position. How much? 50 lakhs. Yes. For reversal, I will be taking a short position, which is basically sell. Tell me, share portfolio, how much percentage it has increased? 15%. Yes or no, everyone? So 50 lakh, it increased by 15%. Is it 57.5? 57.5 lakhs. Yes or no, everyone? Short means I am selling, I am receiving money. Long means I am paying money. 57.5 lakh I got, 50 lakh I paid. That means 7.5 lakh is my profit. Yes or no? Future position, let me see. Originally, what I have done here, I have taken a short position if I am not wrong. Yes or no? I have taken a short position. At what price I have taken a short position? When index futures was at 10,000. Short, that basically means sell when index was at 10,000. Yes, to calculate profit or loss, I'll take a reverse position, that is long, which is basically buy. Yes. On the date of settlement, what happened? Yes, my index has increased by how much percent? 7.5 percentage. So 10,000 plus 7.5 percentage, it is going to be 10,750. Yes or no? Now tell me at what price I sold? 10,000. At what price I purchased? 10,750. Happy or sad? Sad. Profit or loss? Loss. Loss per unit is going to be 750. Total loss, let me calculate. Tell me, it is 750 per unit. Yes, one lot has how many? Yes, Nifty 50. Like that, how many lots I have taken? 15 lots, if I am not wrong. Yes or no? Numbers, you guys better confirm. So I'll be having a loss of 5,62,500. So that means net basis, it is 7,50,000 minus 562,500. Yes, it is 1,87,500. Yes or no, everyone? So on a net basis, I am having a profit. Perfect, everyone. Now you will be having a doubt, sir. If I have hedged, means my profit or loss should be zero, no sir. Why am I having a profit? Yes, because understand, you have not fully hedged. You've kept a risk of 0.5. Yes or no? So that is why you will be having a profit or a loss accordingly. Is this clear, everyone? Situation 3 shall we do? Tuck I will do. Okay, sir. Situation 3. Same story, Rajnikant 50 lakh long position, beta of portfolio is going to be 2. Now he is telling, I want to increase the portfolio beta to 2.5. Oh. What was his existing risk? Look at this. Calculate the number of contracts, overall profit or loss. Now look at this, students. Yes, Rajnikant. Yes, what he has done? Cash market, he has taken a long position. After taking a long position, how much was his beta risk? 2. Now what is he telling? He wants to increase his portfolio beta to 2.5. Increase. He is telling there is nothing Rajni can't. Rajni will take a risk. Yes, I don't want to bring risk to 0. Rajni is hero. Rajni will win. He told, let me increase the risk to 2.5. Okay. Tell me, I want to reduce risk, increase risk. Same position, opposite position. Same position, that means what position I will be doing? I will be going for a long position only. Yes or no? Yes. By how much unit I want to change my beta? From 2, I want to bring it to 2.5. That means the change in beta is going to be 0.5. Yes or no? If you want total value of futures also, you can tell me how much value of portfolio is there? 50 lakh. You want to change, yes, the beta by how much units? 0.5. So into 0.5 means it is going to be 25 lakhs. Yes. Long position you will be taking. Yes or no? Perfect. Simple. Tell me what is the price of one contract? Nifty is trading at 10,000. Lot size is 50. That means it is going to be 5 lakhs. That means total how many contracts? 25 lakh long position. One contract is 5 lakh. That means you will be taking 5 contracts. What complications? What difficulty? Yes or no? Yes, I guess there is a famous Instagram reel. Pressure. What pressure? Challenge. What challenge? We'll make it simple. That is why we are here for. Yes or no, everyone? Now, calculation of profit or loss on the date of maturity or on the date of settlement. Let me see what question is telling. Also calculate the overall profit or loss if on the date of settlement my Nifty falls by 5%. Nifty falls by 5%. So tell me. Yes. Percentage fall in Nifty 5%. Now I want the percentage fall in my share portfolio also. Yes or no, everyone? Tell me what is the beta of the portfolio? 2 times. Yes or no? So that means if index change by 1%, my portfolio will change by 2%. Tell me in this case index fell by 5%. Yes, my portfolio is 2 times volatile. That means it will change 2 times of market. That means it will be changing 5 into 2. 10%. Yes or no? Using this will calculate profit or loss. Quickly I'll do. Tell me original share portfolio. I had taken a long position of 50 lakh. Yes, now for reversal I'll be taking a short position. How much percentage it fell? 10% it fell. Yes, 50 minus 10%. I guess 50 minus 5 lakh. 45 lakh, yes or no everyone? So long I had purchased at 50 lakh, short I sold at 45, happy or sad? Sad. How much is a loss? 5 lakh is a loss. I am doing the calculations faster. There is a scope for slight, yes, arithmetic error, because I am explaining writing using calculator, and that too fast I am doing. Okay, so if any arithmetical error is there, please do ignore. Now profit or loss in futures. Originally what I have done here I wanted to increase my risk, so I took a long position. Yes or no everyone? I took a long position, which is basically buy. At what price? 10,000 rupees I purchased. Now reversal, I'll be going for a short position, which is sell. Tell me on the date of settlement what happened to Nifty. Yes, Nifty fell by 5%, yes or no? So 10,000 it was 5%, it fell, it became 9,500. So tell me students, at 10,000 I purchased, at 9,500 only I sold. Happy or sad? Sad. Profit or loss? Loss. How much is my loss per unit? Loss per unit is 500. So my total loss, I will tell it is 500 per unit. Lot size is 50. That way how many contracts I had entered? 5 contracts into 5. So my loss here is going to be how much? 500 into 50 into 5. Is it going to be 1,25,000? Yes or no everyone? So what is the total loss? 5 lakh, 1,25,000. It is 6,25,000. Yes or no everyone? Now understand, yes, Rajni wanted to increase his risk, so he took same position. So both the place loss only here. On the other hand, if it would have, yes, worked out in his favor, both the places profit only he would have had. Remember the first example. 2 places also I put a bet that India will win. If India will win, here also 1 lakh, here also 1 lakh. But if India will lose, here also I will lose, here also I will lose. That is what they have done. Is this clear everyone? Okay, perfect. Till here absolutely clear. Now one more small adjustment is there. Now sometimes question, they will ask profit or loss. 9 out of 10 question here it will get over. But sometimes question will also tell, also calculate the portfolio beta after hedging. This is one of the most nonsensical questions ever. Because in the question only, question is asking that I want my beta of the portfolio to be 2.5. That means ideally my beta of portfolio should be 2.5. But again they are asking, okay, tell that your portfolio beta is going to be 2.5%. I told you, okay, well, simple, not a big deal, we know how to do. Okay, so let us try doing it. Pay attention, pay attention, pay attention. Tell me students, on the date of settlement, how much loss I had? 6,25,000 loss I had. Yes or no everyone? Now tell me. Rajni is standing here, 0. Yes or no? Rajni is there. Yenna Raskala, mind it. Yes or no? Tell me total how much amount he had invested in his portfolio. 50 lakh he had invested in his portfolio. Yes or no everyone? Perfect. Yes, now after 3 months on the date of settlement, yes, how much loss he got? How much loss he got? He got a loss of 6,25,000. Happy or sad? Sad. How much percentage is the loss? Can you guys tell how much percentage is the loss? He had a portfolio of 50 lakh. In that he had a risk. That is why he took a futures. Yes, in order to hedge himself from the risk. 3 months later, how much loss he got? 6,25,000 loss he got. So can you guys calculate the percentage loss? 6,25,000 upon 50 lakh. Is it 12.5 percentage? Yes or no everyone? 12.5 percentage loss. Yes or no everyone? Or loss means I can tell my portfolio has reduced by 12.5%. Yes or no everyone? Now I want to calculate the beta of the portfolio. Yes, what is beta telling? What is the beta telling? Yes, beta is telling if my market changes by 1%, my portfolio is changing by how much percent? Tell me. 3 months later, how much percentage did market fall? Market fell by 5%. Yes or no? So I am telling that, boss, 3 months later, Rajni is standing here and he is sitting and thinking, she, what unnecessary risk I took. Yes or no? There was absolutely no need. Okay, yes, I lost 12.5%. I am telling Rajni, wait da, market only fell 5%. Yes or no? Market, in 3 months, market only fell by how much percent? 5%. That means Rajni's portfolio fell by how much percent? 12.5%. So I will tell, look at this, 3 months later. Yes, market or index, our portfolio. Yes, when market fell by 5%, my portfolio fell by 12.5%. I want to calculate beta. What is beta telling? Beta is telling if market changes by 1%, how much percentage is my portfolio changing? Cross multiplication, 12.5 divided by 5. It is going to be 2.5. So beta of the portfolio is going to be 2.5 times. Yes or no everyone? That I have written here. Yes, I have shown the calculation. 6,25,000 loss was there. Yes, beta comes to 2.5 times. Yes, I have shown the steps also. Look at this special adjustment if in case question asked to calculate the portfolio beta after hedging. Yes, first step I will do is I will calculate the total percentage gain or loss in my portfolio, which is overall profit or loss on the date of maturity. Step 5, divided by the opening value of portfolio, total how much value of portfolio originally was there. Yes, that gives me the overall percentage change in the portfolio. Yes, now if I want to calculate the beta, portfolio beta, I have told you the formula already. It is percentage change in portfolio or percentage change in market. Formulas all are chumma jujube things. We know logically how to do. Yes or no? On the date of maturity, yes, index fell by 5%, my portfolio fell by 12.5%. So when index is falling by 5%, mine fell by 12.5%. Percentage change in portfolio divided by percentage change in index. Is this clear everyone? Till here everything is clear. Now if this is clear, all the basics of question solving is over. Now one or two extra adjustments can be there. Yes, by looking at all the questions from study material, past paper, RTP, MTP. That also we will do, maximum 5-10 minutes it will take. I hope you guys are thoroughly enjoying. Maja is coming, yes or no? Give me a confirmation, students. Perfect. Yes everyone, situation 4 is there. Look at this. Same question only. Rajnikant has taken 50 lakh long position, beta is 2. He wants to reduce his portfolio beta to 0.7. Yes or no? Beta is currently at 2. He wants to bring it to 0.7. That means by how much time he wants to change? 1.3 time. He wants to come back. So take a reverse position. That means a short. Total how much value? 50 lakh into 1.3. 50 into 1.3 is going to be 65 lakhs. Yes or no? Price of one future contract. Yes, we know it is 10,000 into 50. Yes, it is 5 lakh. That means number of future contract, it is 65 lakh divided by 5. I guess it is 13 contracts. Yes or no? Question has asked you to calculate profit or loss on the date of settlement. Yes, if share portfolio falls by 10% and Nifty rises by 15%. This calculation you guys do by yourselves. Yes or no? Everyone, you will be getting the overall profit or loss. Now one very important thing here, whether question has given you the percentage change in both index as well as in the portfolio. Yes boss, question told share fell by 10% and Nifty rises by 10%. Sorry, 10 and 10. So I will be using this and doing my calculation. But you will be having a question, sir, we know that beta of the portfolio is 2. Beta of my original portfolio is 2. Yes or no? That means if my Nifty rises by 10%, yes, Nifty is changing by 10%. My portfolio is 2 times more volatile. That means it should have ideally increased by 20%. Then why is it that here question is stating it is falling by 10%? Now beta is a calculation of systematic risk. On what basis you have calculated? Using past data you have calculated. In portfolio in detail you are telling. In future what will happen? Anything can happen. Okay, if exactly things go as predicted, there was absolutely no risk, everyone would be making money. Okay, the real joy, the real threat, the real problem, the real drama of market is coming because you can just predict. Necessary, it's not necessary everything will happen that way only. Okay, so here what is happening? Things did not go the way you want. So yes, both things are going in a different way. Okay, if you have understood, great. Otherwise, firstly, anyways, this is a marathon. Secondly, yes, chumma for solving question it is anyways not needed also. So you can completely ignore this. Is this clear everyone? Okay. So with this one master question we have solved, my dear students. Now the only thing that is there for us to do is see what all extra adjustments are there. Quickly we'll get over. Are we ready everyone? Yes. Example number 2. On 1st of April, MS Dhoni, Thala for a reason, is having a portfolio of 2 shares. 2 shares he has taken portfolio. What all shares? Security A, B, market price is given, number of shares is given, beta is given. Do you guys know how to calculate portfolio beta? Portfolio, yes, management basics. That I will be using. I will be calculating the portfolio beta. Yes. Cost of capital for the investor. Okay. Investor is 20% per annum. Current value of Nifty is 10,000 rupees. Nifty futures can be traded in units of 25 only. Futures for June are being currently quoted at 1,060 rupees. You are required to calculate the beta of his portfolio. First question, portfolio management question this is. How do you calculate? Yes, beta of a portfolio, weight into beta. So tell me, security A, 500 shares, yes, sorry, 100 shares at the rate of 500, total value is 50,000. B, yes, 100 shares at the rate of 250, total value is 25,000. So total value is 75,000. Yes, tell me how much percentage of my total value I have put in A? Yes, 2/3, 50,000 divided by 75,000, 0.66. Yes, in B, Yes, 25,000 divided by 75,000, which is going to be 0.33 percentage. Yes, so what is the beta of A? 1.5. Yes, beta of B is 2. So weight into beta, when you add, you will be getting a portfolio beta of 1.6666. Okay, everyone. If you have not understood this, trust me, from inter-days we are doing this. If you still want explanation, go to portfolio. I'll be explaining. Simple, weighted average. As simple as that. Is this clear, everyone? Okay. Second thing that they are asking is calculate the theoretical value of futures expiring in June. Now tell me, where am I standing? Yes, MS Dhoni Thala is standing on 1st of April. Yes, I want the futures for June, which is basically expiring by end of June, 30th June. So tell me total how many months are there? April 1 month, May 1 month, June 1 month. So basically, yes, we are talking about 3-month future. Is this clear, everyone? Okay. They are asking us to calculate the theoretical value of the future. Okay. Right now I am not explaining. If we have time, we'll discuss, or it's a very simple thing. Calculation of future value. Yes or no? Say for example, I am telling, yes, today I am having, today what is the value of, yes, Nifty 1000 rupees. Suppose I am telling today on 1st of April, yes, I am having 1000 rupees. I invested in a bank for 3 months. Yes, bank told I'll give you 20%, 20% per annum for 3 months. Can you guys calculate the future value? Yes, boss. 1000 rupees into 1 plus, yes, 20% is there, but it is for 1 year. I want for 3 months into 3 by 12. Yes or no? So how much it is? 20% into 3 by 12, 5% plus 1 into 1000. Is it going to be 1050 rupees? Yes or no? Same is the way for calculation of theoretical future value. Simple, you are calculating the future value, as simple as that. Okay, yes, not discussing, yes, right now. Okay, if we are having a time, we will discuss that. Okay, yes, if dividend yield is given, what to do, dividend is given as a value, what to do, all those different variants we'll see, but very simple jujube-based calculation. So here right now I'm not spending time on that. 10,500 I got. That is the theoretical value. Ideally at that price it should be. Okay, same thing only. Look at this. Today Nifty value is 1000. I am telling boss, I want Nifty value 3 months later. Okay, they are telling 20% per annum it is. So on that basis I will be calculating. Okay, fine. Now third question, look at this. Calculate the number of Nifty contracts he will have to sell. They are telling sell if he desires to hedge until June in each of the following situations. Situation number 1, he wants to hedge his total portfolio. That is, he wants to hedge his complete portfolio. Okay, boss, let us hedge. Tell me currently, yes, what he has done. He has invested 75,000. That is, he has taken a long position. What is the beta of the portfolio he is having? 1.66. Okay, let us try doing the calculation. Very simple. Now, first thing is, yes, I will see the change in beta and action to be taken. Tell me, students, right now what is the beta? 1.667. I want the beta to come to 0. That means by how much units I want the beta to change? 1.667. I want the risk to reduce or increase. Reduce. That means I'll be taking an opposite position. Originally is long. Here I'll go for short futures. Total how much value? Tell me what is the value of my share portfolio? 75,000. I want the risk to change by 1.667 times. So total value is 1,25,025 rupees. Yes or no? Okay. Step 3 is price of one future contract. If you see at what price future is actually trading, yes, futures for June are currently traded at 1060. Actually at what price it is traded? 1060. Yes, and in one contract, bear in mind how many yes futures I should be buying. Lot size is 25. So total price of one contract is 1060 into 25. It is going to be 26,500. Yes or no, everyone? Perfect. Now you will be having one doubt. Sir. You calculated the theoretical value of futures. You told it is 10,500. Then why you took 10,000? Sorry. Sorry, it is 1050. Sorry, one small mistake. It was 1000. Okay. Sorry, 1000 into 1050. Small mistake. That's all. I guess 1000. I mistakenly wrote it as 10,000. Sir, theoretical price is 1050. Actually is 1060. How, sir? It will always happen.
Yes, everyone. So let us continue our discussion. Now, let me take a small deviation for a minute. So I went on to explain the entire question. Okay. But afterwards, I was just looking at the wireless mic. The wireless mic charge got off. Okay. Then I looked back. Okay. Almost to 15-20 minutes of efforts. Pussa went in vain. What to do? Life does. Sometimes it happens. Okay.
Any option? No option. I'll have to re-record again. Then I kept my mic for charging. Okay, yes, almost 1.5 hours I kept it for charging. Again, I'm seeing for some reason it's not charging or some issue is there. Okay, then what to do? We have committed. We'll have to record it, right? So then, okay, around 6-8 months back, or I guess almost a year back. Okay, once a faculty told these mics are coming, these mics are good. You purchase them. So in the Josh, I purchased this mic and the entire connecting set, everything I purchased. But because I had existing mic, I never installed. Yes, human mindset. Unless necessity is the mother of invention. We don't install at all. Then today we had no other option. Yes, it is late night. Right now it is almost 12 o'clock, midnight. Okay, I have to record. So then I sat, I searched everything. Okay, it's now somehow installed. So that is why gave you guys a small story about that. So don't tell sir midway through you're not having, suddenly you got sir, or some sentences I might repeat again. So just bear with it. Okay, yes. So what is it that I was discussing? I had seen exactly where the audio got off. From there I'm trying to continue. Now pay attention. I told that we have calculated the actual future price. Okay, based on that I did all the calculations. Here I have taken the actual future price for calculating the value of one contract. But sir, we have calculated theoretical price also, na sir? Why sir this we are not using, sir? No, injustice, na sir? Understand, this is the theoretical price. That means ideally how much it should be. Actually in reality, is it necessary it should be at the same price? Simple, I am telling, calculator is there. Okay, yes. In your mind, assume the worth of a calculator is just 50 rupees. Imagine, sir, for us calculator is the best thing in the world, sir, 1 lakh rupees worth. Imagine, in your mind you're feeling for this calculator 50 rupees worth only is there. But you went to shopkeeper is selling, I am selling this at 200 rupees. You tell, no, for me I did all calculation, worth is 50 rupees only. He's telling this is available at 200. If you want, purchase, or else get lost. Okay, same story is happening. Yes, in your mind, okay, yes, value of future is 1050 only. But in reality, yes, you went into the market. Yes, there future is trading at 1060. Can you tell no, it's worth is 1050 only, all those things? No, boss. If you want, you have to pay 1060 rupees. So in the reality, for one future, it is trading at 1060. That way you want 25 units for a single lot. Yes, the price comes to 26,500. Is this clear, everyone? Give me a confirmation. Okay, perfect. Now it will take some time for me to adjust, so till then I'll keep on adjusting, playing with this, so bear with me for that. Okay, fine. So part number 1 we have finished it off. I hope it is absolutely clear, crystal clear, yes or no, everyone? Now comes part 2. Situation 2, what are they asking? Situation 2, yes, calculate the number of nifty contracts he will have to sell if he desires to hedge until June 25 in each of the following situations. Situation 2, he wants to hedge 50% of its portfolio. Understand what we are going to. Same steps only, a small change we will be doing. Now pay attention. Yes, what is the beta of the portfolio, students? Beta of my portfolio is 1.66. Now see how steps are going to change. Slight change, that's all. Tell me, currently cash market I have taken a long position. What is my beta? 1.667. I want to bring my beta to 0. Perfect hedge. That means the change in beta is going to be 1.667. What I'll have to be doing? I'll have to be taking a short position in future. Tell me, in order to hedge my complete portfolio, how much value I should be doing for, yes, what is going to be the total value of futures? Simple, sir. What is the total, yes, value of my portfolio? It is going to be 75,000. Yes, I want the beta to change by 1.667 times into 1.667. Yes or no? So this is going to be the value of the futures. But tell me now, do I want to hedge 100% of my portfolio value? No, I just want to hedge 50%. So what I'll be doing? This, if I do, 100% of my portfolio will be hedged. Boss, I want to hedge only 50%. Sir, why he wants to hedge only 50%? Question is telling he is telling 50% only risk. Yes, I want to eliminate. Balance 50%, I'll take the risk. Okay, into 50% I'll do. Sometimes question will tell, yes, if he wants to hedge 150% of his portfolio, you might be having a doubt, sir, why on earth he wants to hedge 150%? Do not question the question. Yes, question is telling dog has 2 legs, you will tell dog has 2 legs. Simple. He wants to hedge 150%, we will hedge 150%. As simple as that. Yes or no, everyone? So we'll tell 75,000 into 1.66. If I do, I'll be hedging the entire portfolio. But he wants to hedge only 50% into 50%. That gives me 62,512.5. That is the total value of futures. Now what is the value of one contract, price of one contract? It is 1016 to 25, which comes to 26,500. That means how many contracts we should be entering? 62,512.5 divided by 26,500. It comes to 2.35. So yes, it's a sizable number. I'll keep it as either 2 contracts or 3 contracts. Is this clear, everyone? Perfect. So what is the lesson that I've learned? Point number one, if I'm having multiple shares, then I'll calculate beta of the portfolio. One simple lesson, we knew that otherwise also. Second lesson, yes, if question is telling value of futures in order to hedge 50% of portfolio, 150% of portfolio, how do we do that? I know what is the total value of futures. Yes or no? Yes, it is value of portfolio into change in beta. If question is telling 50% only I want, I'll do into 50%. As simple as that. Is this clear, everyone? Perfect. Shall we continue? Continue panlama? Continue करे क्या? बोलो public क्या बोलता है? Okay, sir. Sir, what happens to you, sir? Suddenly, chummada midnight, 12 o'clock, I'm still recording all alone. Yes, current is also not there. In this heat, I'm recording. Yes, I wore this extra jacket also to look like a superman, super doctor. Yes, doctor of derivatives. Yeah, so what to do? No option. Okay, I spent one and a half hour trying to adjust this also. So what to do? Life. Yes. Okay, now going ahead to type 2 question. Beautiful. Altogether 4 type of question. Now 3 more examples. Over. Done and dusted. Yes, I'm finishing it off and going to sleep. You also, I don't want you guys to stop midway and go da. Let's finish it off. Okay, fine. Pay attention now. Pushpa. Jhukega nahi sala. Pushpa is having a portfolio consisting of shares in diversified companies worth 90 lakh and cash of 10 lakhs. So tell me, Pushpa total, how much value portfolio he's having? He's having a total portfolio of 100 lakhs. In that 90 lakhs he has invested in shares. 10 lakh liquid cash he is keeping. Is this clear? This is type 2 question. When cash balance is given, how do we do? Simple point only. But chumma, I've kept the example also. Okay. Now, the beta of share portfolio is 1.6. Yes, that is share portfolio will keep changing. So what is the beta risk of that? Yes, volatility of that 1.6. Tell me cash, whether anything will happen to cash. Today 100 rupees you kept. Tomorrow whether this 100 will increase by 1% or decrease by 1%. Don't tell time value of money. Cash as it is. Will it change? No. That means the beta of cash is going to be 0. Simple point. Portfolio management. Okay, fine. Beta of share portfolio is 1.6. Okay. Index is selling at 5,000 level. That means yes, value of index is going to be 5,000. Yes, one index future consists of 100 units. Okay, fine. Yes, now you are required to calculate and answer the following. Calculate the current portfolio beta. Tell me, students, what all he has invested. Sir, 90 lakh share he is having. Yes, 10 lakh cash he is having. 90 lakh means 0.9. 10 lakh means 0.1. Yes or no, everyone? Yes. What is a beta? For share beta is 1.6. For cash beta is 0. So if you do weight into beta, yes, 1.6 into 0.9, I guess it is 1.44. So this is 0. So beta of your portfolio, I guess, is 1.44 if you are not wrong. Yes or no, everyone? Yes. Perfect. Point number 1 is over. Okay. Now comes point number 2. What is the second requirement? Determine how many index futures should he short for perfect hedging. What he wants? He wants a perfect hedging. Okay. Let us try seeing how do we do the calculation. Now one of the two ways. See, you should know in life matching. Properly you have to match. See, either you can tell that, okay boss, how much value of shares is there? 90 lakh value of shares is there. What is the beta of shares? 1.6. Either you can use this data and calculate, or you can tell total portfolio value is how much? 100 lakh. For this, what is the beta? 1.44. You can use this and also calculate. Anything is fine. What we are going to do? I will use this and do my calculation. So that throughout I know that I will be calculating the total value of portfolio. Total portfolio value, total weighted average beta. That throughout I will be using. Otherwise, subsequent steps, you will be having confusions. Okay, now see how I am going to do. I will verify with the other way also. Now tell me students. Yes, right now, the entire portfolio, that is a share plus cash. What is a beta? 1.44. Yes, spot market, what was the position? I had invested, that means I had long position. Yes, I want to prepare a perfect hedge, that means I want to bring my beta to 0. That means what is the change in beta needed from 1.44 to 0? 1.44 is the change. Yes, what is the action I should be taking? I should be taking a short position. Yes, what is the total value of future? Total value of future. Don't tell TVF. Yes, short films they are doing. Total value of future. Tell me students, what is the total value of my portfolio? 100 lakhs. I want to change it by 1.44. So it is going to be 144 lakhs. Yes or no, everyone? Perfect. Yes, so total value of future is going to be 144 lakhs. Next, price of one contract. Price of one contract. If you see, I guess we have written 5,000 into 100. Yes or no, everyone? So it is going to be 5,000 into 100. How much is it going to be? it is going to be 5 lakhs. That means your number of contracts, it is 144 lakh divided by 5, it comes to 28.8. that means it is going to be 29 contracts. Yes or no everyone? Perfect. Now alternatively, if you tell no no sir, I want to just take share portfolio because only their risk is there now. Okay boss, you do it that way. I am telling share portfolio, how much is a beta? 1.6. Share portfolio I'm having long. Yes, I want to bring the beta to 0. That means beta by how much I should reduce? By 1.6. Yes, tell me how much is the value of share portfolio? 90. So I will tell 90 into 1.6. How much is it going to be? 90 into 1.6. Is it still 144 lakh? Is that the total value of my futures? Same only da. Ultimately gets adjusted. Anything you can do. But what I would recommend calculate the total value of portfolio, calculate the total weighted average beta that you use. Is this clear? This is going to be the lesson from this particular question for us. Okay everyone? Okay sir. Now third question is also important. So many students feel this is one of the most difficult adjustments. I will do it properly the way Institute does it, and I'll also give you guys a simple shortcut. Takka in 5 seconds we'll be doing it because we know things logically. Okay, first we'll do it properly, then we'll see. Now tell me students, Pushpa is having a portfolio. What is the weighted average beta of the portfolio? It is 1.44. Yes or no everyone? So 0 is there. He took a long position of total 100 lakhs. The weighted average beta was 1.44. Ideally, if he wanted to reduce his risk, what position he should have taken? Ideally, he should have taken a short position, reverse position. Okay. But what Pushpa did? Pushpa is Pushpa. He doesn't listen to you or me. Now see what Pushpa did, students. Assume on the current date, today. Yes. Mr. Mandus or Pushpa only should have been there. Okay. Pushpa goes for a long position. Oh. What Pushpa did? He took long position only. Ideally, what he should have done? He should have taken a short position, but he took long position only. If he takes long position, whether his risk will increase or decrease? It will increase on the other hand. Okay. He took a long position on 100 lakh Nifty future. He told I'm going to take a long position only. Okay. After 3 months, what happened? Yes, price of his shares dropped by 3.2%. 3 months later, on the settlement date, yes, share price dropped by 3.2%. Calculate the portfolio beta after 3 months. Let me just take a screenshot here and we will solve it. For some reason, there is a slight dip in the quality of the paper when you are taking a screenshot. I don't know why it is coming. You guys are able to see, right? Okay, fine. Let us adjust. Okay, fine. Now look at this. Let me try quickly explaining this. Okay, now look at this, students. On the date of settlement, I want to calculate the profit or loss. Okay. Now tell me students, yes, what all is there? He took a long position on 100 lakh futures. 3 months later, what happened? Yes, price of shares dropped by 3.2%. Share price dropped by 3.2%. Okay, share price dropped by 3.2%. I also want to know what happened to index or market. Is it given in the question? No. But using beta, I can calculate. Tell me what is the beta of the share? Beta of the share is 1.6. Yes or no? That means if market changes by 1%, my share changes by 1.6%. Now, if my share has changed by 3.2%, how much percentage market should have changed? Cross multiplication, 3.2 divided by 1.6. Yes, the change in index is 2%. Is this clear, everyone? Simple cross multiplication, basic third standard maths. I hope you guys know it. Okay, fine. Now I'll have to calculate profit or loss. First, share portfolio. Yes, what was my original position long? Tell me, total value of portfolio was how much? 100 lakh. In that, share was 90 lakh, cash is 10 lakh. Tell me, after 3 months, will there be any change in the cash balance? Sir, cash will be as it is only, sir. Only what will change? Only share portfolio will change. Only here profit or loss is there. Yes or no? So I will tell long. Originally I had purchased how much? 90 lakh. After 3 months, reverse position, yes or no? That means short, sell. How much percentage it fell? 3.2%. That means it is 87.12 lakh. So 90 lakh I purchased, 87.12 lakh I sold. That means my loss is 2,88,000. Okay, chill. Okay, sir. Now comes profit or loss in futures. Tell me, yes, tell me. On first day, Pushpa, what he did? He took a long position. Yes or no? On how much amount? 100 lakh. So I will tell originally he has taken a long position, 100 lakh. That means on the date of settlement, he'll take a reversal position, that is short position. Yes, how much percentage index has fallen? 2%. So 100 minus 2% will be 98 lakh. Yes or no? I purchased at 100, I sold at 98. I am incurring a loss of 2 lakh. That means overall my loss is 288 plus 200. It is going to be 4,88,000. Till here is it fine? Okay. Question is asking me to calculate, yes, the beta of the portfolio. Yes or no? Not a big deal. I will calculate the overall percentage change. Accordingly, I'll compare it with the market and tell what is the beta. Tell me, students, yes, the overall, yes, value of my portfolio upfront at t is equal to 0 first day. Pushpa was having a portfolio. In that, share was 90, cash was 10. Total 100 lakh was there. Here he had a risk. That is why he tried hedging. But his hedging went wrong. Ideally, he should have taken opposite. He took same position. Yes or no, everyone? Because of that, how much loss he had? He had a loss of 4,88,000 on how much value? 100 lakh value. That means how much percentage loss he had? Yes or no? 4,88,000 on 100 lakh. That means I guess 4.88 percentage loss reduction in the portfolio value. Yes or no, everyone? Perfect. So tell me, in 3 months time, okay, how much percentage market fell? Yes, market or index or Nifty or Sensex, market fell by 2%. In the meantime, Pushpa's overall portfolio, original portfolio, as well as for hedging, whatever he did, because of that, overall, how much loss he had? He had a loss of 4.88%. Yes or no, everyone? Our portfolio fell by 4.88% when market fell by 2% only. That means what is our beta? It is 4.88 divided by 2. 4.88 divided by 2. It is 2.44. Yes or no, everyone? Simple. Yes, when market is falling by 2%, my portfolio is falling by 4.88%. I want to know beta. Beta is when market is changing by 1%, how much it is? It is 2.44. Clear? This is what we had to calculate. Now this calculation, students find it slightly difficult, but I have told you exactly how to calculate. Yes, the revised beta, portfolio beta after all the changes. I'll calculate the percentage profit or loss, overall percentage profit or loss, compare it with the percentage change in index. Simple. Now this much calculation I did. Should I tell you something? Within 10 seconds also I can calculate. You want to see? Tell na, sir. We want to see the magic, sir. Tell us shortcut, sir. MCQ it comes means everyone else is spending 20 minutes. We do it in 2 minutes and come off. You want to see? Ready? Logic, pure, simple logic. Okay. Now tell me, students. Okay. Originally, how much we had invested? Total value. 100 lakh long position I had taken, yes or no? So originally, I have a long position of 100 lakh. When I had a long position of 100 lakh, how much was my beta of the portfolio? 1.44. Yes or no, everyone? Perfect. Now tell me, yes, in Nifty, which position I took? I took long position, short position. I took long position. That means cash market also long, future also long. Am I increasing my risk or reducing my risk? I am increasing my risk, sir. Okay. Yes, here also I took long. How much amount I invested? 100 lakh only I invested. Yes, I have told you. Yes or no? What did I tell you? Yes, if I invest an amount equal to the value of my portfolio, 100 lakh is the value of the portfolio. If I invest that in futures, my risk will change by 1 unit. Yes or no? Which side it will go? Will it increase or decrease? It depends on which position I have taken. I have taken a long position. That means my risk has increased by how many unit? By 1 unit. Yes or no? Risk beta has increased by 1 unit. That means what is going to be my beta now? 1.44 was there. It increased by 1. It became 2.44. Yes or no? On the other hand, if I would have taken a short position for 100 lakh, what it would have become? It would have become 0.44. Yes or no? That was the same logic. How did I calculate for perfect hedging? Yes, I want to invest. Yes, 100 into 1.44 because I am changing by 1.44 times. Here I want to increase by 1 unit only. That means how much position I should take? 100 lakh. 100 lakh only I told. Yes, that means how much was the answer? 2.44. How much I also got after all these calculations? 2.44. Sir, Jujubi sir, this much only, sir, you are thinking so much, sir. Once your logics are clear, everything is Juju-B. Maja is coming. Yes or no, everyone? Give me a confirmation, my dear students. Okay. If this is clear, we are having 2 more examples. So look at this. That shortcut also I have told. Okay. What is the important learning from this? This was a shortcut only for MCQs you can use. For descriptive anyways, stepwise marking is there. So you'll have to do the calculation. Okay. Now, whenever my portfolio will consist share also, cash also, what I should do? First step is, Yes, calculate the total value of portfolio, that is share plus cash, and calculate the total portfolio beta. Throughout you use these figures only. Okay, so calculate the beta of the entire portfolio, share plus cash, and calculate the total investment value, that is share plus cash. We will be using this in all the calculation. Is this clear, everyone? Perfect. Let me just have a sip of water, then we'll go ahead. 2 more questions only. This concept, one of the most important concepts, will be over with all adjustments. Yes, everyone. So now let us continue to type 3 question. Type 3, beautiful question. Okay. 2 more questions only. Okay, type 3, where a longer duration future is used to hedge risk for a shorter period. This is one question most students don't get only. Simple GGP. Let us see. BSC value is 5,000. Today, at what price BSC is trading? It is 5,000. Tell me, is it the future value of BSC or is it the spot value? Spot. Today, at what price it is there? Spot value. Okay, this is a spot. BSE means Sensex, yes or no? Nifty index, yes, market, all those things, one and the same only. Okay, but it is a spot value of the market. Okay, fine. Value of the portfolio, yes, I'm having a portfolio of shares. What is the total amount I've invested? Yes, 10.1 lakh. Yes, risk-free interest rate is 9% per annum. Dividend yield is 6% per annum. Yes, looking at this, it feels that they will be asking us to calculate the theoretical value of futures. Another concept altogether. Okay, fine. Beta of portfolio is 1.5. Okay, fine. We assume that a future contract on BSE index with 4 months maturity is used to hedge the value of portfolio over the next 3 months. Oh. Sir, nothing we understood, sir. Over our head it went. This sentence is going to be the game. Let me highlight and keep it. Don't worry, we will discuss it aram se. Okay, fine. One future contract is for delivery of 50 times the index. Yes, basically in one future contract, what is the lot size? 50 is going to be the lot size. Okay, based on the above information, calculate the theoretical price of the future. Okay, now before we solve, yes, first part, let me try solving. I'm not going to explain what this line is. When it is time for us to understand, we'll understand. Price of a future contract also we'll try doing. Okay, now how exactly to calculate? Now tell me students, or else I'll have to explain this only, I guess. Without that it is not possible. Okay, I am having a portfolio. Okay, how much is a value? 10 lakh 10,000 is a value. Okay, so here I'm standing. Look at this, I guess I've done the drawing. Okay, here I'm standing. Assume on 1st January I'm standing. I am already having a portfolio of 10.1 lakh. Okay, I am having a fear. Sir, what is a fear, sir? Next 3 months, I am thinking that, yes, the overall economy is going to be weak. You guys would be knowing, okay, US is imposing, yes, so many rates. Yes, government is, yes, doing some things. So many issues are happening. So I am thinking that my share portfolio will fall over the next 3 months. Over the next 3 months. That means I am telling, boss, I am having a risk for the next 3 months. That is till 31st March, I am having a risk. Is this clear, everyone? Okay. I want to hedge my risk. Okay. How do I normally hedge my risk? Tell me. Yes, in the spot market, I am having a long position. Ideally, what I'll be doing? I'll be taking an opposite position. That is, I'll be taking a short position. Yes or no, everyone? Perfect. But ideally, if I am having a risk for 3 months, yes, I will enter into a contract with the 3-month futures. Yes, future will be having different months validity. 1 month future, 2 months future, 3 months future, so on and so forth. So I am having a risk for 3 months. So I'll be taking a future which is having a validity of 3 months. But here what is happening is, yes, I went into market. Yes, I told boss I want a 3-month future contract. They are telling 3-month future contract is not available now. I was fully in tension. What to do? They told boss, one idea is there. I asked what the? 4-month future contract is there. If you want, you can purchase that. I told, what nonsense person you are. My risk is for 3 months. You give me a 3-month future contract. Now, why on earth are you giving me a 4-month future contract? They told, wait, listen. 4-month future contract is there. That means when is the expiry date? Yes, expiry is coming on April. Yes or no? Yes. Future is having one special feature. You can buy and sell future at any point. Forward is between 2 people only. Suppose, first example, gold. You and me, we enter into a contract. Only 2 people are there. It is a forward contract. So it is only you and me. Nobody else is there. Future is traded through exchange. So today, I did a forward buy. Yes. Expiry is 30th April. After 2 days, I feel, no, I don't want this. I can sell. Simple. I take a reverse position. I sell. Someone else will buy. Yes. They also don't want. They'll sell. Someone else will buy. This game keeps continuing. So what can be done? What can be done? One simple strategy I can do. I will tell that, boss, today Yes, I want for 3 months only. My risk is till this date, on this date, 31st March. I want for 3 months only, but 3 months future is not there. What I will do, I will purchase a 4-month future. Okay, okay. 3 months later, my risk will be hedged. Yes, my risk is over. Now there is no need for forward. What I will do, I will take a reversal position in forward. So once I reach here today, yes, today I will purchase. Yes, I will enter into a contract for a 4-month future. Yes or no? Yes, 4-month future. I will short. Yes, 3 months later, January is over, February is over, March is over. Yes, my risk is now being taken care of. Okay, now I no longer want the future. So what I'll be doing, I'll be taking a reverse position in future. Assume originally I've taken a short position in future. Now to reverse, what I'll do, I will take a long position in future. Now tell me, yes, I will be taking, yes, I have originally taken a short position in April validity future. That means now for cancelling, I will be taking a long position also in the same future. Simple. Suppose I'm telling, I have purchased this calculator. I have purchased this calculator. That means tomorrow, if I want, I can calculate. I can sell this calculator only. Tomorrow, yes, I have purchased this calculator. Tomorrow morning, can I come and sell your calculator? Not possible, right? Which product I purchase, that only I can sell. Which product I promise to sell, that only I can buy. Yes or no, everyone? Yes. So I am having a forward which is having its expiry on 30th April. So I have originally taken a short in this forward. That means when I'm taking a long, I'll be taking a long in this forward only. But when am I taking a long? I'm taking a long on 31st of March. So how much period is only pending? Only 1 month is pending. Is this clear, everyone? I hope you guys have got a small idea as to what exactly is happening. Here in detail, I have wrote exactly what is happening here. Step by step, we'll do it. Now pay attention, pay attention, pay attention. What is the first question? They're asking, yes, tell me what is the theoretical price of the future. Okay, boss. Future price I'll have to tell. Simple. Now tell me. Today, 1st January, I'm standing. Yes, what is the spot price of the index? 5,000. When I want, 4 months I want. Yes or no, everyone? 4 months. Yes, I'll have to be adding interest. Now tell me how much is a risk-free interest rate? 6%. Yes, interest is going to be cost for me. But yes, with that, I'll be getting dividend also. Dividend is going to be income for me. How much is the dividend yield? 6%. That means what is the net cost for me? Yes, suppose I'm having a share. Yes, interest is going to be cost for me. How much it is? 6%. But sorry, 9%. But 6% income also I'll get now. That means net cost is how much? 3% only. I am not explaining this concept of calculation of theoretical value of future. One more concept will come. Yes, beautifully across 45 minutes, everything, all different things I'll explain here. Just chumma for the purpose of solving, I'm doing it here. That means my net cost is 3% only. So I'll tell 3% per annum. I want it for 4 months. I will do it. So 5,000 is a spot into 1 plus R into T. 1 plus net cost is 3%. I want for 4 months into 4 by 12. Is this clear? That means what is going to be the price of a future? 5,050. Okay, ba. Okay. Now that is a theoretical price. Whether question has anywhere told me the actual price of a future, actual price of future is not given. So what I'll assume? Same price only is the actual price. Now second question is, what is the price of a future contract? Okay, boss. Yes, now tell me. They are telling in one future contract, I am delivering 50 times the index. That means what is the lot size? 50. So what is the price of one future? It is going to be 5,050. So that way for 50 units, what is the total price? 2,52,500. Is this clear, everyone? Okay. As actual future price is not given, I have assumed theoretical price only is actual price. Fine. Now third one is important. Yes, third one is not important. Fourth one is important. Okay. Number of contracts to be short for perfect hedging. Very simple. Now tell me, students. How much is the value of my portfolio? 10.1 lakh. Yes, what is the beta? 1.5. Yes, I am having a long position. Normally portfolio means I would have invested in that. Yes, I am having a long position. 10.1 lakh. Yes, what is the beta? 1.5. I want to perfectly hedge. That means I'll be taking a short position. Total how much amount? 10.1 into 1.5. Yes. Is it 15 lakh 15,000? So I'll be taking a short position for 15 lakh 15,000. Is this clear, everyone? That is a total value. I want to calculate the number of contracts. I've already calculated the value of one contract. So I'll be getting the number of contracts. Yes, price of one contract is 252,500. That means I will get the number of contracts. Yes, it is 15 lakh 15,000 divided by 252,500. It is going to be 6 contracts short. Is this clear, everyone? Okay. Now comes the final thing. Important. Yes. Tell me what is the final thing they're asking. They're asking calculate the gain on your short future position. Tell me on 1st January what I did. I took a short position in 6 contracts. They're asking, yes, how much gain you will be getting if index turns out to be 4,500 in 3 months. 3 months later, how much is the price of the index? 4,500. Now, yes, common normal person, what they'll do? Yes, we know how to calculate profit or loss. Tell me how much was the price of the future? How much was the price of the future on 1st of January? 5,050. Yes or no? I will tell here. Price was 5,050. I took a short position, that is plus. Here, yes, the price became 4,500. Yes, I'll be taking a long position minus. That means my profit is going to be 50. Sorry, not 50. 550 into lot size is 50, I guess, into some 6 contracts. Something like this we'll be doing. If you have also done like this, you have committed a blunder. Sir, what, sir? You're telling like this. Tell me. Look at this, everyone. Yes, calculate the gain on short futures position. If index turns out to be 4,500, index turns out to be 3 months later 4,500, it is the price of future contract. It is the price of the index. Nifty value is 4,500. What price I want? I want the future price. Yes or no, everyone? Perfect. On the date of settlement, convergence will happen. Spot price and future price will be one only, because for this date only maturity will be there. There will be no interest component, not required right now. But right now there is still 1 month maturity left. My original future was for April. Now it is 31st March only. 1 month is left. So future price will not be 4,500, boss. Is this clear? So look at this, what I am telling. On 1st of January, here I was standing. Okay, I took a short position. Yes, on this date. Yes, on this date. For the future, which is expiring on April, how much was the price? 5,050 was the price. So that means on this date, when I'm calculating, what I will calculate? I will calculate the price of the future, which is expiring on April. That means 1 month is still left. That means 1 month interest has to be loaded. It has to be added. Yes or no, everyone? Yes, 4,500 is today's spot price, boss. It is not the future price. Okay, so I'll have to add 1 month interest, only then I'll be getting the future price. Okay, I hope I've given you guys a small idea. Now, because I've not explained too much about theoretical future price, actual future price on the date of settlement, yes, convergence will happen, all those things. Yes, it could be possible, not 100% clarity would have got, but it is fine. So look at this original position that I had taken on 1st of January. I took short for April futures at 5,050. So when I'm taking a reversal, I'll be taking a reversal that is long. Which product I'll be in a position to? Yes, take a reverse position. The product in which I am trading. Yes or no, everyone? Yes, I'll have to be taking a long position in April futures only. How much is the price? Yes, I'm still having 1 month left to expiry. So on 31st March, the price is 4,500. 1 month is still left. So on 1 month interest, I'll be loading. So into 1 plus, yes, risk free is 9%, but dividend income is 6%. Net cost is 3%. 3% into 1 by 12, 1 month, you will be getting the price of 4,511. So you'll be taking a long position at 4,511.25. Once you do this, you will be getting your overall profit or loss. Yes or no? Short I did at this price, long I'm doing at this price. This is my loss per unit. Yes, sorry, gain per unit. Yes, into, yes, lot size into number of contract gives me the total gain. Is this clear, everyone? Quickly I did it off. Okay, fine, sir. Now, crux of this question, very important question. If institute wants to make your attempt difficult slightly, these kind of questions could be asked. Okay, what is happening when a longer duration future is used to hedge risk for a shorter period? For my portfolio, risk is there only for 3 months. So ideally I would have hedged my risk using a 3 month, yes, future. But 3 month future is not there only, boss, in the market. 4 month future is there. In that, how do I hedge? Simple. First, take the position, yes, using the longer duration future. Yes, today at t is equal to 0, take appropriate position in the future. That is, I took a long or a short position in 4 month future. Now, at the end of the period, when your risk gets over, 3 months later my risk gets over, I will be taking a reverse position in the future for the balance period. Now I'm having only balance period. Is this clear, everyone? Okay, fine. Now I'm having the final question, type 4 question, that is when I'm having long as well as short position in cash market. Okay, simple question. Look at this, everyone. Rocky Bhai from KGF. Yes or no? Okay. Rocky Bhai buys 100 shares of KGF Limited at the rate of 22 per share, whose beta is 1.5. Okay, and sells 50 share of Ramika Limited at a price of 40 per share. Rocky Bhai is there. Okay, he took two different positions. What all positions he took? Yes, he is buying. That means he has taken a long position. Yes, in shares of KGF Limited. How many shares? 100 shares at the rate of 22. That means 2200 rupees, whose beta is 1.5. And in the meantime, what he also did, he short sold. That means he took a short position. Yes, in Ramika Limited, 50 shares of Ramika Limited at the rate of 40. 50 into 40, I guess, is 2000, having a beta of 2. Yes, everyone. Till now, whatever questions we had, na, yes, in my cash market, all positions are same only, so I did not have a problem. But here, I am having different positions. In cash market only, one share I went on a long, one share I took a short position. How do I do? Very simple. Jujube adjustment. Okay. Now, he obtains a complete hedge by Nifty future at the rate of 1000 each. Calculate the number of contracts for perfect hedging. With this, yes, all types of questions end to end will be over. Now, understand, students. Yes, let us bring Rocky by here. Okay. Yes, tell me, students. So Rocky Bhai, in the spot market or cash market, he is having two different bets. What all bet he is having? Yes, KGF Limited share. Na, he is having a long position. That means he has purchased. Total how much amount? 2200 he has purchased. What is the beta risk of that? 1.4. Same time, Ramika Limited, he has taken a short position. How much amount? 2000. What is the beta? 2. Now, individually, I will try seeing in order to hedge how much it is. Now, imagine, Rocky Bhai is having only one position. That is only KGF Limited share he is having. Yes, what position he has taken? Long position he has taken. Yes or no, everyone? So, he has taken a long position. So, if he wants to hedge, means which position he'll have to take? He'll have to take a short position. Yes or no, everyone? Perfect. Short position he'll be taking. How much is going to be the total value of futures? Tell me, position is 2200 into 1.5. Yes or no, everyone? Yes. Is it 3300? Yes, 3300 short position he would have taken. Yes or no, everyone? Yes, assume he only had this. Now, he is also having, yes, one more opposite position in Ramika Limited. Tell me how much he had short. He had short 2000. That means if he wants to eliminate the risk, means he has to take opposite bet, which is going to be he'll take a long position. How much amount long he would have taken? 2000 into 2, 4000. Yes or no, everyone? Perfect. Now tell me, if he wants to hedge himself perfectly, he has to enter into two contracts in the future market. That is for index. Okay. Yes, index short he has to do for 3300. Index long he has to do for 4000. Tell me, for the same index, 3300 short you are doing, 4000 long you are doing. Chumma, yes, for 3300 value, double positions you are taking. Na? Instead of that, what you do? You can net it off. You can tell boss, 4000 long you are doing. Yes, with the 3300 short also you are doing. Na? That means on a net to net basis, what is happening? Net to net basis, you are taking a long position of 700 rupees. As simple as that. Yes or no? Simple, students. I am telling, yes, I have to pay you 4000. You have to pay me 3300. That means net I will pay you 700. Na? As simple as that. Simple. I am telling I am going to market and telling boss, I want to take a long position of 4000. I am only going and telling I want to take a short position of also 3300. They are the same product. Same. Why on earth you want to do that? Take a net long position of 700. Yes or no? As simple as that. So I'll take a net long position of 700. Okay, fine. Now let me try calculating the price of one future contract. Tell me at what price future is trading today. Yes, he obtains complete hedge by Nifty future at 1000 rupees each. Tell me at what price Nifty is trading 1000. Whether question has given me the lot size? No, that means I will ignore the lot size. Yes or no? I'll assume the price of one contract is 1000. So I'll tell, okay boss, yes, the price of one contract is, sorry, 100 rupees. 100 or 1000? What? How much was it? 1000 it is. Let me make it 100. Okay. Okay, fine. So tell me, net I have to take a long position of 700. Price of one contract is 100. That means how many contracts I'll have to be taking? 7 contracts long I'll be taking. Is this clear, everyone? So moral of the story is, if I'm having long as well as short position in my share market, what I will do? First, calculate the total value of futures for each of the positions separately. For long position in share market, how much is going to be value of future? For short position in share market, how much is going to be value of future? I will calculate separately. Then I will net it off, and only on the net amount I will be taking a position. Calculate the net value, and based on that I will be entering into futures. Is this clear, everyone? With this, one of the most considered to be most challenging concepts, which is hedging using futures, is done and dusted. every variant of question we've done. You can open any question bank, any questions you can pick. Everything required for you guys to solve this, we have done. I hope you guys have thoroughly enjoyed this. If you guys have thoroughly enjoyed this, okay, right now the time is 12:20 a.m. Yes, I thought that okay, simultaneously one or two more concepts also, at least theoretical value of future we can do. I had thought, and if possible arbitrage also we can do, we had thought, but timing has gone beyond hands. So what we'll do, yes, if you guys want, what do you guys have to do? Firstly, like the video, share it to your friends. Only you are taking benefit. Very bad. Shantam Papam. Okay, put your comment how this video was. Trust me, so many students were asking, sir, derivatives is difficult, derivatives is difficult. Did you feel it difficult? One of the simplest things in the world, the halwa, jujube. Trust me, the entire chapter is this way. Okay, options even more simpler, forex even more simpler. So the entire subject of AFM for CA final, SFM for CMA final, we've made it, yes, into simple stories, wherein just using these stories you will understand the concepts, and maximum questions will do. So if you want to purchase or your friends want to purchase, you know, you'll have to refer. Yes or no? If you feel okay, this is giving you a good quality, trust me, these are just a revision series. It's not a regular batch discussion. Regular batch discussion is going to be even more slower. We'll be doing in more rounds of revisions. Okay? Yes. So what you will have to do, if you have loved it, means share it to your friends, recommend our classes, because you guys are our only marketing. Okay, yes, I do not believe, yes, there are so many faculties who do so many, yes, Telegram paid promotions, all those things are there, but I do not believe in that. You know, I believe that okay, whatever efforts we put, students are there, they are seeing, they love it, they'll share it. So you guys are our only source of marketing. So if you have loved, means you'll have to share it, as simple as that. So quickly we'll revise and we will end today's session. Pay attention from start till now, whatever we have discussed. Okay, fine. Hedging using futures. Now, golden principle for hedging. I told if I want to reduce my risk, means take opposite position. If I want to increase my risk, means take same position. Okay, sir. Now, first one was, how do we hedge using the same respective share futures? Not coming for exam, but still, yes, if you are having a long position in cash market, means take a opposite position, that is short. If you are having a short position, means take long over. Now, if I am using index futures for hedging, first question comes, why am I using index future? Either it could be possible that respective share future is not available, or I'm having a portfolio. Okay. Now, what is a connecting link between my portfolio and index? That is the beta. Beta tells me for 1% change in the market, how much percentage will my share or my share portfolio will change. Is this clear, everyone? Okay. Yes. Now, steps to solve a question. Very simple. Simple, aram se jujube. Okay. First, calculate the desired change in beta and action to be taken. I will see what is the existing beta. Yes, always draw this chart. What is the existing beta? Yes, how much I want the beta to be, that means by how much I'll have to change the beta. Yes or no? And if I have to take if I have to reduce risk, means opposite position, increase risk means same position. Yes or no, everyone? Perfect. Calculate desired change in beta. Action, if I want to reduce risk, means opposite, increase risk means same position. Okay. Additional notes means if required beta is not given, then you assume it as 0. That is perfect hedging. Second is going to be total value of futures. What is the total value of futures? Yes, it is the value of my portfolio into change in beta, because beta, yes, index changes the risk only by 1 unit. So by how many units you want the change in the, yes, risk, yes, you will be multiplying with that. Is this clear? Okay. Step number 3, you will calculate the price of one future contract. It is actual future price into lot size. If actual future price is not given, you will be using the theoretical future price. Step number 4, you will calculate the number of contracts. It is a total value divided by price of one contract. If it is in decimals, ideally you will round it upwards. Okay. Step 5 is calculation of profit or loss on maturity after hedging. Profit or loss. First, profit or loss on share portfolio. How do you calculate profit or loss? Take a reverse position on the day you want to calculate profit. Yes, we'll first write what is the original position. Yes, we'll calculate a reverse position, profit or loss. Yes or no? Yes, profit or loss in futures. First, I'll see what is original position. I'll take a reversal position. I will get the profit or loss per unit. Total profit or loss is profit or loss per unit into number of units. How do I arrive at the number of units? It is a lot size. In one lot, how many units? Into number of lots or number of contracts. Is this clear, everyone? Perfect. Now here, one very important thing. In order to calculate profit or loss, I want to know on the date of settlement, how much percentage my index change, how much percentage my shared portfolio change. If change in both of them are given in the question, simple halwa, jujube, yes or no, directly take it. But if change in only one is given, I'll calculate the change in other using my beta. Yes or no, everyone? Okay, perfect. Then we had the special adjustment. That is, if question is asking, you do everything, After that, you tell what is my portfolio beta after doing all these hedging. So what you will do? Yes, profit or loss, anyways you will be calculating. You will calculate the percentage change in profit or loss. That is the percentage profit or loss on your original investment. That is, I'll calculate the change in the total portfolio. That is profit or loss divided by, yes, original value of portfolio into 100. Yes, so now you will tell, say for example, after 3 months, in 3 months, now my index market fell by 2%. In the same time, our portfolio fell by 4%. That means it is how many times volatile? 2 times volatile. Yes or no? I will see the percentage change in our portfolio divided by percentage change in market. It gives me the beta. Is this clear, everyone? This was one special adjustment. Then we had some Maja adjustments. In that, what all we had discussed in different questions. Okay. First we had seen, question had told me calculate the value of futures in order to hedge 50% of portfolio. I don't want to hedge the full portfolio, only 50% I want. So what I'll be doing? I will write down value of portfolio into change in beta. Yes, that gives me the complete hedge. I only want 50% into 50%. Yes or no, everyone? Next, if total portfolio consists of share as well as cash balance, example 3, 90 lakh share was there, 10 lakh cash was there. What I'll do? I'll calculate total portfolio value. I'll calculate the total portfolio beta, that is the weighted average beta. These figures only I will use throughout in my calculation. Okay. Next, if a longer duration future is used, that is 4-month future is used to hedge risk for a shorter period. Yes or no? 1st January. 3 months only risk I'm having, but future is not there for 3 months. So originally I took a position in 4-month future, but 3 months later I'll be taking a reverse position for the balance 1 month. Yes or no, everyone? 4th one, I am having long as well as short position in cash market. Yes or no? Yes, sorry, Rocky Bhai. Yes or no? He had taken a long position as well as short position. So you will see for long position how much value of future will be there. For short position, how much value of future will be there. Net, how much value will be there. Is this clear, everyone? Perfect. So all these notes that we have used, that is a concept book, yes, as well as a workbook PDF is available on our Telegram group Think with Tabish. So please do go take a printout of that. And if you have loved it, I would really appreciate if you guys put in your valuable comments. Okay. Yes, a lot of efforts has gone behind. Yes, it's midnight, I'm still standing and speaking for you guys. And if you want me to upload other parts also, sir, other part of future, sir, option also, sir, binomial, sir, black scholes also, sir. So this is a full maja, sir. You ask, we'll do it. But you'll have to ask. You'll have to share it to your friends. Okay. So that's all for this video. I hope you guys have thoroughly enjoyed as much as I enjoyed taking this. So thank you so much for staying till the very end. Really means a lot. Yes, my intention is to ensure that we make the learning process simple. So if you've loved this, again I'm asking, do share it to all your friends. So that's all for this video. See you guys some other day for some other session. Until then, keep studying, keep smiling, keep working hard, keep making your parents proud, and see you guys in some other video. Take care. Bye.
Yes, everyone. So now we are proceeding further to concept number 4, which is hedging commodities using commodity futures. Here, what is happening? We want to hedge commodity risk. We have taken a position in commodities. Imagine. I decided I am going to quit teaching. Sir, why, sir? What happened, sir? No much only left. Sir, what happened, sir? Till here you watched the video. Still now you have not put like, you have not subscribed, you have not put a comment. What is this? You have not shared to your friends. People are watching it on YouTube. Put your comments. So I decided I'm going to quit teaching. So then what you are planning to do? Yes, I took up 5 acres of paddy field and I decided that I will be growing paddy. Is this clear, everyone? Okay. So I grow paddy. Tell me, harvest will I be receiving today itself? No, boss. I will be receiving in future. So I thought whenever I will be receiving harvest, 10,000 kg harvest I will be receiving, I will be selling that harvest. Is this clear, everyone? Okay. Now I am having a fear. So what is a fear? Imagine today 1 kg of rice is selling at 50 rupees. So based on that, 10,000 kg rice means 10,000 into 55 lakh I will be receiving. Because I'm having a fear. What if I will receive the harvest at the end of 1 year? At the end of 1 year, if the rice price goes down to say 40 rupees, I will receive 40 only. Is it going to be a loss for me? Yes, boss, it is going to be a loss for me. So am I having a risk? Yes, boss. I want to hedge my risk. But here I am having a risk with respect to commodities. For that, we will hedge using commodity futures. Is this clear, everyone? Okay. So, yes, today, yes, I have grown 10,000 kg paddy. Imagine today the spot price is 1 kg is equal to 50. Yes, harvest is expected at the end of 1 year. I'm having a fear that my price will fall. So yes, I can hedge my risk using commodity derivatives. Commodity derivatives in India, yes, it is done through two exchanges, MCX as well as NCDX. MCX is normally for, yes, all the commodities apart from agricultural commodities. Agricultural commodities are done using NCDX. It's not important, just a practical knowledge. Now, how do we reduce? How do we hedge the risk? Already concept 3 we have understood. If I want to reduce the risk means take opposite position. If I want to increase the risk means take a same position. Yes or no, everyone? Okay. Now, what all will have to be studied? Here, in case of commodity futures, now everything is same only. Two principles I should know. Sir, what are those two principles? Principle number one is calculation of hedge ratio. It is also called as calculation of beta. Tell me portfolio management chapter. Yes, we have calculated beta. Yes, what was the formula for beta? We told, yes, beta is telling, yes, if there is 1% change in market, how much percent is the change in the security? Yes, if only 2 years data is given means I will calculate beta as percentage change in stock divided by percentage change in market. If multiple years data is there means I will calculate it as sigma x into rxm, total risk of x into how much percentage is systematic, that gives me systematic risk of x divided by sigma m, which is the systematic risk of market. Yes or no, everyone? This is the formula. Sir, how this formula came? Portfolio management chapter. If you guys want, on YouTube a detailed revision of portfolio is available. Beautifully we have understood that, you guys can go and refer it. Okay, boss. Now same formula, it was for calculation of beta, same formula only we'll be using here, but a small tweak we will be doing. Yes, instead of security X, here we are having the spot price. Instead of market, here we are having the future price. So it is sigma X into RSF is divided by sigma F. This is going to be the formula for beta. Look at this, everyone. Yes, beta of security, it is sigma X into RXM divided by sigma M. Yes, in case the beta, yes, for the commodity, this is going to be sigma S. Yes, which is the standard deviation of the spot price into, yes, correlation of spot with the future, RSF, divided by sigma, which is the standard deviation of future. Okay, in the regular batch in detail, I've spent so much time, not needed. This is just beta formula tweak. Is this clear, everyone? Okay, point number one. Let's look at this. Imagine standard deviation of spot price is 2%, standard deviation of future is 1.75%, correlation coefficient is 0.75. So how do we calculate beta? Yes, beta is sigma S, yes, into RSF 0.75 divided by sigma F 1.75. It is 0.857. This is principle number one. Okay, principle number two, commodity hedging is always done in terms of quantity only. Oh, 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 always remember, students, in case of commodities, my risk is in terms of quantity. Simple. I am growing 10,000 kg rice. Okay. Yes. After 1 year, I want to sell 10,000 kg rice. Today I am growing. I have purchased or I am growing. I am having a long position. Yes or no, on 10,000 kg rice. Imagine today the price is 50 rupees. After 1 year, I am having a fear that the price will fall and come to 40 rupees. Yes or no? The risk is there on that 10,000 kg rice. So I want to hedge my risk on that 10,000 kg rice. Yes or no, everyone? So the commodity, yes, quantity is available. I will directly hedge my risk using the quantity. Sir, when we did, in case of index future, why we didn't use the quantity? Because understand, students, in case of index futures, now I am having a portfolio of multiple shares. To hedge, I am using index. Simple, I am having 10 Reliance shares, 10 Tata shares. To hedge, I am not using the respective shares. I am using index to hedge that. That is why I cannot compare the quantity. Simple, I am telling 10 dogs are there, buffaloes are there, yes, 10 cows are there, and 5 man people are there. Can you add everything and tell, yes, 45, yes, cow, buffalo, man, people are there? No, boss. Everything is different. So you cannot do it. Here, commodity you're hedging. So directly in terms of, yes, quantity only you can be, yes, hedging. Is this clear, everyone? Simple principle. Commodity hedging is always done in terms of quantity only. So look at this, students, directly without even any formula, just based on the knowledge that we are having from hedging. In case of index futures, we can do it here. Imagine I am having a long position on 10,000 kg rice. Long position is there on 10,000 kg rice. Lot size is 100 kg. Calculate the number of contracts if hedge ratio is equal to 1. There we had done a drawing. Yes or no, everyone? Tell me, yes. I am having a long position on 10,000 kg rice. Tell me what is the hedge ratio. Hedge ratio is basically beta. It is 1. I want a perfect hedge. That means I want to reduce the risk to 0. Yes, I'm having a long position, means I will take a short position. Yes, I want the beta to come from 1 to 0. That means the change in beta is going to be 1. Yes or no, everyone? So first, yes, I will be taking a short position. Okay. Change in beta is going to be equal to 1. So what is the total quantity of futures? I have taken a long position on 10,000 kg. So how much quantity I should be taking a short position? 10,000 into 1, 10,000 kg. Imagine the lot size is 100 kg. That means how many contracts I should be entering into? Yes. One lot is for 100 kg. That means for 10,000 kg, how many lots? 10,000 divided by 100, it is going to be 100 lots. Yes or no, everyone? Okay. Situation 2, if my hedge ratio, that is beta is equal to 2, I will tell, okay, boss, 0, my beta is 2. I am having a long position on 10,000 kg. I want to bring the risk to 0. That means change in beta is equal to 2. Firstly, I will take a short position. Yes, change in beta is equal to 2. Tell me what is the total quantity I want to hedge. Yes, 10,000 into 2, it is going to be 20,000 kg. Yes or no, everyone? Can I calculate the number of lots? Simple, boss. Yes, one lot is of 10,000, sorry, 100 kg. So it is 20,000 divided by 100. I guess it is 200 lots. Yes or no, everyone? Perfect. So if this is clear, we can directly see the steps to solve a question. Yes, first one was calculate hedge ratio, which is basically beta calculation. It is sigma S into RSF divided by sigma F. Okay, then determine the action to be taken in future market. Yes, if you want to reduce risk means take opposite position. If you want to increase the risk means take the same position. Okay, then comes, yes, total quantity of futures that you want to be hedging. It is the total quantity of commodity that you're having into change in the beta. In our example, 10,000 kg rice we had grown. Yes, my beta was 2, so I want to bring it to 0. So it was 10,000 into 2, 20,000 kg. Total quantity of futures. Then comes the number of contracts. It is the total quantity of futures divided by lot size. Yes or no, everyone? Okay, directly we'll go to workbook. Quickly have a look at the question. Pay attention, everyone. Where is it? Where is it? Okay. Hedging in case of commodity futures. Yes, this is a master example where everything we have done. Okay. Yes, item is a rice trader. Okay. Who is currently holding 10 metric tons of rice. 1 ton is 1000 kg. He is currently holding 10 metric tons of rice. That means he has purchased and kept. Yes or no? So original position is a long buy position. Okay. Current spot price is 70 per kg. Today the spot price is 70. So if he is selling today means he can sell at 70. But was he is not selling today, he is selling after some period. Yes, and the 3-month future trading price is 69 per kg. Okay, the variance of changes in the spot price is 16 percentage square and the future price is 36 percentage square, having correlation coefficient of 0.75. Size of one contract is equal to 100 kg. Calculate the optimal hedge ratio, beta. Tell me, how do we calculate beta? It is sigma S into RSF divided by sigma F. Yes, whether sigma S is given, yes, variance is given. I will take a square root, I will arrive at sigma S. Yes, variance of forward is given, future is given. I will take a square root, I will arrive at sigma F. RSF is anyways given, I will arrive at the hedge ratio. Hedge ratio is coming to 0.5. Is this clear, everyone? Okay. Now, hedging is the simplest thing. Tell me, students, yes, trader has currently purchased, just a minute. Yes, everyone, tell me, we have purchased. I am currently holding. That means I have purchased and kept how much? 10 metric tons of rice. Yes, yes, 1 ton is how much? 1000 kg. 10 metric tons is going to be how much? 10,000 kg. So I'm currently having a long position on 10,000 kg rice. Yes or no, everyone? Tell me, beta is how much? 0.5. I want to get a perfect hedge. I want to bring the beta to 0. So which position I will be taking? Short position. How much is the change in beta? 0.5. So what is the total quantity of futures? It is a 0.5 into 10,000. It is going to be 5,000 kg. Yes or no, everyone? Tell me what is the lot size that I am having. Lot size is 100 kg. One lot is for 100 kg. So how many lots? 5,000 divided by 100. Is it going to be 50 lots? Yes or no, everyone? Simple. Yes, optimal hedge ratio we have calculated. Then we have told this. Yes, action to be taken. Here we have done 5,000 kg. It is going to be 50 contracts or 50 lots. Is this clear, everyone? Yes, then accordingly, if you want, you can calculate the total value of futures. Tell me, yes, what is going to be total value of futures? Future is trading at 69 per kg. So you will tell 69 per kg. One lot is for 100 kg into, we are entering into 50 lots if I'm not wrong. That is going to be the total future value. Is this clear, everyone? Okay. Then we are having the last thing, which is net amount received on settlement. If after 3 months the spot price is 72 per kg and the 3 months future contract closes at 67 per kg, then calculate the amount received and the effective realized price. Simple thing. Students unnecessarily make too much complication. Now pictorically, I guess we have done it here. Okay, simple. Okay. Yes, we are the rice trader. Yes or no, everyone? Yes, we are having 10,000 metric tons of rice. Yes, in order to hedge my risk, I entered into a future contract. Yes, by entering into a future contract, it is always cash settled, profit or loss we will be settling. Okay. Tell me, students, after 3 months, I am selling 10,000 kg rice. Yes. On the date I was selling, what was the spot price? Yes, on that date, spot price was 72. So I am having 10,000 kg rice. This is the rice. I go in the spot market, I sell 1 kg, I will receive how much? 72. So for 10,000 kg, how much I will be receiving? 72 into 10,000, 7,20,000. Yes or no, everyone? Perfect. So first I will be receiving cash from the spot market because I'm selling in the spot market. 7,20,000 I received. Is this clear? One side is over. Always I will be selling in the spot market only. In the future market, derivative market, you cannot be selling. In derivative market, only profit or loss will be settled. Is this clear? Now tell me, I was having a fear. For that, I entered into a future contract. Yes or no, everyone? Perfect. Tell me what position I had taken. I took a short position in futures. Yes, boss. Yes. On the day I took short position, what was the price of futures? If you see, yes, I am taking a short position on that day. Future is trading at 69. So I'm taking a short position. Short is basically sell at 69. On the date of cancellation, 3 month future is closing at 67. Future is a separate commodity altogether. Yes or no, everyone? Tell me. Yes, in future, what I did. Originally, I took a short position, sell position at 69. Yes, to calculate profit or loss, we know simple boss, take a reverse position. I had a sell position. I will be going for a buy position. At what price I will be going for a buy position? On the date of settlement, it is 67. So tell me, I sold at 69. I am purchasing at 67. That means I'm having a profit of 2 rupees per kg. Total profit, I will tell it is 2 rupees per kg. One lot is having 100 kg. I entered into 50 lots. So I made a profit of 10,000. Yes or no, everyone? So the total amount I will receive, 7,20,000 from the spot market I will be receiving. Profit or loss on future is 10,000. So total 720 plus 10, 7,30,000 I will be receiving. Yes or no? 7,30,000 is for 10,000 kg. That means effective price is 73 per kg. Yes or no, everyone? So look at this. Look at this. Yes. Net amount received, cash received in the spot market, plus or minus profit or loss on future. I will arrive at total amount received on maturity divided by total quantity. I will arrive at the effective realized price. Is this clear, everyone? Perfect. Now, if this is over, means concept 4 is over. Now we are having the last concept, which is concept number 5, arbitrage using futures. Not a very important concept from the examination perspective. Yes, still, now why will arbitrage exist? Because my theoretical future price and actual future price are different. Okay, so how do we solve a question? Step number 1, calculate theoretical future price. We have seen concept 1b, calculation of TFP, that big chart. Okay. Once we have calculated theoretical future price, now what is going to be arbitrage gain? Simple. You need not do anything. It is a difference between theoretical future price and actual future price. Suppose my theoretical future price is 100, actual future price is 105. Arbitrager will enter into a transaction in such a way that he will ultimately make a gain of 5 rupees. Arbitrager will never make a loss. Suppose theoretical future price is 100, actual future price is 95. Arbitrager will enter into a transaction in such a way that ultimately he'll make an arbitrage gain of 5 rupees. Arbitrage gain, it is a difference between theoretical future price and actual future price. Now what is the decision, what is the action we should be taking? If my actual future price is more than the theoretical future price, that means future is overvalued. Yes or no? So we will enter into a sell future. If actual future price is less than the theoretical future price, that means future is undervalued. That means we'll enter into a buy futures. Is this clear, everyone? Yes. More on arbitrage is not needed from the examination perspective. This much discussion is sufficient. Is this clear, everyone? With this, unit number 1, forwards and futures, is done, my dear students. One of the most important concepts from the perspective of your examination is forwards and futures. In that, we had discussed concept 0, basics. Concept 1, in that first we had seen price of a future contract. Yes. Second thing, we had seen profit or loss calculation. Then concept 1b, we had seen calculation of theoretical future price. Then we had concept 2, which was margins, yes or no everyone, initial margin, maintenance margin, market margin. Then we had seen, yes, concept number 3, hedging using futures. Then we had seen concept number 4, commodity hedging using futures. And then we had seen concept number 5, which is arbitrage using futures. Is this clear, everyone? So with this, unit number 1, forwards and futures, is done, done. Yes, everyone. So let us now continue with unit number 2, which is going to be options. Now, what is options? I want you guys to just remember one word when you hear the term options. What is option? Option means an insurance. Simple. It is giving you insurance. Tell me, what is an insurance? It is protecting you against adverse events. Option is protecting you against adverse price movements. As simple as that. Is this clear, everyone? Perfect. Imagine there is an insurance company. Yes, this is the story we will be using throughout. Yes, this is the legend from Ongole, Koti Reddy. Yes, the one of our students. Yes, imagine there is a soap insurance company. Soap is the name of the other insurance company. Okay, now Koti wants to take a health insurance. He is asking how much is the health insurance premium. They are telling, yes, the health insurance premium you'll have to be paying is 20,000 rupees. Okay, he is asking how much is the cover. Imagine for a time being, yes, cover is unlimited. That means any amount of health claim he can be making just by making a premium of 20,000 rupees. Is this clear, everyone? Okay. Now, yes, Koti has purchased a health insurance for unlimited cover by paying a premium of 20,000 rupees. Now, tell me, students. Situation number 1. There is no any health issues. Front itself, Koti has to pay 20,000. So, for Koti, cash outflow is 20,000. Is he receiving anything from the insurance company? What is insurance company promising? If any health problems will arise, you will incur medical bill that we will reimburse. Will he incur any expense? No. So is he recovering anything? No. So what is his cost? 20,000. Tell me, for the soap insurance company, they have received a premium of 20,000. Are they making any reimbursement? No. That means it is going to be income of 20,000. Second situation, imagine Koti had to incur a medical expense of 20,000. So upfront Koti is paying a premium of 20,000. Once he incurred a medical expenditure of 20,000, he will get it reimbursed. Yes or no? So tell me the total profit or loss for Koti. 20,000 he paid, 20,000 he received. Profit or loss is zero. For the soap insurance company, they have received a premium of 20,000. They have made a reimbursement of 20,000. Profit or loss is zero. Yes or no, everyone? Third situation, imagine in that year, Koti had to incur a major medical expense of 5 lakh. So upfront, Koti is paying an insurance premium of 20,000. Yes or no? But he incurred a medical, yes, bill of 5 lakh rupees. So he is getting a reimbursement of 5 lakh from the insurance company. So Koti is telling, boss, I paid 20,000 to the insurance company and I received 5 lakh from the insurance company. So overall, what is the profit from purchasing the insurance? 4 lakh 80,000. Tell me, for the insurance company, they are telling we received 20,000 from Koti, but we made a payment of 5 lakh. That means what is the loss for the insurance company? It is going to be 4 lakh 80,000. Yes or no, everyone? Now, in all these cases, tell me, Koti is buying an insurance by paying a premium of 20,000 rupees. What is the maximum loss for Koti? Maximum loss is a premium paid of 20,000. Max to max, what can happen? He has paid the premium. He did not receive anything. Yes or no? But tell me, the maximum gain can be pretty high. Yes or no? Imagine he had to incur a medical expenditure of 50 lakh. He will recover 50 lakh. Yes or no? Everyone, perfect. So for Koti, yes, the maximum loss, it is just 20,000, but the maximum gain, it is going to be unlimited or fairly high. Yes or no? Tell me, for the soap insurance company, it is basically for the insurance company. Tell me maximum how much money they can make. Maximum 20,000 they can be making. Yes or no? But their loss can be unlimited. Assume the claim comes to 50 lakh, they have to pay 50 lakh. Yes or no, everyone? So the maximum profit is going to be 20,000, but a loss can be fairly large. Yes or no, everyone? Perfect. Is this clear, everyone? Now, if this is there on the back of our mind, we can understand options quickly. Now, what is options, students? Simple. Options is a derivative contract only. But yes, option gives a choice for the holder of option. That means it is a derivative only, but it gives a choice, an option. That is, they are having the right, but not obligation. That is, if they want, they can exercise. Otherwise, they need not exercise. Forward and future, it created obligation to both the parties. Buyer had to buy, seller had to sell. Option is giving a choice. Yes or no? They're having the right. If they want, they can exercise. But there is no obligation or compulsion. Is this clear, everyone? Through one story, we will get the basics right. Once the basics is right, options is even more simpler than forwards and futures. Trust me on these stories. Very small unit it is going to be. Okay. Yes, we are going ahead with the same story. Koti is there. Koti is planning to get married after 1 year, so he wants to purchase gold. Yes, I'm telling spot 1 gram gold is 12,000. 1 year later, forward if you want 12,500. Is this clear, everyone? This is me, Tabish. I am the seller. Koti is the buyer. Tell me what is the fear Koti is having? He is having a fear of increase in the price. Yes, what is the fear I'm having? I'm having the fear of decrease in the price. Okay, crazy. Now, so imagine Koti is telling I want to enter into a forward contract or a future contract at 1 gram gold is equal to 12,500. So imagine after 1 year, the price of gold reaches 15,000. So tell me whether Koti is happy or sad. He is very happy, sir. Why is he happy? Tell me if there was no forward, how much he had to pay for 1 gram? 15,000. But because the forward is there, how much only he is paying? 12,500. So his profit is 2,500. Yes or no, everyone? But imagine the actual price is 11,000 only. Whether Koti is happy or sad, he is sad. So why, sir? If there was no forward, he would have gone to the market and purchased 1 gram gold at 11,000 only. But because forward is there, yes, it creates obligation. He now has to buy at 12,500 only. So if there was no forward, he would have paid 11,000 only. Because forward is there, he's paying 12,500. So he has incurred a loss of 1,500. Yes or no, everyone? Perfect. So yes, a forward can give us either a profit or a loss. Same is going to be the case for the seller also. That is me, Maja Golden Diamonds. Either I'll be having a profit or a loss. Okay. Now one thing comes in Koti's mind. Koti is telling, simple boss, I am having a fear that after 1 year, gold price will increase. Okay, yes, if the gold price increases beyond 12,500 means I am having a derivative option. Yes, I am having a derivative contract. It is beneficial. Imagine the gold price reaches 15,000. Without derivative, I have to pay 15,000, but because of derivative, I am paying 12,500. But boss, if the price is falling below this, it is having a loss. Yes, he is coming and asking, boss, can we structure a transaction in a way wherein, yes, I will be getting only the profit, not the loss? Yes, this is what Koti is asking. Koti is telling, boss, yes, can I enter into an option contract? Wherein, yes, he is asking me, can you give me an option that after 1 year, yes, I have an option to buy at 12,500. That is, in reality, in the market, if the price is 15,000, I will come to you and buy at 12,500. If the price is 11,000, I will not come to you. I will go to market and directly buy at 11,000. I tell boss, such an option is not available. Yes or no? Why? Because a contract has to either create a profit or possibility of profit for both the parties. I am telling, if I give you the option, you will be making profit or no profit. But for me, what is there? I will either be having a loss or no loss. For me, there is no possibility of making profit only. I don't want to enter into such a contract, is what I tell you. Is this clear, everyone? So Koti goes back. I tell him, I will only give you forward or future. If you want, enter. He tells, no, no, I don't. I want this option. It will get lost. He will go. This is one phase of it. Is this clear, everyone? When he was going further, yes, can you give me an option that is a right but not the obligation to buy gold after 1 year at 12,500? Okay, fine. Yes. Now, yes, when he was going further, he comes across the insurance company, soap insurance company. Tell me what is the insurance company's duty? Yes, insurance company's duty is to ensure that if you are sad, it will make you happy. Yes or no, everyone? If you are incurring a loss, it will reimburse you the loss. Yes or no, everyone? So, Koti was going there. Yes, Koti was going through the yes insurance company. Yes, soap. Yes, is name of another character. Okay. Yes, from our face-to-face class only he is. Okay. Yes. No. Soap was going through there. Soap calls Koti. Koti, come here. Yes. Koti was very sad. He's asking what happened. He's telling, I want to purchase gold after 1 year, but I'm having a fear that the gold price will go up. So Soap is telling you enter into a forward or a future. He's telling if I enter into forward or a future, my price gets locked. I want an option. That is, if the price goes up, I can purchase at a low price. If the price falls down, I will purchase at the actual price. Yes. So he is telling, yes, can you help me? He's telling, boss, I can do one thing. I can give you an insurance. What is Soap telling students? He is telling, I can give you an insurance. Sir, what is this insurance going to be about? He is telling, you will have to pay an upfront premium. Koti is telling, okay, I'm willing to pay an upfront premium. If you are willing to pay an upfront premium, I will give you an insurance wherein yes, we will lock the price at 12,500. Okay. You are buying, you want to purchase, you are having a fear that the gold price will go above 12,500. I am giving you a promise. Soap is telling, soap insurance company, I am giving you a promise, gold price will not exceed 12,500. Court is asking, what if the gold price exceeds 12,500? He is telling, if it exceeds, whatever extra is there, we will reimburse it to you. Same is insurance company's duty. Yes or no, everyone? Health insurance you are taking. Yes, what is insurance company telling? Yes, you give me a premium. If any health expenditure you are incurring, we will reimburse it to you. Same is happening here. You give me a premium. Yes, if your gold price goes beyond 12,500, how much extra ever it goes, we will reimburse it to you. That is the job, the business of insurance company, to make good the loss. If the party is having a loss, we will make good the loss. But for that, we'll be charging a premium. Yes or no, everyone? Perfect. So what soap insurance company is telling, boss, don't worry, in 1 year, gold price will not cross beyond 12,500. Court is asking, what if it crosses? They'll tell, I will reimburse that to you. Is this clear, everyone? So now understand. Yes, promise is made by soap insurance company. We will give you protection against adverse price movement. Yes, we are locking an option contract at a strike price of 12,500 per gram. It is called the strike price, the price that we have locked. So we are giving you an insurance. On settlement, what you do? You purchase the gold from spot market itself. Yes, if the price is more than 12,500, now whatever extra is there, that we will reimburse and ensure that your cost doesn't exceed 12,500. Is this clear, everyone? So tell me, what is Koti having? Koti is now having the option to buy gold 12,500. This is called as a call option. Is this clear, everyone? Now, practically, let us try understanding what will happen. Pay attention, students. Just give me 2 to 3 minutes. We'll get the complete picture. Now, Koti enters into a call option. The right to buy is called as a call option. Is this clear, everyone? Koti purchases a call option. Now, after 1 year is when Koti will be chasing gold actually. Yes or no? Koti paid the premium to soap insurance company. Now, imagine after 1 year, the actual price of gold is 12,000 only. Okay. Tell me, students, from where Koti will be buying gold? Koti has to be buying gold from the spot market. Yes or no, everyone? Spot, what is the price? 12,000. He will pay the price. Okay. He will pay 12,000. Now look at this. Three parties are there. Yes. Maja Gold and Diamonds is there. That is we. Okay. Koti is there. He wants to purchase gold. There is a soap insurance. Imagine after 1 year, gold price is 12,000. So Koti will go to the shop, pay 12,000 rupees, purchase 1 gram gold. Is this clear, everyone? Tell me whether the price has crossed 12,500. No. So whether insurance company will reimburse? No, nothing they will be reimbursing. What is the promise they made? Gold price will not exceed 12,500. If it exceeds, we will reimburse. It did not exceed, they will not reimburse. So what is the cost for Koti? 12,000 only. Yes or no? Okay. Imagine the gold price is 12,300. He will go to the spot market, pay 12,300. Yes, come back. Will he get any reimbursement? No. Imagine the gold price is 12,600. What Koti will do? Koti will go to the spot market. Yes, purchase 1 gram gold at 12,600. Yes or no? When he is coming back, is he happy or sad? He's sad. Why? The gold price has increased. But wait, who is there to ensure that when he is sad, they will make him happy? Yes, we have the soap insurance company. Yes or no? What is the promise made by soap insurance company? Yes, if the gold price crosses 12,500, I will reimburse it to you. Did it cross? Yes, boss. How much extra it went? 100. So soap insurance company will reimburse Koti 100 rupees. Yes or no, everyone? So tell me, what is Koti's effective price? 12,600 he paid, but 100 he received back. That means effectively he incurred a cost of 12,500 only. Yes or no, everyone? Imagine the actual price is 13,000. In the spot, he will pay 13,000 by 1 gram gold, but he will be getting a reimbursement of 500. So his effective cost is how much? 12,500. Yes or no, everyone? Imagine the actual price is 15,000. He will pay 15,000, but from the insurance company, he will receive 2,500. His net cost is 12,500 only. Yes or no, everyone? In essence, call option, the right to buy. Yes or no? My strike price is 12,500. So in simple terms, logically we have understood. In shortcut, what is call option? It is the right to buy. Koti has purchased because he is buying gold. He will purchase a call option. The right to buy. Koti is having the right to buy at 12,500. Yes. Imagine the actual price is 12,000. He will buy at 12,000 only. Imagine the actual price is 12,300. He will buy at 12,300 only. Imagine the actual price is 15,000. He now has the right to buy at 12,500. So he will exercise the right. So his effective cost will be how much? 12,500. Sir, how will it be 12,500? In reality, I have shown you. Yes, he will go to spot market. There he will pay 15,000 only. but the insurance company will reimburse him 2,500. So for him, the effective cost is going to be 12,500 only. Is this clear, everyone? The working of option. Yes, why these things are happening? Is this clear, everyone? Okay, perfect. Now, yes, so for Koti, in any case, maximum cost he is going to incur is going to be, yes, 12,500 only. Okay, perfect, boss. Imagine the option premium that Koti is paying is 200 rupees. In that case, tell me, Koti is paying a premium of 200. So what is the maximum loss for Koti in this option contract? Maximum, this 200 what he has paid, he may lose. Yes or no, everyone? Perfect. But what is again? If in case of adverse price movement, he will recover money. How much he can recover? Whatever is the loss, he will be recovering. Imagine the gold price, 1 gram gold is at 20,000. He will receive 7,500. He has incurred 200 rupees only. So balance 7,300 is going to be the net profit. Yes or no, everyone? So tell me, from Koti's perspective, option buyer's perspective, maximum loss is a premium paid. Yes, I'm paying a premium. That is a maximum loss. Yes, maximum gain can be unlimited. Yes or no, everyone? From the perspective of option seller who has sold the option. Yes, soap insurance company. They have told, I am giving you this option. They have given the option. They have taken up the insurance contract. Yes, in that case, what is the maximum amount they will be receiving? Premium is the maximum amount they will be receiving. Yes or no? But loss can be unlimited. We had already seen in the case of health insurance. Yes or no, everyone? Person who is buying health insurance, for him, maximum loss is the premium, but maximum gain can be unlimited. For insurance company, maximum gain is the premium, maximum loss can be unlimited. Yes or no, everyone? Perfect. The same thing is there here. Okay, fine. Yes. Now we have understood call option. Yes or no, everyone? Buyer is there. Buyer is having a fear of increase in price. He could have entered into a forward or a future also. But in forward or a future, there is an obligation. He doesn't want an obligation. He just wants an option. Yes, for that purpose, they will be entering into option contract. Is this clear, everyone? Call option. It gives the right to buy. Buyer will be going for the call option. Is this clear, everyone? Oh. Now comes the other side of the story. I got to know that boss, Koti is there. He purchased a call option. He purchased an insurance contract. Simple. So I am also there. Who am I? Maja Gold and Diamonds. I quit teaching. I'm having a gold and diamond business. Yes, I'm having diamonds, gold and diamonds with me. Yes. After 1 year, I'm planning to sell this gold. I'm having a fear. What is a fear? When I'm selling, if the gold price falls down, I will be receiving less money. Imagine today the gold price is 12,500. So for 1 gram, I'll be receiving 12,500. After 1 year, if the gold price crashes and becomes 10,000, I will be receiving 10,000 only. So I also go to soap insurance company and tell boss, I am a seller. I'm having a fear that if my gold price falls, I will be incurring loss. Can you give me an insurance? They will tell, I will give you an insurance. So I purchase the insurance. What is this insurance called? It is called as a put option. Yes, it is giving me the right to sell. So insurance company is telling, don't worry, boss. After 1 year, yes, the price will be at least 12,500. So you will be in a position to sell it at least 12,500. This is the promise that soap insurance company is giving. I tell, what if I don't get 12,500? Okay, in the reality, if the price is more than 12,500, great. If the selling price is 13,000, I'm receiving 30,000. 15,000, I'm receiving 15,000. 20,000, I'm receiving 20,000. Great, I am happy. But if the price is 10,000 only, I am sad, I am receiving less. Insurance company is telling, soap insurance company is saying, don't worry. Yes, we are giving you a promise. You will receive at least 12,500. If you are receiving less than 12,500, the difference amount we will pay. Imagine the actual price of gold is 10,000 only. So from customer, I will receive 10,000 only, but I need not worry. The insurance company will give me 2,500. Is this clear, everyone? Yes or no? Okay, perfect. Now look at this, students. Yes, soap insurance company is giving me a promise that they will give protection against adverse price movement. In case of a seller, what is adverse? Fall in the price. They're giving me a protection against fall in the prices. Is this clear? We are locking an option contract at the strike price of 12,500 yes per gram. Yes, they're giving me the insurance. On settlement, I will be selling gold in the spot market only. If my price is less than 12,500, they will remove the difference. Is this clear, everyone? So, me, Tabish, I am having the option to sell at 12,500. Yes, if the price is more, 13,000, 15,000, 17,000, 20,000, I will sell there. Even if my price is less than 12,500, assume my price is 10,000, 5,000, still I have the option to sell it to the insurance company. They will give me 12,500. It is called a put option. Is this clear, everyone? Perfect. Now look at this different situations we have done. Imagine on the date of settlement, after 1 year, I purchased the put option. After 1 year, the actual price of gold is 13,000. So I sold to customer, I received 13,000. Tell me, can I receive anything from the insurance company? They told at least 12,500 you will be receiving. Did I receive? Yes, boss. Imagine the actual price of gold is 13,000. I will sell it at 13,000. Will I get anything from insurance company? No. They promised at least 12,500 I will be receiving. I received. Imagine the price is 12,300. So I sell it to the customer for 1 gram. How much only I'm getting? 12,300 only I'm getting. Am I happy or sad? Sad. I'm smiling or crying or crying. That time who will come there to compensate me? Insurance company is coming. Yes or no, everyone? Insurance company is saying, boss, we promised you that at least 12,500 you will be receiving. From the spot market, you receive 12,300 only now. Take this 200 rupees. So my net cash flow is how much? 12,500. Imagine the spot price is 12,000. So from the customer, I receive 12,000 only. I am crying. Insurance company will come and reimburse me 500. So that effectively I will receive 12,500. Is this clear, everyone? This is going to be about put option. Is this clear, everyone? So tell me, in case of put option, I have the option to sell. I have the option, but not the obligation. If I want, I can sell. Yes. If in the market the price is 15,000, I have the option to sell at 12,500. Will I sell at 12,500? No, boss, I will sell at 15,000. Yes, if the actual price is 14,000, I will sell at 14,000. But boss, if the actual price is 10,000, I have the option to sell at 12,500. I will exercise the option and sell at 12,500. Is this clear, everyone? This is going to be about my put option. Is this clear? Now, same thing regarding cash flow from the options. Again, did not explain. Yes, maximum. Yes, loss for the option holder, option buyer. It is the premium. Maximum gain can be unlimited. For the insurance company, yes, the maximum gain is a premium received, but maximum loss can be fairly large or unlimited. Is this clear, everyone? Okay, fine. Now, summary of this, three parties are there in case of option contract. Just to remember this story. Now, throughout all logics will make sense. Yes, first there is Koti. He is the buyer of the asset. Yes or no, everyone? Then there is the insurance company. Okay. Then yes, we have Maja Gold and Diamonds. Me, I am the seller of the asset, seller of gold. Okay. Now Koti is entering into an insurance contract. Koti wants to buy gold. He wants the option to buy gold. So option to buy, it is a call option. So Koti will purchase the call option. Is this clear, everyone? Yes. I want the option to sell gold at 12,500. It is the option to sell. It is called as a put option. Is this clear, everyone? Yes. Koti is having a fear of increase in the prices, so accordingly, he will enter into a call option wherein he is having the right to bid at a pre-decided price. Is this clear, everyone? Yes, I'm having a fear of fall in the prices, so I will enter into a put option wherein I'm having the right to sell. At least this much I will be receiving in case I'm selling. Is this clear, everyone? Okay. Now, when do we exercise a call option as well as a put option? Call option is exercised when the actual price is greater than the strike price. Simple, boss. Yes, strike price is 12,500. Imagine the actual price is 13,000. Tell me, from Koti's perspective, Koti is having the option to buy gold at 12,500. Yes, boss. In reality, the gold price is 13,000. Now he will exercise the option and buy at 12,500. Yes or no, everyone? In simple terms, he will buy gold at 13,000, but he will go to the insurance company and cry there. They will give him 500 rupees back. Yes or no? In that case, he will go. Imagine the actual price of gold is 12,000 only. Will he go to the insurance company? He will not be going to the insurance company. Yes or no, everyone? Same thing is given here. Now, when is a put option exercise? It is exercised when the actual price is less than the strike price. Imagine strike price is 12,500. I sell and I receive 12,500 or more than 12,500. Am I having a problem? No. But if I'm receiving less than 12,500, imagine, yes, the spot price is 10,000 only. So I receive 10,000 only. Am I happy or sad? Sad. So that time, where will I go to? I will go to the soap insurance company. They will reimburse me the difference. Yes or no? That is when I will be exercising. Is this clear, everyone? Yes or no? I hope logically we have understood. I'm not trying to spend so much time there. Trust me, in the regular batch, just this basics alone, 2 hours we have spent in different angles. But this is going to be a rocket revision, my dear students. Is this clear, everyone? So quickly, let us try seeing. Yes, what is an option contract? Simple. Yes, we know what is a derivative. It is a agreement between two parties to buy or sell a pre-decided specified asset at a specified future date. Yes, at a pre-decided price. Now, what is going to be an option contract? Option is a derivative contract only. Boss, it gives choice for the holder. Whoever is buying the option from the insurance company, they will have a choice. That is, they're having the right but not obligation. If they want, they can exercise, but there is no compulsion to exercise. Is this clear, everyone? Okay. Now, what all parties will be there to the option contract? There will be two different parties. One is the option holder, also called as the option buyer, the party who has purchased the option. One is the option seller, also called as option writer. This is basically the insurance company. Tell me, in the first example, Koti was there, soap insurance company was there. Yes, Koti was a person who was having a fear of increase in the prices. So he purchased the option, yes or no, everyone? Perfect. So Koti is going to be the option holder, option buyer, yes or no? And tell me, who gave the insurance? Who gave the promise? It was a soap insurance company. So soap insurance company is going to be the option writer. They write the option and give it. And don't worry, boss, we will take care of it. Yes or no? He is option seller. He is selling that option. In the second transaction, that option was for buying from the buyer's perspective. Second transaction, soap insurance company is there. Maja Gold and Diamonds, I am there. I wanted to sell gold after 1 year. I had a fear that the gold price will fall. So for that purpose, I took an option. Yes or no, everyone? Tell me, who is the person who is purchasing the option, who is purchasing the insurance contract? Yes, it is me, Maja Gold and Diamonds. Yes, and tell me, who is the party which is giving the insurance, which is giving the option? It is soap insurance company. Yes or no? So in the second transaction, who is the option buyer? Maja Gold and Diamonds, I am the option buyer. I am having a fear of fall in the prices. That is why I am purchasing the option, put option. Who is giving the option? Yes, Maja insurance company, sorry, soap insurance company. So they are the option writer. Is this clear? Yes, the option holder, option buyer is having the option. Yes, option writer, they are taking up the obligation if the option holder exercises the contract. Is this clear, everyone? Okay, fine. Then comes the different types of option contract. We are having call option, we are having put option. What is a call option? Yes, it is the right to buy the asset. What is a put option? It is the right to sell asset. Who will purchase a call option? Buyer of the asset will be buying his call option. Who will be buying put option? Seller of the asset will be buying put option. Is this clear, everyone? Okay, fine. Now, other important pointers is strike price. It is the price at which option is exercised. Is pre-decided price at which option is exercised. It is also denoted as K or X. These are different ways in which strike price is denoted. Is this clear, everyone? Then comes option premium. Tell me, soap insurance company, are they doing charity? Are they doing public service? No, boss. They are also making money. How? In the form of premium. In order to give the option, they are charging premium. It is called as option premium. Is for option price, the price to get the option. Now, different types of options. There are two different types of options: American option, European option. Yes, American option, it can be exercised at any point up to expiry. Suppose expiry is 3 months. At any point before 3 months, we can be exercising. European option can be exercised only on the expiry date. Is this clear, everyone? Till here, things are clear. Any doubts, give me a confirmation, students. Yes, everyone. So now let us go ahead to concept number one, which is profit or loss in case of options. In this, altogether, 3 points we'll be discussing. First, it is the profit or loss for the option holder. Second, we will discuss the profit or loss for the option writer, which is option seller. Third is going to be calculation of break-even point. Is this clear? 3 pointers are there. First, let us try understanding from a story. Now, Mr. Koti purchased a call option on 1 gram gold from the soap insurance company at a strike price of 12,500. Same story I am keeping. Yes, premium paid is equal to 200. Yes. Calculate the gross payoff and net payoff from the following cases. Tell me, students. Yes, Koti has purchased a 1 year call option. Yes, 1 year call option. Call means it is the right to buy. Yes or no, everyone? Yes. So Koti wants to buy gold after 1 year. Yes, at strike price of 12,500. So Koti is having the option to buy gold at 12,500. Is this clear, everyone? Okay. Now imagine the actual price on maturity is 15,000. Tell me, students. Different ways we can look at this. Yes, the gross payoff, premium, net payoff. Gross payoff, it is the profit I will receive on the settlement date. Simple. Tell me, students. Today is the date I am entering into option contract. Today I will be paying a premium. Yes or no? This is the settlement date. Imagine today Koti entered into a yes call option. Yes, imagine on the settlement date he entered into a call option at 12,500 per gram. Imagine on the settlement date 1 gram gold is at 15,000 rupees. So tell me what is Koti telling? Boss, you are the insurance company. You made me a promise that gold price will not exceed 12,500. See, it has reached 15,000. Yes. So what insurance company will tell? Don't worry. I made you a promise. It will not exceed. If it exceed, I will pay you. Take this 2,500. Is this clear? So how much Koti will be receiving? Yes, 2,500. This is the gross payoff. Gross payoff means the payoff, payment, cash that I will be receiving on the settlement date. Yes. But to receive this 2,500, premium also I have paid 200. So what is the net profit I have received? 2,300. It is the net payoff. Is this clear? What is gross payoff? Gross profit. It is the payoff or cash that I'm going to receive on the settlement date, on the date of expiry. I may be getting, I may not be getting. Yes or no? Yes, from that I will reduce the premium. I will arrive at the net payoff. Is this clear, everyone? Okay. Logically, we'll try doing. Then I'll give you guys a very simple shortcut. Now tell me, Koti wants to purchase gold. Yes or no? He was having a fear of increase in the prices. Yes, soap insurance company gave him a promise. It will not exceed 12,500. Tell me if the actual price on maturity is 15,000. Tell me how much should the insurance company pay him? Yes, insurance company promised him it will not exceed 12,500, but boss, it reached 15,000. So they have to pay him 2,500. Yes or no, everyone? Yes, this is one way of understanding this. Multiple ways are there. I will show you one more way. Now tell me on the settlement date. Yes, on the maturity date, Koti will go and purchase 1 gram gold from the spot market. How much he has to pay? 15,000. So he paid 15,000. He purchased 1 gram gold. He is coming back. Is he happy or sad? Sad. He is praying and coming back, coming back, coming back. Will he come back to whom? No. He will directly go to the insurance company. He will go to soap insurance company and tell, yes, you as the insurance company, you told me gold price will not exceed 12,500. See, it has reached 15,000. So what insurance company will do? Don't worry. Take this 2,500. So tell me for Koti, even though he paid 15,000 here, he recovered 2,500 here. So effectively his cost is how much? 12,500 only. Yes or no, everyone? So this is what is happening here. Okay. That way also I can tell, yes, how much I am receiving from the insurance company? 2,500. This is the gross payoff. Is this clear, everyone? Or one more way also I can be doing. Yes, I have the option to buy at 12,500. I have the option to buy at 12,500. The actual price is 15,000. Will I exercise the option? Yes, boss, I want to buy cheap. So I will exercise my option and buy at 12,500. That means tell me how much benefit I did. 2,500 is a benefit I did. So gross payoff is 2,000. Different ways I can tell you. Yes, but for now, this much is sufficient. Tell me gross payoff is 2,500. On settlement day, 2,500 I received. But to receive 2,500, 200 premium also I paid na boss. That means the net payoff, net profit is how much? 2,300 only. Is this clear, everyone? Oh. Now imagine the actual price on maturity is 12,700. Tell me, yes, insurance company had given him a promise that the price will not exceed 12,500. Now it has become 12,700. How much did it increase? 200. So insurance company will reimburse him 200. 200 he received. But tell me, students, initially premium how much he had paid? 200. So the net profit or loss is going to be how much? 0. Yes or no? Imagine the actual price on maturity is 12,500. Whether insurance company will pay him anything? No, it will not pay him anything. 0 he is receiving. But boss, 200 premium he had paid. So his loss is going to be 200. Yes or no? Imagine the actual price on maturity is 10,000 only. Tell me whether insurance company will pay him anything. No. Insurance company is telling, boss, I gave you a promise. Gold price will not exceed 12,500. It did not exceed. So they will not give him anything. 0. Yes. But boss, he has paid a premium of 200. That means he will be incurring a loss of 200 rupees. Is this clear, everyone? This is the logical understanding. Logically, I've understood. Always remember, students, my gross payoff, it will either be positive or 0. It will never be negative. Yes or no? Insurance company will either reimburse me or it will not reimburse me. It will not do negative. It will not ask, okay, you only pay me, not positive. Is this clear? Point number one. My net payoff, that is a net profit, it can either be positive, it can either be 0, it can be negative. Yes, tell me when it is going to be negative. I did not claim only, but I paid premium. It is going to be negative. Yes, when it is going to be 0. Yes, how much premium I paid? That much only I recovered. Yes, in that case, it is going to be 0. Yes, when it is going to be positive. Yes, I recovered more than the premium I paid. Yes or no, everyone? Logically, I have understood gross payoff as well as net payoff in case of call option. Is this clear, everyone? Now, the same thing, same thing, same thing. Yes, quickly in a very shortcut way also we can be doing. Shall we understand the shortcut, students? Trust me, in 2-3 seconds, you will get to know the gross payoff, yes, premium as well as net payoff. Shall we do it? Yes, this one logically we thought and everything we did. Quick shortcut I have for you. Are we ready? Yes, please. Tell me I am having a call option. So I will write it this way. Yes, 3-month call option. 3-month call option. Yes, what is the strike price? 12,500. I will put an upward arrow. So what is this upward arrow? We understood 3-month call option. It is a 3-month call that Koti has purchased. Strike price is 12,500. What is this up arrow? Tell me, Koti is purchasing gold. He is the buyer of the asset. Yes, sir. That means what is the fear he is having? He is having the fear that the gold price will increase. Yes or no, everyone? Perfect. Against this, he has taken an insurance. Yes, insurance company has told that, boss, don't worry. If the gold price increases above 12,500, I will pay you. Yes or no, everyone? So if it goes above 12,500, in that case, the insurance company will be paying him. Now see how simple this becomes. Pay attention, everyone. Pay attention. Yes, I will just write it this way. Yes, 3-month call, 12,500 up. So the simple meaning is, if my actual price goes above 12,500, I will exercise the option. Tell me, if the actual price is 15,000, did it cross 12,500? Yes, boss. Will I exercise? Yes, boss. How much I will be getting difference? 2,500. That is a gross PF. Yes, 12,700. Did it cross? Yes, boss. Will I exercise? Yes, boss. How much I will receive? 200. Here, 12,500. Did it cross 12,500? No. So will I receive anything? No. Yes, 10,000. Did it cross 12,500? No. So whether the insurance company will pay him anything? Is this clear? This way, quickly I can calculate my gross payoff as well. Is this clear, everyone? This is a technique which we will be using throughout. Okay, pay attention. One more example I'm giving. Yes, I am having a call option at 12,500. Okay, so I will write 12,500 up. Imagine the actual price is 10,000. Will I exercise the option? No. Gross payoff is 0. 11,000 means it is 0. Yes, 15,000 means it is going above 12,500. Yes, insurance company will pay him 2,500. Yes, imagine it is 13,000. Yes, what is the difference? 500 they'll pay me. 12,700. How much they'll pay me? 200 they'll pay me. Yes, 30,000. How much is the difference? 17,500 they'll be paying. Is this clear, everyone? This is the gross payoff minus the premium. We will arrive at the net payoff. Is this clear, everyone? Yes or no? Perfect. Yes. Now let us try seeing from the perspective of shares also. Yes, simple. Yes. Mr. X purchased one call option to buy share of Reliance at a strike price of 1,000 after 3 months. Okay, Mr. X is purchasing a call option. What is Mr. X doing? He is purchasing the call option. He is the option buyer, call option buyer. Okay, perfect. To buy shares of Reliance at a strike price of 1,000 rupees. Strike price is 1,000. Option premium paid is 50 rupees. Calculate profit or loss in the following situation. First, I will just write down. I am having a 3-month call option at 1,000 rupees. So I will just write 3-month call. 1,000. When will I exercise? If the price goes above this, yes or no, everyone? Tell me, if the actual price is 1,100, yes, in that case, what we will be doing, students? Tell me. Yes, I will go to the market and purchase it 1,100. Am I happy or sad? Sad. I will directly go to insurance company. They will reimburse me 100. So I'm receiving 100 from the insurance company. It crossed 1,000. Yes, means whatever difference is there, I will receive 100. Imagine it is 1,000. I will not be receiving anything. Imagine it is 900. Did it cross 1,000? No. Will I be receiving anything? No. This is the gross payoff minus premium. I will arrive at the net payoff. Is this clear, everyone? Yes or no? Yes. Any doubts still here, everyone? Give me a confirmation, online live students. Accordingly, we will proceed further. Yes, everyone, we are having some crazy Maja examples. Pay attention. I want you guys to tell, will we exercise the option or not? That is basically, will I get reimbursement from the insurance company or not? If so, how much I will get? Yes, it is a gross payoff. How much premium I have paid? What is the net payoff? Okay. Mr. X purchased a 3-month call option at a strike price of 1,000 rupees. Okay. Premium paid is 50. Calculate gross payoff and net payoff in the following cases. First, I will write down, I'm having a 3-month call option at 1,000. How will I write? 3-month call. Yes, 1,000. Call is the right to buy. When will I get? Yes, if the price exceeds this, I will be getting a reimbursement. Yes or no, everyone? Imagine actual price is 1,100. Will I exercise the option? Yes, boss. It has crossed 1,000. Yes, how much? 100 rupees I will get. If it is 1,000, no, I will not exercise. I will be getting 0. If it is 900, no, I will not exercise. I'll be getting 0. If it is 1,400, it has exceeded 1,000. How much extra? 400 I'll be receiving. If it is 1,200, it has exceeded. How much extra? 200 I'll be receiving. If it is 800, no, it did not exceed. I will not be getting anything. If it is 5,000, it exceeded 1,000. How much? 4,000 extra. Accordingly, I can do my gross payoff. From gross payoff, if I reduce the premium, I will arrive at the net payoff. Yes or no, everyone? Perfect. Is this clear? Okay, fine, boss. Now we also have in case of put option. option also logically first we will do it quickly. Then yes, I will give you guys the structure. Simple for the put structure is going to be very simple. Yes, I will write 3-month put, whatever is a duration put option. Yes, whatever is a strike price down. Tell me put option. It is the right to sell. Yes or no, everyone? Perfect. What is the fear seller is having? He is having a fear of fall in the prices. For this, he is getting the insurance. So if the prices fall, he will be getting the reimbursement. Simple, boss. This is the mean. Is this clear, everyone? Perfect. Yes, Tabish purchased a put option on 1 gram gold from the soap insurance company at a strike price of 12,500. Okay, firstly, I have purchased the option. I am having the option. Which option? Put option. What is put? It is the option to sell. So I can sell to the insurance company at 12,500. Yes or no, everyone? Premium paid is 200. Calculate gross payoff, net payoff in the following situations. If the actual price on maturity is 15,000, first logically also quickly I'll tell. Tell me, I am the seller. What is the fear I'm having? I'm having a fear of fall in the prices. Yes, so I purchase an insurance at 12,500. Insurance company will tell if your price goes below 12,500, we'll reimburse. Imagine the price is 15,000. Will they reimburse? No. Imagine the price is 12,700. Will they reimburse? No. Imagine the price is 12,500. Will they reimburse? No. Yes. Imagine the price is 10,000. Will they reimburse? Yes. How much difference is 2,500? They'll be reimbursing. Yes or no? This is something logically we've got. Minus the premium, we will arrive at the net payoff. Yes or no, everyone? Or else this way also we can be doing simple. Tell me, students, I can write 3-month put option. 12,500 less. Yes, put option means the right to sell. I am having a fear of fall in the price. So if it falls below 12,500, they will go to insurance company. They will reimburse. Okay, boss. If it is 15,000, it did not fall. I will not get it. If it is 12,700, it did not fall below 12,500. I don't get. If it is 12,500, still I will not get anything. But boss, if the price is 10,000, it fell below 12,500. So I will receive how much? Difference of 2,500. Is this clear, everyone? Perfect. Now, one more example I will show it to you guys. Okay, here. Yes, Tabish has purchased a 3-month put option, the right to sell. Yes, at a strike price of 1,000 rupees on the shares of Reliance Limited. Premium paid is 50 rupees. Calculate gross payoff and net payoff in the following cases. How will I write? Simple. I will write 3-month put option. 1,000. So if it goes below 1,000, we will be exercising. Imagine the price is 1,100. We will not exercise. It is 0. 1,000 means we will not exercise because it is 0. Yes, 900 means it fell below 1,000. Yes, 100 I am receiving. Yes, if it is 1,400 means nothing I am receiving. 1,200, nothing I am receiving. 800 means it fell below 1,000. 200 I am receiving. So accordingly, I will arrive at gross payoff minus premium. I will arrive at my net payoff. Is this clear, everyone? Give me a confirmation, everyone. Oh. Now look at this, students. Yes, beautiful. This is one of the biggest things. This is one of the areas where students commit lots of mistakes. Logically, I've explained, and we will be following a very simple thing. First thing, I will always calculate profit or loss for the option holder, option buyer. Because understand, students, option seller, soap insurance company, they do not have any right. The right is with the option buyer. If I buy, yes, if I exercise, they'll have to be paying. As simple as that. Yes or no, everyone? So always profit or loss will be calculating from the perspective of option buyer, call option buyer or put option buyer. Tell me, in case of call option, how do we do this? One example we have created. Assume you purchase a 3-month call option of Maja Limited at a strike price of 1,000. How do I present it? I will write 3-month call. Call the right to buy. What is the fear I'm having? Fear of increase in the prices. For that, I'm getting a protection. 1,000. What does it mean? It means that if my price actually goes above 1,000, insurance company will pay me the balance. Yes, if it is more than 1,000, I will exercise the option. Insurance company will be paying me the balance, gross payoff. Yes or no? If it is 1,000, yes, I don't have any. Yes, any. I'm indifferent. Did it cross 1,000? No. Will they give me anything? No. Gross payoff is 0. If it is less than 1,000, what did insurance company tell? It tells if your price crosses 1,000, we will reimburse. Here it did not cross. They will not pay anything. As simple as that. Yes or no, everyone? Perfect. In case of put option, I am the seller. What is the fear I'm having? I'm having a fear of fall in the price. So insurance company is telling if your price falls below strike price, we will pay you 3-month put option 1,000 down. So if my actual price is less than 1,000, it will be exercised. So if actual price is more than 1,000, I'm anyways getting more than that. Be happy. Yes, your option gets left. Insurance company won't pay you anything. If actual price is 1,000, yes, we are indifferent. If the actual price is less than 1,000, oh, tell me, yes, actual price is 900. So from the party I'm receiving 900 only. Am I happy or sad? Sad. I will go to insurance company. That promise at least 1,000 you will receive. Balance 100 they will be paying. So in this case it will be exercised. gross payoff is going to be positive. Is this clear, everyone? Oh. Now, oh, my iPad is out of charge. Just a minute, we'll connect it for charge, my dear students. Yes, everyone. Now, gross payoff cannot be negative for an option holder. Yes, you have purchased the option, you have purchased the insurance. You will either receive money or you will not receive money. Yes or no? Gross payoff can either be positive or zero. It cannot be negative. Is this clear? It will either be positive or zero. Okay. Calculation of net payoff. Net payoff calculation, be it for yes, call option or put option. It is very simple. It is gross payoff minus premium. Is this clear, everyone? Yes, we will follow the same format for call also, put also. It is gross payoff minus premium. Net payoff can be positive also, zero also, negative also. Okay. Gross payoff is also called as payoff. If question tells payoff, it means gross payoff. Is this clear, everyone? Okay. Now comes the second thing, profit or loss. That is payoff for the option writer. Yes, in our example, it is a soap insurance company. Tell me, students, we know that derivative is a zero sum game. Yes. Say for example, yes, I entered into an option contract with the soap insurance company. I made a profit of 100. What does it mean? It means soap insurance company incurred a loss of 100. I incurred a loss of 100. What does it mean? It means that soap insurance company has made a profit of 100. Is this clear, everyone? Yes. Option writer doesn't have a separate existence. Yes. How much money option writer will make? It depends on option holder, option buyer. If option holder exercises, means he'll have to be paying. Otherwise, it will not be paying. So they're having the obligation. So what we will do is, yes, we will never ever calculate profit for option writer directly. Instead, what we will do? We will always calculate profit or loss for option holder. Yes, if option holder is having profit of 100, it means option writer is having a loss of 100. If option holder is having a loss of 100, that means option writer is having a profit of 100. That is how we will be doing. Is this clear, everyone? Okay, simple. Yes, the profit or loss for option seller is not independent. It is a dependent. It is opposite of option holder's profit or loss. So if in case we are having a question wherein we'll have to calculate profit or loss for option seller, simple. First step, we will calculate profit or loss for the option holder, option buyer. Once I've calculated that, now it is very simple. If option holder is having a profit, that means the same amount will be loss for option seller. Option holder is having a loss, same amount will be profit for the option seller. Is this clear, everyone? Till here, any doubts? No doubts. Now we have the final point, which is going to be break even price. Yes, simple. Yes, where do we go here? Here, I guess we have explained this. No, or we'll have to explain it through the workbook, I guess. Okay. Now we are having a call option. Look at this, students. Yes, concept one. Yes, profit or loss in case of options. Yes, first example. Babu Bhaiya purchased a 3-month call option on ABC Limited at a strike price of 420 and paid a premium of 30 rupees per share. Current price of the share is 400. Current price is anyways irrelevant because exercise is happening at the end of 3 months. Is this clear? You are required to calculate payoff and net payoff in the following situation. If share price after 3 months is 480, share price after 3 months is 300. Is this clear, everyone? Now, how do we write it? Okay, simple. Tell me, Babu Bhaiya has purchased option. So he is option buyer. Which option he has purchased? All options. So he wants to buy the asset. He was having the fear of increase in the price at a strike price of 420. Yes or no, everyone? So he has purchased a 3-month call option. Here I have written 3-month call option 420 up. So he was having the fear that yes, price will go above 420. Yes, soap insurance company told, don't worry, if it crosses, I will pay you. Great. Imagine the actual price reaches 480. Yes, what will Babu Bhai tell? Yes, Babu Bhai, I will go to soap insurance company. You told na, price will not exceed 420. See, it reached 480. So insurance company will have to pay him 60 rupees. Yes or no? So he received 60 rupees. He had paid a premium of 30. That means the net payoff is going to be 30. Is this clear? Imagine the actual share price is 300 only. Did it cross 420? No. Whether the insurance company will pay him? No. So gross payoff is 0. Premium paid is 30. So the net payoff is going to be minus 30. Is this clear, everyone? Simple. We will write 3-month call 420 up. Yes, if actual price is more than 420 means it will be exercise. Yes, how much is the difference? 60. 60 is the gross payoff. Yes, here actual price is 300. It did not exceed 420. That means it will not be exercise. So gross payoff is going to be 0. Is this clear, everyone? Okay, fine. Now comes the third situation, that is also calculate the price above which the call option can be gainfully exercised. This is asking us to calculate break-even point. Now tell me, students. Yes, through this only, or we are having any other means wherein we explained break-even point. Okay, here we are having the example through which we are explaining break-even point. Look at this. What is break-even point? Simple. No profit, no loss. Yes or no? Tell me, call option, when will we exercise? When the actual price goes above the strike price. Simple. Imagine there is a 3-month call option. Gold. 12,500 Koti had purchased. Okay. Actual price of gold is 12,000. Whether Koti will exercise the option, will he get anything from insurance company? No. Imagine it is 13,000. Yes, boss, he will be receiving. How much he will be receiving? 500 he will receive from the insurance company. How much premium he had paid? Imagine premium paid is 200. That means how much is the profit? 300 is a profit. What is break even? Yes, break even means no profit, no loss. Ultimately, profit or loss is zero. Tell me how much premium I have paid. 200 premium I have paid. That means to compensate for that, how much I should be receiving from the insurance company. Simple. Quote is telling, I paid 200 premium. If I somehow recover that 200, nah, I am neither in a profit nor in a loss. Perfect. Okay. Tell me, Koti has purchased a call option. When is call option exercise? If the price goes above 12,500, how much he wants to recover? 200. So how much above 12,500 it should go? 200 above 12,500. So if the actual price is 12,700, now he will be at break. Let us try saying, imagine the actual price is 12,700. Okay. Yes. Whether sorry, Koti will go to the insurance company. Yes. He's telling, boss, you told price will not exceed 12,500. See, it is 12,700. So they will pay him 200. So he received 200. Tell me upfront he had paid premium also of 200. So is he ultimately making a profit? No. Incurring a loss. Is this clear? So what is the break even price? It is going to be 12,700. How did I arrive at that? It is the strike price 12,500 plus the premium, which is 200. Yes or no, everyone? So in case of call option, the break even point, it is the strike price plus the premium. Yes or no? Logic also I will tell it to you guys. This way logic I have told you. One more logic also I will be telling it to you guys. Yes. In case of put option, tell me, yes, Maja Gold and Diamonds, I wanted to sell gold. I had a fear gold price will fall. So I purchased the put option at 12,500 per gram. Yes or no? I want to calculate my break even point. Tell me, when will I exercise the option? If the actual price goes below 12,500, I will be exercising. Yes or no, everyone? Yes, boss. Tell me how much premium I paid. 200. So I have to recover 200 if the price goes below 12,500 by 200. That is if the price is 12,300. Yes or no, everyone? Yes. Let us try seeing. Imagine the actual price is 12,300. Yes, I am happy or sad? Sad. So I will go to the insurance company. I will tell him, boss, you promised me at least 12,500 I will receive. See, the gold price is 12,300 only. So what insurance company will do? They will pay me 200 rupees. Yes or no? So I received 200 rupees from the insurance company. Tell me how much premium I paid them? 200. So ultimately profit or loss? It is going to be zero. Is this clear, everyone? Tell me, how do I arrive at that in case of put option? Yes, it is going to be the strike price minus the premium. Strike is 12,500 minus 200. I will arrive at 12,300. Is this clear, everyone? Now, there is one more logic for this formula. Through this, we have understood. Yes, in case of call, it is a strike plus premium. In case of put, it is strike minus premium. One more. Yes, call means I am buying. Yes or no? Now, premium is always the cost because I'm getting the option. I have to pay it to the insurance company. Yes, call option. It is the right to buy. I am the buyer of the asset. When I am buying the asset, strike price, I will pay. Koti is buying gold. Strike price 12,500. He will pay. Premium also he will pay. So 12,500 also he is paying. Premium of 200 also he is paying. So total how much is the, yes, minimum break even price? 12,700. Yes or no, everyone? Now put option. It is the right to sell. Yes, Maja Gold and Diamonds. Me. I am selling gold. When I sell gold, money I am receiving. Strike price I am receiving. At least 12,500 I am receiving. Yes or no, everyone? But tell me, I am having the option. Get the option. I had to pay 200. Yes, minus I am paying 200. That means effectively how much only I am receiving? It's 12,500 minus 200. It is going to be 12,300. This way also we can be doing yes or no, everyone. In case of call option, it is the strike price plus the premium. In case of put option, it is strike price minus the premium. Is this clear, everyone? Now, yes, if the option holder can gainfully exercise call option at any price above the, yes, BP price. Tell me, call is exercise if price exceeds, yes, if it reaches BP price, till then we will have no profit, no loss. If it goes beyond that, yes, we'll be having a profit from the option. Simple. Look at this. Yes, Koti has purchased the call option at 12,500. If the actual price is less than 12,500, he will not exercise. If the actual price is 12,500 or more, he will exercise option. Imagine it is 12,600. He will exercise. How much money he will receive? 100 he will receive. How much premium he had paid? 200 he had paid. So overall, is it profit or loss? It is loss. Imagine the actual price is 12,700. 200 he received. 200 he paid. So it is BP. Imagine the actual price is 13,000. Now tell me how much money Koti will be receiving. 500 he will receive. How much only premium he paid? 200 only he paid. That means his net profit is going to be how much? 300. So if the price goes above 12,700, overall we will be having the profit from the option. Is this clear, everyone? In case of put, it is going to be reverse. Yes, here we are having 12,300. Yes, put is exercise if price falls below 12,500. Yes, at 12,400 we'll exercise, but only 100 will get. 200 premium I paid. 12,300 also I'll exercise. 200 I'll get, 200 I've paid. Imagine at 12,000 rupees. Yes, how much price has fallen? 500. So 500 I will receive. How much premium I've paid? 200 only. So net profit is 300. Yes or no, everyone? So if the price falls below 12,300, I will be making profit on an overall basis. Is this clear, everyone? Okay. So with this concept is completely over. Quickly pay attention, mind map in your mind, you guys. First is profit or loss for the option holder. How do we do it? First is calculation of gross payoff. Yes, in case of call option, we will write, okay, 3-month call. Imagine 12,500 is the strike price. If the actual price goes above 12,500, we will exercise. Gross PF is positive. At 12,500, it is 0. If it is less than 12,500, also it is going to be 0. Is this clear, everyone? In case of put option will be exercised if price falls. Yes or no? Seller is having a fear of fall in the price. Okay. So if the actual price falls below 1,000, in that case, it will be exercised. In that case, gross payoff will be positive. In other case, it is going to be 0. Okay. Now comes calculation of net payoff. It is gross payoff minus the premium paid. Okay. So for the option buyer, we have understood. Option seller is very simple. How do we calculate for option seller? Simple. Calculate for option buyer. Take reverse of that. That is going to be for option seller. Then comes yes, calculation of break even point. Simple. Call option. Call option I am buying. So strike price I am paying. Premium also I am paying. So it is strike price plus premium. Put option I am selling. So strike price I am receiving. But boss, I have purchased option. So premium I am paying. So it is strike minus the premium. It is going to be the break even. Is this clear, everyone? Till here things are clear. So quickly from workbook, shall we try quickly solving some good example questions? Okay, all these things are not very important from exam perspective. Now from the exam perspective, payoff for call, all these things are okay, fine. Now mixed situations, this is a put option. Okay, this is also fine. Some crazy examples we are having. This is also fine. Okay, these are the kind of questions which multiple times institute has tested in the examination. 4 marks, 6 marks, 7 marks. Yes, item took the following spread on shares of Maja Limited. What all he did? He purchased a 3-month call option at an exercise price of 550 at a premium of 30. He also purchased a 3-month put option at an exercise price of 450 at a premium of 5. Okay, fine. Maja Limited share is currently trading at 500. It is irrelevant. Tell me, calculate profit or loss if share price becomes 600, share price becomes 300, if share price becomes 500. These way questions are coming. Students feel it to be one of the most difficult thing. Trust me, it is the simplest thing. Tell me what all options are there. Call option is also there. Put option is also there. Firstly, did I purchase call option? Yes. Did I purchase put option? Yes. So in both the places, I am the option buyer, option holder. Okay. Tell me, call option, what is the presentation? I will write 3-month call option 550. So when will I exercise call option 550? So if it exceeds 550, I will exercise. Yes, put option. When will I exercise? It is exercise price of 450. If it falls below 450, 450 down, I will exercise. Yes or no, everyone? So I will write it this way. Calculation of profit or loss is in case of call option. It is exercise if the price goes above 550. Put if the price falls below 450. Okay. Imagine the actual price is 600 per share. Tell me whether the call is exercise. When is call exercise? When the price goes above 550. Did it go? Yes, boss. How much? Yes, 600 it went. So the difference is 50. Gross payoff is 50. Minus premium, I will arrive at the net payoff. Tell me when is put exercise? If the price falls below 450. Did it fall below 450? No. Will I get any reimbursement from insurance company? 0. But boss, I already paid a premium of 5. So my loss is going to be 5. So overall gross payoff, overall money I received from insurance company is 50. Overall premium paid is 30 plus 5, 35. Overall net profit is going to be 15. Is this clear, everyone? Okay. Second situation, if the actual price is 300, tell me I am having a call option at 550. If it goes above 550, I will exercise. But boss, the price is 300. Will I exercise? No. Gross payoff is 0 minus premium net payoff. Tell me put option I'm having at a price of 450. So if it falls below 450, I will exercise. How much is the price? 300. So I will exercise and receive how much? 150. Premium is 5. So net is 145. I will add and arrive at the total payoff. Yes or no, everyone? Okay. Third situation, if the share price is going to be 500, tell me call option will be exercised. If it goes above 550, here it is 500, so it will not be exercised. Gross payoff is 0 minus premium net payoff. Yes, put option is exercised. If the price falls below 450, tell me the price is 500. So will I exercise? No, boss. This is 0 minus, yes, premium paid net payoff. Add all of this, we will arrive at the total situation. Is this clear, everyone? Similarly, for, yes, purchase call option, purchase put option, one more example is there. Combination of call and put. This was also combination of call and put. Okay, yes, one more situation is there. Here different, yes, cases we have done. And then, yes, profit or loss for option writer, option seller. Yes, on a simple, first we'll calculate profit or loss for option buyer, then we'll do reverse of that. Okay, now one more crazy example I'm having. This is a beautiful example. Pay attention, this kind of question has not come, but you never know if it comes. Trust me, 99.9% students will be committing mistakes here. Okay, yes. Koti took the following spread on the shares of Maja Limited. Very important. Okay. He has purchased 3-month call option. What he did, he purchased. So he is the option buyer. Which option he purchased? Call option. At a strike price of 550 at a premium of 30. So tell me he is having a 3-month call at 550. If it goes above this, we will be getting a payoff. Next, he sold a 3-month put option. Oh, what is there? Put option is there, right to sell. What Koti did? Did he buy the put option? No, he sold. Basically, he became the insurance company. He told, yes, the work that soap insurance company was doing, I will do. If in case adverse situation happens, I will pay them. Yes, he did. He told that and he received the premium. Is this clear, everyone? This is the meaning here. Okay, he sold 3-month put option at a strike price of 450. So there is another party who would have purchased the put option. Yes, 450. When will they exercise? 3-month put is there. If the price falls below 450, they will be exercising. Yes or no, everyone? Okay. Imagine the price becomes 600, 300, 500. Now, step 1, we will calculate the payoff for the, yes, call holder. Yes, in case of call option, we will try exercise. Tell me, students, first we will always do calculation from the option holder's perspective. Then we will see our actual position. Tell me, in case of call option, what we did? We purchased. So simple life only here, no tension. Tell me exercise price is how much? 550. So I will write 3-month call 550 upwards. Tell me actual price can be 600, 300, 500. 600, 300, 500. Yes, if it is crossing 550, here it is crossing, we will exercise 50 will get. In these two situations, nothing will get. Minus premium, we will arrive at the net payoff. Is this clear? Okay. Step number 2, we will calculate for the put option holder. There is a party who has purchased put option. Imagine, yes, Koti is there. Koti has sold put option. Someone else would have purchased. Now imagine you have purchased put option. Yes, you were selling. You had a fear of fall in the prices. You have purchased put option. So how much you will be getting? Tell me, you have purchased the put option at 450. So you'll write 3-month put option 450. If it falls below, you will exercise. 600 means above, you will not exercise. Yes, 300 means it fell below. How much you will be getting? 150 you will be getting. 500 means it did not fall below 450. You will not be getting anything. Yes, gross payoff minus premium, you will arrive at the net payoff. Yes or no? Let us try understanding the interpretation. Now, first case, if the actual price is 600, yes, a person who has purchased call option will be making a profit of 20. Yes, if the actual price is 600, person who has purchased a put option will be incurring a loss of 5. This is clear. Tell me, what did Koti do? Koti purchased call option, so he will make a profit of 20. Yes, Koti has sold put option. Person who is buying put option, he will make a loss of 5. But Koti sold put option, so if he is making loss of 5, means Koti will be making a profit of 5. So 20 plus 5, he will make a profit of 25. Is this clear? In simple terms, this, yes, it is for call option holder, call option buyer. Yes, you are also call buyer only. Yes, simply it will be as it is. This is for option buyer. We are seller, so we just have to reverse this. It's minus 5 becomes 5. This becomes minus 145. This becomes 5. Yes or no? Accordingly, we add the two, we will arrive at the total profit. Is this clear, everyone? Crazy example. If it comes, 99% students will not be in a position to do it. But I want you guys to be doing it. Is this clear, everyone? Give me a confirmation, students. Yes, with this, our concept number 1 is done. Done. Now we'll have concept 2 as well as concept 3. Very small unit. It is going to be options. Yes, everyone. Now let us go ahead to concept number 2, which is going to be expected value of option at maturity and value of option. This is the next big concept. If this is done, option is more majorly done. Is this clear, everyone? Okay. Let us try understanding this beautifully, my dear students, through a story. Now imagine you are purchasing share of Reliance. Okay. You are purchasing share today and you are expecting that at the end of first year, you will get a dividend of 5 and the sale price will be 104. That means tell me total how much you will be getting at the end of first year. 110. Imagine you want a required rate of 10%. That means today how much you are willing to pay. Yes, 110 you will receive at first year. Bring it to present value. Divide by 1.1. You are willing to invest 100. Is this clear, everyone? Okay. So can I tell value of an asset? Yes. Or the price payable for an asset. It is the present value of future cash flows. Yes or no, everyone? Simple, boss. We know it. Okay. Now, example number 2. Imagine you purchase a lottery ticket. After 1 year, winner will be announced. Okay. You are thinking that there is a 10% chance that you will win the first winner. You will get 1 lakh. There is a 20% chance that you can be in the top 100, wherein you will get 10,000 rupees. Yes. There is a 70% chance that you will not get anything. That means your reward is going to be 0. So tell me, can you calculate what is the expected reward you are going to receive at the end of first year? Tell me, if you purchase a lottery ticket today, when will you receive the reward at the end of first year? What all it can be? Yes, 1 lakh also you can receive, but boss, there is a 10% chance only. Yes, 10,000 also you can receive, but boss, there is a 20% chance only. 0 also you can receive, there is a 70% chance. So tell me, what is the expected cash flow you are going to receive at maturity? Yes, 10,000. Yes, 2,000. Is it going to be 12,000? Yes or no, everyone? Tell me, when will you be receiving this? This is the expected cash flow you will receive at the end of first year. Yes or no, everyone? Perfect. Now tell me, imagine you're a person, you're an investor, you're telling, boss, a lottery ticket is there, I can purchase a lottery ticket today. At the end of first year, there is a 10% chance I can win first winner also, 20% chance I can be in the top 100 also, 70% chance I don't get also. That is, after 1 year, I'm expecting that 12,000 I will receive. Yes. Imagine as an investor, you want 10% return. So how much you are willing to invest today? You will tell, boss, first year if you are getting 12,000 means divided by 1.1, you are willing to invest how much? 10,909 you are willing to invest today. Yes or no, everyone? Okay. Imagine. Yes, that lottery ticket is actually trading at 5,000 rupees. Will you be interested to purchase or not? Tell me, students, how much you are willing to pay for the lottery ticket? 10,909. Even if you pay 10,909 today, at the end of first year, you want 10% return, it will become 12,000. You are having an expected outcome of 12,000. So, but it is available at 5,000 only. Is it undervalued? Yes. Will you be buying the lottery ticket? Yes. Same is the story which is happening here. First, let us have a look at the lessons. Yes. Lesson number 1, value of asset. It is a present value of future cash flows. Yes. Okay. Yes. In this case, it is the present value of future expected value. Future values, many values are there. Probability is there. Do a weighted average. You will get the expected value. Bring it to present value. It is going to be value of this. Second, if multiple probable values are there on the outcome, is on maturity, we will take the average. That is going to be expected value. Okay. Yes. Now comes the final story. Through this, everything will understand. We will understand expected value of option at maturity, value of option today. We'll get a proper intro to the binomial model, everything just through this simple story. Okay. Imagine the story of soap insurance company. Okay. Today, spot 1 gram gold is available at 12,000. Okay. Koti is buying a 1 year call option to buy at a strike price of 12,500. Is this clear? Okay. What all can happen to the gold price at the end of first year? Imagine two things can happen. Either gold price can reach 14,000. How much is the chance? 60% chance. Or gold price may come to 11,000. How much is the chance? 40% chance. Yes, sir. Calculate the following. Calculate the expected cash flow on maturity, which is the expected value of option at maturity. This is the first thing. How much money I will receive from option on maturity, we have to calculate. It is the first requirement. Tell me, students, let us try drawing a binomial tree. Yes, binomial tree. Yes, advanced capital budgeting we've learned. Yes or no, how to draw a tree. Again, here I am showing. Tell me students, first we will write today. Yes, first I will write down the spot price. Tell me students, today what is the spot price of gold? 12,000. After 1 year, what may happen to the price of gold? Gold price may reach 14,000 also, 11,000 also. If the gold price increases, goes up, the gold, yes, gold price becomes 14,000. I will write it as SU. Spot price if the asset goes up. If the gold price falls down, it will come to 11,000. I will write it as SD. Spot price if the asset falls down. Look at this, everyone. I will write it SU 14,000, SD 11,000. Is this clear? The end of 1 year, my option is going to mature. Yes or no, everyone? Yes, I have taken a 1 year call option. Tell me, I have taken a 1 year call option at 12,500. Yes, for gold. Tell me, imagine the actual price of gold is 14,000. Will I exercise my option? Yes, boss. How much payoff? How much money I'll be receiving from the insurance company? Boss, they promised me that gold price will not exceed 12,500. It is 14,000. They will have to give me 1,500. Yes or no? Everyone perfect. I will write it as CU. Call value if the share price is going up. Share price is going up. In that case, what is the price of the asset? Spot price as well as what is the value of the option. Call option means CU. Put option means PU. Is this clear? Tell me if the share price is 11,000. Yes, I want to buy gold. Did the price cross 12,500? No. Whether insurance company will pay me anything? No. CD is going to be zero. Yes or no? Everyone, tell me what all chances can be there. Okay, boss. Today, Koti purchased the call option. After 1 year, yes, from the insurance company, he may be receiving 1,500 also. He may be receiving zero also. What is the chance of receiving 1,500? 60%. What is the chance of receiving zero? 40%. So can you tell what is the expected value? Simple was, it is 1,500 into 60% plus 0 into 40%. It is going to be how much? 900. Yes, it is going to be the expected value of option at maturity. On maturity, how much money I will be receiving from option? 1,500 also I can receive, 0 also I can receive. For 1,500, the chance is 60%. For 0, the probability is 40%. Is this clear? I can do it in the form of a table, accordingly arrive at 900 rupees. Is this clear? Okay. If this is clear, can I calculate the value of option today? Yes, boss. Tell me, if I purchase the option, Koti is telling, boss, if I purchase the call option today, at the end of first year, I can receive 1,500, 60% chance. 0, 40% chance. That means expectation is 900 I will be receiving. Yes, but boss, premium I should be paying today. Imagine Koti wants a return of a 10 percentage. So you will tell, if I purchase the option today, at the end of first year, I am receiving 900. So how much I should be investing today? Bring it to present value divided by 1 plus interest rate. It is 1.1. 900 divided by 1.1. It is 818.18. So the value of option, it is the present value of future expected payoff. It is going to be 818.18. Is this clear, everyone? Perfect. Now imagine, yes, actually you go and see. Yes, option is available at 600 rupees. You will tell, boss, I am willing to pay 818 also. It is available at 600. It is undervalued. So you will buy the option. If it is overvalued, you will not be buying the option. Is this clear, everyone? Perfect. So with one example, we've understood entire linkage. We understood value of option at maturity. We understood the value of option, price of the option today. How much I should be paying today. With a good introduction to binomial model is also done. Is this clear, everyone? Now look at this, students. Expected value of option at maturity. What is it? On maturity, multiple prices can come. Each of the price, either I will exercise or I will not exercise. If I exercise, I will be having a payoff. Yes, probability will be given. Yes, the weighted average is the value of option at maturity. It is the weighted average of options payoff at maturity, considering the expected prices as well as the probability. What are the steps we should be doing? Yes, step number 1, we'll calculate payoff for each of the price. Step number 2, we'll calculate the value of option at maturity. It is a payoff into the probability weighted average. Yes, this format we will be using. Expected price at maturity, what is the probability? Will we exercise or not? In that case, what is the gross payoff? Yes, payoff into probability will arrive at the weighted average. Is this clear, everyone? Quickly, shall we do one master example question? Yes, sir, let us quickly do it. Okay, look at this. Example number 9. Item has purchased a 3-month call option on equity shares of Maja Limited for a premium of 1 and exercise price of 200. Okay. The current market price of the share is 175. Okay. The expected price of the share at the end of 3 months and the probability, it can either be 170, 190, 210, 230, 250. Tell me, today the share price is at 175. Yes or no, everyone? 175. At the end of 3 months, It can reach 170 also, 190 also, 210 also, 230 also, 250 also. Yes, with the respective probability it is given. Is this clear, everyone? I am having a call option at a strike price of 200. So tell me, I'm having a call option 200. So if it goes above 200, we will exercise. If it is 170, I will lapse, P of is 0. 190, I will lapse, P of is 0. 210, I will exercise. 10, I will receive 230. 30, I will receive 250. 50, I will receive. So simple. Tell me what is the value of option at maturity. Yes, it is 0 into 10%, 0 into 25%, 10 into 30%, 30 into 25%, 50 into 10%. Is this clear, everyone? Simple. So let us try seeing all the requirements. Now, if a question like this comes, yes, Chumma, it is a small question only, but institute will unnecessarily drag it and make it into a 6-mark question. What all they will ask? See, first, you are required to calculate the following. First, expected share price at the end of 3 months. At the end of 3 months, how much could be the share price? Tell me, they're telling share price can be 170, 190, 210, 230, 250. Probability is given. Can I do weighted average? Yes, boss. Price, probability, weighted average. I will get. First requirement is over. Second, what is the value of the call option at the end of 3 months? They're asking how much will be the value of option at the end of 3 months if the share is trading at the expected share price. If the share is trading at its expected share price, tell me, students, what is the expected share price? 210. So, the end of 3 months, they're telling, boss, at the end of 3 months, the share is trading at 210. Tell me how much money I will get from the option. I am having an option, yes, to purchase at 200 rupees. So, I will write 3-month call option is there, 200 up. So if it crosses 200, I will receive. Boss, the share is at 200, so it is crossing 200. How much it is? 10 rupees is going to be the payoff. Yes or no? That is going to be value of the option. Third is calculate the value of call option at maturity. If the exercise price prevails, this is one requirement. Trust me, free market is. They are telling, tell the value of option at maturity. At maturity date, 3 months later, how much is going to be the value, money I'm going to get from the option? If the exercise price prevails, that is on maturity date, what is the price prevailing in the market? Exercise price. Tell me what is exercise price? 200. Simple. I am telling at the end of 3 months, I go to market and see, oh boss, what is the price? The price is 200 rupees. Tell me, I'm having a call option which will be exercised. If my price crosses 200, did it cross 200? No, it is at 200. So will I get anything? No, I will get 0. Yes or no? So in this case, the value of option is 0. Fourth one, in case the option is held to maturity. Okay, boss, we are holding the share till maturity. What will be the expected value of the option? Expected value of option if the share is held till maturity. Same thing only in the form of table I will do. I will write down the share price. Yes, I will write down the probability. I will write down if it is exercised or not. I will write down the payoff. Payoff into probability I will be doing. I will arrive at the expected payoff. Look at the students. Here we have done. Yes, price, probability, exercise or not, gross payoff, payoff into probability. I will arrive at the, yes, expected value of asset on maturity. Is this clear, everyone? Perfect. Simple. Yes, done, done. With this concept number 2, value of option at maturity is over. Now we will be discussing concept number 3. It is value of option at the beginning of the contract. That is, yes, on maturity, this much I am receiving. So at the beginning of the contract, how much I am willing to invest. Simple, boss. You purchase the share. You want to hold it for 1 year. At the end of 1 year, you will receive dividend also, sale price also. But to receive that, you should be putting some money today. How much you have to be putting today? Present value of that. Yes, you purchase the call option at the end of 1 year. Yes, you will be receiving payoff in case of negative outcomes. Yes or no, everyone? Okay. Yes. Present value of that is going to be value of option. Yes or no, everyone? Value of option at the beginning. Yes, it is telling how much premium I should be paying to get the option. Yes, it is nothing but present value of expected payoff. Is this clear, everyone? Yes. Now, two different models are there to calculate. First is binomial model. Next is Black-Scholes model. For exam purpose, Black-Scholes model is the least important. Trust me, last 15, 18 years, not even a single question has come. Only two questions are there in the study material. So in the revision, we will not be covering this. But trust me, this is also very simple. Trust me, Black-Scholes is also very simple Halwa model. Yes, you might feel, okay, big lengthy formulas are there. Trust me, using a simple story will finish it off. But not needed for examination. For exam, what is important is binomial model. So we'll now take a minute of break. Then we'll discuss binomial model in a beautiful way. Very simple Halwa concept, my dear students. Yes, everyone. So now let us begin with one of the most important concepts in option valuation, which is going to be binomial model. Now, again, students feel it to be difficult. Trust me, it is the simplest thing. And an introduction to this is already laid down in the previous concept. Tell me, students, what is value of an option? Yes, it is the present value of future expected payoff. In future, yes, whatever is the payoff that we are expecting, bring it to present value. We will arrive at the value of the option, how much we should be paid. Yes, there are two assumptions of binomial model. Binomial is telling at one point the share price will either go up or down. Only two outcomes are possible. Is assumption number one. Assumption number two is that investors are risk neutral. That is the only return that they are expecting, they are happy with. It is a risk-free rate. So throughout, whenever we are discounting anything in yes binomial model, we will be using the risk-free rate. Is this clear, everyone? Assumption. Now, there are different methods to calculate value of option in case of binomial model. We have a risk neutral approach. We have delta hedging, also called as riskless hedge portfolio. We also have the replicating portfolio approach. But should I tell you something, students? You follow any of the method. Ultimately, you will be getting the same value of option. So for simplicity, here we will discuss only one. In the regular batch, yes, we have discussed multiple options also, but trust me, ultimately you follow any option, you will be getting the same value. So we'll keep it very simple, unnecessarily will not complicate things. Is this clear, everyone? So the value of option as per all the approach is going to be same only. Okay. Now, before we do understand binomial model, first we need to understand the concept of calculation of probability. How do we calculate probabilities in case of a binomial model? Okay. Binomial model is very simple. We have done it already. Yes or no? Probability, how do we calculate? For that, multiple formulas are there. Look at this. All these formulas are there. If you want, you guys can by heart. But we will not be going for anything. Now, in regular batch, in a very detailed way, we will discuss. Here, quickly, we will be discussing. Simple point. Investors are just expecting risk-free return. Simple. Spot price of a share. Imagine there is a share of Reliance. Today, it is trading at 100 rupees. Okay. Yes, we are telling by end of first year, what may happen? Either the share price may go up and reach 120, or it may fall and become 80. Is this clear, everyone? Yes, risk-free rate is 10%. Calculate probabilities. First thing we will be doing is we will draw a binomial tree. Tell me, students, what is the spot price today? 100. So I will write S naught spot today at 0 is equal to 100. In 1 year, what may happen? Either the price will go up. SU spot price, if it goes up, it can become 120, or if it falls down, it may become 80. Yes or no, everyone? What is the probability? I don't know the probability. I want to calculate the probability. Yes or no, everyone? Perfect. Multiple formulas are there. We'll keep it very simple. Okay. Now, simple. Investor is just expecting 10% return. Okay, great. Now, I don't know the probability. Let me do one thing. Let me assume that the probability of share going up is P. That means probability of share going down, it is 1 minus P, because the summation of the probability is going to be equal to 1. Now tell me, at the end of first year, how much is the expected price of share? Is it 120? No. Is it 80? No. It is an expectation. So can I tell it is 120 into P? Or let me use pen only. Yes, at the end of first year, how much will be the price of the share? It is 120. Yes, how much is the chance? Into P. Plus it can be 80 also, or it can be 80 also into 1 minus P. This is the value of share at the end of first year. If I want to know the value of share today, bring it to present value. Yes or no, everyone? Divided by, discount it. Yes, which rate I will be using? Risk-free rate I will be using, which is 10% divided by 1.1. I will arrive at the value of the asset today. Tell me, what is the value of the asset today? It is going to be 100. Yes or no, everyone? Perfect. It should be equal to 100. If I use this equation, can I simplify and arrive at the value of P? Yes, 100 into 1.1, 110, 120P plus 80 minus 80P. I will simplify. I will arrive at the value of P. Yes, P will come to 0.75 and 1 minus P is going to be 0.25. Is this clear, everyone? This is how we will be doing. Now, this I have written down in the form of a formula. Look at this. How did I arrive at this? Yes, my share price can reach 120 also, 80 also. Probability of this, we will always assume probability of share price moving up is P, down is 1 minus P. So either it can be SU, spot up, probability is P, or it can be SD, probability is 1 minus P. So SU into P plus SD into 1 minus P. This is the value at the end of first year. I want to know the value today. Bring it to present value. Yes or no? I will do divided by R. R is the interest rate factor. Yes, in case of simple interest, it is divided by 1 plus R into T. Yes, in case of compounding, it is 1 plus R to the power T. In case of continuous compounding, it is e to the power RT. Already we have discussed in futures. Yes or no, everyone? Okay. So divided by R, I will arrive at the value today, which is S naught. So using this formula, I can calculate yes or no, everyone. Very simple. Draw binomial chart. This into probability plus this into 1 minus probability. Bring it to present value, should be this. As simple as that. Yes or no. Need not even by heart the formula. Yes, this is the formula, logical approach. Now there is one more approach, which is the formula approach. Yes, what this formula approach is telling, yes, value of P, that is the probability of moving up. Yes, it is R minus D divided by U minus D. Sir, what is R? R is the interest rate factor that I've used here. Yes or no? 1 plus interest rate. Simple. What is D? D is the down factor. It is telling if the share price falls down, how much percentage will be the value? Tell me, share price is 100. If it falls down, how much it will be? 80. So it will be just 80%. So it is 80 divided by 100. Yes or no? 80%, 0.8. Yes, this is a D, down factor. Basically, it is 80 by 100, which is SD divided by S naught. Yes or no, everyone? Yes, perfect. U is the up factor. It is telling if the share price goes up, na, how much percent up it can go? 100 can become 120. So 20% up it can go. It will become, yes, 1.2, 120 percentage. Simple. 100 can become 120. So it is 120 by 100, 1.2. Yes or no, everyone? Yes, it is SU divided by S. Yes or no, everyone? Look at this. Here we have written down the terms. Yes. Formula approach, P is equal to R minus D divided by U minus D, where R is the interest rate factor, U is factor, which is, yes, up is SU divided by S naught, D is the down factor, how much down it can go, SD divided by S naught. In a regular batch, for this also, using the original formula, yes, that we had, we have tweaked, we have played, accordingly we arrived. Look at this. Yes, for students, if you just want for reference purpose, see, mathematical derivation of the formula. This is basically just a shortcut. Still, mathematically, how to derive this? Everything we did. Yes or no? But this is just a quick rocket revision, not needed at all. Yes or no? This is just be telling R minus D divided by U minus D. Okay. Now, students sometimes feel that it is difficult to remember this. For that, I had given students a simple mnemonic to remember this. R minus D. Yes, I will tell it as Randy. Yes, U minus D is Uppinangadi. Sir, what is Uppinangadi? Uppinangadi is the name of my place where I belong to. Okay, history tells us that powerful people come from powerful places. History was wrong. Powerful people make places powerful. So Uppinangadi is such a big city that the day I became chartered accountant, I was the first chartered accountant from Uppinangadi. It's basically a small village. So yes, Randy, you know who is Randy? Randy Orton. Yes, if you guys are following WWE, boys, you should be knowing who is Randy Orton. Okay, yes, Randy Orton's a crazy BGM. I hear thunders in my head. They talk to me. Yes or no? Okay, leave it. So simple. I told a simple sentence. Randy is coming to Uppinangadi. Randy R minus D. Uppinangadi U minus D. Chumma one way for you guys to remember it. Anyways, nevertheless, this you will have to be remembering. Yes, logic I've told. This anyways, logically we can be deriving. Is this clear, everyone? Perfect. This is calculation of probability. Now I have told R. R is the present value factor. Yes or no, everyone? Interest rate factor for 1 rupee principal. In case of simple interest, it is 1 plus R into T. Yes, in case of compound interest, it is 1 plus R to the power T. Yes, in case of continuous compounding, it is e to the power R. Yes or no? Basics we have already discussed in this chapter only. In forwards or futures, we have discussed this. Is this clear, everyone? Okay. Calculation of probability, I hope is fine. Yes or no? Now we will you create a simple example. I want you guys to calculate probability. Simple. Imagine spot price today is 500. Yes, in 1 year, share price may reach 600 also. Share price may fall to 450 also. Calculate the probabilities. Yes or no? We will assume this is P, this is 1 minus P. Simple. I will tell after 1 year, imagine a risk-free interest rate is 10%. I will tell after 1 year, price can be 600 also. Probability is P. Price can be 450 also. Probability is 1 minus P. Boss, this is at the end of first year now. Today, bring it to present value. 10 percentage means 1.1. That gives the value of asset today, which is 500. Simplify this. You will arrive at the value of P as well as 1 minus P. Is this clear? This is one approach, or else I can also do it this way. It is R minus D divided by U minus D. Tell me, R is the interest rate factor. 10 percentage means 1 plus 10%, 1.1. D, 500. If it falls, it becomes 450. So D is going to be down factor, 450 by 500. It is going to be 0.9. Yes, U is the up factor. Yes, if it reaches 600, 600 by 500, it is 1.2. So R minus D 0.9 divided by U 1.2 minus 0.9. Using this also you can be calculating. 0.2 divided by 0.3. I guess is it 0.6667? Yes or no? Something like this. Perfect, everyone. Any doubts still here? If this is clear, trust me, binomial model is over. There is nothing more in binomial model. Yes, binomial model, the only thing we had to know is calculation of probability. That also is very simple. Whatever is the price, yes, into P into 1 minus P, bring it to present value. You know the value today. That is going to be your probability. Is this clear, everyone? Okay. Now let us do one thing. If we know this, yes, additional notes that we should be knowing. Okay. Which type of interest we should be applying? Question specifically asks you to do continuous compounding. Yes, value of E is given. I will apply continuous compounding. Otherwise, simple interest I will be applying. Yes. Note, always consider risk-free interest rate only. Point number one. Point number two, calculation of probability. In binomial model, probability is something we will only be calculating. Okay. So as per binomial model, probability we only should be calculating as per the formula. Sometimes question will give you some probability. Assume share price today is 100, share price may reach 150 or 50 with the probability of 60%, 40%. You will not use the probability given there. In binomial model, probability, we will only calculate probability as per the risk neutral approach. Is this clear, everyone? Okay. Now comes calculation of value of option. Trust me, students, value of option is very simple. It is a present value of future payoffs. Simple. Look at this. Imagine there is a 1 year call option available at a strike price of 110. Okay. Yes. Today's spot price is 100. Same example. In 1 year, the share may reach 120 also, 80 also. We have calculated probability 75%, 25%. Calculate the value of option today. Yes. This is the question. Tell me step number one, we have drawn binomial chart. Yes, spot is 100. Either it may reach 120 also, 80 also. Okay. Number two, we calculated probability. Okay. Yes. Step number three, we will see the value of option or payoff. Tell me I am having a call option at a strike price of 110. So how will I write? I have a call option at 110. So if it goes above 110, I will exercise. 120, it has crossed. So I will exercise. I will get 10 rupees. 80, it has not exercised. Yes, it has not crossed. I will not get anything. Yes or no, everyone? So tell me, if I purchase this call option at the end of first year, na, yes, from the option, from the call option, either I can receive 10 or I may receive 0. How much I am receiving? Either 10 or 0. So give me expected value. Yes, how much percent chance is there that I will receive 10? 75%. How much chance is there that I will receive 0? 25%. So the expected value is going to be 10 into 75% plus 0 into 25%. Yes or no, everyone? So it is going to be 7.5. It is the value of option at the end of first year. At the end of first year, I will receive 7.5. I want to know the value of option today. So bring it to present value. Yes or no, everyone? Divided by 1.1, I will arrive at the value of option today. Is this clear, everyone? Perfect. So simple. Yes, it is a payoff into probability plus payoff into probability divided by R. I will arrive at the value of option. Look at this. Payoff into probability plus payoff into probability divided by R. I will arrive at the value of option. Simplest thing in the world. Is this clear, everyone? So look at this. If I am having a single period binomial model, what are the steps? Step number one, draw a binomial tree. I will first write 0th period, first period. S0, which is spot. Yes. SU, if the price goes up. SD, if the price goes down. Here it is P, here it is 1 minus P. Okay, fine. I will write down the value of option also in case of call option CUCD. In case of put option PUPD. Is this clear, everyone? Okay. Next, step 2, I will calculate probabilities. P and 1 minus P values I will calculate. Okay. Step 3, I will calculate gross payoff for each node. Yes, here what is the value of call or put option? Call means call, put means put. Yes, here what is the value of option? I will calculate. Okay. Now value of option today. Yes, value of option into probability plus value of option into probability. That is at first period. Bring it to present value. It is going to be value of asset today. It's P of into probability plus P of into probability divided by R. This is going to be, yes, binomial model single period. Simplest thing in the world. Shall we quickly do one example? Yes, sir. Let us quickly do one example. Pay attention. American option is anyways not needed. Repeated, all these things are not needed. Directly we'll go to the workbook. Pay attention. Okay. So many different situations for calculation of probability. I've put it here, but I guess you guys can tackle it yourselves. In case of monthly compounding, continuous compounding, all those things. If you guys want, you guys can try this. Example number 21 by yourselves. Okay. Yes. Now we are quickly proceeding further. Okay. Now look at example 21. Current share price of Maja Limited is 500. Spot today S not is 500. It will either increase to 600 or fall to 400 within 3 months. In 3 months, either it will become 600 or 400. Calculate the value of 3-month call option if strike price is 550. What is step number 1? We will draw binomial tree, whether it is asked or not. Tell me, S0 is 500. It will increase and become 600 or decrease and become 400. First, with this, we'll have to calculate probability. Yes, I will tell 600 also can be there. Chance is P. 400 also can be there. Chance is 1 minus P. So 600 into P plus 400 into 1 minus P. But boss, this is at the end of third month. I want to know the value of option today. Bring it to present value divided by 1 plus 12%. But I want to bring back 3 months only into 3 by 12. Yes, I will arrive at the value of asset today, which is 500. I will simplify. I will arrive at the value of P as 0.575. 1 minus P as 0.425. This is 0.575. This is 0.425. Now I will calculate the payoff at maturity. Yes or no, everyone? Tell me, I am having a 3-month call option at a strike price of 550. So I will exercise it if it crosses 550. Here it is crossing 550. I will exercise and I will receive 50. Here it is not crossing. I will receive 0. So I know on maturity, either I will receive 50 or I will receive 0. Yes or no? I want to know the expected value. It is 50 into 0.575 plus 0 into 0.425. It is a value at maturity. I want the value today. Bring it to present value divided by 1 plus interest is 12%. I want to bring it back by 3 months into 3 by 12. I will arrive at the value of the option. Is this clear, everyone? Now imagine one more example we have put for put option. Look at the students. Current share price of Maja Limited is 500. Either it will increase by 30% or decrease by 20% in the next 3 months. Okay. Calculate the value of 3-month put option. Put option. If the strike price is 475 and interest rate is 12% per annum. In bracket, they have given E value. That means I should be using continuous compounding. First step is I will draw binomial tree. Tell me spot is how much? 500 at 0th period. Third month, either it will reach increase by 30% means reach 650 or fall by 20% means reach to 400. Now I'll have to calculate probability 650 into P plus 400 into 1 minus P. This is the expected value in third month. I want to bring it to 0th period divided by R. Tell me what is R here? Continuous compounding I should be doing. So e to the power 12% into 3 by 12, it is e to the power 0.03, value is given. So this divided by, yes, e to the power 0.03, that value is equal to today's value 500. You simplify, you will arrive at a value of P is equal to 0.461. 1 minus P is equal to 0.539. So this value you got. From here onwards, it is very simple. Just in a single binomial tree, will finish off the entire calculation. Trust me. Okay. Step 2 is over. Step 3, I will calculate a value of option at each of the points. Payoff. Tell me I am having a put option. Option is exercise. The strike price of 475. If it falls below 475, here it is a 0. Here it is falling below 475. 75 is a payoff. So tell me what is the value of option? It's 0 into 0.461 plus 75 into 0.539. It is on maturity. I want the value of option today. Bring it to present value divided by e to the power 0.03. Yes, I will arrive at the value of option. Is this clear, everyone? It is 39.2. Is this clear? Is this clear? Is this clear, everyone? Okay. Crazy? Yes, everyone. This was regarding one period binomial model. Now, in the examination, major.
Yes, everyone. So now let us go ahead to two-period binomial model, my dear students. Now, what is a two-period binomial model? We have seen single-period binomial model. Question is telling 100 rupees the share price. Share price may increase or decrease by 10%. Two-period means question is telling 2 times the change will happen. Simple example. Imagine the spot price is 100 rupees. Question is telling in the first day my share price will either increase by 10% or decrease by 10%. We are asking what will happen on the second day. Yes, we are telling second day again the share price may either increase by 10% or decrease by 10%. So see how my, yes, binomial tree will come. Yes, spot today the share price is 100. Tomorrow what may happen? Either the share price will increase by 10% or decrease by 10%. If it increases means SU, yes, 100 plus 10%, it will become 110. If it decreases means 100 minus 10%, 90 rupees. Yes or no? This is on the first day. Yes or no, everyone? T is equal to 1. Next day, okay, imagine I'm telling share price went up and became 110. I'm asking what will happen tomorrow. Well, again telling either it may again increase by 10% or fall by 10%. So second day from 110, it may either become 121 or it may reduce by 10% and become 99. So this how we will write. Yes, it is already from S0 we went up SU. Again I'm going up SUU. Or here I went up, now I'm going down SUD. Yes or no, everyone? Perfect. Now I am telling, imagine first day share price fell down to 90. Now what is the story? Second day again either it may increase by 10% or fall by 10%. Second day it may increase by 10%, 90 plus 10%, 99 it may become, yes, S D it fell, U SDU, yes or no? Or it may again fall by 10%, SD D, yes or no? 90 minus 10% it may become 81. Is this clear, everyone? Perfect. Two times it is moving. Is this clear, everyone? Yes, perfect. So again steps are going to be similar only. Now if you see properly, yes, we have done similar things in the chapter advanced capital budgeting. We have seen, yes, decision tree. Yes, a big binomial tree. Yes or no? It has gone this way. We have told always we will do calculations in the reverse order. This one, if you actually see now, there are three binomial trees. Look at this. This is one binomial tree. First day, if it goes up from there, it may either go up or come down. Yes, this is a second binomial tree. Yes, boss. First day, if it comes down from there, it can either go up or come down. And then this is a third binomial tree. And we will do the calculations in reverse order. So first, I will calculate this one. Yes, here what is the payoff, here what is the payoff, probability, I will arrive at the value here. Then I will solve for this. Here what is the payoff, here what is the payoff, bring it to present value, I will arrive at the value here. Now that I know the value here and here, yes or no, now what I will do, I know here what is a payoff, here what is a payoff, bring it to present value, I will arrive at the value here. Simplest thing in the world, jujube it is. Is this clear, everyone? Same, more or less same steps will be following. Look at this. Share price will move up or down in two steps. One before maturity, second is going to be again on maturity. It creates multiple possible paths. Okay. Steps to solve a question. Golden principle. Always calculation we will be doing in the reverse order. Is this clear, everyone? Okay. What are the steps? Step number one, draw a binomial tree. Okay. At t is equal to 0, I will be having S0 spot. Either it will go up or come down, SUSD. Again, it may either go up, yes, or come down. Yes, go up or come down. Is this clear? For each of the nodes, I have given name A, B, C, D, E, F, G. This is the first period. This is the second period. Now, once I have drawn the binomial tree, what is the second step? I should be calculating probability. Tell me how many times I should be calculating probability. Here once, here once, here once. But there is a shortcut. Sir, what is a shortcut? 99.9% questions in your CA CMA examination, question will frame it this way. Yes, spot price is say 100. Yes, first day the share price may either increase by 10% or decrease by 10 or 20%. Second day also the share price may either increase by 10% or decrease by 20%. Now if the percentage increase decrease in day 1 as well as day 2 is going to be same, then you need not calculate 3 times. Only 1 time probability calculation is sufficient. Is this clear? And for us in the examination, yes, every time institute will frame question that way only, or else multiple times we'll have to keep calculating probability. Look at this. Yes, procedure for calculation of probability is already discussed above. Yes, Maja tip, the probabilities will generally remain the same for first period as well as second period in most of the questions. So we did not calculate again. Once if we calculate, it is sufficient. So if question specifies that the price can move up or down by the same percentage in each period, that is, the first day how much is the percent up down, second day also same percentage, in that case probability will be same. And for us, all questions which is there in study material, past paper, RTP, MTP, till now every question was on that line only. So we can calculate probability once only. Is this clear? Once I have calculated P, yes, 1 minus P, same I will be writing here. Is this clear, everyone? Okay. What is the third step? Boss, yes, I know that I'm having an option. Imagine I'm having a call option. Yes, at 100. So if it goes above this, I can exercise. So I can arrive at the value of the option payoff at each of the points. Yes, boss. Step number 3, I will calculate payoff for each of the node in the second period. That is for D, E, F, G. Yes, boss, I will be doing that. Okay. Now what I will do, yes, I will treat it as a 3 separate binomial, single period binomial models. three separate binomial trees. First I will tell from first period to second period. First period, if it goes up, what is the story? This is one binomial tree. If it goes down, this is a second binomial tree. If I do that, I will arrive at the value of option here and here. Based on that, I will do the final binomial tree. I'm telling this is the value, this is the value, this is the probability. Bring it to present value. I will arrive at the value of option here. Is this clear, everyone? 3 times I will be doing this binomial tree, and then this binomial tree. Is this clear? Reverse order I will be doing the calculation. Look at this, everyone. Yes, calculate value of option for each node of the first period, that is node B as well as node C. For this binomial tree I will do, for this binomial tree I will do. Once I have calculated, using this value, I will calculate the value for this binomial tree. Using a simple example we'll do. Quickly we'll get to know this. Look at this crazy example it is. If you do this, 2-period binomial model is done. Now for the information of, yes, recorded students, right now the time is 1:12 a.m. midnight. Yes, I had come up with Zoom live classes. We still have, I guess, around 15 students still live. Okay, so that is the energy students are showing. So when students show the energy, we'll also get the energy. People who are watching it on YouTube, yes, we are doing night and day into one. Yes, even late in the night we are recording, even though my eyes are slightly dozing off. For you guys, still you guys are not liking, you are not sharing to your friends. What is this, If your juniors are asking, Final AFM, CMA Final SFM, whose class to buy? You should tell, crazy maja class is there. Purchase Tabish sir's classes. Go to website thinkwithtabish.com at the best possible price. You should tell that way, yes or no, everyone? Okay, you guys are our biggest advertisement. Okay, crazy quickly, let us do the example. Pay attention, everyone. Okay, the current share price of Maja Limited is 1000. Current share price is 1000. Strike price is 1050. Okay, there are 2 time periods of 6 months each. There are 2 periods of 6 months each. 6 months, 6 months. So total 1 year. In each period, that is in 6 months, the share price can either move up or down by 10%. Oh, tell me students, only single time probability they have given. Same probability only. So that means same up and down percentage is given. That means same probability it will be. The risk-free interest rate is 6% per annum. You are required to calculate the value of 1 year call option, 1 year put option. Quickly we will do it, students. First, step number 1, we will draw the binomial tree. Tell me spot is how much? 1000. Yes or no? In 6 months, the share price can either move up or down. How much percentage? 10%. So either it can become 1100 or 900. If it has become 1100 in 6 more months, 6 more months, 12 months, either it can go up by 10%, 1100 plus 10%, 1210, or it may come down by 10%, 990. Imagine it is 900. Again, it may go up by 10%, 990, or come down by 10%, 8. Is this clear, everyone? Binomial tree is ready. Step 1 is over. Step 2, calculation of probability. Either you can calculate separately 1 time, 2 time, 3 time, or 1 time you do, it is sufficient. Simple. Tell me students, at the end of 6 months, price can be 1100 also, 900 also. I will tell 1100 into P plus 900 into 1 minus P. Bring it to present value. This is at the end of 6th month. Yes or no? Yes, I guess the interest rate is going to be how much? Yes, 6% per annum. So it is divided by 1 plus 0.06 into 6 by 12. That gives me the value of asset today. It is 1000. I will simplify. I will arrive at P as 0.65, 1 minus P as 0.35. Always remember, P is the probability of moving up. So this is 0.65, 0.35, 0.65, 0.35, 0.65, 0.35. Is this clear? Step 2 is also over. Yes, below I will write down. Now comes a step 3. Yes, I will calculate payoff at each of the points. Tell me I have purchased a call option at a strike price of 1050. So I will write I am having a call option 1050 up. So if it goes above 1050, we will exercise. Yes or no? 1210 it crossed, we will exercise. How much is the payoff difference? 160. 990 we will lapse 0. 990 we will lapse 0. 810 we will lapse 0. So I will write this is CUU, this is CUD, this is CDU, this is CDD. Is this clear, everyone? Step 3. Till here students will not be having problem. From here onwards you just need to be careful. That's all. Okay, 3 binomial trees are there. Slowly we will come back. First I will tell, okay boss, in the first period, now if my share goes up, from here what all can happen? Yes, either it may go up to 1210 or 990. In this case I will receive 160. In this case I will receive 0. So can I calculate the value of option here? Yes, boss. 160 also I will get. What is the probability? 0.65. 0 also I will get. Probability 0.35. Boss, this is at the end of 6 months. From here, 6 months. From 6th month to 12th month. Basically 6 months. So I will come back by 6 months. It is 1 plus 0.06 into 6 by 12. I will arrive at the value of option. It is 100.97. Is this clear? Now, if the share price goes down, that is from 900, either it may go to 990 or 810. Yes, here it is 0, here also it is 0. So it is 0 into 0.65 plus 0 into 0.35. Yes, bring it to present value, divide by 1 plus 0.06 into 6 by 12. Yes, it is anyways 0. Yes or no, everyone? Perfect. I am showing it here in a single binomial tree itself. When you guys are doing what I want you guys to do, yes, step 1 is done, step 2 is done, step 3 here itself you calculate the value of call. Below, if you want, in a table you show. Step 4, yes, calculate value of option at node B. You give the heading, do this chart. Yes, 1100, it may go to 1210, it may come to 990. Here it is 160, here it is 0. Calculate the value of option. Show it as a step, so you will never commit a mistake. Is this clear, everyone? Yes, show it as a step. Okay, this was a crazy thing that I've done. Where did I show the steps? Okay, here it is. Look at this. From node B, it can either be 160 or 0. Probability is there. Calculate the value of option. Node C, from node C, either I will be getting 0 or 0. Yes, calculate the value of option. Okay, this is also done. Now tell me finally what is happening here. Yes, this binomial tree is done. This binomial tree is done. Now what is pending? The last binomial tree. Boss, today if I purchase the option at the end of 6 months, I can either be getting 100.97 or I can be getting 0. So to get that, how much I should be investing today? Tell me, 100.97 I can get. What is the chance? 0.65. Yes, 0 also I can get. What is the chance? 0.35. But boss, this is after 6 months. How much I should invest today? Present value divided by 1 plus 0.06 into 6 by 12. This is going to be value of option today. Is this clear, everyone? For this, again, I want you to do it in the last step. This is at node A. Either I can receive 100.97 or 0. Calculate present value of that. Where is it? Here it is. Either I can receive 100.97 or 0. Yes, bring present value of that. You will arrive at value of option as 63.72. Is this clear, everyone? Perfect. Now, in the regular batch, one crazy thing also we did. Right now, it is not important. Yes, another quick shortcut way in a single stretch to calculate. That is not important. Concept of joint probability. Yes, this we will leave it here. Is this clear, everyone? Perfect. Now, one more thing which I wanted to tell. I forgot something in the middle. My mind got stuck. What is it I wanted to tell here? Something I wanted to tell here. Leave it. Yes, it happens. You're in the flow, you're telling. Your mind tells, okay, something I should be doing. Subsequently, you forget it off. Okay, nevertheless, nothing important anyways. Okay, leave it off. Not a big deal. Now, calculate value of 1 year option, assuming it is put option. Same story. First, you will draw a binomial tree. Look at this, students. In case of put option, you will draw a binomial tree completely. Same thing. You will calculate a probability. Probability anyways is going to be same only. Now, yes, step number 3, you will calculate payoff at each of the points in the second period. Okay, yes, you're having a put option at 1050. So if it falls below 1050, you will exercise. 1210 means 0, 990 means 60, 990 means 60, 810 means 1050 minus 810, you will be getting 240. Yes or no, everyone? Okay, perfect. So tell me here, from node B, you will calculate. Yes, boss. From here, you can either receive 0 or you can get 60. Probability is given. So 60 into 0.35, bring it to present value. You will get 20.39. Yes, if it goes below, either you will receive 60 or you will receive 240. Yes or no? Probability is given. Bring it to present value. 60 into 0.65, 240 into 0.35, bring it to present value. You will receive 119.42. Then finally, for the last binomial tree. Yes, today, if you are purchasing an option at the end of 6 months, you can either receive 20.39 or 119.42. Bring it to present value. 20.39 into 0.65, 119.42 into 0.35. Bring it to present value. Divided by 1 plus 0.06 into 6 by 12. You will arrive at the value of option today, which comes to, yes, how much is the value of option today? It comes to 53.45. Is this clear, everyone? Perfect. Yes, I remembered what is it that I wanted to tell. Now, yes, options, yes, can either be American option or European option. In case of 2 period as well as single period, institute always does the calculation assuming the options are European options. So for us, for examination, only European options are going to be important. Is this clear, everyone? Even if question tells American option, the final answer will be coming as per European option only. In regular batch, in detailed way I had told for you guys, yes, even if you have taken classes from other faculty, they have taught you European option for exam, that is not important. Okay, you do it, sorry, they've taught American option for exam, only European is going to be important. European means only on maturity you're exercising, only on that day you will calculate P of that, you will bring it to present value. Is this clear, everyone? Perfect. Any doubts till now? No, boss. So with this 2-period binomial model is also done. Now we are left with only the Maja adjustments with respect to binomial model. Almost for 5-6 hours I'm speaking in a stretch, that too at a faster pace. So sometimes we fumble for words as well. Yes, everyone. So now let us go ahead to the final point that we're having. We've understood binomial model, calculation of probability we have understood, single period we have understood, 2-period in case of call, in case of put, everything we did. Now we are having the final point, which is Maja adjustment. Sometimes with these questions, some extra adjustments also they'll be asking. Sir, what extra adjustments? Sometimes question will tell, determine the composition of a riskless hedge portfolio. What all different words can be there in the question? Either question will tell calculate the composition of a riskless hedge portfolio. Yes, question will tell calculate the delta hedge portfolio. Question will tell calculate the combination of share and option to have a perfect hedge. Yes, question can tell calculate the number of shares to be bought to have a perfect hedge. All means one and the same. We need to calculate the delta ratio. Is this clear, everyone? Now, how do we calculate the delta ratio? What does it mean? Simple. Delta ratio is very simple. It is a change in option value divided by change in the, yes, share value. Simple example, imagine there is a share, spot price is 100. Yes, spot price is 1000. Either the share price may increase by 10% or decrease by 10%. So either it will become 1100 or it may become 900. Is this clear? Imagine there is a call option at a strike price of 1020. So tell me, if the share price becomes 1100, it is crossing 1020, we will exercise, we will get 80. But boss, if it is a 900 means we will be getting 0. Is this clear, everyone? Okay. Tell me, students, imagine we are at this level. How much is the value of the share? 900. How much is the value of the call? 0. Yes, from 900, if my share price reaches 1100, my share price has increased by 200. Yes or no? In the meantime, what happened to my call option? What happened to my option? My option from 0, it has increased to 80. Yes or no, everyone? So when my share price has increased by 200, my option value has increased by 80. So if my share price is increasing by 1 rupee, by how much my option value is increasing? Simple, it is going to be 80 divided by 200. It is 0.4. Yes or no, everyone? Simple. Delta, it is a change in option value divided by change in share value. 80 divided by 200, it is going to be 0.4. Is this clear, everyone? Okay. Delta ratio, it is change in option value divided by change in share value. Yes, note ICAI is only having questions on calculation of delta ratio for call option. Now what is interpretation of delta ratio? Imagine my delta ratio is equal to 0.4. What does it mean? It means, interpretation is something we should be knowing. If in case it comes in the question, we should be writing interpretation. If delta ratio is equal to 0.4, it means that in order to have a perfect hedge, a riskless hedge, what an investor needs to do? Yes, investor needs to write one call. So write means sell. Investor needs to sell one call and buy how many shares? Does he need to buy full one share? No, only 0.4 shares. Is this clear, everyone? Sir, how this interpretation came, what it means? Not needed at all. Simple. What delta ratio is equal to 0.4? What does it mean? Yes, delta ratio is equal to 0.4. It means that if we want to have a perfect hedge, in that case, I will write one call option. Write one call option and purchase how much shares? One share or no? Just delta shares is sufficient. 0.4 share is sufficient. Is this clear, everyone? This is going to be the interpretation. Okay. Interpretation of delta ratio. If delta ratio is equal to 0.5, it means that investor will write one call option and buy 0.5 shares in order to have a perfect hedge. Is this clear, everyone? Okay. Now we have the last point, which is calculation of expected rate of return on the option. Yes, this is basically the return calculation, how much return we are going to get. Now both these things combined together, we are having one beautiful example. which is a question which is picked directly from the question bank only, which is the Mr. Dayal question. Students feel it to be the most difficult question. Trust me, it is a very simple halwa jujube question. We will understand this question. Trust me, if this question comes in the exam, it comes for 8 bucks. Okay, simple. Spot price is 600. Okay, the share price may either go up to 780 or it may come down to 480 in 3 months. Okay, the chance of occurring such variation is 60% and 40%. Tell me, students, I have told you one very simple thing. In binomial model, probability, who will calculate? We will calculate. If question gives you that probability, means in binomial model I will not apply. Yes, in binomial model I don't want, because I know how to calculate. I will only calculate probability. Okay, sir. Call option is available at a strike price of 630. Okay, risk free rate is 10% per annum. Okay, yes, calculate the value of option today. Requirement number 1. Okay, requirement number 2, what combination of share and option should you buy for a perfect hedge? They are asking us delta ratio. Okay, let us try doing it. Spot is 600, it may go up to 780 also in 3 months, or 480 also. I want to calculate probability. It is 780 into p plus 480 into 1 minus p. I will bring it to present value divided by 1 plus interest rate is how much? 10 percentage into 3 by 12. Yes or no, everyone? My p is 0.45, 1 minus p is 0.55. Is this clear, everyone? So in binomial model, I will only calculate p, I will only apply that. Okay, perfect. This is done. Now tell me, I am having a call option at a strike price of 630. So call option 630 up. If it is 780 means I will exercise, I will get 150. If it is 480 means I will lapse, I will be getting 0. So tell me, what is the value of option? 150 into 0.45 plus 0 into 0.55. This is at the end of 3 months. Bring it to present value divided by 1 plus 0.1 into 3 by 12. Yes or no, everyone? So value of option is 65.85. Is this clear? Yes, boss. First requirement is done. Yes, boss. First requirement is done. Second, what combination of share and option I want? Tell me, students, here the change in the share value from 480 it is reaching 780, that means it is increasing by 300. What is the change in the option? Change in the option is 150. Yes or no, everyone? So delta ratio, it is the change in option divided by change in share. It is 150 divided by 300, it is going to be 0.5. I can write the interpretation also. Delta ratio is equal to 0.5. It means that investor has to write one call and buy delta, which is 0.5 shares, to have a perfect hedge. Yes or no, everyone? Okay, so this I will do. Yes, 0.5. Yes, we'll have to write one call option and buy 0.5 shares in order to get a perfect hedge. This is also done. This is also done, sir. Now comes the last thing, which is what is the expected rate of return on the option. This is a beautiful thing, my dear students. Tell me, how do we do this calculation? Yes, what does it mean? Yes, it means a very simple thing. Imagine you are the investor. Okay, boss, you want to purchase this option. You are just purchasing, the way you purchase shares, debentures, you are purchasing this option. Tell me, to purchase the option you should be paying a price. Yes, boss, how much amount you are paying to purchase the option? 65.85 you are paying today. Yes or no? This is your investment value. You will be expecting that at the end of the period you will be receiving some money as well. Yes, boss. So let us try seeing how much return we are getting. Value of option is 65.85. It means investment, if I have to purchase a call option today, how much I should pay? 65.85. Okay, now I have purchased the option. At the end of 3 months I will be getting some payoff. Okay, now as per binomial model, what is a payoff, what is a probability, I know, but investor is having different expectation. I told you, when I am calculating value of option as per binomial model, I will only calculate probability as per binomial model. So then that probability is given. Where do we use that? We will be using it here. Yes, investor is telling, okay, boss, binomial model told that, okay, probability of going up is this, coming down is this. But investor is telling, boss, I have some internal information. As per me, he is telling, yes, the share price, the probability of share going up is 60% and going down is 40%. Okay, so what all can happen? Yes, tell me. Yes, investor, I am the investor. I purchased the call option by paying 65.85. Okay, I am telling at the end of 3 months how much will be the value of option. Yes, as per our prediction, I am telling 600 can become 780 also. As per my expectation, how much chance is there? 60%. It can come down and become 480 also. How much chance is there? 40% chance is there. Tell me I am having a call option at 6:30. So if it goes above 6:30, I will exercise. So I may receive 150 also, 0 also. Tell me how much chance is there that I will receive 150? 60% chance. How much chance is there that I will receive 0? 40% chance. So can I calculate the value of option at maturity as per our expectation? Yes, boss. My expectation is 60%, 40%. As per that, 150 into 60% plus 0 into 40%, it is going to be 90. Yes or no, everyone? Simple. So what does it mean? I am telling that, boss, today one option is available. At what price it is available? It is available at 65.85. This is the value of option. I am telling, if I wait for 3 months, if I purchase a call option and wait for 3 months, I know 60% chance it will go up, 40% chance it will go down. If it goes up 150, I will get. If it goes down 0, I will get. So expected I will be receiving 90 rupees. Yes or no? So if I purchase this option, tell me how much profit I will be making in 3 months. I have put 65.85. It will reach and become 90. That means I guess 23.15 something. Yes or no, everyone? Perfect. Sorry, 24.15 I will be getting. Yes, on my investment amount. Yes, profit percentage is always on investment. 100 you put, it became 110. So you'll tell profit percentage, 10 profit I received on 100. Yes or no? 24.15 profit I received on how much you invested? 65.85 into 100. This is the profit percentage. Yes or no, everyone? Yes, you have invested 65.85. It has become 90. So it has given you a return of 24.15 on a 65.85. So you are achieving a return of 36.67 percentage in 3 months. If you want, you can convert it into per annum basis as well. Is this clear, everyone? Look at this, the steps I have written it down here. Expected rate of return in options. If institute asks this question, what we have to do? Step number 1, calculate value of option as per binomial model. We would have calculated, this is the investment value, initial value. Okay. Then step number 2, calculate expected value of option at maturity as per our prediction. Boss, this is how much I'm putting. On maturity, how much will the value be? That I will calculate as per my expectation. Because question is asking calculate expected return. Okay. Yes, there also if you do as per binomial model, your expected return is going to be risk free only. Okay. So I will do it as per my expectation. Value at maturity. I will use my probability, payoff into probability, payoff into probability. I will arrive at the value on maturity. Yes, consider the probability given in the question, payoff into probability, payoff into probability. This is also called as final value. Now calculate return percentage. Initial value, it is the investment. Final value, this is what I'm getting. Yes, return I will get. So it is going to be return divided by initial value. It is going to be the return percentage. Is this clear, everyone? Very simple it is. So with this point is also done, my dear students. Is this clear? Yes. Then we are having Black-Scholes model, not important for exam. To understand Black-Scholes, we are also having put call parity theory, that is also not very important for the examination. With this, unit number 2, options is also done. I've tried doing it a bit faster because we are lacking time, and I have told this is going to be a rocket revision, but I hope you guys have thoroughly understood this. So what we have completed, my dear students, pay attention. Unit 0, basics of derivative, we've understood properly. Unit 1, forwards and futures, we've understood. Yes, concept number 1, concept 0 was basics. Concept 1, we've seen pricing of forward contract, profit or loss calculation, theoretical future price. Yes, concept number 2, we had seen margins, initial margin, maintenance margin. Yes, mark to market margin. Yes or no? Concept number 3, hedging in case of futures, we had seen. Yes or no? Concept number 4, we had seen commodity hedging. Concept number 5, we had seen arbitrage. That was unit 1, forwards and futures. Then we have come to unit number 2, options. Concept 0, basics, we have done. Yes, concept number 1, we had done. It is profit or loss in case of options. First, we told calculation of gross payoff in case of call, in case of put. We are just building a mind map. Yes, then I told calculation of net payoff. It is gross payoff minus the premium paid. Yes, then I told, yes, what should be done for the option seller. I told option seller, you don't think. Whatever you first calculate for option buyer, option seller, you just do a reverse of that. Okay. Then I told calculation of BP. In case of call option means, yes, strike price plus premium. In case of put means strike price minus premium. Okay, that was concept number 1. Concept number 2 is the expected value of option at maturity. On maturity, what is expected value? It is a payoff into probability, summation of that. Then based on that, I told value of option today. It is a present value of expected value at maturity. Yes, multiple methods are there. For us, for examination, we are only having binomial model. Okay, in binomial model, first thing was calculation of probability. Okay. Then we have understood single period binomial model. Okay. Then we have understood two period binomial model. Two period binomial model, simple. Step number one, yes, we'll draw the binomial tree. Step number two, we will calculate probability. Probability generally will be same only, once if you calculate will be sufficient. Okay. Point number three, we will calculate payoff at every point in the second period. Okay. Then yes, treat it as a three binomial tree. First period, if it goes up from there, what is a binomial tree? If it goes down from there, what is a binomial tree? From 0th period, what is a binomial tree? So calculate for the first period, then calculate for the 0th period. Is this clear, everyone? Okay. Additional point we have told, yes, composition of riskless hedge portfolio. It is a change in option divided by change in share, then expected return on the option. First calculate value of option as per binomial model. This is the investment. Then calculate expected value at maturity. Yes, using the probability given in the question. That is a final value. Calculate return percentage. Is this clear, everyone? Perfect. Options is also done. Now we are having unit number 3, which is real option. A very simple concept, but not very important for the examination. So right now the time is some 1:40 a.m. in the night. Okay, not very important. You guys can try it by yourselves. Only two different types of questions are there. You guys can try it by yourselves. I'm not going to discuss it here. Okay, but please try it. If in case a question comes, it may come for 4 marks. Very simple. It is just an extension of option. Okay, then we are having unit number 4, which is going to be equity swaps, that we will be discussing together with, yes, our interest rate swaps. Is this clear, everyone? So with this, successfully we have completed the chapter derivatives. Considered to be difficult chapter, trust me, it is the simplest chapter. And a very simple caveat, yes, I have taught this chapter from the perspective of a rocket revision. Trust me, in each of the points, so much I can tell, so much more logics I can tell you, so much more simplified we can do it. Okay, but was there is a restriction. This is a rocket revision, not a regular batch or a fast track or an exam oriented batch, not even a detailed marathon. So from the perspective that you guys have studied already, you just want a quick brush up, we have done this. And if you guys want, we can come up with a super fast revision of, yes, all chapters or AFM, wherein every chapter possibly in 45 to 60 minutes we'll try covering it off, so that approximately in 8-9 hours all practical chapters gets over quickly. No logics, just a repetition of whatever we've told. That if you guys want, I want you guys to put in your valuable comments. If this has added value to you, I would really appreciate if you guys put your valuable comments. Yes, share it to all your friends. As a policy, we want to keep monetization off, because we don't want your learning to be interrupted. But if monetization is off, YouTube doesn't generally share it, because YouTube is not getting any benefit. So I want you guys, if it is adding value to you, to share it to your friends. So that's all. With this, we are ending the session. See you guys some other day for some other session. Until then, keep studying, keep smiling, keep working hard, keep making your parents proud, and see you in the next session. Take care. Bye. Yeah, one small point. Now in the question, if you see now, for binomial model, there are 3 different ways. Risk neutral, yes, binomial model, yes, as well as riskless hedge portfolio. In different ways they would have done. We will keep the same standard way for everything. Same approach, every question we can do it. Whatever extra adjustments were asked, that I have shown. So using this only, every question we will do, it is sufficient. We will be getting the marks. Okay, so that's all. Take care. Bye.
Yes, everyone. So, hello, hi, namaskaram, and good morning, students. So, hope you guys are having a crazy, amazing day. Not, let us make this crazy, amazing day, my dear warriors. So, it is time for us to have a quick, comprehensive rocket revision of one of the most simplest scoring chapters, which is going to be IRRM, Interest Rate Risk Management. Now, students consider it to be a very difficult chapter, but trust me, it is one of the simplest chapters. Now, we'll be uploading this on YouTube as well. So, for the reference of our YouTube students, we are going to make it dead simple for you guys. Now, I've spent a good amount of time, approximately 8-9 hours, preparing the charts and ensure that this entire chapter is summarized in just 2 pages. So, we are going to have a crazy revision. Are we ready, everyone? Yes. So, in 3, 2, 1, let the maja begin. Now, the word is telling a story. Interest rate risk management. Let us try understanding the story. First, interest rate. I am borrowing a loan. I can be borrowing my loan or investing my money in one of the 2 different interest rates. Either I can be going for a fixed interest rate, or I can be going for a floating interest rate. Fixed interest rate. Say, for example, I want to borrow 1000 rupees. Banker is telling me you pay a fixed 8% interest. Whatever happens to the interest rate in the market, tomorrow RBI may do whatever, you pay me fixed 8%. No tension at all. Is this clear, everyone? This is fixed interest rate. Tell me, we are understanding interest rate risk management. In case of fixed interest rate, tomorrow RBI hikes the interest rate, whether my interest will increase, no. Tomorrow RBI reduces the interest rate, whether my interest will reduce, no. Risk means fluctuation. Here, is there a fluctuation? No. Is there a risk? No, boss. So in case of fixed interest rate, there is no risk. Is this clear, everyone? Next one is the floating interest rate. Yes, the interest rate keeps on changing. Every time there is a change in the interest rate. Yes or no, everyone? It will change for every reset date. Periodically, it will keep changing. Say, for example, banker is saying, boss, I want to borrow 1,000 rupees. He told, okay, I am going to give you a loan of 1,000 rupees at LIBOR plus 1%. LIBOR is the reference rate. Reference rate can be LIBOR, MIBOR, BPLR, SOFR, SONIA, etc., etc. will be given in the question. Okay. Now tell me, every time my LIBOR or the reference rate changes, say, assume today the LIBOR is 10%. So I will have to be paying 10 plus 1, 11%. After six months, assume the LIBOR is 15%. 15 plus 1, 16%. Assume LIBOR after 1 year is 5% only. So 5 plus 1, 6% will have to be paying. So based on the change in the reference rate, my interest rate keeps changing. That means the interest amount that I'm going to pay is going to keep changing. Yes or no, everyone? Here, is there a risk? Yes, boss, there is a risk. Risk means fluctuation. Here, if there is a change in the reference rate, interest will keep fluctuating. So there is a risk. Is this clear, everyone? So interest rate changes on every reset date based on the benchmark rate. How do I determine my interest rate? It is going to be benchmark plus the spread. Spread is a margin that the bank is going to charge from us. Is there a risk? Yes, boss, there is a risk. So in this entire chapter, everything we are going to discuss is from the perspective of floating interest rate. So for a minute, we'll have to understand what is a reset date. Reset date is a date on which interest rate gets revised, my dear students. Say, for example, we are telling, I want to take a 2-year loan. 6-month LIBOR plus 2%. What does it mean? It means that my interest rate will be revised every 6 months. So today I am taking a loan. Assume today the LIBOR is a 10%. That means today I have locked the interest rate. Banker is telling me, boss, today the LIBOR is 10%. That means you will have to be paying me 10 plus 1, 11% for the next 6 months. So from today, for the next 6 months, whatever is outstanding amount, on that I will be paying interest at 10 plus 1, 11%. At the end of 6 months, again I will reset my interest rate. So on that day, I will see what is the LIBOR. Oh my God, LIBOR is 11%. That means banker will tell me, boss, today the LIBOR is 11%. So you'll have to be paying 11 plus 1, 12%. So every six months, the interest rate keeps on revising. Is this clear, everyone? Perfect. So look at this. So here, is there a change in the interest? Yes, boss. So is there a risk? Risk means fluctuation. There is a risk. Oh, this one we have bifurcated further. Get a perfect picture, clarity on what is risk. So we have understood, boss, in case of fixed interest, there is not much risk. In case of floating, there is a risk. When will risk arise? Okay, we have bifurcated our loan into two different categories. Either we are having a short-term loan, wherein we are having only a single reset, or we are having a long-term loan, wherein there is a multiple reset. Short-term loan, say for example, there is a single reset. Say for example, I am taking a 6-month loan. Today I go to bank, I'm taking a 6-month loan. I ask the banker, boss, I want 1,000 rupee loan. He will tell me, okay, I will give you a loan at 1 year LIBOR plus 1%. So assume today's LIBOR is 10%. That means tell me what is the interest rate? 10 plus 1, 11%. Yes or no, everyone? Tell me for the next 1 year, my interest rate is going to be 11% only. My loan is for how much period? 6 months. So tell me for the entire 6 months, the interest is going to be 10%, sorry, 11% only. Yes. Tell me, is there a risk in this situation? No. Why? Boss, mine is a short-term loan. There is only a single reset. Today was a reset. Today I know what is the interest rate. Based on it, how much I should be paying, I know. Yes, boss, in future it will change. But in the meantime, my loan will be over now, boss. So is there a risk in this situation? No, there is no risk. So look at this, students. So if I'm having a short-term loan, that is single reset, and the loan is starting today, I know today's the reference rate. I know how much interest I should be paying. Till the end of the loan, there is no change. And we know risk is fluctuation. Here, there is no change, means there is no risk. Is this clear, everyone? But sir, when will risk come? Say for example, I want a short-term loan, but I am taking the loan in the future. Say for example, I go to bank. I'm telling boss, I want a 6-month loan only, but I want my loan after 3 months. So today I'm standing here. I don't want a loan today. After 3 months, now I want to take a loan. And I want to take a loan for the next 6 months. That means the third month I'll be taking a loan. Ninth month I'll be repaying it back. Banker tells me, okay, boss, I will give you a loan at LIBOR plus 1%. Tell me, do I know today's LIBOR? Yes, boss. But am I taking a loan today? No, boss. When am I taking a loan? At the end of third month. That means which LIBOR I should be taking at the end of third month. Today, do I know what is a LIBOR at the end of 3 months? No, boss. As a borrower, I'm having a fear. Boss, today the LIBOR is 10%. What if after 3 months, the LIBOR increases, it becomes 15%? Boss, I'll have to be paying a higher interest now. So in this case, is there a risk? Yes, boss, there is a risk. Even though it is a single reset only, but my interest rate is locked in the future and I don't know what will happen in the future. So there is a risk. Is this clear, everyone? So look at this. If loan is starting today, my interest rate is locked and it is only a single reset, so I do not have a problem. But if loan is starting in future, I don't know what is the interest rate, so there is a risk. Suppose it is a long-term loan and there are multiple reset, then in any given case, we will be having a risk. Why, boss? Say for example, I'm taking a 2-year loan at 6-month LIBOR plus 2%. Okay. Tell me today only I'm taking a loan. Today's LIBOR, do I know? Yes, boss. That means for the first 6 months, how much I should be paying, do I know? Yes, boss. So for first 6 months, do I have a risk? No, boss. But after 6 months, my interest rate will be revised. Do I know how much will be the LIBOR at that point? No, sir, I don't know. That means, is there a risk? Yes, boss. If I'm a borrower, what if the interest rate goes up? I'll have to be paying higher. Yes, after 6 months, what happens? I don't know. After 12 months, what happens? I don't know. After 18 months, what happens? I don't know. After 24 months, what happens? I don't know. So it's a long-term loan. If it is a floating, means in the future, it may keep on changing. Accordingly, my interest payment will keep on changing. So there is a risk. Is this clear, everyone? So interest rate risk management, interest rate risk, we have understood till now. Yes or no, everyone? Perfect. We have told two different types of loans can be there. Fixed interest rate, floating. Fixed means there is no risk. Floating means there is a risk. When will risk come? Yes, either you are having a loan on a single reset. If you are taking the loan today, there is no risk because your interest rate is locked. But if you are taking a short-term loan in future, you don't know the interest rate, so there is a risk. If you're taking a long-term loan, whenever you take it today or you take it in the future, boss, there is a risk. Okay. Now let us try understanding what is the risk. When will interest rate come into picture? Only for two people. Either you're a borrower or you're an investor. Assume you're a borrower. Yes, what is the fear we are having? We are having a fear of rise in the interest rate. Say, for example, I've borrowed 1,000. Today, the interest rate is 10%. So on 1,000, 10%, 100 I'm paying. Boss, what if it reaches 15%? 150 I should be paying. Yes or no, everyone? So I'm having a fear of increase in the interest rate. Assume I'm an investor. I've invested 1,000 rupees. Yes, today it is giving me 10%. 100 rupees I'm getting. Assume in future I'm getting 5% only. 50 only I'll be getting. So as an investor, the fear is of fall in the interest rates. Is this clear, everyone? Perfect. So we have understood interest rate risk in the most comprehensive way. This is a beautiful chart. You will not be finding it anywhere, but this is what will help you to get a perfect picture on what this chapter is trying to teach. Now I want to manage the risk, interest rate risk management. How do we manage the risk? By using derivative instruments. We are having majorly four instruments. First is a forward, next is future, next is option, next is swap. So in each of these units, unit 1 is forward, unit 2 is future, unit 3 is options, unit 4 is going to be swaps in this particular chapter, my dear students. Next, we are going to have master chart on the position to be taken. To understand one very important thing, students, yes, the most important thing in life is to take the right position concepts. Okay. Now, simple logically we have told, yes, borrower is similar to buyer. Investor is similar to seller. Why, sir? Tell me, buyer is there. What is the fear buyer is having? Buyer is having a fear of increase in the prices. Today I purchased at 100. After 6 months, if it reaches 150, he's having a fear. Borrower is there. Borrower is having a fear of increase in the interest rate. Yes or no? Today the interest rate is 10%. 10% only I'm paying. After 6 months, if it reaches 15%, 15% I'll have to be paying. So both of them are taking a similar position. Both of them are having a similar risk of increase. Perfect. Seller is there. Yes, seller today, he can sell a product at 100 rupees. After 6 months, he's selling. He's having a fear of fall in the price. Boss, after 6 months, what if I'm in a position to sell only at 50 rupees? Yes or no? Investor is there. Investor has invested today, he can earn 10 percentage. He's also having a fear of fall in the interest rate. Boss, what if after 6 months I'm getting 5 percentage only? So both of them are having a fear of fall. Is this clear, everyone? So for this entire chapter, remember that the position a borrower is going to take, it is going to be the position that a buyer is going to take in the derivatives, whatever we have discussed. Is the position an investor is going to take, it is going to be the position that a seller would have taken. Is this clear, everyone? So this is our golden principle. Borrower means buy, investor means sell, except in the case of interest rate futures. In case of interest rate futures, it is going to be reverse of that. Why it is, we will discuss it later on, don't worry. So borrower is there, investor is there. This is a quick snap of all the positions. In case of FRA, borrower is going to go for a buy FRA, investor will be going for a sell FRA. In case of interest rate options, two things we are having. One is interest rate guarantee, next is caps and floors. Yes, always the buyer will be going for a call option, seller will be going for a put option. So borrower will be going for a call option. Yes, in case of caps and floors, call is called as a cap option. Yes, investor will be going for a put option. It is also called as floor. Yes. However, the exception is interest rate future. Interest rate future, we are going to do reverse of that. Yes. Borrower will generally be going for a buy, but here he'll be going for a sell. Investor will generally be going for a sell, but here they'll be going for a buy. Is this clear, everyone? Perfect. The next thing is basic interpretation of interest rate. Yes, interest rates are always assumed to be given on per annum basis unless otherwise specified. Is this clear, everyone? Suppose interest rate given in the question is 10% slash 12%. What does it mean? It means that, boss, if I'm investing, bank will give me 10%. If I'm borrowing, bank will charge 12%. Thereby, bank will be earning a spread, a margin of 2%. And always remember, 1% is equal to 100 basis points. Is this clear, everyone? Now, one more simple example is there. Look at this interpretation. Interest rate is equal to 12%. It means 12% per annum. Interest rate for 3-month borrowing is equal to 12%. It still means interest rate is 12% per annum. But boss, this interest rate is applicable for the 3-month borrowing. If you are borrowing for 3 months, the interest rate is 12% per annum. 6-month LIBOR is equal to 12%. It means interest rate is 12% per annum. But boss, your interest rate will be revised every 6 months. If question specifically tells interest rate is equal to 2% per month, 2% per month, only in that case we'll assume interest rate is 2% per month. Is this clear, everyone? Interest rate is always assumed to be on per annum basis, and whenever we are calculating, our interest rate should also be ultimately on a per annum basis. Is this clear, everyone? With this unit number 0, basics is done. Giving you guys a minute to let this sink in, then we'll go ahead to unit number 1, which is going to be forward rate agreement. Yes, everyone. Now let us go ahead to unit number 1, which is forward rate agreement. This is basically a forward contract on interest rate. Tell me, students, we know what is a forward contract. Yes, boss. Forward contract is a derivative contract which creates obligation for both the parties. That means buyer has to buy, seller has to sell. Later on, they cannot tell boss, I'm not interested. Yes or no, it is going to create an obligation. So this is going to be a forward contract, but on the interest rate. So now understand what is a derivative contract. A transaction is happening in future, but you are locking the interest rate today. Same thing is going to happen. You are borrowing in future or you're investing in future, but boss, you're having a fear. Because of that, you're locking the interest rate today itself. Look at this very simple example, students. Look at this. Okay. Yes. Forward contract. What is FRA? It is a forward contract on interest rate. That is, we are locking the interest rate today for a loan that will start in the future. Now understand, my IRRM chapter can be from the perspective of two people, either a borrower or the investor. But for us, all questions are only from the borrower's perspective. Yes, but we have logically understood, even for investor, we know what to be. Okay, fine, boss. Now, look at this, look at this, look at this. Say, for example, I am telling boss, I want a loan of 100 crore. Crazy, sir. Yes, for 3 months, short-term loan I want. Starting 6 months from now, do I want the loan today? No, boss. I want the loan after 6 months for a period of 3 months. Banker's FRA quote is 9% slash 10%. We need to know how to write the FRA quote, or if FRA quote is given, what is the interpretation? Tell me, I am standing here 0. Do I want the loan today? No, boss. I want the loan for 3 months. 3 months loan I want. When I want? Starting 6 months from now. That is after 6 months I want the loan. Here I'm standing. Yes. After 6 months I want the loan. For how much period I want the loan? For 3 months period. That means tell me when will I be repaying the loan at the end of 9 months? I'll be repaying the loan. Yes or no, everyone? Now, how do we write the FRA code? Tell me when is the loan starting? Sixth month. When is the loan ending? Ninth month. So I will write it as 6 by 9 FRA is equal to what is the interest rate? 9% slash 10%. Now understand what is the interpretation of FRA. Every word is telling a story. 6 by 9 FRA. Loan is starting at the end of sixth month. Loan is ending at the end of ninth month. That means it is going to be a 3 month loan. Yes. What is the 9% interest rate? Always the lower interest rate is for investment. Boss, if I'm investing after 6 months for a period of 3 months, na, yes, banker is giving me 9%. If I am borrowing, na, I should be paying 10%. Is this clear, everyone? Perfect. So look at this. Two different FRA codes are given here. Look at this, everyone. I've written it here. 6 by 12 FRA is equal to 10% slash 12%. 6 by 12 FRA. That means tell me, I'm standing today. When am I taking a loan? Sixth month. Yes. When am I repaying it? 12th month. That means tell me it is a how much month loan? It is going to be a 6 month loan. Yes or no, everyone? So loan is going to start at the end of sixth month. Yes. Loan is going to end at the end of 12th month. So basically it is going to be a 6 month loan. 10% slash 12 percentage. If I'm investing, I will get 10%. If I'm borrowing, I'll have to be paying 12%. Now, one more quote can be there. If question is giving me 2v3 FRA, this means it is in terms of years. That is basically I am borrowing at the end of 2 years. Yes, I am returning at the end of 3 years. That means it is basically a 1 year loan. Is this clear, everyone? This is how my FRA quote will be given. Is this clear, everyone? Perfect. Now, all calculations on FRA, we have simplified and we have brought it into two different types of questions that can be there. Look at this, students. Types of questions that can be there on FRA. Yes, from understanding the concepts. Yes, all questions from study material, past paper, RTP, MTP. Two category of questions can be there. Type 1 question is asking, calculate the effective interest rate on FRA. Type 2 question is asking, tell me the final settlement amount on FRA. How do we do each of these calculations? Now, whatever be the question, step number 1 is going to be, we will be calculating the gain or loss percentage. Now, there is a formula for each of that. We are not going to discuss the formula. Yes, logically, quickly, let us try understanding. Firstly, we will be calculating gain or loss percentage. For that, I have designed a unique approach called the FRA box approach. Very simple, crazy simple, my dear students. People who are watching it on YouTube, if you love it, means tell crazy approach it is. Is this clear, everyone? Now look at this. I have given you guys a simple example. FRA is essentially locking my interest. Yes or no, everyone? Simple. Look at this. Yes. Legend wants to borrow 1,000 rupees at the end of 6 months for a period of 6 months. Tell me, end of 6 months I want to borrow for a period of 6 months. That means I'll be repaying at the end of 12 months. Yes or no? So it is going to be a 6 by 12 FRA. Okay, crazy. Accordingly, he entered into a 6 by 12 FRA at 10 percentage. We have locked our interest rate at 10 percentage. Now, after 6 months, whatever may happen, how much ultimately I will be paying? 10 percentage only I will be paying. Yes or no, everyone? Perfect. Calculate gain or loss percentage if the actual rate turns out to be as follows. Now, first for a minute, let us try understanding the psychology. I am standing here at 0th period. I want to take a loan after 6 months. Tell me if I'm taking a loan today, a short-term loan today. Yes, even if the loan is at floating rate, I do not have a fear because today itself I'll be knowing the interest. Boss, I'm taking a loan after 6 months. I don't know. I'm having a fear. What if the interest rate goes up, boss? So in order to protect myself, what do? I take an FRA. Is this clear? Yes. For how much period I want a loan? 6 months. That means I'll be repaying at the end of 12 months. I go to bank. Banker will tell me, boss, don't worry. Whatever may happen in the future, interest rate increases, decreases, whatever may happen, I am giving you a promise. My promise is ultimate. Yes or no? The Bahubali they have given. Yes, this is my Vachan is Shasan. Some nonsense dialogue was there. Yes or no, everyone? Yes, I've translated to English. 10 percentage means we are locking it at 10 percentage. Whatever may happen in the future, you pay 10 percentage. Okay, boss. Now tell me. Yes, if the actual rate is 12 percentage. Now understand FRA is always cash settled. We will not give me a loan at 10 percentage, but whatever is a gain or loss, we will be settling. Tell me, students, FRA has given me a promise that my interest rate is going to be how much only? 10 percentage only. At the end of 6 months, say I go to a bank, I want to borrow. What is the actual LIBOR? What is the actual reference rate? 12%. Banker doesn't know about the FRA. He's telling, boss, you want a loan from me, you pay 12 percentage. So what I will be doing, I will be paying 12 percentage. But boss, I have a promise, I have an FRA. It can be either with the same bank or it can be with another bank. So many things we've discussed in regular batch. Yes, what is my FRA telling? Boss, essentially you will be incurring 10 percentage. That means tell me I have paid 12 percentage. That means because of FRA contract, what I will be doing? I will be receiving 2 percentage. That means it is my gain on FRA. Simple. Yes, I know that if I am paying, I will show it as cash outflow. I will show an outward direction. If I am receiving, I will show an inward arrow, which means it is going to be cash inflow gain. Yes or no, everyone? So in this case, tell me, I will be having a 2% gain because of FRA. Situation 2, if the actual interest rate is 8 percentage only, perfect. Tell me FRA has locked my interest at 10 percentage. So after 6 months, whatever may happen, my interest is going to be 10 percentage only. Tell me the actual interest rate is how much? 8% only. So to the bank, I'm paying 8 percentage only. I am very happy. Maja is coming. No, boss, Maja is not coming. Why? FRA person will come to me. Later, boss, I made a promise. Whatever may happen, your interest rate is 10 percentage. Yes, you paid 8 percentage, no? 2 percentage you paid to me. So 2 percentage I am paying to the FRA person. It is my loss on FRA. Is this clear, everyone? Third situation, interest rate is 10 percentage only. So tell me, to the bank I have paid 10%. Do I need to pay anything extra? Will I be receiving anything? No. Is there profit? Is there loss? No. 0 percentage is going to be my profit or loss. Simple. FRA is locking. I will write down the FRA rate. Yes, whatever I'm paying, I will show it here. Whatever, if I'm receiving means it is gain. If I'm paying means it is going to be loss. As simple as that. Assume the actual interest rate is 15%. FRA has locked at 10%. Actually, if I pay 15 percentage means no issues. I will be receiving 5 percentage. It is going to be my gain on FRA. Is this clear, everyone? Similar lines we can be doing for investment also. Investment, just a single example, I'll be showing it to you guys. Look at this. I want to invest 1000 rupee. FRA is 10%. Assume the actual return is 12%. Tell me, in FRA, I have promised, we have locked that 10% return I will be receiving. I am an investor. Tell me the actual return is how much? 12%. So from the bank, actually I am receiving 12%. But can I do balle balle, magic is coming, Maja is coming? No, boss. We have locked our investment rate at 10 percentage. 12% I receive means full 12 is not mine. 2 percentage I should be paying. It is my loss on FRA. But if the actual rate is 10 percentage only, FRA has promised I will be receiving 10 percentage. Investor will receive. So from bank I will receive 8%. That means from FRA I will receive 2%. It is going to be negative. Yes or no, everyone? There are so many formulas people do by heart and keep simplest thing in the world, boss. Yes or no, everyone? Okay. Now, once we have calculated gain or loss percentage, the second step we will be doing is we will calculate the gain or loss on FRA in terms of rupees. How do we calculate? Simple, boss. Always know that this gain or loss percentage is per annum because I'm doing it on the interest rate. Interest rate was 8%, interest rate is 10%, so difference is 2% per annum. So how I will do is FRA is entered on a notional principle. So I will do it as notional principle into gain or loss percentage. It is a percentage per annum. Yes, my FRA is going to be for a specific period multiplied by T, where T is the loan tenure in terms of years. So look at this, students. If we come to a simple example, pay attention. Example number 3. Yes, Kabir Singh wants to borrow 1 lakh rupees for a period of 6 months in the coming 3 months time from now. Tell me. After 3 months, he want to borrow for 6 months. It means he will be repaying at the end of 9 months. He is going to enter into a 3 by 9 FRA. Because we have locked our interest at 8.5%. So whatever may happen, I will end up paying 8.5 percentage only. Perfect, boss. Now calculate the effective interest rate. All these things are there. Okay, first one is if the actual interest rate is 10 percentage. Tell me what is the promise we have made. Boss, 8.5 percentage only I'm going to pay. Tell me, if in case I actually pay 10 percentage to the bank, will I sit and cry? No, boss. I will be receiving 1.5 percentage gain from FRA. Step number 1, gain from FRA is 1.5 percentage. Step number 2, what is the total gain? Tell me what is the borrowing amount? 1 lakh. On 1 lakh, how much percent gain I made? 1.5%. But boss, 1.5 percentage is per annum, na boss. Tell me for how much period I am taking a loan? 6 months only. So my gain is going to be into 6 by 12. I will arrive at the gain. I guess it is going to be 750, something like that. Yes or no, everyone? This is my gain on FRA in terms of rupees. Till here, is this clear? Okay, perfect. Now let us take the discussion forward. Now, yes, in case of type 1 question, what is type 1 question asking? Calculate effective interest rate in FRA. Now, first two steps are going to be same only. Calculate gain or loss percentage. Step 2, yes, calculate gain or loss in terms of rupees. Step 3, if question is asking, tell me the effective interest rate. Simple boss, I know to the banker, I will be paying the actual interest. Yes, actual interest cost. It is nothing but my principal amount into the actual rate into the time, that is the loan duration. Yes or no, everyone? Imagine we are a borrower. All questions will be from borrower's perspective only. Interest I am paying. What kind of cash flow it is? It is a cash outflow. I will write it. Is this clear? This is one transaction. Boss, if it was a normal transaction, only this much would be there. But boss, in order to protect myself, what we did? We took an FRA. In FRA, I am having a gain or loss. So I will adjust that as well, gain or loss on FRA. Tell me if I'm having gain on FRA, it is going to be cash inflow. I will be reducing it. If it is a loss on FRA, it is going to be cash outflow. I will be adding it. Yes, no need to buy halt and keep. Yes or no, everyone? Simple logic. Yes, that gives me the total interest cost. Now, yes, I want to understand the effective interest rate. So I will convert it into percentage. First, I will calculate this interest is how much percentage of the loan. Is interest divided by loan. I will get the interest percentage. Know that it is for the loan period. Suppose I have borrowed for 6 months, it is for 6 months. Then I will be converting it into per annum basis. Yes, effective interest rate per annum. Now, if you want, there is a big formula for that, but there is no need for us. Step by step, if you do, it is going to be very simple. And a simple check for us to ensure if you have done the calculation correct or not. I have taken an FRA. FRA is locking my interest. Suppose my FRA is 10%, means in the end, my effective interest rate per annum is always going to be 10%. Is this clear, everyone? So look at this example, pay attention in the workbook. Same example of Kabir Singh. Yes, 1 lakh we are going to borrow for a period of 6 months. After 3 months, tell me we entered into FRA and locked ourselves at 8.5%. Tell me we've calculated that we are having a gain on FRA of 750 rupees. Yes or no, everyone? 750 is going to be the gain on FRA that we'll be receiving. Tell me in reality how much interest we are going to pay. Look at the students quickly. Let me try doing the calculation. In FRA, I locked myself at 8.5%. Perfect. Firstly, from the banker, what is the actual interest rate that is happening? 10% is happening. So I'll tell, okay, boss. In reality, to the banker, I should pay 10%. 1 lakh into 10%. I have borrowed for 6 months into 6 by 12. It is going to be how much? 5,000 is my cash outflow. Tell me, boss. Here I am having a gain on FRA. Yes or no? Yes, I am paying 10% to banker. But FRA person had promised me you will be paying 8.5% only. So 1.5 percentage is my gain. Tell me on 1 lakh into 1.5 percentage into 6 by 12, how much is going to be the gain? 750 is going to be my gain. So when I'm calculating effective interest, I will tell 5,000 I paid, 750 I received. Look at this, everyone. 5,000 I paid, 750 I received. That means my net cost is 4,250. 4,250 is my cost on how much? On 1 lakh. So 4,250 divided by 1 lakh gives me the interest rate. It is 4.25%. Tell me I have borrowed for 6 months. So this is my cost for 6 months. Yes or no, everyone? And we have told that always we will be writing our interest rate on per annum basis. Convert into per annum. For 6 months, if it is 4.25 means for 12 months, it is how much? It is going to be 8.5% per annum. My FRA is 8.5 percentage per annum. Is this clear, everyone? With this, type 1 question is Dandana. Giving you guys a minute. After that, we will complete type 2 question. Yes, there also step 1 and step 2 is same. Just that step 3 is going to be slightly different. Yes, everyone. Now look at type 2 question, which is a final settlement in FRA. Yes, this is more likely asked. More often is this requirement which is asked. Even if this is asked, it is going to be very simple as well. Step 1, calculate gain or loss percentage, if you know. Step 2, calculate gain or loss in terms of rupees. That also we know. Now, step 3 is calculation of final settlement amount. Always remember that, yes, final settlement amount is nothing but it is present value of gain or loss. I've calculated gain or loss. Now, it is the present value of that discounted for the loan duration. Let us try understanding through this example only. Kabir Singh example was there. Yes, he has taken an FRA at 8.5%. So FRA party has promised, boss, your interest rate is going to be 8.5% only. Don't worry. Tell me the actual interest rate is going to be 10%. So yes, interest rate has increased by 1.5%. So the FRA party will pay him 1.5%. Now understand, students. Here we pictorially we've done. Tell me, third month Kabir Singh is taking a loan. When is he actually paying interest? Is he paying on third month? No, boss. He will be paying at the end of the loan tenure. Yes, at the end of ninth month, he is going to pay. Yes or no, everyone? Yes, third month we have taken a loan. Ninth month I'll be repaying. When I'm repaying in ninth month, now that time I'm actually paying 10 percentage interest. Yes or no? So ideally, yes, the FRA party has to pay Kabir Singh 1.5% gain. But when it has to be paying, yes, ninth month, because he's actually paying interest in ninth month. Yes or no? So accordingly, I understood how much is the gain amount. We got that the gain amount is 750. So imagine, I am the FRA party. I am telling him, boss, I will give you your gain of 750. But yes, when I will pay you at the end of ninth month. Is this clear, everyone? But he is telling, boss, today itself we got to know. Yes, third month, Kabir Singh is taking a loan. Today's LIBOR is what we'll be taking. Today I got to know that my interest rate is 10 percentage. That means today itself I got to know that at the end of 9 months, am I having a profit or loss? So why do we extend it till ninth month? Today itself, make the net settlement and finish up the story. Okay, we tell, okay, boss, we will pay. Tell me, will I be paying 750 rupees today? No, boss, 750 I'll be paying at the end of ninth month. Na. Today I will only be paying the present value of that. Yes or no, everyone? So 750 I should bring it to present value. How many months I should pull it back? 6 months I should pull it back. So I will discount it for 6 months. Yes or no, everyone? And which rate I will be using to discount it? Boss, today what is the rate? Boss, today is loan or investment is available at 10 percentage. That means today I will discount the cash flows at 10 percentage. Is this clear? So I will do 750s at the end of ninth month. I am coming back 6 months. So divided by 1 plus interest rate is 10 percentage into 6 by 12. I will arrive at a value of 714.28. Okay. Now what Kabir Singh can do is, today third month it is there. He can take 7 on 4.28, go to the bank. He can invest. Tell me today, if he is investing in reality, what is the interest rate? 10%. So he'll be getting 10%. But boss, he's investing only for 6 months. That means he'll be getting effectively 5 percentage. 7 on 4.28 plus 5 percentage. He'll be getting 750 at the end of 9. Is this clear, everyone? Logically, also quickly I've explained, but understand. Step 1, calculate gain or loss percentage. Step 2, calculate gain or loss in terms of rupees. Step 3, bring it to present value, from where this gain or loss will be on the last day, that is loan repayment day. From there to the loan start day, you discount it. Which rate I will be using to discount? The actual interest rate I will be using to discount. Is this clear, everyone? Simple. So it is going to be gain or loss divided by 1 plus actual rate into T. T is the loan tenure in terms of years. I am going to discount at actual rate prevailing on the settlement date, which is the date of taking the loan. Assume there is a 6 by 12 FRA, means this is my settlement date. On this date, I will get to know what is the actual rate. On this date, I am taking a loan. On this date only, I will be calculating the present value settlement. Is this clear? My gain will be for this amount, so I will bring it back for this bit. Is this clear, everyone? So with this unit number 1, FRA is done. This was basically concept 1, FRA for hedging. There is something else called as concept 2, FRA for arbitrage, which is not important for exam perspective, but in the regular batch we have covered that as well. Is this clear, everyone? Now with this, one more additional adjustment was there when we were solving a question. Crazy Maja adjustment. If the actual rate is not given, but the net settlement amount is given. In one of the question, I guess question number 4, net settlement amount was given to us, but the actual rate of interest was not given. Whatever is not available, we will assume it as X. So we'll be assuming the actual interest rate as X, and accordingly we'll be solving the question, my dear students. Is this clear, everyone? So accordingly, you guys can have a look at the question bank. Yes, in the question bank, question 1, study material, simple question. Yes, question 1, 8 marks it is coming. They're just asking 2 interest rates. Yes or no, everyone? Question 2, question 3 is also going to be very simple. Yes, question 4 was that beautiful question which had come for 6 marks in the examination. Yes, we have solved that. Again, I'm quickly telling, look at this, everyone. We want to borrow 100 crore for a period of 3 months in the coming 6 months from now. That means after 6 months, I am going to borrow for 3 months. That means I'll be repaying at the end of 9th month. So we will be entering into a 6 by 9 FRA. Yes, the interest is locked at 8.2 percentage. Perfect. First one is you're required to calculate due to FRA the actual interest rate. What is the actual interest rate? If banker pays to XY Limited an amount of 9,78,952. Tell me, banker is paying to me. Banker is paying to me. That means I am receiving. That means tell me, because of FRA, am I having a loss? Am I having a gain? I am having a gain. That is why I am receiving an amount. Yes or no, everyone? Perfect. I'm having a gain. I don't know my actual interest rate. I will assume it as X%. Tell me, how do I calculate gain? Yes, if you are not getting a field, take a random number. Assume FRA is 8.2%. Yes or no, everyone? Assume the actual interest rate is say 10%. That means actually on the loan I'm paying 10%. Yes, that means can I calculate how much is my gain on FRA? It is a 10 minus 8.2. It is 1.8 percentage. Yes or no, everyone? Perfect. In this case, do I know the actual interest rate? I don't know. So let me take it as X. So the gain is going to be X minus 8.2 percentage. Is this clear, everyone? So accordingly, I will do all the calculations. So look at this. My gain percentage is X minus 8.2%. Either you can write it as 8.2% specifically, or it is always better convert it into decimals. Yes, 8.2% is 8.2 divided by 100, which is 0.08. So accordingly, I calculate the total gain on FRA. It is 100 crore is a loan amount into gain is X minus 8.2% into the gain is going to be for 3 months into 3 by 12. I will simplify. I will get it as 25 crore into X minus 8.2 percentage. Settlement amount, it is the present value of the gain. It is going to be a loan of 3 months. So I will come back by 3 months. Tell me, I will discount at the actual rate. That only I don't know. I am taking it as X. So I will take it is 25 into X minus 8.2% divided by 1 plus X into 3 by 12. I know the settlement amount. I will simplify. I will accordingly arrive at the value of X as 8.6%. Is this clear, everyone? On the other hand, I have the other situation as well. If the actual interest rate, calculate the actual interest rate. If XY Limited will pay to the banker 9,80,000. Yes, we are paying to the banker. Are we happy or sad? Sad. I incur the profit or loss. Loss on FRA. Yes or no, everyone? Tell me, how will my loss on FRA look like? Simple. In FRA, I have locked myself at 8.2 percentage. Imagine the actual rate of interest is 7% only. So for the bank, I'm paying 7% only. Perfect. But still tell me, will I be incurring 7% only? No, boss. We have locked our interest at 8.2%. So to the FRA party, I'll be paying 1.2%. How did I calculate? It is 8.2 minus 7%. Yes or no? Do I know the actual interest? No, boss. This is X. So it is 8.2 minus X percentage. 8.2 percentage minus X percentage is the loss. Accordingly, I will calculate the total loss 100 crore into 8.2% minus X. Yes, into 3 by 12. I will bring it to present value. Accordingly, I will be getting the answer. Is this clear, everyone? With this, unit number 1, which is going to be forward rate agreement, is done. Giving you guys a minute, then we'll go ahead to unit number 2, which is going to be interest rate futures. Yes, everyone. Now let us proceed to unit number 2, which is going to be interest rate futures. In interest rate futures, we are having two main concepts. One is interest rate future having a zero coupon bond as its underlying. One more is IRF having coupon bearing bond as its underlying. Coupon bearing bond is not important, so we'll not be covering this in the revision. Yes, zero coupon bond as underlying is what we'll be revising here. Yes, everyone. So now let us have a look at IRF having zero coupon bond as its underlying. The first point we discussed is price of an IRF, which is having zero coupon bond as its underlying. We have told price of an IRF is very simple. It is 100 minus interest rate prevailing on that particular date. Simple example, students. Imagine we are having an IRF on a zero coupon bond. Zero coupon bond will not be paying any interest. Then how will investor be getting the return? Because they will be issued at a discount and redeemed at par. Say for example, interest rate prevailing is 10%. Otherwise, a normal life, what will happen? Say for example, yes, borrower has taken 100 rupee means on that 10%, 10 rupees interest they'll be paying, they will be repaying 110 rupees. Yes or no, everyone? But in case of zero coupon bond, what will happen? Yes, we are telling boss 100 rupees. How much is the interest? 10% only. We want to ensure that we will issue the bond in such a way that my investor will still be getting 10 rupees. That means how much money only we will raise from our investor? 100 minus 10, 90. So we will raise 90 rupees from our investor and ensure that on maturity, when we are paying, we will pay 100 rupees. So that is inherently in the form of capital gain, he is getting that 10 rupees interest. Is this clear, everyone? So what is going to be price of an IRF? It is 100 minus the interest rate prevailing on that particular day. Is this clear, everyone? Suppose interest rate is 5% means 100 minus 595, 8% means 100 minus 892, interest rate is 10% means 100 minus 10, 9. Is this clear, everyone? One simple example I had told to you guys. Say for example, Koti is there, Koti's girlfriend is there. She has prepared like crazy for a dance competition. Koti knows she is going to win the dance competition. There are two teams, team A, team B. Yes, Koti's girlfriend is in team A. Koti knows that team A is going to win the competition. He wants to do a betting. So he ideally wants to bet that team A will win the competition. But he went for the betting counter. Nobody is betting for team A. People are betting for team B only. That is, you can either tell team B is winning or you can tell team B is losing. So what is it Koti will be telling? Koti can't bet for team A. Koti can bet for team B. Tell me if team A will win means team B should lose. So Koti will bet that team B will lose. Is this clear, everyone? India, Pakistan, you want to bet that India will win, but there is no betting happening on India. Betting is happening only on Pakistan. If India will win means Pakistan should lose. So you will bet that Pakistan will lose. Is this clear, everyone? Now the most important thing is futures are traded on the exchange. In the stock exchange, interest rates are not traded. Only the prices are traded. Is this clear, everyone? Perfect. So I cannot be doing a betting or a hedging on the interest rate directly. But boss, I know that the price of my IRF changes based on the change in the interest rate. Tell me if my interest rate increases, the price of the ARF decreases, yes or no, everyone? And tell me, yes, generally we've told borrower is having a fear of increase in the interest rate. So generally, what position borrower wants to be taking? A buy position. But tell me, can he be hedging on the interest rate? No, boss, it is not traded. What is traded? Only the price of the bond. If my interest rate increases, what will happen to price of the bond? Decreases. So he'll be going for a downward position, which is going to be a sell position. That is why we are getting into a sell IRF. Is this clear, everyone? Quickly, I have told. Otherwise, very simple for us. Yes, we have remembered the golden principle. Borrower means buy, investor means sell, except in the case of IRF. That means in IRF, we are going to take a reverse position. Is this clear, everyone? Okay, position is also clear. Now, what are the steps we should be taking to solve the question? Now, look at this, students. We are having a beautiful example here. Okay, look at this. Let us try understanding through this example only. Where did it go? Just a minute. Yes, everyone. Now, the most important point, what all we have understood. Point number one, we understood price of IRF. It is 100 minus interest rate on that debt. Position to be taken. Borrower will generally be taking a buy, but was here he'll be taking a sell position. Okay. Now, the most important thing we need to understand is the total value of futures and the number of contracts. For that, there is a big formula, but we will not be going for that formula. Logically, we'll understand. Simple, boss. Yes, item wants to borrow 1,000 rupees after 3 months for a period of 6 months. So tell me, after 3 months, I want to borrow. For how much period I want to borrow? 6 months. That means when am I repaying? At the end of 9 months. So it is basically a 6 month loan. So I am having a fear that the interest rate will increase because I'm not borrowing today, na boss. For how much months I am having a risk? 6 months I'm having a risk. Okay, boss. Perfect. He is afraid of increase in interest rate. 3 month future contract maturing in a period of 3 months is quoted at 90 rupees. Tell me if my interest rate future is quoted at 90. What does it mean? It means my interest rate is 10%. Yes, price of IRF, it is 100 minus interest rate. So if it is 90 means interest rate is going to be 10%. This is what is being told. Yes or no, everyone? Every future contract is for 200 rupees. Tell me, students, there is the interest rate future available that will protect my head risk. Yes or no, everyone? But tell me, my interest rate future is available for how many months only? 3 months only. Yes or no, everyone? 3 month future contract is available, which is maturing in 3 months. That means basically after 3 months it will start. It will protect my risk for 3 months. Is this clear? But tell me, my risk is for how much months? 6 months. So tell me, otherwise, my loan amount is how much? Loan amount is going to be 1,000 rupees. Yes, ideally, I would tell boss if your loan amount is 1,000, for how much amount I should be taking a future? Take a future for 1,000 rupees. Yes or no? But here, boss, understand Yes, my loan is 1000, but my risk is for 6 months. For 6 months, I am having a risk of 1000 rupees. But my future is protecting me for how much months only? 3 months only. That means if I have to protect myself fully, my risk is for 6 months. This is protecting me for 3 months only. I should take double the exposure, yes or no? So the total value of future should be how much? It should be 1000 into 2, which should be 2000. Yes or no, everyone? This is the total value of future. If you want it in the form of a formula, yes, it is going to be the loan amount. 1000 is the loan amount into, yes, the loan duration. That gives you the weighted average risk. Was 1000 rupee risk I am having for 6 months. Yes or no, everyone? Tell me, future is protecting my risk for how much months only? 3 months divided by future's duration. That gives me the total value of future. 1000 into 6 by 3. This is the multiplier. It tells me that 2 times exposure I should be taking. That means total 2000 should be the value of futures. Yes or no, everyone? Perfect. Tell me, every future contract is for 200 rupees. Which means, can I calculate the number of contracts? Was total value of future is 2000 divided by 200. That means I should be going for 10 future contracts. Yes or no, everyone? Look at this summary. Yes, steps to be taken. Step 1, determine the position to be taken. Tell me, generally borrower will be going for which position? Buy. This is exception, so he'll be going for sell IRF. Yes. Step number 2, calculate the total value of future. It is going to be loan amount only. But was my loan duration is different, future duration is different. So I'll be doing the adjustment of that into the loan duration divided by future contract. It gives me the total value of future. Next, step number 3, calculate the number of contracts. It is total value of futures divided by contract size. Yes or no, everyone? Then we will calculate profit or loss on IRF. How do I calculate profit or loss on anything in the world? See the original position, take a reverse position. Yes or no, everyone? Here, yes, original position was say sell IRF. That means reverse position is going to be buy IRF. So I'll be calculating the price of IRF on that particular day. I will arrive at the profit or loss percent per annum. Is this clear, everyone? Yes. Price of IRF is nothing but 100 minus interest rate. Based on that, I will calculate the profit or loss on IRF in terms of rupees. How do I calculate? Boss, what is the total exposure in IRF? It is a total value of futures into the gain or loss percentage. Boss, this is gain or loss is always on per annum basis. Percentage is always on per annum basis. I want it for the future contract into T, where T refers to the period of future contract. Is this clear, everyone? And then we will be having the final step, which is calculation of net interest cost. Let us do one thing. We will go to a workbook. This example, let us try see. Pay attention, students. Mr. Mandus wants to borrow 1 lakh rupees after 3 months for a period of 6 months. So tell me, what is the timeline looking like? After 3 months, we'll be borrowing for a period of 6 months. So that means loan I will be repaying at the end of 9th month. 6 months is a loan. Crazy. He's afraid of increasing interest rate. Okay. 3 month 10,000 rupee future contract is available, which is maturing in a period of 3 months. 3 month future contract it is. And tell me, what is a contract size? 10,000 rupees is a contract size. So tell me, future contract is giving me protection only for 3 months. My risk is for 6 months. So I'll have to be taking 2 times the exposure. Tell me, my loan amount is 1 lakh. So I'll be taking a total value of future, which is of 2 lakh. Simple. So look at the steps, students. Now, 3 month future contract is quoted at 90 rupees. You are required to advise position to be taken. Demonstrate how 3 month future contract is useful if later on interest rate turns out to be 13%. Simple. Step 1, position to be taken. Tell me, borrower will generally be taking a which position? Buy. But boss, this is exception, so he'll be going for a sell IRF. Step number 1 is over. Yes. Step number 2, I will calculate total value of future. I have logically told you it is going to be 2 lakh rupees. Yes or no? My risk is for 6 months, but future is protecting only for 3 months. That means I'll be taking 2 times the exposure. Loan is 1 lakh, so I'll be taking a total value of 2 lakh. Then comes the number of contracts. Step number 3. Yes, 2 lakh is the total value of future. Every contract is for 10,000 rupees. That means I'll be taking 20 contracts. Till here it is clear. Okay. Then comes step number 4. Here we'll be calculating gain or loss on IRS. First, I will calculate gain or loss percentage. Tell me, students, what is the original position I have taken on IRF? Sell IRF. On that day, what was the interest rate? Yes, 10 percentage. That means price of IRF was 100 minus 10, 90. This is clear, everyone. Now, on the day of settlement, what is the actual interest rate 13%. So if my interest rate is 13%, how much is the price of IRF? It is 100 minus interest rate, 100 minus 13. It is going to be 87. Yes or no? I am going to take a reverse position. Original was sell. That means this is going to be buy. So tell me, I sold at 90. I am buying at 87. That means I am having a gain. Yes or no? So I am having a gain on IRF, which is 3. Now remember, understand students, all these are just percentages. This is a revision, so not telling much in detail. Yes, the gain or loss I'm going to get is always the gain or loss percent per annum. Basically, essentially here what I did, I just saw the change in the interest rate. Simple, boss. Tell me, originally my interest rate was 10 percentage. Today the interest rate is 13 percentage. Tell me, I am a borrower. Yes or no? If I had not hedged myself, that means today if I am taking a loan, I should have paid 13% interest. But boss, I hedged myself using IRF. That means because of IRF, I will be paying 10 percentage only. That means tell me how much gain I got. 3 percentage gain I got. The same thing we are doing in a different way. But because institute is doing the calculation this way, we are having stepwise marks this way, we are also going to do it this way. Is this clear, everyone? Perfect. So my gain is going to be 3% per annum. Now I will calculate the total gain. Tell me, students, what is the total value of futures? 2 lakh. How much is the gain? 3% per annum. Now this is a gain on futures. Future is for how many months? 3 months. Into 3 by 12 gives me the gain on future, which is going to be 1500. This is one area wherein most students commit mistake. Do not take the loan duration. This is a gain on futures. So take the duration of future contract only. So I will be ending up with a gain of 1500. Is this clear? Then we have the last step, which is calculation of net interest cost. Tell me, in reality, I've taken a loan from the bank. There I'll be paying actual interest only. Tell me what is the loan amount. Do not complicate. Loan amount is 1 lakh. Loan interest is 13%. Loan is for 6 months into 6 by 12. My actual interest is 6,500. But tell me, because of entering into IRF, I got a gain. How much was my gain? 1,500 is my gain. That means what is my net cost? 6,500 I paid. 1,500 I received it back. That means my net cost is 5,000. Can I calculate the interest rate percentage? Yes, boss. My interest is 5,000 on a loan of 1 lakh, which means it is 5 percentage for how many months? For 6 months. I will always be converting my interest rate into per annum basis. So 5% for 6 months means 10% per annum. Is this clear, everyone? Always remember, in case of IRF, ultimately my effective interest rate per annum, it is going to be the interest rate on the date of entering into IRF. So I am freezing my interest rate at that particular rate. Is this clear, everyone? Now look at the steps again one final time. Look at the students. Step 1, position. Generally, borrower will be going for a buy, but this is exception, so he will be going for sell IRF. Okay. Total value of future. It is going to be loan amount into the loan duration divided by duration of futures contract. Step 3, calculate the number of contracts, which is total value of futures divided by contract size. Then calculate profit or loss on IRF. First, I will calculate profit or loss percentage. What is the original position? What is the reversal position? Yes, how do I calculate price of IRF? It is 100 minus the interest rate. I will arrive at the profit or loss. Remember, this is a profit or loss percent per annum. Yes or no, everyone? Then I will calculate the total profit or loss. How do I do it? Simple. It is the total value of futures into profit or loss percentage into. Always remember, I am calculating here profit on futures. So take the duration of futures. Is this clear? Final step, calculate net interest cost. Show the actual interest that you are paying on loan. Yes, loan amount into actual rate into the loan duration. Is this clear? Plus or minus profit or loss on IRF gives me the net interest cost. Convert it into percentage terms. Remember, your net interest percentage per annum is always going to be the interest rate on the date you have taken IRF. So it is basically you're locking your exposure. Is this clear, everyone? So with this, my IRF is also done. We are having question number 5. Very simple question. You guys can try it by yourselves. With this, unit number 2 is also done. Giving you guys a minute. After that, we'll go ahead to unit number 3, my dear warriors. Yes, everyone. So now let us proceed to unit number 3, which is going to be interest rate options. That is, I am trying to manage my interest rate risk by using option contract. Tell me what is an option contract? We've learned it already. Boss, it gives holder the right, but not obligation. That is, you have a choice, you have an option. If it is beneficial, you will exercise. Otherwise, you will not be exercising it. Yes or no, everyone? Perfect. We are having two different types of options primarily. Yes, one is the call option. Buyer will be going for a call option. One is a put option. Seller will be going for a put option. Yes or no, everyone? So always remember, tell me my borrower is equal to buyer. That means my borrower will always be going for a call option. Investor will always be going for a put option. Yes. Now look at this, students. Simple example we have cooked it is in case of should we exercise or not. Imagine I am a borrower. I am having a call option at a strike rate of 8%. That means if my interest rate goes above 8%, na, I have an option to exercise and pay 8%. Assume the actual interest rate is 10%. So that means if I'm borrowing from the bank, I have to pay 10%. What will I do? I will exercise my option and pay 8% only. I know that all my derivative contracts are cash settled. It means to the bank, I will be paying 10%, but from the insurance company, I will receive 2% payoff. In this case, I will be exercising, receive a payoff of 2%, yes or no. But assume the actual interest rate is 5% only. Yes, I will take a loan at 5%. Will I receive any compensation from the insurance company? No, it is going to be zero. Simple as good as call. The way we used to be writing, I can directly write it as call 8%. In this case, it is going. That means my gross PF is 2. In this case, it is not going. So my gross PF is 0. Investor will be going for a put option. Investor is having a fear of fall in the interest rate. So put option gives him a guarantee that bare minimum this much at least you will be receiving. Assume we are having a put option at 8%. That means bare minimum insurance company is promising you at least 8% you will receive. Tell me, assume if the actual interest rate is 10%. You are receiving 10% income on your investment. Yes. Will you like to exercise your option in this case? No, boss. Will you receive any compensation from insurance company? No, boss. But assume in reality you are getting 5% only. You will go to insurance company and tell, boss, you promised me 8% I will be receiving. Boss, from here I got 5% only. So give me my balance 3%. In this case, we will exercise and receive the 3%. Is this clear? Put option it is. If it goes below 8% means we will exercise. Here we will not exercise, it is 0. Here we will exercise, that means we will be getting 3%. Yes or no, everyone? Basics are over. Now understand, we are having two different terms. One is an interest rate guarantee. One more is caps and collars. What is it? 99% students don't know at all. Let us now try cracking it in the simplest way possible. Simple, boss. If you are going for a short-term loan, wherein basically you are having only a single rate set, yes, whatever is your call or put option is called as the interest rate guarantee. Suppose you are having a long-term loan, wherein there are multiple reset dates. So on every reset date, you will have to keep on exercising or rejecting your option. Is for that we will be calling caps and floors. Basically, cap is a series of call option. Floor is a series of put option. Is this clear, everyone? So first, let us try seeing interest rate guarantee. What is it? It is used for a short-term loan. Is this clear, everyone? Okay. I know that if I'm a borrower, I'll be going for call option. If I'm an investor, I'll be going for put option. Simple, directly using an example. Let us try understanding. Okay, this item wants to borrow 1 lakh after 2 years for a period of 1 year. Means after 2 year, I want to borrow for a period of 1 year. That means I'll be repaying at the end of third year. Crazy. Yes, Maja Bank has offered interest rate guarantee at 8%. Oh, Maja Bank is telling boss, above 8% in any case you will not be paying. That is my guarantee. Tell me whether insurance company will give insurance for free. No, boss. They will be asking for a premium. Yes or no, everyone? At a premium of 0.5% of loan amount. They're telling, boss, you first pay 0.5%. I will give you a guarantee. In any case, your interest will not exceed 8%. Okay. Calculate total interest payable if situation 1, interest turns out to be 12%. Simple. Tell me, students. My loan amount is going to be how much? 1 lakh rupees. Upfront, I will be paying a premium of how much? 0.5%. First, I'm paying a premium. 1 lakh into 0.5%. How much is it? 500 rupees. It is my cash outflow. Tell me, in reality, the interest is 12%. So tell me, from the bank, I have borrowed. This is a bank. This is an insurance company. Yes, always all derivative contracts are cash settled. Yes or no? This transaction is separate. Here only profit or loss settlement will happen. From the bank, I am borrowing. Banker is saying, boss, I don't care whether you have an option or not. You pay me the interest. Yes or no? Whatever is your option, whatever is there, you settle it. Is this clear? So tell me what is the actual interest rate? 12%. So here how much I should be paying? 12% interest. So actual interest that I'm going to pay to the bank is actual interest is going to be 1 lakh into 12 percentage. Yes, it is for 1 year. It is going to be 12,000. Yes or no, everyone? But tell me. Insurance company had promised me that boss, if you pay me a premium, na, I will protect you. Your interest will not exceed 8 percentage. Tell me, did it exceed 8 percentage? Yes, boss. How much percentage did it exceed? 4%. So I will go crying to the insurance company. Boss, you gave me a promise that it will not exceed 8 percentage. It has exceeded. Now it is 12 percentage. Na extra amount, give it to me. So they will be paying me that extra amount of 4 percentage. I will receive the payoff from the insurance company. 1 lakh into 4 percentage, 4,000. Yes or no, everyone? So tell me my net cash flow. 12,000 I paid, 4,000 I received. That means the net is 8,000 plus 500. So the net amount incurred is 8,500. Yes or no, everyone? Look at this. First, I will show the actual interest payable. Next, I will show the payoff from the call option, 12,000, 4,000. Then I will show the premium paid. That gives me the total interest cost. Is this clear, everyone? Perfect. Now, how do we calculate the payoff? Yes, I've told you logically how to do, or else, yes, borrower means it is a call option. I'm having a call option. If it crosses 8 percentage, I will exercise. Here, boss, it is 12 percentage. That means the difference is going to be, yes, it has crossed 8 percentage. We will exercise. Payoff is going to be 4%. 1 lakh into 4% into 1 year, it is going to be 4,000 rupees. Second situation, if the interest is 6%, tell me upfront I am paying a premium. Okay, actual interest is 6 percentage only. It means actually I am paying 6,000 only. Tell me, will I be receiving any compensation from insurance company? What they told, it will not cross 8%. Did it cross? No. Will they pay me anything? No. That means I am paying 6,000 as well as 500. I am paying 6,500. Is this clear, everyone? Concept 1, interest rate guarantee is over. Altogether 3 cash flows. First one, I am having the premium that I am paying. It is my cash outflow. Next one, I am having the actual interest payable at the actual rate. This is also my cash outflow. Third one, I will be having the gross payoff from the call option. It is my cash inflow. Yes. Based on this, we will be getting the total interest payable. Is this clear, everyone? Now we are having for long-term loan. That is, I am having multiple reset. Yes, we are having caps and floors. Sir, what exactly is cap and floor? Boss, it is call and put option only. But just that there are multiple reset dates. Understand, students, if I'm taking a short-term loan, only a single reset date, it means only one time I am exercising. Say, for example, I am having a 5-year loan at LIBOR. Yes, I also purchased a call option at a strike rate of 10 percentage. That means if I'm having a normal call option, means one time only I can exercise. Yes or no, everyone? Suppose here it is 12%. I can exercise. Boss, it exceeded 10 percentage. Means I want to exercise and receive a gross payoff of 2%. But boss, mine is a long-term loan. Multiple reset is there. That means I don't want a single call. I want a series of call. It is called as a cap. Is this clear, everyone? What is a cap? It limits the maximum interest we are putting. Cap we are putting on the head. Maximum, this much only we are paying. Yes, it is going to be for the borrower. It is similar to your call only. It is just called as cap. Floor is nothing but a series of put option. Is this clear, everyone? Now, how do we do calculations in this? Before that, we need to be knowing one more thing. First is cap. I've told it is a series of call option. Next is floor. It is a series of put option. Yes. Next, we also have something called as a collar strategy. What is collar strategy? Borrower is there. Borrower wants to buy a call option, which is a cap option. Yes. Why? Because he wants to limit the maximum interest he wants to pay. But boss, when you're paying, you're buying an insurance, now you'll have to be paying a premium. So we are telling boss, I am paying a premium. Is there any way I can reduce this premium cost? Boss, do one thing. Yes, here you are the option buyer. Do one thing, try selling another option. Try selling a floor option so that whatever premium you're paying here, to a good reasonable extent, you can compensate it. So in collar, what we are doing? I am buying a cap plus selling a floor. What is the strategy? What is the intention? In detail, I've told. But here, simple. Yes, here I am paying a premium. Here I will receive a premium. So net to net basis, my premium cost gets reduced or nullified. Is this clear, everyone? Now comes the most important calculation. How do we calculate? Yes, that is going to be very important. Yes, for that, one thing we should be knowing is going to be the interest reset date as well as the interest payment date. Interest reset date, it is a date on which interest rate is locked. Say for example, today you take a loan. Today itself you will get to know what is the rate of interest. Tell me, are you paying today? No, you will be paying on the next due date. Say for example, you are taking a 1 month loan. Yes, every month you are paying EMI. That means next month you are paying. That is your payment date. Is this clear, everyone? Okay. Directly through an example, let us try solving type 1. Now, all questions here we have bifurcated into three different types. Type 1 is basic questions on cap and flow. Type 2 is collar strategy. Type 3 is show how much the interest rate risk is hedged. Type 1 question, let us try doing. Very simple question, students. Look at this. Maja Limited took a 1 year loan of 1 lakh rupees with interest linked to 3-month LIBOR on 31st December 2026 at LIBOR plus 1%. So tell me the actual interest is how much? LIBOR plus 1% with resetting of coupon every 3 months. Every 3 months, the coupon will be reset based on the LIBOR. Okay, boss. It also buys a cap option at a strike rate of 10%. That means I've purchased a call option at 10%, pays a premium of 1%. Actual LIBOR rates are given here. Okay, crazy. You're asked to calculate the total premium payable and the effective interest paid on every payment date. Simple. First, they're asking total premium payable. How much premium I am paying to get a call option? 1%. So I'll be paying 1 lakh into 1%, 1000 rupees premium. Is this clear, everyone? Now, the different interest rates are given here. LIBOR rates. Look at this. 31st December, 31st March, 30th June, 30th September, 31st December. Generally, in the question, the last date will not be relevant. Why, sir? Now, look at this. Did I draw it? I did not draw it. Okay, fine. Let me draw it here. Pay attention. Yes, today I am taking a loan. When am I taking a loan? 31, 12, 26. Today, what is the interest rate? 10%. That means today I'm telling boss, till the time interest rate gets changed, my interest rate is going to be 10%. When will it be changed? Next quarter. Yes. When is it? 31/3. On that day, what is the interest rate? 12%. So what we are telling boss, your interest rate is 12% from today. We are asking till when? Till that next quarter. So for the next quarter, my interest rate is 12%. Then after that comes 30th June. Yes, banker is telling boss, today the LIBOR is 13%. So your reference rate is going to be 13%. Yes or no? I'm asking till when? Till the next quarter. Okay, then comes 30th September. Yes, on that particular day, the LIBOR is 5%. So telling boss, for the next quarter, your reference rate is going to be, yes, 5%. We are asking till when? Till the next quarter. Then comes the last date, 21st December. Banker is telling boss, today your reference rate is 7% for any amount you are paying in the future. Tell me, I took a 1 year loan. Yes, I took a loan on 31st December. Yes, I am repaying the complete loan on 31st December. So after this, is there any amount pending? No. That means, is there any relevance of this rate? Is this clear, everyone? Now, how do we solve this? Simple. Yes, we have bifurcated into 8 different columns. That also how to remember. I've told you 3 different segments. Segment number 1. Yes, this is how we will calculate also. We will first write down the reset date. When is the interest rate getting reset? We will write down the reference rate, which is basically the LIBOR rate. Here question has given 4 quarters. I will write down. Then I will write down the actual interest rate. Tell me, students, this is my LIBOR. Whether interest I'm actually paying at LIBOR? No, boss. Interest I'm actually paying at LIBOR plus 1%. So accordingly, I will write down the actual interest rate. Look at this. 31st December, the LIBOR is 10%. That means I will be paying 10 plus 1, 11%. Similarly, for every quarter, I will first finish off this segment 1. Then I will go to second segment. Second segment, I will write down the interest payment date. Tell me today, 31st December, the interest rate is locked. When are we making payment? Yes, for every quarter it will be reset. That means the next quarter on 31st March, I will be making payment. So I will write down 31st March. 31st March, new interest rate I got. When will I be making payment? 30th June. Accordingly, I will write down the interest payment date. Yes or no? Yes. So let me also calculate the number of days for which I am making payment. Yes, from 31st December till 31st March. Yes, January 31, February 28, March 31. I am having 90 days. So based on this, I will show the actual interest payable. It is my cash outflow. Tell me, I will show my principal amount 1 lakh into what is the actual interest rate. Do not take the reference rate. Actually, how much I am paying? LIBOR plus 1%, 11%.
For how many days? For 90 days into 90 divided by 365. Similarly, next quarter, 1 lakh into 13 percentage into 91 by 365. Similarly, I will keep on doing. Segment 2 is also over. Now comes segment number 3, wherein I will show off the payoff from my call option and the net interest pay. Tell me, students, I have purchased a cap, which is basically a call option, a strike rate of 10 percentage. That means I will write it this way. I am having a call 10%. So if it goes above 10 percentage, I will exercise. Now comes the most important thing. I should compare 10 percentage with what? I will be comparing 10 percentage with the reference rate. Yes or no, everyone? Yes, my risk is in the LIBOR. LIBOR plus 1%. Plus 1% in any case I have to do. No insurance company can protect me from that. Risk fluctuation is in LIBOR. So protection is for LIBOR. Call option is for LIBOR. I will be comparing with LIBOR only. Yes or no, everyone? So I will be comparing it with call option. I'm having a 10 percentage. Tell me, in this case, it is 10%. Will I exercise? No, 0. Is 12%. Will I exercise? Yes, boss. 2 percentages appear. 13. Will I exercise? Yes, boss. 3 percentages appear. Will I exercise? No, 0 is appear. Tell me, now I will do the calculation. 2 percentage I calculated. It is on the loan amount. So I will tell it is going to be 1 lakh into 2 percentage. It is the gain. Yes, per annum. Yes or no? I am doing for how many days on? 91 days on into 91 divided by 365. Similarly, I will be doing yes or no. Now remember, I have purchased a call option. Logically understand, students. Simple. Yes, I took a call option wherein insurance company promised me that was your interest will not cross 10 percentage. In reality, your interest is 12%. So for the banker, you will be paying 12 plus 1, whatever it is. Yes or no, everyone? Tell me, from the insurance company, you will be receiving the additional amount you paid. Yes or no, everyone? So this one is cash outflow. This one is cash inflow. You reduce it, you will arrive at the net interest cost. Yes or no, everyone? Yes, 3241 minus 498. I will arrive at the net interest cost of 2742.47. Yes or no, everyone? Is this clear? Perfect. Now, in case of collar strategy, one more column gets added. Everything else is same only. One more column gets added. Yes, here look at this. First three same, next three same. Cap payoff is also same. In collar strategy, what extra we are doing? I am selling a floor. I am selling a put option. Why? Because I want to receive some premium amount. Yes or no, everyone? Tell me, in this example, we are having a put option at 6 percentage. So look at this logically. This is going to be important. We will commit mistake here. When is put exercise? If it goes below 6 percentage, I will be comparing the reference rate, that is LIBOR. Did it fall below 6%? No. Did it fall below 6%? Did it fall below 6%? Did it fall below 6%? Yes. That means put option will be exercised. Payoff is going to be how much? 1%. I wrote payoff is going to be 1%. Accordingly, I will do calculation 1 lakh into 1% into days 252. Now understand what is happening. I am a borrower. So first interest I am paying to the bank. It is cash outflow. I had a fear of rise in the interest rate. So I purchased a call option. So in case of adverse situation, that compensation I will be receiving from the insurance company. Yes. Third one, I wanted to receive some premium as well. So what I did, there was another investor. For him, I acted as the insurance company. I told boss, I am giving you a floor. Bare minimum this much, bare minimum 6% you will be receiving. So I am the insurance company here. In case of adverse situation, last situation, this is an adverse situation. LIBOR is 5 percentage only. Yes or no, everyone? So he will be asking for a compensation. So what I should be doing? I should pay the compensation. It is going to be cash outflow. Is this clear, everyone? Yes, I'm explaining it fast. Still, I am telling you guys the logic. If you feel it is fast, you guys can accordingly reduce the speed, or else boss you can purchase the classes. Simple. Is this clear? This is supposed to be just a revision. Okay, so this is cash outflow, this is cash inflow, this is cash outflow. That gives me the effective interest. Perfect. Sometimes question will tell, calculate the overall effective interest rate per annum. Simple. You add all the interest, you will get the total interest. Yes, you can see total interest is for total how many days. Yes, accordingly you will calculate it on per annum basis. Is this clear, everyone? So look at the format. Yes, all in all, maximum 9 columns could be there. 3 segments.
Segment 1, you will write down the reset date. You will write down the reference, which is a LIBOR rate, and actual interest rate, which is basically LIBOR plus whatever the spread question has given. Segment 2, you will write down the interest payment date. Based on that, you will see the number of days for which interest has to be paid. You will calculate the actual interest payable, which is the cash outflow. Segment number 3, you will show the cap payoff. Yes, cap is basically call. You will write it this way, call 10 percentage. Yes, if you are receiving a payoff from cap, it is a cash inflow. In case of collar strategy, you would have sold a floor. So in case of collar strategy only, this will also come floor payoff. Yes or no? It is a put option 6% down. Yes, here I am acting as insurance company. So in case of adverse situation, I should be paying compensation, cash outflow. Yes, I will show the effective interest cost, which is basically interest payable plus compensation payable on floor minus compensation received on cap. Is this clear, everyone? Perfect. Now we are left with the final type of question, which is a type 3 question. Show how much interest rate risk is hedged through option. Very simple question. Two steps only we should be doing. Step number 1 is allocation of option premium. Question will tell you the total option premium that I'm going to pay. Say for example, question is telling I'm going to pay an option premium of 1 lakh rupees. I should allocate it to every period. How do I do it? Simple. It is the total option premium paid divided by present value annuity factor. Then step number 2, I will calculate the net payoff on every interest payment date, which is basically gross payoff minus option premium. Directly we'll come to the workbook and look at this example. Pay attention, students. Look at this. Maja Limited takes a 1 lakh floating loan on 31st December 2026 with LIBOR plus 1%. Okay. With resetting of coupon every 3 months. Okay. It also buys a cap option at a strike rate of 10%. Cap I'm having 10%. Pays a premium of 1%. Okay, 1% premium I'm paying. Yes, the actual LIBOR rate is given. Yes, the fixed interest rate is 8%. Yes, you're required to show how far the interest rate risk is hedged through option. If question gives you this wordings, show how far the interest rate risk is hedged through option. That means I should be calculating the net payoff. Now understand, there is one simple challenge. Now understand, students, here. Premium, when am I paying? At the start of the contract. Tell me how much is the premium? 1 lakh into 1%. 1000 premium I am paying here. But tell me gross payoff every period based on the actual interest rate. I will be having my gross payoff. So my gross payoff will be in these period. Yes or no? So if I have to calculate my net payoff, which is basically gross payoff minus premium, I want premium also for each of this period. But boss, premium I'm having here na boss. How do I distribute it? Simple, in advanced capital budgeting, I've told how to calculate equivalent annual cost. It is cost divided by present value annuity factor. I'm not explaining much. Simple, what I will do, I will take 1000 rupees divided by present value annuity factor. I will be doing simple logical explanation is this is 1000 for 4 period I have to distribute, so it is going to be 1000 divided by 4, 250. But boss, this is in terms of present value, so take present value of 4 period, so divide by present value annuity factor. You will be getting it as 1000 divided by present value annuity factor. To take present value, question has given you the fixed rate. Using this you take, its factors are given. Using this you will be getting allocation of option premium. Present value annuity factor is 3.807. Accordingly, allocation of option premium is 263. That means for every period the premium is 263, 263, 263, 263. If you want to bring all these cash flows to present value, you will be getting 1000. Is this clear? Step 1, yes, allocate option premium. It is a total option premium divided by present value annuity. Once you have done this, now it is simple. I will calculate the net payoff at every day. Simple. Tell me, students, here, if the LIBOR is 10%, I am having a call at 10%. So if it crosses 10%, I will exercise. Here will I exercise? No. Here will I exercise? Yes. 2% I will get. Here will I exercise? Yes. 3% I will get. Here will I exercise? No. So accordingly, I can arrive at my gross payoff. Simple. Look at this. Reset period I have written. Yes, reference rate I have written. Gross payoff in terms of percentage I have written. Yes or no? Yes, how much it is? 2% means 500. This. Yes, but premium I have paid. So net payoff, it is gross payoff minus premium. I will arrive at my net payoff. Is this clear, everyone? With this, the entire concept, yes, which is entire unit interest rate options is done. Yes, concept number 2, yes, which is caps and floor is very important from examination, considered to be difficult. We have made it very simple. Ultimately, 3 types of question. Type 1, basic question. Type 2, in case of collar strategy. Type 3, show how much interest rate risk is hedged. Step 1, allocate option premium. Option premium divided by present value anti-factor. Step 2, calculate net payoff at every date, which is basically your gross payoff minus the premium paid. With this, unit number 3 is done. Giving you guys a minute to take a break, pause, let this sink in. Then we'll be going ahead to the final unit number 4, which is interest rate swap. Yes, everyone. Now we have one final unit number 4, which is going to be interest rate swap, my dear warriors. The entire chapter till now we have made it halwa, even though it is just a quick rocket revision. Now we have one final unit, which is unit number 4, swap. Swap in simple terms means exchange. Very simple example. Imagine. I am having an iPhone. I don't like the iPhone. Yes, Koti, our legend student, he is having a Samsung phone. He doesn't like Samsung phone, but I like Samsung phone. So what we can do, we can swap, exchange. Yes or no, everyone? Simple essence of swap. I have something that I don't want, but you want. You have something that you don't want, I want. In that case, we can be going for a swap. Yes or no, everyone? Now understand what is happening in case of interest rate. I have taken a loan at fixed interest. I don't like this for some reason. You have taken a loan at floating interest. For some reason, you don't like. That means if there is a need, we can swap the interest. Is this clear, everyone? That is going to be essence. One party has taken a loan at fixed interest, other party has taken a loan at floating interest. They don't want, they can swap this. Is this clear, everyone? Now, what all different types of interest rate swaps are there? From exam perspective, we are having majorly two swaps. First is the plain vanilla swap, also called as the generic swap. Then we are having the overnight index swap. Now, plain vanilla swap is the simplest form of swap wherein one party is paying the fixed interest, other party is paying the floating interest. Both of them agree for a swap. Yes, we will be doing a net settlement. We will see how much is the interest payable by the fixed rate payer, how much is the interest payable by the floating rate payer. Yes, the difference amount we will be setting. Say for example, fixed rate payer has to pay 1000, floating rate payer has to pay 800 only. Now always understand, yes, in a swap, I am paying one means I am receiving the other. I am giving my iPhone means I am receiving Samsung phone. Fixed rate payer, he is paying fixed interest, he is receiving floating. Floating rate payer, he is paying floating interest, he is receiving fixed. Is this clear, everyone? So if I am a fixed interest payer, suppose the fixed interest payable is 1000. Suppose the floating interest payable is 800. So what I will tell, boss, I'm a fixed interest payer. Yes, I am paying. I want to pay in the swap 1000 rupees interest. But boss, I will be receiving 800 also now. That means net how much fixed interest payer has to be paying? 200 rupees. Same calculation if I'm doing from the perspective of floating rate payer. What floating rate payer will tell? He is telling, boss, I have to be paying 800. That means I have to be receiving 1000. That means net I will be receiving 200. Is this clear, everyone? Simple. I will take the interest payable by fixed payer. I will see the interest payable by floating payer. Difference will be the net settlement. One very important thing. How do I calculate interest? Because it is the notional principal into the interest rate into T, which is the time in years. But here, a very important trade practice comes into play. Whenever you are paying a fixed rate, now fixed rate is always taken based on 30 divided by 360 basis. That means we will always assume 30 days in a month and 360 days in a year. Suppose it is for 6 months, I will take, okay, 30 into 6, 180 days divided by 360. But my floating interest, na, it is always taken based on actual divided by 360. That is, I will take the actual number of days in that 6 months divided by 360. Suppose actual number of days is 182, so I'll be calculating interest for 182 days out of 360. Is this clear, everyone? Simple. Directly we'll come to workbook. We'll have a look at the example. Suppose a dealer quotes all in cost for a generic swap at 8% against a 6-month LIBOR flat. Yes. Understand, I am having a loan at floating interest rate, LIBOR. I am having a fear that LIBOR will go up. So I go to bank. Bank is telling, boss, I am giving you a swap at an all-in cost of 8%. That means you pay me 8%. Enough. End of the story. I will take care of your loan. Is this clear? If the notional principal amount of the swap is 1 lakh, is first calculate the semi-annual fixed payment. Semi-annual fixed payment. Semi-annual I have to be calculating, and question below is telling, yes, consider 180 divided by 360 days. Yes or no, which is basically 30 divided by 360. Tell me fixed payment. How much is the loan amount? 1 lakh. How much is the fixed rate? 8%. But boss, it is per annum basis. I should be calculating the semi-annual fixed payment. Tell me fixed payment is always based on 30 divided by 360. 1 month is 30. That means 6 months is going to be how much? 180 divided by 360. It is coming to how much? 4,000 rupees. Yes or no? Yes or no, everyone? Okay. Second requirement. Calculate the floating rate payment if the 6 month LIBOR comprises of 181 days and the corresponding LIBOR is 7% on the date of swap. Tell me floating payment is going to be how much? 1 lakh into the floating rate. Floating rate is how much? 7%. Tell me floating payment is always based on actual divided by 360. Actually, in that period, how many days are there? 181 days are there. So into 181 divided by 360. Yes or no? Which is basically going to be how much? 3519 rupees. Yes or no, everyone? Tell me. Then we'll have to calculate the net settlement amount. Tell me interest payable by fixed rate pair is how much? 4,000. Payable by floating rate pair is how much? 3519. Now understand, fixed rate pair is telling, boss, I have to pay 4,000. I am paying something means I am receiving the other thing. I will be receiving 3,519. That means net how much I should be paying? 4,000 minus 3,519, which is going to be 481. Who has to pay? Fixed rate payer has to be paying. Yes or no? I will take the difference amount 481. Then I will see who has to be paying. Was fixed rate payer has to pay 4,000. He is receiving 3,500 something. That means a net. Yes, 381 he will be paying. Is this clear, everyone? Perfect. Yes. Any other situation also we can be doing it here. This is what we have shown it here. Then comes overnight index swap. It is same as your plain vanilla swap. That is, one party is fixed pair, other party is floating pair. The only difference is floating interest. I will be calculating based on the overnight rates, which is the daily interest rate. And floating payment, we will be compounding daily. Is this clear, everyone? This is how my format is going to look like. Step 1, I will calculate the floating interest payment. I will write down the day. I will write down the floating interest rate. I will write down the opening balance, add interest, closing balance. Always know that it is based on the overnight rate. So interest will be added only for one day, except in case of Saturday, because Saturday's interest is applicable for Saturday also, Sunday also, because Sunday is off. There is no overnight rate for Sunday. Yes or no, everyone? Floating rate of Saturday is applied for 2 days, which is Saturday as well as Sunday. Is this clear, everyone? Look at this example question. Yes, Maja Bank entered into a swap on a principal of 1 lakh and agreed to receive a MIBOR overnight floating rate for a fixed payment of principal. Swap was entered on 1st January and was to commence on 2nd January for a period of 5 days. Simple. You need not see the story at all. Question will tell you Thursday to Monday. You write down properly. Thursday, Friday, Saturday, Sunday will not be there. Monday. Is this clear? Interest rates are given 8.5, 1, 2, 3, 4. Thursday to Monday. This is Thursday, Friday, Saturday. Sunday is not there. Monday. Yes, I will write down these things. Now I will write down what is the opening balance, 1 lakh. So look at this, 1 lakh. On Thursday, I will tell 1 lakh into 8.5% into 1 by 365. I will arrive at my interest. Opening balance plus interest, I will arrive at closing balance. For the next day, 1 lakh 23 is the opening balance. On that, I will charge 7.75% interest for one day. I will arrive at the closing balance. Saturday, my opening balance is 1 lakh 44,000. I will be adding interest 1 lakh 44 into 8.25%. Wait, Saturday's interest rate is charged on Saturday also, Sunday also. So into 2 by 365. Yes, 45. That gives you the closing balance. Accordingly, do it for me. Is this clear, everyone? Tell me, opening balance was 1 lakh. At the end of the period, closing balance is 1 lakh 113. That means the total interest is going to be 113. Is this clear? This is the interest payable by floating payer. Now, question is telling, if the fixed interest rate is 8%, calculate the net settlement amount. Tell me, floating payer has to pay 113. Okay. How much interest fixed payer has to be paying? Simple, boss. It is 1 lakh into fixed is 8% into how many days was there? 5 days. Thursday, Friday, Saturday, Sunday, Monday into 5 divided by 365. It is 110. So floating payer has to be receiving 113. Yes. Payable by fixed is going to be 110. That means the net amount receivable is 3. In this case, look at this, students. Question is telling, yes, Maja Bank, we entered into a swap and agreed to receive my bar. I am receiving floating against fixed. I am paying fixed. So I will receive 113 I am paying 110. That means on a net basis, I will be receiving 3 rupees. Is this clear? This is one type of question. Another type of question is more common, wherein what they will do is they will tell me the net amount receivable or payable. I should calculate the fixed interest rate. Whatever is not available, I will assume it as X. Look at this, students. Situation number 2. Yes. If Maja Bank received 10 rupees net on settlement, then calculate the fixed rate. Is this clear, everyone? Here also, step 1 is going to be same only. I will calculate the total interest on floating rate. Fact, I got it as 113. Step 1 is same. Now I will go to step number 2. Tell me, students, we are Maja Bank. What is our agreement? We promised to receive MIBOR floating rate. I will be receiving floating. That means I will be paying fixed. Yes or no, everyone? Tell me, I am receiving floating. Receive floating. Tell me how much is the floating interest I received? 113. That means I will be paying fixed. Perfect, everyone. Tell me, as a result of this transaction, what happened? I received 10 rupee net settlement. Net 10 rupee profit I had. That means tell me I received 113. How much only I paid? 103 only I paid. Yes or no, everyone? No need to unnecessarily complicate. Profit means do minus, loss means do plus. Was simple, logically do it. What is happening in the story? Okay, I am receiving floating. 113 I received. That means I am paying fixed. How much fixed I am paying? I don't know. But boss, net profit is 10 rupees. That means less only I should have paid. Yes, 103 only I have paid. Tell me now, 103 I have paid. Yes, fixed payment is nothing but principal into rate into T. Yes or no, everyone? 1 lakh into X percentage into 5 divided by 365. It is going to be how much? 10 rupees. Simplify, we will arrive at X is equal to 7.52 percentage. Is this clear, everyone? Yes. Now, remember, students, look at this. Here we have done. Yes, floating interest rate is compounded daily. Step 1, calculate floating interest payment. Day, floating interest rate. Opening interest, closing balance. Yes, Saturday, I will be putting interest for 2 days. Okay. Step 2, calculate net settlement amount. What is a fixed interest? What is a floating interest? Accordingly, logically, I will calculate the net settlement amount. If the fixed rate is missing, plus net settlement amount is available, okay, assume fixed rate is equal to X% and accordingly solve the question. Is this clear, everyone? One very important thing. Yes, this assumption that fixed leg is for 30 by 360 and floating leg is for actual by 360, it is only for my plain vanilla swap. Yes, in your overnight index, don't do that. Is this clear, everyone? Perfect. So here, whatever they are doing, that way only will be doing. Is this clear? This is something that comes with practice, my dear students. Now we are having the final concept, which is designing a two-party swap contract to reduce the cost of borrowing. Giving you guys a minute to let this sink in, then we'll be going to the final segment, my dear warriors. Yes, everyone. Now we are left with the final concept, which is designing a two-party swap contract to reduce the cost of borrowing. Simple thing. Remember this golden principle. Always borrow the opposite type of the loan than the one you actually desire in case of swap. Let us try understanding it directly through example. Students consider it to be very difficult. Trust me, it is the simplest thing in the world. When a question comes for 8 marks. Trust me, there cannot be anything simpler than this. Look at this. Item Limited and Bomb Limited can take loans at the following interest. Item Limited, Bomb Limited, if they are going for fixed rate loan, this is the interest rate. If they are going for floating rate loan, this is the interest rate. Now, Item Limited wants to borrow at floating rate. Tell me, Item Limited wants to borrow at floating rate. That means LIBOR plus 0.5 percentage. Yes or no, everyone? And Bomb Limited wants to borrow at fixed rate. Bomb Limited wants to borrow at fixed rate, which is 10.5 percentage. Yes or no, everyone? Okay. Amount of loan required by both firms is same. Financial institute may arrange a swap and require 20 basis points as a commission. Gain, if any, will be shared equally. Yes. Determine whether a beneficial swap can be arranged. Tell me, simple principle we have told. In a swap, I will be borrowing opposite loan than the one I actually desire. If I want A, I will not tell A, I will tell B. Is this clear, everyone? Perfect. Now look at this. What is our desire? Item Limited wants to take a floating rate loan, which is LIBOR plus 0.5%. Bomb Limited wants to take a fixed rate loan, which is 10.5%. So if they take a loan as per their desire, what is the total interest rate? L plus 0.5 and 10.5. So the total interest rate is L plus 11%. Yes or no? So if I take as per my desire, the total interest is LIBOR plus 11%. Wait, what we are telling? Boss, go against your desire. Tell me if you're going against your desire. Tell me item limited wants to take a floating rate loan. We are telling don't take floating, take fixed. 9%. One wants to take fixed, don't take fixed, go for floating. In that case, how much is the interest? LIBOR plus 1%. Here it is 9. So your total interest becomes how much? LIBOR plus 10 percentage only. Yes or no, everyone? Perfect. Tell me previously my total cost was how much? L plus 11%. Now my total cost is how much? L plus 10 percentage only. That means how much cost we have saved? 1% cost we have saved because of swap. Yes or no, everyone? This is the total gain on swap. Tell me, can we do party in the total gain? No, boss. Why? There is a party which has arranged for the swap. For them, I should be paying a commission. How much commission they're asking? 20 percentage, sorry, 20 basis points, which is a 0.2 percentage commission I will be paying. That leaves us with the net gain of 0.8 percentage. Tell me, this is a gain for two parties, item limited and bomb limited. How we should be distributing the commission? Equally. So 0.8 percentage I will distribute equally. Every party will be getting a benefit of 0.4 percentage. Is this clear? This is my step one. Check if a beneficial swap can be arranged. I will write down the total interest rate if we take the loan directly, that is no swap, minus total interest rate if we go for the swap, that is take a opposite loan. I will arrive at the total gain minus commission. I will arrive at the net gain. If my net gain is positive, that means I can go for a swap and reduce my cost. Is this clear, everyone? Now comes the next point. Yes, calculate the effective interest rate. It is also very simple. Tell me what is the effective interest rate. Tell me item limited. Ultimately, what loan only they want to take? They want to take floating rate loan. If they had taken the floating rate loan directly by themselves, how much they had to pay? LIBOR plus 0.5 percentage. But tell me they went for a swap. In swap, how much gain they got? How much interest they saved? 0.4 percentage they saved. That means what is the net interest cost? LIBOR plus 0.1 percentage. Bomb limited is there. Telling me what interest only they want to take, fixed interest rate only they want to take. But if they had taken directly in a boss, they had to pay 10.5%. But boss, they strategically went for a swap. Yes, in swap, how much benefit they got? 0.4%. That means effectively how much only they are paying? 10.1%. That is going to be the net interest rate. Is this clear, everyone? So much complications you can be doing, but this is the simplest way. What is the loan I want to take? What is the rate? But boss, I went for a swap, so I got a gain. That means what is my net interest cost? Is this clear, everyone? Look at this. Yes. Step one, check if a beneficial swap can be arranged. Total interest rate if party go for loan directly, that is there is no swap, minus the total interest rate if parties go for the swap, that is take the opposite loan. I will arrive at the total gain minus the commission. I will arrive at the net gain. Simple. If net gain is positive, means the beneficial swap can be arranged. Yes, net gain is shared in the ratio specified in the question. If ratio is not specified, we will assume that it is shared equally. Okay. Then step 2, calculate the net interest rate on the loan. Here be careful. Yes, here I will tell, okay, if I had taken a loan directly, how much is my interest rate? That is interest rate if loan is taken directly. But boss, I went for a swap. Because of that, I got a swap gain. Minus my swap gain, I will arrive at the net interest cost. Is this clear, everyone? Yes, the example similar to the one that we have solved. It has come 2-3 times in the examination. For 8 marks, it has come. Trust me, students, it is going to be one of the simplest. Then we have one crazy question here. Look at this. It was there in study material as well as RTP. Quickly, I will try telling that one as well. Pay attention. Very simple. A incorporation and B incorporation intend to borrow $2 lakh and $2 lakh in yen respectively. That means A incorporation wants to take a loan in dollar. B incorporation wants to take a loan in yen. Yes or no, everyone? Tell me, A incorporation wants to take a loan in dollar. B incorporation wants to take a loan in yen. So if they directly take a loan, how much will be the total interest cost? 9 plus 8, 17. But boss, we will go for a swap. Take the opposite loan. That means 5 plus 10, 15. That means what is the total gain on swap? 2 percentage. Yes or no, everyone? Now, how this gain is distributed? Question did not help. Either logically we can do a long procedure and arrive at the gain, or else I've told you a simple shortcut also, that you can assume that commission is 0 and the gain is distributed equally. That means both the parties are getting 1%, 1% gain. That is a simple shortcut in this question. Okay. Yes, not logical, but you will arrive at the answer. Now, logical, let us try seeing what is happening. They entered into a currency swap. under which it is agreed that B incorporation will pay A incorporation at 1% over the loan interest rate, which the latter will have to be paying. Yes, whereas A incorporation will be reimbursing only to the extent of 9%. So nothing we understood. Don't worry. Slowly let us try doing this. Everything will fall in place. Now, pictorial representation we have done. Yes, A incorporation is there. Tell me what is the desire they are having. They want to take a dollar loan. B incorporation is there. What is the desire they are having to take a yen loan? But tell me in swap, in reality with the bank, will we take the loan of our desire? No, boss, we will be taking the opposite loan. Yes, A's desire is dollar. That means in reality, they will be going for a yen loan. Tell me yen loan is available at 5%. So to the bank, I will be paying 5%. Is this point clear? From bank, I will take a yen loan. I will be paying 5%. Okay. Tell me B incorporation wants to take a yen loan, but from the bank, will they take yen loan? No, they will be going for a dollar loan. How much percentage they are paying? 10% they are paying. This is this 10%. First leg is over. Absolutely no problem. Now comes the swap. Because they have paid to the bank, they will be getting reimbursement. Now, how much reimbursement they are getting? Look at this line. B incorporation will pay A incorporation at 1% over the yen interest rate loan which the latter will have to pay. Tell me B will pay A how much? 1% over the yen loan which the latter, which is A, will have to be paying. Tell me A from the bank has taken a yen loan at what rate? 5%. When B is paying, it will pay 1% extra. So how much it will pay? 6% it will pay. Yes or no, everyone? Tell me B will pay A 6%. Okay, fine. Now, yes, whereas A incorporation will reimburse interest to B incorporation only to the extent of 9%. A will pay B. How much only? 9% only. So A will pay B. How much only? 9% only. Even though the loan is at 10%, he is going to pay 9% only. Now, let me try calculating the effective interest cost. Look at this, students, from A's perspective. He paid 5% to bank. He paid 9% to B. What was he received 6% from B? So 5 plus 9 is 14 minus 6. It is going to be 8%. Yes or no, everyone? Tell me from the perspective of B. He paid 10% to bank. He paid 6% to A. So total he paid 16%. But boss, he received 9%. His net interest cost is 7%. So accordingly, we arrived at the net interest cost. Now, yes, this one I will be finally converting it into amount terms. So look at this. Finally, I will be converting. Yes, A incorporation. Ultimately, I want to borrow in dollars. So my ultimate cash flow will be in dollars. B, ultimately, I want to borrow in yen. So my ultimate cash flow will be in terms of yen. Tell me, I have calculated the total benefit we will be getting. Tell me, A incorporation, if I take a loan directly, na, my cost will be how much? Yes, A incorporation, if I take a loan directly, it will be 9%. But boss, because of swap, how much only I am paying? 8%. That means how much is my gain? 1% is the gain. Same for B. B incorporation wants to take in yen. If I take directly, it will be 8%. But boss, because of swap, my interest cost is 7% only. So 1% I saved. Yes or no? I want to know how much is the benefit in monetary terms. Simple, boss. My loan is of 2 lakh. Yes, benefit is going to be 1%. So in dollar, my loan is a 2 lakh dollar. 2 lakh into 1%. The gain is going to be 2 lakh dollar. Is this clear? Sorry, $2,000. Perfect. Now tell me, A incorporation wants ultimately everything in dollar. A incorporation got it in dollar. But boss, B incorporation wants it in yen. So I should convert into yen. Very simple. Tell me, question has given me $1 is equal to 120 yen. That means $2,000 is equal to how much? 2,000 into 120, which is going to be 2,40,000 yen. Is this clear, everyone? This is the simplest an answer can be. You see the institute's question, they have made it such a big mess. We've simplified it to the maximum possible extent. Again, I told, if this one feels to be difficult for you guys, I have told you one more shortcut, which is not logical, but you can remember and do it. Tell me, students, if I'm taking a loan directly, look at this, everyone. Yes, what is A's desire? A is there, B is there. Yes, what is the original loan if I take a loan directly? Yes, A if it takes loan directly 8%, B if it takes 7%. Sorry, 8 and sorry, 9 and 8 percentage. Yes or no, everyone? Tell me total swap gain, total benefit from the swap was 2%. I told distribute equally. Means benefit is 1% to 1%. That means your net interest cost should be 9 minus 1, 8%. 8 minus 1, 7%. This only I got logically also after doing all of this. Yes or no, everyone? Perfect. Everything we have tallied, my dear students. So with this, yes, considered to be one of the most difficult chapters, interest rate risk management. Now understand, first there is the regular class. Then slightly less duration is exam oriented. Slightly lesser duration is fast track. Slightly lesser duration is going to be the detailed revision. And finally comes the rocket revision. Rocket revision, it is just supposed to be you're just telling the things. This one at the end of the chapter, it is supposed to be a rocket revision for the students who purchase the classes. But we will also be uploading it on YouTube. So I hope you guys have understood things logically. But if any point in time you felt it is a bit fast, boss, it is a rocket revision. On the assumption that you've learned, on the assumption that you've revised, you're just seeing it for a quick glance. On that basis, at so much fast we are explaining. So I genuinely hope that you guys have understood things. And I know that if you have at least learned the chapter once, you would have understood. Yes, you would have understood in a simple way. But if you are watching it for the very first time, you don't know what is IRRM, only you are coming here directly, means it would be very fast for you. It is something we cannot be helping it. Is this clear, everyone? So I hope you guys have thoroughly enjoyed. So see you guys some other day for some other session. Until then, keep studying, keep smiling, keep working hard, keep making your parents proud, and take care. Bye.